Of sectors in negative territory this morning, and consumer products and services at the bottom of the basket, down more than 1%. That's the biggest mover in terms of the sectors. Just in terms of a few of the things that we'd flagged before the open, Renault raised to investment grade by S&P. That's seeing gains of 0.8%. I'd said to keep an eye on the delivery stocks. DHL up more than 1% after you saw FedEx beating estimates, but not all of the names in that basket really making gains. The Austrian postal company, in fact, down 0.7%. We're waiting for Puma and Adidas at the moment, and then BBVA was another one that I had flagged because of the buyback news, and actually they are up 0.7% at the moment. Anna.
Yes, I guess you might expect on the buyback. So yes, waiting for some of those sportswear makers to kick into gear, but in lieu of that, or as we wait for those, interesting to see that consumer products and services is the worst performing sector, with some weakness, not a huge amount, but a bit of weakness in some of those luxury names, as the team points out. So Christian Dior down by 1.9%, Burberry down 1.4%. Perhaps a little sense that maybe there is read across into anything that a business the size of Nike has to say about the Chinese market. Does that have an impact on our expectations for these luxury names? We'll keep that in mind. Adidas just opening, and it is down by 2% right now.
All right, well, let's get some analysis, shall we? Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, joins us round the desk. Welcome, Peter.
Thank you, Lizzie.
Friday.
Good morning.
We had Mark Cudmore just a few moments ago telling us 2025 isn't over. Can we have a Santa rally yet?
Well, we've been having one, certainly, and there's still some time to go, as you were saying. So I think we're going to end the year pretty strong, and it has been an incredibly strong year, not all in a straight line, but I think the tailwinds remain with us as we move into next year. OK,
so in terms of those tailwinds, we were talking about the US CPI print. I wonder whether it made much of an impact on your outlook for Fed cuts and therefore US equities in 2026.
I don't think it's changed very much. The central backdrop, I think, is relatively benign for risk assets, for equities broadly. Look, you've got continuing economic growth, with the US in particular, in our view, likely to grow stronger than the consensus. But alongside that, we're seeing some decent progress on inflation coming down, and we're expecting inflation in most countries to hit their target rates by the end of next year. And that's going to provide the platform for some more rate cuts, particularly in the US and the UK, with some dollar weakness. And when you look at that combination, all things equal, that should be a reasonably supportive environment again for risk assets for next year.
And so you're constructive on stocks. Good morning to you, Peter. You're constructive on stocks in 2026, but you do see that there'll be lower index returns than we experienced in 2025. What's behind that conclusion?
Well, firstly, let's say, 2025 has been a remarkably good year. It's been a year in which most markets have made very strong progress. And indeed, as we've been arguing, most markets have outperformed the US, and that's been the first time that's happened decisively for 15 years or so. But given the scale of the rises that we've seen, much of it coming from valuation expansion outside of the US, we would expect profits to be the main driver next year. That's still going to deliver, we think, pretty decent returns, but not as strong as we've been seeing through the course of 2025.
Yes, and to your point, I mean, Eurostoxx 50 up by 17% year to date, NASDAQ up by 19%, S&P 15%. Some of these European stock markets, I mean, the IBEX 35 up by 47% year to date.
Well, remember that those numbers are double that in dollar terms.
Yes.
So if you look at everything in common currency, many markets in Asia and Europe are up twice as much as the S&P.
Yeah. I was just about to say, if Guy Johnson were here, he'd say something very smart about if you turned it all into euros, how it would look different. But yes, but I wonder, so given that that's the case, that we've seen some of these markets really outperform the US this year, what does that tell us about the tech trade stateside and our expectations for 2026? What should we take away from, what should we expect to see in that particular sector?
Well, I think still positive, but what we've got to understand is that in the last 15 years, tech has been the only major sector consistently to generate high returns, driven by very, very strong profit growth. And that was reflective of an environment where the leading tech stocks were relatively capital light. And now, of course, we know that they're building up their capital spending at a tremendous rate. We still think that's going to generate good returns. And in fact, within the US, We're still looking at better earnings growth in the tech sector than the broader market, but the differences are narrowing. And of course, the valuation gaps are very large. So I think what we should expect, as we've seen this year, frankly, is a broadening out and more diversification opportunities. We've spoken about how that was reflected this year in a broadening of geographical returns. But we also saw it sector-wise. Tech did very well, but so, of course, did many value sectors, banks, utilities in many cases, some industrials and so on. And I think that's really reflective of how this ramp up in CapEx spending in the tech sector is beginning to move out into other sectors.
And some of that is part of that tech theme, isn't it? Because
Very
into
much
financial services, into utilities, into energy, very much related. Are there other themes, though, if you want to insulate yourself? I mean, pharma did okay in the States this year as well, or globally, in fact. Is that, where are you looking for things that are maybe not quite so related to the AI build-out?
Well, I think we're seeing a broadening out of different styles. So for much of the last 15 years since the financial crisis, nearly every year and in every market, growth outperformed value. And that reflected consistent falls in interest rates, which really helped growth stocks re-rate. Of course, it reflected the dominance of technology profits, but also a lot of the value or more mature industries were facing very significant challenges. You know, banks had to delever and raise capital, many of them cut dividends and so on. We were seeing lower commodity prices, excess capacity in many industrial spaces. And I think that while the tech space is generating some high returns in those mature industries, so it is a bit related to technology, that's not entirely the case. I mean, financials are also benefiting from steeper yield curves and from ongoing economic growth. The fact that they have very strong balance sheets now. We're seeing a ramp up in fiscal spending in many places. Germany is an obvious example. Some of that's going into defense stocks. And we have very high savings rates in many countries, and some domestic stocks, particularly in Europe, which have lagged behind for many years, are beginning to see some stronger returns. So I think it is really broadening out.
So the AI benefits are spreading to other sectors, and there are other themes going on. But what about the downsides to AI? You know, if we get job losses, and I wonder whether you expect them, how does that affect other sectors? Consumers, particularly.
Yeah, I think that certainly we are beginning to see some positive effects of AI in terms of productivity, especially in the US, and we expect that to continue through the next few years. There may be some increases in unemployment. Some of that might reflect the impact of AI, some may not. But I think that at the same time, we should acknowledge that private sector balance sheets overall are very healthy. That's true for banks, it's true for corporates, and it's true for households, particularly in Europe and Asia. And so I think there is still an underlying support with rising real wages for some improvement in consumption.
And earlier in the week, and it seems a long time ago with all the central bank action, we had the jitters around Blue Owl and Oracle, and I just wonder whether that volatility is going to really be a theme in 2026. The more we question the AI bubble, every time there's a little bump in the road like this.
Yeah, well, I don't think it's a bubble because although clearly AI and technology has been dominating the narrative, it hasn't actually this year been dominating returns. And of course, the balance sheets overall are very strong and valuations are not as high as we've seen in other bubbles. Nonetheless, I wouldn't expect returns to be in a straight line. We saw this year very strong returns, but bear in mind, 6-8 months ago, we saw quite a big correction in tech stocks, triggered in part by the introduction of DeepSeek in China, and that sort of rattled people's confidence in the competitive moats around some of the dominant companies. We could easily see something like that happening again. Of course, these stocks are very big, particularly in the US index, and that could have an effect of triggering a correction. But I think that would be different from a significant broad drawdown, which really would require a more significant negative macro picture.
Peter, thinking about other global themes, I wonder how China looks to you next year, as it relates maybe to European stocks or to the global stock story. We're looking at some of the European athletics companies down today, the likes of Puma, Adidas, on the back of the Nike numbers. That's a sector that still has a lot of exposure to that kind of market, and the consumer there has been just sluggish for a long time. And there's a lot of political pressure for China to do something different and expand its economy. How does that play out for the companies that you're watching?
Well, I think there is a very strong theme in China of weak domestic demand, as you mentioned, but actually the overall economy is strong, and our views are above consensus for next year. A good deal of that is reflective of very, very strong exports, notwithstanding the impact of tariffs in the US. China is extremely competitive and moving up the value curve in many of its exports. That has got a negative effect competitively, I think, for Europe, and that's reflected in a longer-term headwind that we see for the European economies. And indeed, that is going to be a struggle, I think, for some companies that are very, very tied to China domestic consumer demand. Of course, many of these have derated a lot over the course of this year. And I think, again, selectivity is going to be a crucial part of the diversification story as we look into 2026.
Okay, Peter, thank you very much. Thank you for joining us. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Let's check in on the core six then. Some large heavyweight businesses that tell some good stories here in Europe. Schneider Electric up by 0.3%, often part of that AI narrative. Of course, everywhere else, though, we see red on the board. Not a huge amount, but red nonetheless. Let's check in with Chloe Melly. She's got our stocks on the move this morning. Chloe.
Good morning, Anna. Renault is up about 1.2% this morning after winning back its investment grade from S&P. So S&P has said that the company had managed to refresh its product portfolio and had also just done quite well recently. And so this is something that is now driving the stock. This morning it's managed to really expand internationally outside of Europe as well, and therefore that will boost volumes going forward. And therefore we are seeing that reflected in some positive movement in the share this morning. Moving on to some downward moves, and this time this is for Puma and Adidas. This is back on the back of the read across from Nike, with Nike flagging that there will be weaker sales for this quarter, the quarter that started on December the 1st, because of weakness in China in particular. So that doesn't bode too well for Adidas and Puma, given the fact that they also have a huge presence in China, a huge market in that region. And we are seeing particular weakness actually for Puma, which is down about 2.3% this morning. Moving on to DHL, which is up on the back of the read across from FedEx, which has reported earnings ahead of estimates over in the US. FedEx is considered to be really a bellwether for the economy. This is a company that has exposure to manufacturing, to retail, and therefore when it does well, it does kind of spell good news for the rest of a bunch of different sectors, and it does spell good news as well for that delivery sector. And we are up about 0.7% for DHL this morning. And finally, WH Smith is down quite a lot. Well, it was down quite a lot. This has now pared some of those gains after announcing that the UK financial regulator was going to open an investigation into the accounting error that had led it to overstate its results. So this is an accounting error that had led the shares plunging. It forced the CEO to resign, forced it to delay its results. And so now the fact that we have got a probe by the FCA is really the latest blow for the company. And so we are seeing a little bit of weakness this morning for WH Smith.
All right, Chloe Melly from our equities team, we thank you so much. And coming up on the programme, disappointing numbers and sales warning from Nike. We discussed the European read across. We will dive into the details next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We're 17 minutes into today's session. As you can see, it's slight gains across the European continent this morning. Flat to the upside on the Stoxx 600. The FTSE 250 is the one that's letting us down this morning. It's down at 0.2%, but green elsewhere. We've discussed the read across to Adidas and Puma from Nike. Let's dive in, though, to the Nike story. Nike shares sinking after the company warned that sales were going to decline this quarter. The world's largest sportswear company blaming persistent weakness over in China, but also at its own Converse brand. So let's bring in Bloomberg opinion columnist Andrea Felsted for more. Andrea, you're looking at Nike shares down this year. Is it a Nike story? Is it a China story? It seems like from the other athletics names, this could be more than isolated to the company.
It's a bit of both. Nike is in the middle of a big turnaround. China is obviously weak in the retail luxury side. Hopefully it's coming back. But there's also been a big change in China. They're very into outdoors, outdoor lifestyle kind of wear that is really owned by Anta Sports. And Nike is seen very much as a kind of a fashion lifestyle brand with the Jordan sneakers and the Air Force One sneakers. And I kind of think those two things are working against it. So it's got to really do what Elliott Hill has set out his strategy to sort of win with sport, rediscover its kind of sport, functional, outdoor credentials rather than being seen as a fashion brand.
Yeah, it's funny that you say about the Jordans. We're kind of forgetting the Michael Jordan history and the athletes that made Nike into what it once was.
Yeah, and it seems to be that that's something that analysts have picked up on with regards to China, saying that the nature of the Chinese consumer has changed really quickly, and what they're looking for is a bit more technical, a bit more performance, rather than maybe what Nike had on offer in that particular area.
Exactly. It's become more of a fashion brand, and it really needs to discover those roots. But these things take time, and he kept saying about being in the middle innings, and what you're seeing with Nike is they're just really, he's been there just over a year. Maybe takes 18 months to 2 years to get the products in. So he's just grinding through that change, and it is going to take time.
I mean, when you've got the likes of Hoka and On, how does Nike keep up with them when it comes to that lifestyle side of the equation, or does it just completely pivot to the sportswear athletes?
It's got to do a bit of everything. I mean, the way to think about Nike is, years ago, Nike and Adidas were everything to everyone. Now, gradually, all these other companies are sort of chipping away, and so he started with running, he started with performance. That seems to be working. But there is this whole huge lifestyle brand, this fashion element, and Nike really needs to win on both, because the biggest sneakers are the ones that start off in the gym, then they get tweaked a little bit, and they become massive on the street. And Adidas is really winning in that market. Nike's got to try and compete with the runners, but also on the fashion side.
It seems like today, I mean, some of those other athletics leisure wear makers are down on this, but not by, I mean, Adidas just down 0.3% or so. So we shouldn't read too much across from Nike into its competition here in Europe, do you think, Andrea?
No, I mean, the other thing with Nike is they said it is improving in North America, which is its biggest market, so that's important. It's also got this issue with Converse. I think they should just sell Converse. It's a distraction that they don't need. So it's also a big year for sport next year. So yeah, a bit of a read across, probably not, shouldn't be too much.
I feel like it's the same problem that Lululemon's having in a way, where they have to make stuff cool. I loved your column yesterday. You kind of put my thoughts into words that, you know, you've got Aloe now and you've got Skims as well. How does Lulu and Nike end up, Nike, I should say, I'm British. How do they kind of get cool again?
It's all about the product, and what Adidas has done, what Bjorn Gulden at Adidas has done really well is he has come up with some great products. So when he came in, they were really reeling with from the Yeezy debacle. He noticed there was some heat around the Samba. He, you know, ramped up the production, got them out, and people loved them, and, you know, it became really, really big. And he's followed that through with other terrace styles. They've had the, you know, the ballerina sneaker, the taekwondo, the low rise. He's now talking about bringing the Stan Smith back. He's a whiz with product, and that's really working. And I think that's what Nike and Lululemon are both missing.
It's all about the product, all about performance. Nice message for 2026. Andrea, thank you very much. Bloomberg's Andrea Felsted from Bloomberg Opinion, of course. 8:22 here in London. Now, oil prices just a touch weaker this morning, down just 0.1%, so not by a huge amount. But oil is on track for its biggest annual decline since the pandemic, as a glut of supply stalks the market. Tankers filled with oil are idling on the world's seas, waiting for the market to pick up. For more, we're now joined by Bloomberg's Anthony DePaola with this story. Anthony, what's driving this surge in supply then? We've talked for quite a lot of months, it would seem, about how everybody fears this big wave of supply coming onto the markets and how that's been the dominant theme for oil pricing.
Good morning, Anna. Yeah, that's correct. A buildup of oil at sea or in storage is going to be a bearish factor for prices. And as you said, we have been expecting that for a long time, most of this year, in fact, and it's just kind of been pushed back as demand continued. There was a lot of great demand in the summer. We also have had lots of geopolitical uncertainty that's been buffeting the oil price, so that's been keeping things higher. But now it is appearing that this glut has finally arrived. We've got a lot of additional production that has been coming on, continued to come online from the Western Hemisphere. We've had Guyana starting production, increasing output. The U.S. is still a huge producer, even as we've seen some of those marginal barrels in the U.S. Drop off in terms of those producers, in the shale patch in particular, not being economical at certain lower prices. We still have seen growth, even if a little bit less than expected. So oil supply is continuing to grow, and it is outpacing the increase in demand. It should be said, go ahead.
No, I just wondered what the floor could be then. Before we talk about the demand story, Anthony, good morning, Lizzie here. For oil prices, big picture, how low prices could realistically go from here?
Good morning, Lizzie. Yeah, we are hearing discussions around the $50 mark. So we have dropped into the high 50s now, below 60, which is kind of a watershed mark for Brent to go below 60. We haven't been below and spent this much time below 60 for a while. We've been down there for a good part of this week, and so people are looking at it going even a little bit lower into next year, as we get a little bit more certainty about some of the geopolitical issues potentially, as this oil glut does materialize on the market. We've also seen OPEC Plus, which I should mention has also been adding production, lots of production this year. For example, the Saudis alone have added about 1 million barrels a day on their own this year as OPEC Plus has eased those production constraints. Even OPEC Plus has decided to take a pause in increasing production in the first quarter because they have seen this glut coming because anyway, these winter months are generally a shoulder season where we don't have huge demand. So we're going to assess the market as we get into this next year and see if it's going to be a really weak year and we are going to drop closer to that 50 mark, or who knows, geopolitical concerns could then pump that up again. But on the fundamentals, the market is looking long, feels long, and we're seeing that in the prices, Lizzie.
Okay, Anthony, thank you so much for joining us. Bloomberg's Anthony DePaola there. Happy Friday to you. As you say, Anna, we're looking at Brent weaker this morning, but only a touch, down 0.1% at $59 a barrel. Well, coming up on the programme, we're going to discuss plans for a European-backed stablecoin. Floris Klucht, digital assets leader ING Wholesale Bank, is coming on the programme next, which will discuss that and the broader crypto story later in the programme. So do stay with us for that, as we're looking at the Stock 600 flat to the upside. Not doing much this Friday morning. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the opening trade. 30 minutes then into our European session, and maybe this is what we need at the end of a really busy week, but we're not going anywhere very quickly. It would seem the best way to sum this up here in Europe. We've got a couple of markets, or 3 markets in the green, 1 in the red, but really no change across these European equity markets, Lizzie. It's been an incredibly busy week. We've had data aplenty from both sides of the Atlantic. We've had a focus on the central banking story here in Europe, over to the BOJ. Quite a sizable move in the yen, actually. Yen weakening as Governor Ueda didn't stand in the way or didn't add to any hawkish expectations, certainly within that market. So, I'm talking about the BOJ, Lizzie, because really there's frankly not much to say about this.
Well, I can't promise you much on my board either, Anna. It's very balanced, really, when it comes to the members higher and lower on the Stock 600, which makes your picture make sense that really we're pretty unchanged when it comes to the broader index. The volume is higher this morning, perhaps surprisingly for a Friday, but let's flip the board over and you can see who some of the winners are this morning. In terms of the leaders, we've got Roche, Rolls-Royce and Total. Perhaps what you would expect for Rolls-Royce, given the news we've had on defence and the agreement on funding when it comes to Europe backing Kyiv. But flip over to the laggards picture, and we've got some of the tech names, SAP and ASML, in the red this morning. Unilever also down 0.4%, Anna.
Let's get an update on some of the other stories that we need to know this morning. Let's start with the news about Ukraine. European Union leaders agreed to loan Ukraine 90 billion euros for the next 2 years to strengthen Kyiv's hand and keep the war-torn country afloat. The EU will fund the loan through joint debt raised on the capital markets and backed by the bloc's budget, rather than using Russian assets frozen on European soil. The Bank of Japan raised its benchmark interest rate to the highest in 30 years. The BOJ made it clear that the hiking cycle will continue by asserting that it intends to keep raising borrowing costs if its economic outlook is realised, adding that the chances of that happening are increasing. And TikTok says it has signed deals to create a US joint venture, majority owned by American investors. An internal memo seen by Bloomberg from the CEO, Shu Chu, tells employees that agreements have been made with Oracle, Silver Lake and MGX. Oracle shares jumped in after-hours trading on the news. The new venture will operate as an independent entity that will control data protection, content moderation and algorithm security in the United States. Chinese regulators have yet to say whether they will approve the deal. And Lizzie, this has taken quite a long time, hasn't it? We talked for a long time about how they were going to resolve this tension geopolitically between China and the United States. President Trump was involved. Seems a deal has been done. And of course, Oracle at the centre of it. Oracle seems to be at the centre of every tech story right now.
Yeah, there's that squiggly diagram that shows us that everything seems to lead back to Oracle, doesn't it? Quite worrying for AI funding when it comes to that. But look, we don't know, as you say, what China's opinion is on this when it comes to TikTok. If it's approved, hopefully it would fix that issue in US-China relations and signal progress there. But of course, we await China's opinion on it.
Yeah, absolutely. We'll wait to get that perhaps into the new year. Let's pivot back to Europe then. Work to launch a euro-backed stablecoin will step up in the new year. Kivalis is the consortium of banks behind the digital asset, and Floris Lucht is digital assets lead at ING, and he will become the Kivalis CFO in January, and he is with us this morning. Floris, really nice to speak to you. Thank you so much for giving us your time. So tell us a bit about the consortium. The consortium includes lots of European banks working towards this euro-backed, euro-denominated stable coin platform. Talk about the progress. Are you still launching in 2026? What do we expect?
Yeah, indeed. That's the ambition. And indeed, we right now have a consortium of consisting of 10 major European banks. That is expanding, by the way, so we have the ambition to grow that consortium because we want to create one European standard euro stablecoin that will be used and distributed by European banks. Right now, where we are, so we launched the consortium several months ago and incorporated Kivalis, the new company that will be dedicated to the issuance of that euro stablecoin. So right now we are in the middle of developing that company, so hiring the management board, the supervisory board, the staff members, developing the tech platform and the risk framework. So yes, we do want to launch in the second half of the next year.
Okay, second half of 2026. Now, the US has moved ahead with dollar stable coins, of course. That's been boosted, in particular, recently by the Genius Act from the Trump administration. Why does the world need more stable coins? Why does the world need a euro stable coin, Floris?
Well, we believe the euro stablecoin or any trusted regulated stablecoin will be building blocks for new digital, meaning on-chain payment and financial market infrastructure. So transactions on-chain settle 24/7 globally and instantly. And what's more, they enable programmability of transactions. So this enables a huge range of new efficiency benefits as well as new innovative use cases that as banks we want to unlock for our clients and that we haven't managed to unlock yet. And the stablecoins are the trusted means of payment and settlement then on-chain. So that is one of the key building blocks that need to be developed.
I wonder why then euro-denominated stablecoins, Floris, haven't taken off so far. And in terms of your geographical ambitions, why it's only Citi that's the only non-European bank in the group so far?
So to clarify, Citi is not one of the 10 consortium banks. So far, it's only European banks that have joined. But yeah, why in particular a euro one? Well, because right now stablecoins are predominantly used in crypto trading and DeFi markets. And we want to make our euro stablecoin available for those markets as well. But we believe that going forward, there will be a lot more growth in payment markets as well as in settlement of tokenized asset markets. These markets exist already based on stablecoins, but we believe they will grow significantly going forward. And the key step to doing so is that banks will enable these kind of solutions and use cases for their clients. And that requires the banks to develop a new set of products, like offering a wallet, or like offering custody to their clients, offering liquidity management, FX, programmability of transactions. So that is still at an early stage for most banks in Europe and across the world, actually. And we believe that development is essential to really unlock these payment and settlement use cases. And that is when the euro stablecoin will really significantly grow, as will other stablecoins.
Well, yes, some banks are already going ahead and issuing their own stable coins. I'm sure you'd prefer those tokens were on your platform. But Floris, what if that liquidity is fragmented?
Well, that's exactly what we want to prevent by setting up a consortium, indeed. So if every bank or other institution would issue its own euro stablecoin, it will not help our clients, we believe, because it will be very difficult for clients to navigate that field. And it will absolutely not be efficient. And you create fractured infrastructure and same for liquidity, indeed. So by setting up this consortium, we want to create one European standard. And we want to manage that consortium as a utility. So Kivalis, the stablecoin issuer, we do believe it will over time be profitable. But profitability is not the main driver. We want just to develop a piece of infrastructure. So just the conversion of the fiat euro to the euro stablecoin to enable these solutions on chain. And then the real profitability should come from the banks that offer these new solutions to the bank's clients. So we believe we need one European standard and avoid this fragmentation.
Yeah, so that's other banks that might want to, or some of the banks in Europe that maybe are already tempted to do their own thing, Floris, and you would like to see them maybe come into line with your plans. What about what central banks are doing? How does your project sit alongside, for example, the ECB's digital euro plan? Are they aimed at different audiences? Because I mean, in the United States, the focus is on private stablecoin solutions. You're also in the private sector, but the ECB has its own plans.
No, exactly. So we believe that our consortium stablecoin is complementary to the digital euro that the ECB is developing. So first, the digital euro, there are currently no plans, as far as we are aware, to issue that on blockchain. So for specific blockchain solutions, which we are focusing on, it's not a suitable instrument. Plus, it focuses primarily on retail payments within Europe. And that is not a focus area that we are having right now, because we believe retail payments in Europe, that infrastructure is robust and efficient already. And there is no client demand that we see, at least, to replace that with a new infrastructure. The digital euro is focused on that right now, which is, of course, perfectly fine that ECB has its own plans and ambitions there. But we focus really on those use cases, which are now much more difficult with today's infrastructure. So, for example, cross-border payments, and like I mentioned already, settlement of tokenized assets, which are really the on-chain benefits.
Floris, it seemed in the past that banks in Europe, but maybe even globally, had been a bit worried that stablecoins and the digital euro project from the ECB could drive away deposits from the banking sector and put them elsewhere. But now we see the banking sector embracing the stablecoin idea. Is that a fair reflection? And what's changed?
Well, indeed, it is being embraced right now, and there is this concern indeed because banks use the deposits that are received from clients to fund lending assets, obviously. So it's important not to undermine the funding base of banks. But at the same time, we see that there is an opportunity here to serve our clients better, which is essentially the ambition that all the banks have. We need to keep in mind that the stablecoin is a means of payment and settlement. So it's not meant to generate any yield. Also, under EU regulations, it's not even allowed for stablecoin issuers to pay any yield or any interest on the stablecoin. Therefore, by having banks in the lead in this market, we believe that we can manage it in such a way that it serves our clients while also making sure that it doesn't interrupt the lending capacity of banks. And that is indeed a bit of a concern for banks, that if fintechs dominate that market, that don't have this same concern for European funding to fund the European economy, essentially, that could be disruptive in a way. But that's not the main reason for banks to step into this market. We believe this is a new opportunity, and we want to unlock these benefits for our clients, which is the main driver.
Okay, Floris, really great to have you on the programme this morning. Thank you so much for joining us. Floris Lucht, Digital Assets Lead at ING Wholesale Banking and soon to be the Quivalis CFO. Well, let's get more on this now. We can bring in Bloomberg's Senior Editor for Crypto, Anna Herrera. Good to have you with us, Anna, to get a bit more context here. I just wonder how stablecoins are going to affect demand for treasuries as all of this progresses.
So obviously in the U.S. or in general, stablecoins are traditionally pegged to an asset like, the U.S. dollar. And the way they work is that for each dollar you give to a stablecoin issuer, they give you a stablecoin back. And they invest those reserves in highly liquid assets so that you can get your dollar back if you need to. And generally this goes to treasuries, right? And so this has created a very big demand for U.S. treasuries. If you think about stablecoin, the biggest issuer right now, they have billions in treasuries, and that's leading them to generate lots of profits. So part of the reasoning of why the U.S. has been very favorable of stablecoins is that they think it's going to drive up or diversify the demand for their debt. So it's not just other countries, but it's also issuers like Tether.
Yes, indeed. And there's been, good morning to you, Anna. Yeah, there's been a lot of debate, hasn't there, about whether this is really going to sustainably drive up demand for treasuries or if it just takes it from other sources. But that one will no doubt run into 2026. In terms of that Euro stablecoin initiative we were just talking to Floris about, we finished there talking about the way that the banking sector does seem to have changed its mind or learned to embrace stablecoins in a way that it hadn't previously. What do you think is driving that?
I think definitely the Genius Act and the big change in the U.S. With Trump, they weren't sure before whether they were going to do a digital dollar, much like the digital euro, so sort of a Fed digital dollar. Instead, they've decided to go all in on the private sector, and we've seen American banks, we've seen American fintechs launch or think of launching stablecoins. So there's now the potential that you might see dollars flooding other countries with stablecoins that exist now. We have many instances of holders in countries where the currencies are very volatile or the countries are very prone to inflation. And so you could think that it's not just going to go to emerging markets, but could come to Europe. So there's a concern, also competitive threat a bit for the banks here. So before they were a bit concerned about deposit flight to the digital euro, and now maybe they're also a bit concerned that their competitors, American competitors and rivals, might start bringing dollar stablecoins in.
And Anna, speaking of volatility, we've got Bitcoin volatility really rising ahead of this $23 billion options expiry. Just walk us through why there is so much intense pressure on Bitcoin into these final weeks of 2025.
I think it's been a wild ride as usual with crypto. The big difference in Bitcoin this year is that, as I've said, and we've been talking a lot about, the environment. It's been a very favorable general crypto macro environment, in the sense that there's been a lot of support from regulators, especially in the U.S. We've seen big players come in, and so there's this big contrast, and it's a bit jarring to see that Bitcoin has fallen in these last few months. So I guess we'll have to see towards the end of the year whether it can pick up. It's more likely to stay range bound, we're expecting, but with crypto, as I always say, you really never know.
You really don't. I mean, we have seen selling by long-term holders, haven't we, Anna? I wonder, and this is Bitcoin specifically, how does Bitcoin sit alongside its competitors? Is there something else happening here? I mean, we just spent the last 10 minutes talking about stable coins, for example. Is there something else happening in the digital landscape that we need to be aware of when thinking about this weakness in Bitcoin?
I think, again, Bitcoin is the one that everybody focuses on the most, and largely because we've seen it's been there for longest. It's one where, institutional investors are slowly coming in. It was also the year of meme coins, which are the ones that are extremely volatile, but it's still not, those ones are even harder to predict. They tend to move on news or sentiment, but, Bitcoin is the one that has achieved more of an institutional status, in part because of the ETFs that have drawn in a lot of money from retail investors, but also, starting to bring money from institutions.
Anna, thank you so much. Thanks for joining us. Bloomberg Senior Editor for Crypto, Anna Herrera. Coming up on the programme, European Union leaders have agreed then to loan Ukraine 90 billion euros after failing to break the deadlock over using Russian assets frozen on EU soil. They have found a different solution. It's a loan. It's going to be funded by debt. We're live in Brussels with the details next. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. The reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
8:50 a.m. in London, and we end the week with European Union leaders having reached an agreement on a loan to Ukraine after marathon talks at a summit in Brussels. The EU will raise joint debt to loan Ukraine 90 billion euros for the next 2 years, and across all of it has been Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, just break down for us what this agreement means.
Lizzie, this is not an intensely simple thing to understand for what the Europeans have come to yesterday after 16 hours of negotiations and trying to figure out a way to get that bridge loan to the Ukrainians so that they don't run out of money by the first quarter, which is what we've been told by Zelensky. Zelensky telling me just a month ago that this is a question of survival, them getting that 90 billion euros. So the solution that the European leaders have found yesterday here in Brussels, I should say, and into this morning, is to basically have a joint debt funded 90 billion euro loan to the Ukrainians, backed by the European budget, but the loan that they will only have to repay if the Russians pay them back reparations. So this is a way, in a certain sense, to sort of make a delay on any kind of real decision on the frozen Russian assets, because the Europeans will say if the Russians do not pay back those reparations, it is actually from the frozen Russian assets that money will come to, and that is how that loan will be repaid. So this sort of solves a lot of the problems. It sort of goes around some of the main issues that Belgium has. We should say that the loan is going to be backed by all of the European member states, with the exception of Hungary, the Czech Republic, and Slovakia. So what it manages to do is to bridge that financing for Ukraine while basically deferring this decision on the frozen Russian assets. Depending on who you ask, this is really either a very elegant solution or a really sort of convoluted can-kicking to try to not make the more sort of complicated decision as to what to actually do with those Russian assets.
Yeah, it's really interesting how some of those European countries do get that carve-out from contributing. Ollie, what could this decision mean for the peace negotiations that are obviously ongoing? There had been US pressure not to use the frozen Russian assets for this very reason.
Yeah, that's right. The U.S. really wants to use these frozen Russian assets as part of their own architecture for peace, their own rubric for trying to bring Russia to the table. We heard some sort of really kind of, I think from the European perspective, outlandish plans on how to do that in the original 28-point plan. But this in some way sort of preserves that conversation, leaves the Russian assets on the table. It leaves that tension in the air, saying that the Europeans could move on these assets at any sort of given time without escalating the situation. And we actually heard from Kirill Dmitriev, who's the head of the Russian Sovereign Wealth Fund, but who's also been spearheading the peace negotiations with Steve Witkoff in the various talks that they've had. He's said, as this sort of plan emerged to not take the Russian assets, he said that if that is true, shelving the EU's original proposed illegal scheme to tap Russian foreign reserves to fund Ukraine is a major win for law and common sense and for the voices of reason in Europe that protect the EU, the Euro, and Euroclear. So from the Russian perspective, we haven't heard a great deal yet from the outcome of this decision, but that sort of initial take from Kirill Dmitriev sort of suggests that the Russians, this is a solution that they can live with, and this sort of still does leave the path for diplomacy open for them to discuss those peace talks with the United States.
Oliver, thank you very much. Bloomberg's Chief Europe Correspondent Oliver Crook joining us there. Now, the delayed US CPI report, back to the markets and the movement of this week, showed core inflation at a 4-year low, but with October's data absent, economists have warned of anomalies, huge anomalies in the report. Despite that, the Chicago Fed President Austin Goolsbee said there was a lot to like. Let's bring in Valerie Teitel for her analysis. Valerie, does this end here, or do we keep talking about this very flawed and full of holes CPI report into next week?
Well, look, if next week's a quiet week, I think there's still going to be a lot of debate on what
Yes.
exactly happened this week. We had not only an extremely noisy non-farm payroll report, but then a double CPI report that left a lot of blank holes, essentially, and a lot to be chewed over about what the BLS how they're going to handle the data distortion for months to come from the missing October CPI reports. Now, I think there is some comfort given to the market that Fed's Goolsbee did say that there was a lot to like in yesterday's report, so he was still able to make a conclusion from the noisy report, and he did say that he thinks rates can go down a fair amount if inflation does stay on track. And that is interesting, Anna, because he was the main new dissenter in the decision a week ago, and he's coming out and saying that at least yesterday's CPI report is enough for him to maybe flip his mind and thinking that they can reduce interest rates in the first quarter of next year.
Okay, so the year very much is not over when it comes to the data and the Fed speak. Val, stay with us. Bloomberg's Valerie Teitel there. I want to switch gears to Blackstone's annual holiday video. It's back, and this year the firm's 40th birthday, sparking an over-the-top midlife crisis.
Turning 40, it's a really big deal. Did you get a nose ring? I've always had this.
Some of us are in denial that we've become a mature organization.
Hey, guys, let's start buying sports teams.
Okay. We could buy Ferraris.
No, let's buy Ferrari.
Yeah, we're definitely having a midlife crisis. Wait, are we rolling?
Even Steve's going through it.
Well, I was thinking of becoming a DJ. Steve Schwarzman, a DJ? He'd crush.
I really don't know what to make of that.
Just what we need, more finance DJs. I mean, what I made of it, I think the people in this video know well. I mean, 40 is a bit, is that a little young to be having a midlife crisis? I mean, maybe they got more years of crisis still to come.
Do you know what? I think it's commendable when CEOs have outside hobbies. You know, you try to interview them about what they do outside of work, and there's never that much. Look, in terms of what we're all up to this weekend, let me tell you what's on the weekend agenda. You've got the Night of the Proms in Cologne, Avatar. Is it Avatar 3?
Yeah, there's a third one.
That's coming out. You've got some alpine skiing.
That's in there for Guy.
And it's Christmas market season. That's for Val.
Well, maybe Val's into the skiing. Or maybe not. Maybe that would be dangerous. The skiing is in there for Guy. There always has to be sport. That's one of the unwritten rules about the Weekender. Speaking of the weekend, Bloomberg Weekend newsletter, of course, is available. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa.
a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The EU greenlights a €90 billion loan to Ukraine after plans to use frozen Russian assets fails, despite marathon talks in Brussels. Governor Waida strikes a cautious tone after the Bank of Japan hikes interest rates to a 30-year high. Plus, Nike tumbles as the sportswear giant struggles to get back on track in China. Let's get to the markets right now then. Futures on a day when we're starting to see lackluster moves across Europe, and the sentiment that came through on Wall Street and overnight in Asia is petering out when you look at the European session. US futures pointing to modest gains over 0.3%, looking to build on the upside for the S&P 500, which logs gains of around 0.8%, but still on track for a second week of losses. We'll see how that turns out, of course. Nasdaq 100 gains close to 1.5% by the close yesterday, and we'll see how that transpires with tech once again in focus. The US 10-year at 4.13, the inflation data out yesterday, giving some a little bit more ballast to push forward in terms of bets on the Fed for next year, but with all the caveats around the messiness of that data print. 4.13 right now on the US benchmark 10-year. The yield's up close to 2 basis points. The Japanese yen is in focus, of course, with the BOJ hiking rate to 0.75%. As expected, the commentary from Governor Waida, some markets participants not convinced that they can go that much further. 156 then, as the Japanese yen weakens, down by 0.9% versus the greenback. $60, below $60 a barrel right now on Brent, 59.74, softer again by 0.1%. Let's have a look at the breakdown then across the map. The FTSE 100, the last time I checked, was flat. That remains the case. Similar picture for the CAC 40, the IBEX as well, and the DAX just down 0.1%. The FTSE MIB over in Italy, slightly brighter, up 0.2%. But this seems to be a market on the last, of course, full trading day of the year, looking for the next catalyst. We know that volumes will be thinner, of course, at this time of the year. We're checking in on some individual stories that are much more interesting than the broader picture. One is Nike. Look at that then. Pre-market down almost 11%. Concerns about the China story on the earnings impact that came through yesterday. The China story has not turned around for Nike, and the Converse brand is still struggling. The inventory build-up is the challenge for Nike, so selling off pretty sharply pre-market. Let's flip the board and have a look at Oracle. This, of course, has become something of a canary in the coal mine around the build-out of AI, but the story today for Oracle is the role that it will be playing in running the TikTok business in the US. Cooled higher by 6%, almost 6% on the back of that story. You'll get more details on Oracle and TikTok through this show. So, for the conversations and the analysis that matter, let's get it all started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. Happy Friday, everyone. The EU has agreed then to lend Ukraine 90 billion euros of its own funds after failing to reach a breakthrough on using frozen Russian assets. Following marathon talks in Brussels, French President Emmanuel Macron said Europe will need to find a way to directly engage with Russia. Let's get more with Bloomberg's Oliver Crook, our chief Europe correspondent. He's on the ground for us in Brussels, following all of this, of course, for us. Ollie, tell us about the nature of the loan and the failure to really use these Russian assets.
Yeah, well, Tom, depending on how you see it, you can see this as a failure and a success. And I think that that is exactly the line that the Europeans wanted to tread, and basically saying that, you know, on the one hand, yes, the Russian assets are still being held, and technically speaking, in the longer term, they're backing this loan, but they have sort of capitulated from the original plan, because that 90 billion euro loan to the Ukrainians, which will be at zero interest, which will fund Ukraine 2/3 of the way for the next 2 years, will be backed by the European budget, by joint debt, not primarily by the Russian assets. Now, what the Europeans have said, and the way to sort of fudge this is that in the longer term, the Ukrainians will only have to repay this loan if the Russians pay reparations to Ukraine. If the Russians do not do that, then the Russian assets are back in play. So this sort of solves the problem in some respects for the Europeans. The first thing it does is it does bring financing to Ukraine, which we know is very desperate for that money, that they run out of money in the first quarter of next year, so it solves that problem. This circumvents some of the issues that Belgium and some of the other member states of Europe have had, such as Hungary, Slovakia, and the Czech Republic. Those three, for example, are carved out from sort of having any backing to that loan. They're exempt from having to back it. And the third thing that the European member states can say, sort of truthfully, is that this risk does not sit on their balance sheet, but that's not quite the full story. So there's a little bit of a complicated process. Depending on how you look at it, this is an intensely elegant solution to a very complex problem, or it's a really complicated fudge to something that they have just decided not to make a decision on quite yet.
So there are still question marks then, Ollie. I mean, what happens? We have this 2-year time frame then in terms of the loan, tying Ukraine over for that period of time. What are you watching for next? When does that loan get dispersed?
Yeah, well, so they're going to need to disperse that loan very quickly because, as the Ukrainians have told us, they basically run out of money in the first quarter. And when I spoke to Zelensky basically a month ago, he said that this money is a matter of survival for the Ukrainians, their ability to withstand the pummeling from the Russians that we've had over the last certainly the last couple of months, more intensifying, but over the last few years. But what I think is interesting is how this is going to play into the peace negotiations. We expect those peace negotiations to resume over the weekend between the U.S. and the Russian delegation after that 20-point plan got a sort of makeover by the Europeans and the Ukrainians. What we're looking for now is the reaction to the Russians to this European plan. We've had just a sort of glimmer of that from Kirill Dmitriev, who's sort of the lead negotiator from the Russian side on the peace negotiations, also head of the Sovereign Wealth Fund. He came out on Twitter when we started to see that the Europeans were not going to actually seize the assets, but we're going to go with the loan. He said, if true, shelving the EU's originally proposed illegal scheme to tap Russian foreign reserves to fund Ukraine is a major win for law and common sense and for the voices of reason in Europe that protect the EU, the Euro, and Euroclear. So if we have any sort of reaction from the Russians, and if that is anything to go by, a sort of positive reaction for the Russians, on the one hand, this leaves the sort of path open for conversation, for dialogue, for the peace proposal, while still leaving the tension in the air because those Russian assets are still frozen and the Europeans can still move on them.
Okay, Oliver Crook, Bloomberg's chief Europe correspondent, with the details of that loan, the implications for those peace negotiations, of course. Ollie, thank you. Let's get to macroeconomics now and monetary policy because, of course, the Bank of Japan has raised interest rates, and the governor says the benchmark interest rate remains some distance from the lower end of the neutral rate range. Earlier today, the central bank, of course, raised those rates then to the highest level since 1995.
It is difficult to determine the neutral rate in advance, and it is necessary to consider it within a fairly wide range. On that basis, we believe it is appropriate to continue monitoring how changes in short-term interest rates affect the economy and prices, while exploring the level of the neutral rate and adjusting the degree of easing accordingly.
Okay, let's bring in Paul Jackson now, our Japan government and economics editor in Tokyo. Paul, just make sense of this for us then. The rates increase as almost fully expected to 0.75%. Yields are up, but the Japanese yen is down about 9/10 of a percent. And the Bank of Japan is saying they still have scope to increase rates further from here. Just make sense of that picture for us.
Yeah, well, I think it was so telegraphed in the rate hike that it was all about, the forecast, the outlook for where rates might go. And in Japan, Japanese media has been fixated on this neutral interest rate concept, thinking, well, Governor Ueda is an academic, he likes the textbooks. Maybe this prescription of finding the neutral rate, which neither stimulates nor restricts the economy, that's kind of the end game for your rate hike cycle. So he referred to it in Parliament recently, and so there was a lot of attention on, is he going to use this neutral interest rate estimate as a way of giving guidance on where rates might go in the future. And I think that the takeaway from what he's repeatedly said is, no, I don't want to use a textbook. That's a very interesting theoretical concept. Of course, we do need to understand that. But in the real world, it's all about pragmatism. You go up a little bit, you see how the economy responds. If it's still growing, it means you can go up again. And that's the view that is repeated today. And clearly, for the traders out there in the markets, that wasn't enough.
Okay, so that's the market reaction, Paul. What about economists? How has the view been adjusted on the back of today, what we've heard at the press conference, in terms of how to think about future hikes, if indeed they do come through? I read one piece of analysis saying maybe it's going to be at a 6-month cadence.
Yeah, I mean, I think that is the overall consensus amongst economists and market participants, really, is, once every 6 months, he hikes. That's maybe as fast as he can go. Could get slowed down a little bit. We've got this expansionist Prime Minister, Sanai Takaichi, in power. She might get cold feet or want to disrupt the rate hikes if the economy tanks. And this is something that the Bank of Japan has done in the past by going too fast with rate hikes. So that's certainly got to be on his radar as he goes forward. But I think, he's repeated his message over and over again. If the economy develops in the way we expect, we are going to continue to raise rates. So really, there was enough there to suggest that rates will continue to go up, even though the market moves suggested otherwise.
Paul, thank you very much indeed. Always excellent analysis in terms of the BOJ and how to think about things in the path forward. Currently, the Japanese yen down 0.9% at 156, closing in on 157. Paul Jackson in Tokyo, thank you. Now, for more on the BOJ and wider markets, we're joined by Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Michael, always great to get your insights as well. So let's start on the BOJ then. Are you convinced that this is a BOJ that has the space to increase rates further from here? And what are you thinking about in terms of the so-called neutral rate for the BOJ?
Well, I think that question that you started with, Paul, about why markets have reacted the way they did, I'm pleased you asked him that, not me, because I think Ueda did everything that he should have done in terms of signalling that hikes are coming. He's never going to be direct enough to say, I think the neutral rate is at 2 and that's where we should go, because he's not going to pre-commit to that. Nevertheless, I think this was a change. If you think about where the market was 2-3 months ago, it was the idea that the change in government would mean that the BOJ would have to be more dovish. And that, I think, clearly isn't going to be the case. I think that the policy settings in Japan is going to be stimulative fiscal policy, which means that rates do need to go a bit faster, which means 1.5 and above. And that isn't yet fully priced in the market. So I think despite the market reaction today, I do think we're going to get tightening in Japan, and I do think that will ultimately lead to a strong yen.
And you think rates ultimately 1.5 and above?
Yeah.
And in what kind of time frame?
Well, so I think to Paul's point, the BOJ has been and continues to be quite cautious. I think if they have the inflation to justify it, which they currently do, it's not impossible that they could start to go in quarterly increments, and maybe that would. The market reaction today, I think, will be disappointing for them, and they'll be surprised that the market has reacted that it's a dovish hike, which I think his commentary suggests that it isn't. But look, I think sometimes we overread intraday market reactions, which in thin markets like today, it could just be that the market's quite thin and there's been a few flows that have gone the other way.
That's really fair.
So we shouldn't extrapolate, I guess, is what I'm saying.
But what you do see is a picture of narrowing rate divergence between the Fed then and the BOJ. And so my question then is, what does that do to capital flows? I mean, we're seeing a little bit, some modest selling in European sovereign debt and treasuries today, and some are linking that to the rate increase by the BOJ. What does that do to capital flows? I mean, how much is that a risk for the sovereign debt of the Eurozone and the US?
Everywhere. Yeah, I mean, look,
how challenging would that be?
So I think in kind of all the year ahead outlooks, there's always this question. So everyone always favors Japan. They're always waiting for Japanese rates to go up, and then also the impact of that of Japanese investors to bring money home.
Yeah.
And look, I think what we can say is that so far the experience of 2025 is they have not done that yet. But it remains a risk going forward that they will. I mean, look, rate differentials are still favoring, to some extent, Japanese investors to put some money abroad. But it would be surprising, given where long-term Japanese yields are now, that you don't get some repatriation and we don't eventually get this correction in what is still, by far and away, the most dislocated market right now is the Japanese yen and its valuation. And so at some point, we're going to get a correction in that.
Let me get to the UK then. So inflation in the UK is down, growth is down, unemployment is up. Is the BOE behind the curve?
Well, Not yet. I think you can understand why the BOE has been cautious simply because of where wages have been, and inflation has been sticky. But eventually you'd expect the weakness in the economy and the weakness in the labour market in particular to drag both of those things down. So, I actually think the market is a little bit underpriced for UK rate cuts right now. And we could get more rate cuts next year than the market currently prices.
More than two?
Yeah, 2 or 3, or maybe even 3 or 4 actually, because I think that the weakness of labour market demand in the UK is very clear. The UK is a standout on things like job postings and metrics like that. That the labour market here is much weaker. So I think eventually you will get.
We could be below 3% then by the end of next year. On the if we get 4, we're at 3.
Yeah, I mean, I don't think it would be our central scenario, but there is a risk that if the economy weakens further, then clearly that's the risks are all skewed to that side, I think.
You've talked about the need to look for hedges in 2026. In 2026, investors need to be ready for a range of outcomes and be ready to hedge accordingly. What are your favourite hedges?
Well, so I think, look, our concern right now is we go into 26 with investors' allocation to equities very stretched relative to bonds. And when we look at what typically happens next, you either have very good scenarios, which is the kind of the pre-bubble stuff, or very bad scenarios, which is obviously the bubble bursting. And so, I think it's going into alternates and just reducing your risk on beta, because I think that's just the danger is that. And look, it's the same danger we went into 25 with. Is that investors are very overweight risky assets right now, and we're going into 26 with the same level of holdings.
It's on AI, before we let you go, is Oracle now the canary in the coal mine for whether or not the AI momentum can continue? What are you watching for in terms of what could be a trigger point either down or for further gains to reassure the markets on AI?
So I think the lesson from this year, and look, every major earnings announcement has been a potential trigger point, and I think almost every time this year they've actually been a validation point rather than anything else. So we capture the fact that investors are very overweight equities. Obviously, their biggest overweight is in tech. And so you can understand that investors lighten ahead of all the big major earnings announcements.
Yes.
And then every time they rebuild afterwards. And so, I do think actually the story is relatively straightforward. It is earnings driven.
Okay.
And right now the earnings, and generally the news flow has been pretty positive. So it kind of justifies the position, and it's hard to go against it. And that's the challenge.
Fantastic to get your insights as we close out and get towards the end of 2025 and look ahead to next year. Of course, Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Michael, thank you. Coming up, money has been pouring into data centers amid that AI boom. We've just discussed with Michael. We discussed what it means for the real estate outlook with Chris Brett, European Head of Capital Markets at CBRE. That is next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The conversations that matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. Now, the global property market is showing tentative signs of a recovery as easing interest rates bring back some of the conditions that powered the previous rally. This time, there's also huge demand, of course, for infrastructure linked to data centers and the AI boom, although some investors worry that the level of capex spent could be getting out of hand. One firm making a shift into operations tied to digital and power infrastructure is the commercial real estate company CBRE. Joining me now is Chris Brett, the firm's European head of capital markets. Chris, before I get your take on AI and the spending boom there, just looking back on 2025, how has the year shaped up? What are some of the key themes that have come through for your space and your sector in terms of transactions and activity and where the regional impulse has been?
Sure. Good morning, Tom. 2025 had a little bit of a slow start, but as we sit here today at the end of Q3, volumes are up 8% year on year across Europe, which is clearly a good sign. We have been buoyed by the amount of debt capital that's been available in the markets across all sectors. And as we said at the beginning of the year, living and logistics would be the two sectors which captured the most capital around the region. That has been the case, but I think the surprise of the year, Tom, has been the interest and the transactional activity in retail, which is a really good sign for that sector, which has clearly had a very tough time during and post-COVID.
What do you think is underpinning that interest in retail, Chris?
Well, I think that very simplistically, it can't be worse than being closed, right, like it was in COVID. And actually, what COVID did for the retail sector was it really secured the balance sheet of a shopping centre, a retail park or a high street and those retail tenants. And that has given people the confidence that actually when they're buying a retail asset, the income that's underpinning those assets is exceptionally strong and perhaps stronger than it was pre-COVID. At the same time, the cap rate in the sector has moved out considerably, and just versus other sectors, I think retail therefore looks like a pretty attractive buy. Hence, we've seen that spike in activity during 2025. And Tom, we expect that to continue in 2026.
Okay, so the interest in retail continues in 2026. What about the office space? There have been some anecdotes, Chris, around the office space starting to tighten in London, some big name projects coming on board and some big tech companies looking for additional space and additional real estate and to be able to expand their headcount here in London, just as one example. Is office coming back, and does that momentum continue in 2026 if that momentum is there?
I think there's no doubt about it. Office is definitely coming back. And it's had a much better 2025. And we can feel that momentum growing in the sector. It's really been very underpinned by the strong leasing demand that you just referred to, actually, with companies looking to take more space. And we've seen the best buildings attract top-class tenants. And we've seen a very strong rental growth story. And this is evident across all parts of the market in both London and other major cities around the world. The investor demand has been a little bit slower than the occupier demand, but we're seeing that catch up now, Tom. And again, we see a lot of capital that is now focused on offices for the rest of this year and certainly into 2026.
We were just talking about the lower rate regime that we're starting to see. The Bank of England, of course, cutting rates. The Fed looking to cut further. Potentially, that's the market expectation next year. How supportive is that lower rate regime for the space that you operate in, and how much of a catalyst for next year?
Well, it makes a huge difference, right? I mean, and when you look at volume activity this year, volumes are slightly down on the UK, but they're much higher and up on 2024 across Europe. And you know better than I do, ECB rates have been at 2%, whereas UK's been at 4% up until yesterday. And so that differential in the cost of borrowing has clearly had an impact on investor demand and capital that's gone into our sector. But the availability of debt from mainstream banks, from alternative lenders, is clearly there, which is giving the sector a real confidence across all the different verticals within real estate that actually there is enough debt capital to go into 2026 with real confidence. What I would say, though, and we hope we try and learn lessons from previous cycles, that the debt capital and the loan-to-value ratios are much more in line with prudent investing versus when we went into the 2008 GFC, where clearly debt and leverage ratios got a little bit out of whack.
Chris, when we think about debt ratios and leverage ratios, we can think about AI and the building boom there. So I guess my question is, how is that reshaping your sector? And are there any red flags for you in terms of what is being built out, what is being committed, whether it's the lease agreements or anything else within what you've seen there that is causing any concern?
I think the biggest red flag, and I remember talking about this on your show earlier this year, is really not the demand from the companies and not the availability to actually go and build, but it's the planning regime, which is quite tough, and it's really around the power and the availability of power. Wherever we look in any geography, can it sustain the building activity that we need for data centers to grow? So I don't think there's certainly as we see it today, there's not a red flag around data centers per se. What we are, though, seeing with data centers is, given the scale and given the amount of capital available and needed, we are seeing this merger of infrastructure capital with real estate capital coming together. And I think that is a really interesting dynamic that we're going to see play out even more during 2026 and beyond, Tom.
That's really interesting. Okay, so we look for that merger between infrastructure and real estate capital in 2026, and if that continues. Chris Brett, really important and interesting insights into the real estate space. Thank you, Head of EMEA Capital Markets at CBRE. Coming up, Swedish tech darling Lovable closing a fresh round of funding, tripling the value of the vibe coding startup to $6.6 billion. We're going to be joined by Anton Asika, Lovable's CEO and co-founder, for an exclusive conversation. That is next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. The EU greenlights a €90 billion loan to Ukraine after plans to use frozen Russian assets fails despite marathon talks in Brussels. Governor Ueda strikes a cautious tone after the Bank of Japan hikes interest rates to a 30-year high. Plus, Nike tumbles as the sportswear giant struggles to get back on track in China. Pre-market, you can see that stock called lower by close to 10%. Now, the governor of the Bank of England has warned that the pace of interest rate cuts will slow as the BOE reaches the end of its cutting cycle. Andrew Bailey was speaking after the central bank voted 5-4 to cut rates by 25 points to a near 3-year low.
Now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the 6th cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path.
Well, for more on the key central bank action we've seen over the past 2 weeks, let's bring in Vanya Stavrakeva, Assistant Professor of Economics at the London Business School. Vanya, great to have you in the studio. Thanks for coming in. What is your kind of takeaway from the central bank action that we've had so far this week? So the BOJ hiking as expected, the BOE cutting as expected, the ECB on hold as expected, and yet you lift the hood and there's significant divergence on views and on the path forward for all of these central banks.
So thank you so much for having me. Indeed, central banks are again front and center in the news for very good reason, and there is significant heterogeneity. So let me start maybe with Bank of England, and there are some parallels that I'm going to draw with the Federal Reserve. One of the main problems that Bank of England is facing is, of course, inflation is still elevated, the unemployment rate is picking up, and there are a lot of fiscal forces that are not helping the central bank. What do I mean by this? We recently had significant increase in taxes that are actually propelling wage growth due to higher minimum wages, higher national insurance contributions, so that is not helping tame down the inflation. On the other hand, the unemployment rate is increasing as a result of those fiscal forces as well. Another big problem, both for Bank of England and the US, is significant divergence in terms of view of what is the long-term natural rate. So what are we converging to? So when we have a discussion, is it going to be another 1 or 2 cuts? We need to know what is the consensus. Now,
here we're talking about the rate that is neither stimulative nor tightening.
Exactly. So if you look at an interesting report that the Federal Reserve publishes, which is the summary of economic projections, they tell you all the different FOMC committee members, where do they stand in their expectations of the long-run natural rate. So usually a very important number there is this kind of centrality tendency measure. So you remove the top 3 outliers, the bottom 3 outliers, and usually we find that spread is very narrow, right? It's only 2-3 basis points. At the moment, we are talking about a range in the US between 2.8 and 3.5. So how do we know
2.8 and 3.5?
Exactly. So even in the long run, there is massive divergence, even once we remove these outliers. So we're talking only about the middle 6 members of the committee of where we're going towards. So what does this mean for asset prices, right? So asset prices are forward-looking variables. So their revisions, their function of revisions and expectations over the whole path of policy rate. So the moment you start to have shocks driving the long-run natural rate, meaning markets don't know what we are converging towards, you're going to have massive market volatility. And this type of shocks are way more important than are we cutting next quarter by 0.25, because they're changing the whole trajectory of expectations going forward.
Okay, let me get to the volatility piece is really interesting. Before we get there then, what is the reason for this significant uncertainty on the path forward?
Perfect, that's a great question. It's supply shocks, and in this case, AI. AI is another supply shock, right? We don't know what this is going to do to the labor market. There'll be massive heterogeneity across sectors. A lot of discussion centers around implementation, right, and adoption of AI. But adoption of AI is going to be very heterogeneous. It's going to have very different impacts across countries and within sectors across countries. So we don't know what is the new real, long-run real rate, right? So this is a standard productivity shock, which is a supply shock. So supply shocks generate this kind of divergence in views because we don't know whether in the long run the real growth rate is going to be 2.8 or 3.5, how important is going to be AI for long-run growth, and then on top of that there'll be massive heterogeneity across sectors.
Do you expect to get a start to that answer next year?
No, there'll be no answer directly, but I do expect that there'll be way more discussions on that. And this is going to show up in the numbers through impact on employment across different sectors, through impact on productivity. I do expect that we're going to get an interesting dynamic where you might find good profits, which we have been seeing in the US in certain sectors that are linked to tech, bad performance in others. It will be a function of the adoption of AI and other factors, but moreover, the labor market is where we're going to see much more bifurcation, right? We see, for example, in the UK and in the US, where certain jobs still demand high wages and high inflation in terms of wages if they're complementary to AI, but to the extent that some jobs are going to be substitutes to AI, those jobs are going to disappear, and the wages in those sectors are going to become lower. So central banks will have to deal with this heterogeneity, which is going to be even bigger than what we've seen so far as AI starts to get adopted across different sectors and countries.
That's really interesting. And so this increases volatility, and, yes. and investors should be prepared for that in the years ahead as a result of what you've just described. Do the central bank frameworks need to be reworked in light of this uncertainty and this fundamental change?
Absolutely. It creates a massive problem for central banks because historically central banks had it easy. What do I mean by this? The correlation between the unemployment rate, output gap, real GDP growth was very strong, and they almost use these different variables as substitutes. This will no longer be the case. You can have very fast real GDP growth and the labor market doing very poorly, etc., and then they will have to prioritize. Clearly, the Fed has a objective function which is linked to the employment rate, but having said that, even there'll be massive heterogeneity, and we are seeing this in the UK as well. Fiscal policies are not helping, of course, in the UK in terms of creating high unemployment among lower income and younger people, etc., but more divergence, much harder objectives in terms of how we define them and how we measure things. So we need central bankers that are equipped to tackle those problems.
Really interesting, fascinating. Vanya, thank you very much indeed for bringing that insight to us this Friday morning. Vanya Stavrakeva, Assistant Professor of Economics at the London Business School. We're going to stay on AI and do a deeper dive into a particular sector of that space, because Swedish AI startup Lovable has just closed a $330 million Series B funding round, valuing the company at $6.6 billion. That is treble the valuation from the company's previous round back in July. Lovable specializes in so-called vibe coding. Its AI-powered platform enables users to build applications without writing code. The latest fundraising round includes the VC arms of both Alphabet and NVIDIA. Joining us now exclusively is Anton Osika, CEO and co-founder of Lovable. Anton, fantastic to get your time. Congratulations on the raise. It is significant. It's a chunky amount of money. How are you going to be putting it to play, Anton?
Great to see you again, Tom. And we're super excited about this new era where anyone can build. And what we're going to do is to continue to support both founders that have been starting new companies from scratch using our product, and the really large companies out there that we're seeing a lot of success using Lovable, Microsoft, Uber, and a large part of Fortune 500 companies. And what we're building out is more integrations to everything else that you're running your company and collaborating with. So other tools, where many of these tools are investing in this round. So we're seeing support from HubSpot, Databricks, as you mentioned, NVIDIA, and many more. And then on top of these integrations, we have been differentiating in making vibe coding secure since the early this year, and we're going to continue to invest in being the most secure place to build with AI.
That's really interesting, and you're bringing me to a question around the enterprise push for you and the team, Anton. How significant do the revenue streams from enterprise, and you've already, as you've mentioned, got companies like Klarna, Uber, Zendesk already adopting your services and your platform and your capabilities. How important does enterprise become for you versus the individual, and how are you ensuring that security component for them?
So the shifts we're fundamentally seeing is that building things has been the biggest blocker for businesses, and many individuals are now discovering how much you can get done when you build software without being bottlenecked by not being able to code. So the individuals who are the ones who have discovered the power of Lovable, and they are taking it into their work, into the enterprise. And at the same time, we're seeing people who discover Lovable from their colleagues and bringing it out into their small businesses, to their personal use cases. So we're focusing on making the enterprise adoption much easier over the coming months. And it's, as you say, there are all of these companies that are now even listing Lovable in job requirements as they're hiring more people. And at the same time, we're supporting both of these groups.
So, Anton, on the security part for enterprise, how do you make sure that AI-developed apps are both secure and auditable?
So I love that you bring up auditable. So one part is, of course, that the software that's being created with Lovable does not have security vulnerabilities. And that's something that has been traditionally very difficult to guarantee, because us humans, it takes a long time for us to verify that something is secure. What we're starting to see is that AI can much faster validate if code is secure. Currently, we don't have a 100% guarantee that something does not have a security vulnerability. It's in the same way that your iPhone might have a security vulnerability right now. But we're seeing that AI is going to be able to do this better than humans. And then the other part is the data and being able to audit who has access to which data. And that's something where we're pushing forward a new standard for how you give access to the AI, and how you give access to AI agents, and how you give access to humans of which data in your enterprise, which is currently a huge pain point, where configuring who has access to what has been a blocker for productivity in large companies, medium companies, even in the government.
Anton, I want to get you some growth stats from you. So you famously hit $100 million in annual recurring revenue, that milestone, within just 8 months. You doubled that 4 months later. What is annual recurring revenue looking like by the end of this year, and what's your target for next year?
So I'm looking forward to see what happens next year. But what I can say is that we've more than tripled the revenue since our last fundraise, and so far this year, since we decided on taking the investments from this round, we beat our projections. And what we're focusing on now is just to make our customers as successful as possible, because we're doing this for the coming decades, as we think that we have an opportunity here to architect how do we humans build software. And that's going to be a very, very long-term effort. I think it's early days in everything that we're doing, and that's why we're so excited to partner with the current investors that are coming on.
Anton, let me push you on the ARR. Are you at 300 million right now, or above that?
I'm looking forward to get way past 300. As I said, we announced 200 like a month ago, and we're way beyond that right now.
Okay. It's a competitive space, Anton, and one of your main competitors, Cursor, valued at almost $30 billion US dollars. What differentiates you from the competitors, and do you see consolidation in the space, or is this a winner-take-all?
So what we're hearing from everyone who loves Lovable and uses Lovable is that it just works. There's a lot of complexity under the hood that Lovable is reducing, while using that, like simplification to ensure certain standards. For example, in terms of security and how the applications on Lovable are built to be secure and have AI included from the get-go. So there's this simplicity that we think is the future of how us humans will want to build software. And as for how this looks in the future, there are piles of gold in what value you can unlock for businesses and for individuals across the board. We are ensuring that we create an interface that can be used by everyone, by CEOs, CROs that are building their command centers in Lovable right now, as well as your mom and pop store that's creating a new website for their for this.
Anton, what stops OpenAI and Anthropic replicating what you do?
So it's a very complex product that we're building, and that's something that we're seeing when people try Lovable, that all of this complexity is boiled down. Maybe there's some Scandinavian design taste that people talk about that makes people just keep coming back to Lovable and absolutely love the experience.
Okay, Anton, I'm going to try and fold two questions into one. One is, you get asked this all the time, but your view probably changes because the environment changes. Who are the losers and who are the winners when it comes to jobs as an impact of this? And how are you thinking about an IPO?
Okay, so the winners, I think, is what we're seeing since we launched Lovable about 1 year ago, is that there's a movement being spawned of that everyone can create. And this is extremely empowering, both to individuals in large companies and, for example, founders and educators for starting new companies and new economic opportunities. I think it's truly an example of AI being a democratizing force, where it was previously very difficult to collect a team that could create amazing software. Now, anyone, anywhere in the world can do that. I don't see, I see this like democratizing force as something where there will be more winners, and currently maybe some of the big winners are going to have a more competitive experience, which I think is good, very, very good for consumers. As for an IPO, it's not something we're looking at right now, but I'll make sure that we're doing whatever decision is best for our business and for our customers.
Anton, really appreciate your time. Thank you so much. Anton Osika, CEO and co-founder of Lovable, joining us exclusively from Stockholm. Coming up, gold hovering near record levels after softer than expected US inflation data. We're going to get the view from Amy Gower, metals and mining commodities strategist at Morgan Stanley. That is next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Gold and silver hovering near record highs after slower than expected inflation in the US supported bets for more interest rate cuts from the Fed. We're joined now by Amy Gower, metals and mining commodity strategist at Morgan Stanley, and certainly interest rates, part of the thinking, of course, when you think about this space. Amy, good morning. Thanks for joining us in the studio. And you write, we are above consensus for almost all metals in 2026. What are your targets and why?
Yeah, so I think the metal story remains very positive as we look into 2026. And I think the key things we're thinking about is the ongoing expected rate cuts from the Fed, which are broadly supportive for commodities, which are non-yielding assets, also help many of the sectors we look at, things like construction, autos, making it cheaper to finance purchases, etc. And then we expect a bit more dollar weakness as well into the first half of next year. So that's, again, a nice tailwind for commodities. And then I'd say broadly, we've got quite good supply-demand balances, looking quite tight across many of the metals. So the ones we're most positive on, we have uranium, lithium, copper up there as well, aluminium. And then we think that the gold rally is not yet done either. So maybe slightly slower paces of gains than we've had this year, but more to go.
So I have to get you on gold. Do we get to 5,000 next year?
We have 4,800, so just shy of 5,000. But of course, we can get volatility around intraday moves. I think the key thing for gold next year is going to be we likely will see a continuation of exchange-traded funds buying large quantities of gold. We see their behavior is very linked to what the Fed is doing.
Why are you more cautious on iron ore and zinc?
Yeah, so for iron ore, it's a combination of factors. So we think China will be probably buying less iron ore. So we've actually seen very strong iron ore imports this year from China, but that is starting to show up in elevated port inventories. They are declining their steel production, so they just won't need as much. And then there's also a large new iron ore mine coming on in Guinea. That's just done its first shipment, so we should be starting to fill those volumes in the market from next year. I would say, though, we don't think it's as bad as maybe some others in the market. We would say that the cost curve has shifted quite a lot higher over the last few years, so that will provide a floor. And then on zinc, we have mine supply coming through. We have China really producing a lot of refined zinc and then starting to export that. And that is also your construction-linked metal, which is still a little soft.
Where are you seeing new sources of demand coming online next year?
Yeah, so the key one, I guess, is two actually. So one is the data center story linked to AI, and then the second is ESS, so stationary storage batteries. So these are particularly for copper, aluminium, and then lithium on the battery side as well, are key beneficiaries here. So for AI, we think in copper alone, that could drive about 0.6 percentage points of our demand growth forecast. So it's driving about a third of total,
just from AI?
Just from AI. And that's based on our estimates for data center build-out, very copper intensive, and we're hearing, although copper is perhaps being replaced by fiber optic in some areas, it's still a very key part of the data center. And then the stationary storage batteries. So this is really, as we put more renewables into the grid, as we have more pull from the data centers, things are getting more unstable. So we need that battery source to bridge the gap. So that's leading the way in China, but even in the US, some EV battery factories are now trying to repurpose themselves as stationary storage batteries.
We've seen a bit of impact in terms of tariffs and the hoarding, particularly of silver, platinum in the US, on expectations that maybe tariffs will be imposed on those metals. How much of an impact is that likely to have going forward?
So the key, I guess, piece of legislation or thing we're waiting for there is the Section 232 on critical minerals that was launched back in April, covers silver, platinum, copper, many of the other metals as well. And we were supposed to hear on that in October. We haven't yet had anything, perhaps because of the government shutdown, and that has driven metal across to the US. And actually, I'd say that has contributed to some of the silver price strength we've seen, because it's taken that metal out of London, moved it to the US, and then when exchange-traded funds have come to buy silver and wanted that physical offset, that metal's not been there in London. I think I would say it feels less likely that we will get tariffs on silver in the US, but I think that stockpiling has come through, and that is tightening markets.
So if we don't get tariffs, do we see a headwind then for silver? Silver's outperformed gold by a long stretch this year. Does that continue? Does the tariff story, if there are no tariffs, does that derail the story for silver?
I think if we were to see metal moving back from the US to London, which is already starting to happen, that could ease up some of the pressures, and we have already seen that with lease rates in silver, which is the cost to borrow. They really surged in October. They've come off quite significantly as we've seen a bit of that metal moving back. So I think it reduces those kind of physical squeezes, but there's many other factors that can drive silver as well.
Okay, really interesting. Amy, thank you very much indeed. Amy Gowan, Morgan Stanley's Metals and Mining Commodities strategist with a view on how that space evolves in 2026. Amy, thank you. Switching focus now, because Nike is down around 10% in pre-market on a sales warning and problems in China. Bloomberg's business reporter Jennifer Creary joins me now with the details. What is going wrong with Nike then?
Really the pace of innovation under CEO Elliott Hill. And there are two persistent sore points here. So the first is Converse, the brand, sales down 30%. Previously, the company really relied on sales of its iconic Chuck Taylor sneaker, but now that's really kind of lost consumer interest. The second sore point is Greater China, so sales are down 17%. And it's no surprise to any retailer in China. It's a tough consumer environment at the moment, but Nike has really been pummeled a lot harder than some of its rivals like Adidas, like Hoka. Selling off its excess inventory has proven particularly difficult at the moment in China. It's a very discount-heavy sportswear market. That's not a good sign for Nike because, no one wants to see, no consumer wants to see, products that are discounted and then being sold at full price. So really, there are a couple of green shoots, really. So Nike has been able to make progress in North America and also its running category, but it takes about 18 months to 2 years for new products to feed through. So it's going to take time for that turnaround to really take place, and shareholders clearly unhappy with the pace of that so far.
Is there a need? Is Nike under pressure for a strategic change of direction given some of these challenges?
Yeah, well, listen, CEO Elliott Hill says that, it won't be a straight line. We're acting decisively to accelerate those lagging areas. So really, he's saying, hold on for the time being. It's going to be up and down for Nike. It's worth remembering that they haven't issued full year guidance for a while now. So they're only issuing guidance for the following quarter. So really, we're going to see a lot of up and down for the company. It's the same diagnosis. So really, they need to boost in-store traffic. They need to innovate a lot quicker. They need to capture the zeitgeist, consumer interest. I think what's really interesting, there was one analyst comment that likened Nike's recovery to a marathon, not a sprint. They said that you can't expect the company to issue robust numbers when it's midway through its recovery. And I think that is very much the case for the company. Okay, and we'll see if investors are patient as that analyst may be in terms of the marathon versus the sprint for Nike. Bloomberg Global business reporter Jennifer Creary with the update there, with Nike called lower by almost 10% pre-market. Thank you. Let's check in also pre-market on Oracle, on the news that TikTok will be setting up this US subsidiary and Oracle will be a key member of that US grouping that will take charge of TikTok US. We've still yet to have confirmation from Beijing that they are supporting this, but we know we're counting down to that renewed January deadline to get this agreement, of course, to ensure that TikTok is, at least to some extent, isolated from its ByteDance parent over in Beijing. And you can see Oracle's called higher by 6% on that. Cross asset, we're looking at S&P E-minis higher by 0.3%, a brighter picture than we've seen so far in Europe. 4.13 on the benchmark US 10-year. The Japanese yen continues to be under pressure. Look at that, down more than 1% at 157. And Brent still below $60 a barrel, softer by 0.3%. Up next, it's Bloomberg Brief. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
On AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets. It's 5 a.m. in New York City and 10 a.m. here in London. Good morning. I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. An American reset, an Oracle-led investor group, will buy TikTok, advancing plans to separate the social media firm from its Chinese parent, ByteDance. And the Bank of Japan hikes interest rates to the highest level since 1995. JGB yields rise and the yen weakens. All of that as we wrap up a busy week of data and rate decisions. The UMich Sentiment Survey is on deck. Well, we have futures pointing higher stateside. Looks like it's going to be a positive end to the week on Wall Street. We had that CPI surprise yesterday, but then the gains on the S&P paired towards the end of the day as economists got a bit skeptical about the data. The bond market was less convinced that the data would lead to more Fed cuts, and indeed this morning the reaction really is happening in your bond space. We had that BOJ hike, JGB yields up to 1990s levels on the 10-year, above 2% there, as you can see, and that having a read across into treasuries and your European bond space too at the long end. Let's get to your stocks to watch now. Is Valerie Titel. Val.
Good morning, Lizzie. Let's start with a check on the sports retailer and Nike out with earnings after the bell, disappointing investors as they have warned that there will be a sales pullback in the current quarter. Now, this comes as a surprise after 2 quarters of pretty decent sales growth for Nike. They also said that their Converse brand might suffer a 30% sales decline in the latest quarter. So we're seeing shares of Nike fall around 10%, and they are amidst a turnaround. The CEO said on the conference call with analysts that they are in the middle innings of that turnaround. Next, let's move to some more positive news, this time on Oracle. Shares of Oracle are rising over 5%, nearly 6% in pre-market trade, as they, I guess, did get some confirmation that they are part of that U.S. JV of investors who will be taking ownership of the U.S. TikTok. They will get some 15% ownership of the U.S. TikTok and also house all of its data as well. So Oracle jumping some 6%. We have yet to hear whether the Chinese regulators approve of this deal. Lastly, let's check on some home builders. It has been a disappointing week for some of these home builder names, and we got a disappointing report from KB Home. Those shares were trading down in after hours around 3% and follows a weak report from also Lennar on the home building industry, still struggling amidst lower consumer confidence and demand. Lizzie?
All right, Valerie, thank you so much. And Valerie Titel will be back with us later in the program. But coming up this hour, we'll also get an outlook on travel demand with IAG Chief Financial and Sustainability Officer Nicholas Cadbury. And later on, more on the bond market with Kelsey Barrow of JP Morgan. But first, the Bank of Japan raising its benchmark interest rate to the highest in 30 years.
It is difficult to determine the neutral rate in advance.
and it is necessary to consider it within a fairly wide range. On that basis, we believe it is appropriate to continue monitoring how changes in short-term interest rates affect the economy and prices, while exploring the level of the neutral rate and adjusting the degree of easing accordingly.
Well, we have 10-year yields topping 2% and the yen weakening. Let's get analysis now with Bloomberg's Adam Linton. Adam, we were talking to a strategist earlier who said that Ueda in that press conference was giving us constructive ambiguity, were his words.
Yeah.
What did you make about the clues on the path ahead for when the next hike is coming?
Yeah, I mean, I think realistically he did all that he possibly could have done. I mean, the market can't have its hands held at every juncture. You know, he let them know there is a tightening bias, and I thought some of the remarks were actually quite hawkish. You know, he said that existing tightening measures haven't had too much of a tightening effect, and we could still be some way away from the lower bound of the neutral rate. So I think from a central bank perspective, given the uncertainties that lie ahead, he did as much as he reasonably possibly could have done. I think the issue for the market is it wants such crystal clear guidance and wants more signalling about when these hikes are going to come that it just hasn't been able to, you know, get the green light to be able to buy the yen up, and that's why we've seen dollar yen move above 157.
So just walk us through that market reaction then. You've mentioned the yen, but it seems like this is spreading more globally.
Yeah, so I think, you know, the thing with the yen is I think there's two factors at play here. You know, one, like I said, we're not getting enough guidance, or the market doesn't think it's getting enough guidance on when these hikes can come. And then we're also, you know, got a bit of fiscal elements as well. You know, the Takaichi government, that's very much looming large. Those fiscal policies, they're incredibly loose relative to what the market's hoping for. And no matter what the BOJ does in the short term, there isn't really too much the yen can do. And, you know, I think this is also, there's a bit of like a broader market theme here where markets, you know, in the price area of the cycle where markets really want to start beginning pricing hikes. I know we've already got a few from the BOJ, but if you take the ECB yesterday as an example, we saw the euro sell off during the press conference because the markets didn't really get any explicit guidance from President Lagarde about when those next hikes can come, which ultimately I think personally was a unrealistic assumption to have in the first place. But in terms of, you know, yen going forward, I think the path of least resistance is probably to keep selling the yen. I know verbal intervention looms large, but I don't think the market's going to buy that. There's obviously the risk of physical intervention, but I don't think we're quite there yet. But that will naturally, you know, place a bit of a floor on some of the losses for the yen.
I feel like constructive ambiguity is part of the job when you lead a central bank. Good to see you, Adam. That's Bloomberg's Adam Linton. Well, over in Europe, the EU has reached a historic agreement to aid Ukraine.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years. We will do this by way of enhanced cooperation that is backed by the EU budget headroom.
On the ground for us in Brussels is Bloomberg's Oliver Crook. Ollie, we need to get your explanation of what this agreement means, because it's a complicated one. And where does it leave peace talks as well as that?
Yeah, after 16 hours of negotiations here in this very building here in Brussels, after all those European leaders are sitting around the table to try to find a breakthrough, to find a way to fund Ukraine for the next 2 years with that 90 billion euro loan, they found a solution, and I think we can say an intensely European solution. It's a little bit complicated, but what's going to happen is that 90 billion euro loan is going to be delivered to Ukraine, backed by the European budget, as you heard Ursula von der Leyen saying just there, backed by European joint debt, and ultimately, they say, backed by those Russian assets. Now, what they mean by that is that this loan for 90 billion euros given to Ukraine will be done at 0% interest, and that ultimately the Ukrainians will only have to pay it back if the Russians pay reparations to Ukraine. If they fail to do so, then they will be using and monetizing those assets that are held here in Belgium. And this was, of course, the sort of sticking point for these conversations. Going into this meeting, we heard from a number of different leaders, including the Chancellor of Germany, Friedrich Merz, saying that basically there was no way of going forward with this without using the frozen assets, but they have found a way to do so. So what this sort of satisfies are the concerns that there were around Belgium. They also have a carve-out for Slovakia, the Czech Republic, and Hungary. They don't need to back that 90 billion euro loan. It's only the other European member states that need to. And of course, it gets the money to Ukraine. What it also does is it allows the member states, everybody within the European Union, to say that they do not carry this risk on their own sort of member state balance sheet, which is not true, but it's a little bit more complicated to that. There is an effective deferral about what to do with these Russian assets in terms of making that decision. Some will call this a very elegant solution to the problem. Others will say it's a very elaborate kicking of the can down the road.
All right, Ollie, thanks for the explanation. I mean, we've heard from Putin in the past few minutes saying that these attempts to seize Russian assets are robbery. He says Russia will protect its interests in the courts. Seizing Russian assets would hurt the global finance system, and promising legal actions in the case of seizing those Russian assets. Oliver Crook, we thank you so much for breaking that down for us. Well, let's turn to tech now, because TikTok says that it's signed agreements to create a new US joint venture, majority owned by American investors. An internal memo seen by Bloomberg from the CEO, Shu Chu, tells employees that the agreements have been made with Oracle, Silver Lake and MGX. That deal expected to close on January the 2nd, 2026. Bloomberg Tech Europe anchor Tom McKenzie joins us now for more. Tom, how is this likely to go down in China? Will it solve some of the issues around that US-China relationship?
So I think it's a key question to watch is how China responds to this. You would assume that ByteDance wouldn't be going ahead if they hadn't been given at least tacit approval from Beijing, but we still need that official line from the central government in China, of course, to have the all clear on this, because they, of course, ultimately have the levers to pull if they want to derail this. To your point, it's also central in that relationship between the US and China. We know that President Trump is gearing up for that visit to China for the first time in this second term, of course, as president, potentially in April of next year. So they certainly, both sides want to get this cleared away before that visit, you would imagine. So it would be a hurdle that they would get across if this happens, and that would be beneficial to the broader relationship. What we know about this deal, and this is why Oracle is up, is that Oracle is one of the key partners then taking over TikTok US, which under the previous deal, the memo that the White House put out, was $14 billion US. There's a lot of analysts that think that TikTok US is much more valuable than that. So if the ticket price is $14 billion, then Oracle will be seen as having done pretty well in terms of the potential upside that can come through as a result of ownership of this. It's not just Oracle, it's Silver Lake as well, and MGX, which is a Middle Eastern fund. So that money's coming together. Interestingly, ByteDance, the parent company, is still going to have about 20% stake, 19.9%. So the other thing to watch is how much pushback you get on Capitol Hill, because, of course, all of this came about as a result of a piece of bipartisan legislation that ended up on the previous president's desk, Biden, who signed off on it. It was bipartisan, which was to essentially shut down or completely carve out TikTok US because of concerns about data, because of concerns about the algorithm. And so whether or not this meets the test to satisfy those lawmakers who helped craft that bill, I think it's going to be interesting to see what kind of response you get, both from Republicans and Democrats on that front.
Well, Tom, you mentioned Oracle, and we've also had the news that Michigan regulators have approved the Oracle and OpenAI data center project. It's a massive one that needed powering. Does that basically show that Blue Owl's concerns when it backed out were unfounded, or are there actually other lingering concerns around this?
Yeah, so Blue Owl was a trigger for some, at least, in terms of further caution about what's happening in terms of commitments around spend and liquidity and the financing of some of these projects. We don't know exactly what the rationale was for Blue Owl to pull out of that deal. The reporting suggested that they just were uncomfortable with the terms, not necessarily that this whole ecosystem is necessarily problematic. So I think I would put that caveat around the Blue Owl story, but of course you're right, it did draw a lot of attention. What it reminds us of, the story around Michigan and OpenAI and Oracle, is that the build-out continues. And there are very few in this space who think that there's going to be a sudden halt to that. It's how it's funded, and it's whether or not you get the revenue streams on the back of that. Interestingly, the information has come out and said that OpenAI is on track to beat its revenue target for this year, $14 billion US, 13 billion, I should say. That compares to 4 billion last year. So OpenAI on track to beat those revenues. Of course, revenue is very different to profit, so we'll see what comes out in the wash as they continue to look to raise additional capital. The Wall Street Journal reporting that OpenAI is looking to raise potentially an additional $100 billion US dollars at a market value or valuation of $830 billion US dollars, and that could be happening within the first quarter of next year. So the capital raise continues and the build-out of data centers continues, even as the question marks are still there in terms of whether or not this ultimately all pays off.
Yeah, significant numbers for Q1. We'll continue to watch that. Tom McKenzie, we thank you so much for that analysis. Now, let's get to some other top stories trending on the terminal this morning. The Trump administration has suspended the green card lottery program, which it says allowed the suspect in the Brown University and MIT shootings to come to the US. According to Homeland Security Secretary Kristi Noem, the pause is intended to, quote, ensure no more Americans are harmed by this disastrous program. Elsewhere, Toyota is building on its charm offensive to try to get President Trump to ease steep tariffs. Toyota is going to begin introducing 3 models produced in the US, the Camry sedan, Highlander SUV and Tundra pickup truck to the Japanese market from 2026. And Goldman Sachs lags record gold and weak oil in their 2026 commodity picks. Goldman expects gold to hit a fresh record next year with a base case for a rally to $4,900 an ounce. By contrast, oil faces downside risks, burdened by a surplus Brent, and that's expected to average $56 a barrel next year. Well, coming up on the programme, Nicholas Cadbury, CFO of the International Airlines Group, will join us next on this holiday travel season. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Lizzie Burden in London. Now, for the latest episode of CFO Briefing, just in time for the holiday travel season, it's Nicholas Cadbury, Chief Financial and Sustainability Officer at the International Airlines Group. Bloomberg's CFO Briefing is a weekly newsletter for and about CFOs, featuring top executives at global companies and covering trends in corporate finance. So, Nicholas, it's a real pleasure to welcome you to the show. I want to talk about your outlook for 2026, if we may. I wonder how you are thinking about the biggest risks when it comes to air travel, when it comes to geopolitics, when it's consumer confidence, or if the biggest risk actually is something more close to home, like the delivery of aircraft.
Nice to talk to you, Lizzie. We're just closing 2025 at the moment, so looking forward to 2026 immensely. Actually, what we're seeing overall is just people just continuing to just want to travel. You can see it in credit card data and surveys that people just want to kind of get on a plane and travel. People are spending more money on experiences at the moment, and we're really seeing that. I think one of the things that's really helping us, and it's helped us for many years, but continuing to do so, is it's particularly those premium traveling customers who want to go. We're based in the southeast of the UK, so 65% of our customers come from London and the surrounding areas, and we're flying into some of the richest markets in the world, particularly into North America as well, and therefore we're really getting the benefit of those premium traffic customers who are really filling the front of our planes overall. So that's really positive as well. We're also seeing just in kind of we're very focused on both the North Atlantic but also the South Atlantic as well, and we're seeing that kind of growth across the the South Atlantic as well. I don't know if you've had a chance to go to Miami lately, Lizzie, but it's a really booming city full of bustling restaurants, more five-star hotels, and they've been there for a long time. And about 15% of people who live in Madrid are South American based, and they're just kind of traveling between the South America more and more, and kind of not just for friends and families, but also for business as well. So we're seeing that there are risks kind of ahead of us, of course, as economic kind of risks and kind of fuel price risks at the moment. But I think that kind of continual growth that we're seeing overall for travel is going to outweigh that overall. So we're feeling very positive.
Alas, I haven't been to Miami for a number of years. I'll have to refresh that. I've been stuck in London, Nicholas, and I'm interested where you say that the concentration...
not Miami. Madrid is the new Miami.
Okay, you heard it here first. Look, you have a concentration of customers here in the UK, in London and the southeast of England, as you say. Given that we are flirting with recession here in Britain, is that concentration actually a vulnerability for you?
You're always kind of wary of kind of recessions overall. I think what we're seeing right now, though, is that just where we're based, just in terms of the kind of demographic of our customers and where we're based in London, is actually kind of outweighing that at the moment. And because we're flying mainly into rich North America as well, we're just not feeling that at the moment. So we're seeing kind of really positive trends overall. People have just been, over the last 20 years, people have been traveling more and more, and we just don't see that stopping. People are spending that, as I said, people are spending more on kind of, seeing friends and family and visiting, places for experiences, and that's just going to continue to happen.
So you've not seen any change to that transatlantic travel because of the change of administration? I'm thinking about the rhetoric, the visas, and the trade tensions as well.
We saw a little slowdown kind of around about April time overall, just when there was a bit of uncertainty with what was happening overall. But actually, the slowdown was actually mainly just from America, people flying into Europe, actually. But in the last few months, we've seen actually strong growth come back actually overall. So that's been kind of counterbalanced, and actually the kind of bookings from the UK, and again, particularly on that premium traffic, have been very strong as well. I think one of the kind of great strengths of the group, though, particularly, is that we're quite diversified. We're not just about flying across the North Atlantic. We're also about a strong business across Europe, and also strong with Iberia flying into South America as well. We also fly into the Middle East and also into the Far East as well. But actually, we're a very well diversified business, which means you can see weaknesses in some place, but actually you can see they're kind of countered by strength elsewhere in the business. So overall, we're feeling fairly positive about next year overall.
Well, as CFO, I have to say I've been marvelling, Nicholas, at your margins, especially compared to your European and US peers. How is it that they're so much higher for IAG?
I think that's the kind of benefit of our business model overall. We've got a kind of target range that we have to get to 12 to 15% margin for our businesses. Just to put that in comparison, most of the American full-service carriers make 8 to 9% margin, and most of our kind of peers in Europe make 7 to 8% margin. So we really are unique and stand out in our kind of financial strength and our margins as well. And the way that works overall is where the IAG, the holding company, is very, very focused on allocating capital to the best returning airlines. And what that generates is it means that each airline really has to transform itself to deliver the best margins possible to earn that capital overall. And that kind of generates internal competition and drives performance and gets us to those high margins. We're also based very, very clear in terms of where we're focused in our marketplaces in North America, South America, and across Europe as well. And they are very, very strong markets, particularly in London. You've got that kind of wealthy population. In Aer Lingus, in Dublin, we've got a huge kind of diaspora of Irish people in North East America, and then in Madrid, you've got that kind of strength from Iberia flying across into South America overall, and those things are really helping drive the margin. The real benefit of that, Lizzie, overall though, is it kind of really helps build our kind of financial strength, and our balance sheet is incredibly strong, which again is so important for the airline industry. We've got very low debt at the moment. We've got much less debt than we had going into COVID. We've only got about 1x net debt overall. We're investing very heavily in our business overall, investing 4.5 billion euros per year in the business, but we're also being able to really benefit our shareholders. Last year we gave about 1.6, or this year we gave about 1.6 billion euros back to our shareholders, and that's all just to the strength of those margins that we're able to deliver.
Well, I do wonder whether you're keeping some money in your back pocket for deal making, Nicholas, because I know that you've got your eye on expanding into Portugal. I wonder whether that potential deal is more about Latin America or about shaping the next phase of European consolidation.
Yeah, IAG is a great home for airlines. You know, we've done that. We've bought Aer Lingus, we've merged with Iberia and British Airways, we've got Vueling, we're setting up Level. So we're a really good house for airlines. And we think TAP, the Portuguese airline, would be a great asset to kind of build into that house overall. We're very, very strong into Spanish South America, but less strong into Portuguese Brazil at the moment. And we'd love to set up Lisbon as a really strong hub within the IAG to grow that. The issue for us is the government are only at the moment planning to sell a minority stake in the airline, and that's an issue for us overall. We want to grow towards that 12 to 15% margin. They're currently making about 8% margin, so we'd really need to transform the business, and to do that we'd need a real clear path to ownership, full ownership or majority ownership, and that's at the moment that's not on the table. So we need to work very hard with the government to understand how we'd be able to transform the business to really get it to be operating properly, and therefore enable us to invest in the business overall. If we can't do that, it's going to be a very difficult deal to do.
Okay, well, conversations continuing then with that government. Nicholas, a real pleasure to get to talk to you this morning. Nicholas Cadbury of IAG, we thank you. And do check out the CFO Briefing newsletter by subscribing on your terminal or on Bloomberg.com/CFO Briefing. You can see the QR code there. Time now for your front page news. First up on the New York Times, we have the suspect in the Brown University shooting found dead in New Hampshire. The man, a 48-year-old former Brown student, was found with a self-inflicted gunshot wound in a storage unit. Officials believe that he was also connected to the killing of an MIT professor this week. So that on the front of the New York Times. Next up, we turn to the Wall Street Journal and President Trump signing into law new powers to screen and restrict US investment in Chinese tech firms. That legislation citing entities in China and other countries of concern that develop dual-use technologies that have commercial and military applications. And just finally, we turn to the FT. China boosting AI chip production by upgrading older ASML machines. According to FT sources, Chinese manufacturers are buying components on the secondary market to improve their machines. Export controls prevent them from buying the higher-end ASML devices. Just quickly checking in on your markets, and we have futures pointing higher, up 0.3% for S&P E-minis, up 0.5% for Nasdaq futures, and the 10-year US Treasury yield there at 4.14. Coming up on the programme, we'll wrap up a week full of data and rate decisions with JP Morgan's Kelsey Barrow. That's next. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. here in London. Good morning. Happy Friday. I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. An American reset, an Oracle-led investor group will buy TikTok, advancing plans to separate the social media firm from its Chinese parent, ByteDance. And President Trump signs into law new powers to scrutinize U.S. investment in Chinese tech firms. All of that as we wrap up a busy week of data and rate decisions, plus the UMich sentiment survey is on deck. Checking in on these markets, and it looks like we're going to have a positive end to the week on Wall Street. US futures pointing higher after you had those gains on the S&P after the CPI surprise yesterday, before they were paired towards the end of the day as economists got skeptical about the data. The bond market, meanwhile, was less convinced that the data would lead to more Fed cuts. But indeed, the bond market is where the action really is happening this morning. We had that BOJ hike, JGB yields up to 1990s levels. You can see it there on the 10-year, up above 2%, and that seemingly having a read across into treasuries and your European bond space at the long end, though perhaps not to quite the same extent. Let's look under the hood, though. We've got some stocks to watch. Valerie Teitel is back with those.
Good morning, Lizzie. Let's start with a check in the retail space. Nike shares not doing very well in the pre-market, down over 10%, and this comes after they warn of a sales decline in the current quarter, pointing fingers at some weakness they're seeing in China. And this comes also after the previous quarter saw some brands of theirs struggling. Converse sales dropping 30% in the last quarter. The CEO still saying investors that the turnaround is on track. They're just in the middle innings. Let's move over to FedEx. Again, another disappointing report here. FedEx shares are down just shy of 1% in the pre-market trade. They're undergoing this network overhaul. They did hit some cost overruns in the previous quarter, having to do with the grounding of some of their planes. But again, this network overhaul, we are expecting it to eventually pare down its cost overruns. But FedEx shares and FedEx investors disappointed by the latest report. Lastly, let's end on a positive note here, Lizzie. Shares of Oracle rising over 5% in the pre-market trade, as TikTok has confirmed they will be part of that U.S. JV to take over the TikTok U.S. ops. They will run around 15% of the U.S. TikTok operations. Now, note that this deal has yet to be approved by Chinese regulators, but they do expect this deal to close in late January.
All right, we'll dive back into that tech story later in the hour with Tom McKenzie. But for now, Valerie, thank you so much. Now, let's get back to the broader markets. Japanese 10-year yields rising as the Bank of Japan hiked rates to the highest level in 30 years. Joining us now is Kelsey Barrow, fixed income portfolio manager over at JP Morgan Asset Management. Nice to see you, Kelsey, as always. Let's talk about the BOJ then. No fresh guidance, it seems, from the press conference. When do you expect the next hike from Tokyo?
Yeah, so based on the guidance that they gave, it seems that the Bank of Japan is going to continue on a gradual hiking path. So there is still space for them to hike rates towards more of a neutral setting. So they are in a process of normalization, but the pace is still, you know, I would say probably more like every 6 months versus something that is more frequent. And I think an interesting thing to look at in terms of the market reaction is the divergence we're seeing right now between the reaction in JGB yields and the reaction in the yen. So you have the reaction in JGB yields, which are moving higher on this more hawkish BOJ decision, but you have the yen that's also continuing to weaken. And I think some of that is on a bit of disappointment heading into the decision, with some hopes that the pace of rate hikes may accelerate in the next year. So far, the Bank of Japan is staying pretty even-keeled as it relates to the pace of that hiking.
Yeah, Governor Ueda seeming not to take the opportunity to counter that yen weakness in the press conference earlier. 157 per dollar is where we trade on the yen right now. I just want to turn to the US as well, Kelsey, because we had a raft of pretty noisy data from the US this week. Yesterday, that CPI drop, a sudden CPI drop, and I've seen different strategists describing it as a Swiss cheese report because it was full of holes, and an advice to take it with an entire salt shaker. I wonder if you were that skeptical and really if it's changed your outlook to Fed cuts next year.
So this data hasn't changed our outlook, but the way that I would think about it is differentiating between the direction of the surprises and the magnitude of the surprises. So to me, the direction of the surprises made sense. So you had the unemployment rate surprise on the upside. The trend for the unemployment rate has been fairly consistent. It's been ticking higher. Now you have the trend, the surprise on the inflation side, inflation surprise to the downside. Again, that makes sense to us. We are seeing a lot of leading indicators on the service inflation side that continue to suggest that outside of the tariff story, we should start to see further normalization in inflation towards 2%. So the trends to us remain consistent, but you do need to be skeptical about the magnitude of those surprises in these data points, given what we know about the government being shut down and how that impacted data collection.
So as we think about how gradual the Fed's descent will be, where do you like along the Treasury curve?
So along the Treasury curve, we've been hanging out in the belly of the curve, so the 5 to 10-year point. There's a couple reasons for this. One is when we have had, and this year has been strong for fixed income and for equities, but when we have had those little bobbles in the equity market, the flight to quality bid that you see in high quality fixed income tends to be the strongest in that belly of the curve. So there is one reason to like that point in the curve. And we also think that in terms of our range for the 10-year Treasury, you know, we've had a fairly consistent range of 3.75 to 4.25. We continue to expect us to maintain that range next year, which means, you know, that's not a huge move in the Treasury market relative to where we are now. But when you're at the higher end of the range, if you're someone who's more underallocated to high quality fixed income, you know, that can be an area to tactically or more strategically add to your position. And when you're at the lower end of the range, you know, that's where we'd be saying that you know, should be fading some of the price momentum. And it's a function of, on the upper end, what's keeping yields from rising too far is that we do think that the Fed will maintain an easing bias. And at the lower end, what we think is keeping yields from rallying too much is that the odds of a recession are still fairly muted.
I also want to turn to Europe because we've had a flurry of ECB officials this morning, Kelsey, coming out after that decision to hold rates yesterday. They're trying to keep the door open to either a cut or a hike next. Are you convinced that Frankfurt's done with cuts?
Not sure. We do think that ultimately the ECB is going to be on hold for the totality of 2026. But I will say, as someone who's based in the U.S., I found it very interesting how Lagarde handled the questions on the balance of risks versus Powell. So when Powell was asked about the risks of the Fed funds rate being more two-sided, he was very clear that the committee is not considering hikes. He was very quick to rule that out and to make sure that the markets knew that the bias was still, a decision between holding rates or cutting rates. Whereas Lagarde was much more ambivalent and kept it open in her response. So I think that that is an interesting point, and it does speak to where the ECB is in their easing cycle versus where the Fed is. We think the Fed still has a little bit of space to cut rates just to get back to neutral, whereas the ECB is already there. They moved a little bit faster.
Yeah, we were discussing the constructive ambiguity, in quote marks, earlier in the programme from the ECB and the BOJ, and it's interesting to make that comparison to the Federal Reserve. I also want to ask you about something we were discussing with Oliver Crook earlier in the programme, and that is this EU decision to agree this €90 billion loan to Ukraine. Does that change your outlook for European bonds at all?
Well, one of the things that we're very focused on as it relates to the European bond market is the fact that the direction of travel on the fiscal side is clearly towards more expansion. And I think the question is, does that expansion ultimately lead to more inflation or not? I think for now, we think that the inflation story is a little bit further out. They're still in a generally okay place. But that being said, it's why Lagarde was more even-handed in her view of the direction of policy rates from here, because I do think that they expect a decent growth backdrop next year, and we see the European governments preparing to spend more, whether it be to support Ukraine or whether it be to support their own initiatives in defense or other areas of infrastructure.
Okay, Kelsey, always a pleasure to talk to you. Kelsey Berry there of JP Morgan Asset Management. Thank you so much. Now, to some other top stories trending on the terminal this morning. The Bank of Japan, as we've been saying, raised its benchmark interest rate to the highest in 30 years and said that more increases are in the pipeline if conditions allow. In a unanimous decision, the policy board increased the rate by a 0.25 percentage point to 0.75%. Governor Kazuo Ueda said that the central bank intends to keep raising borrowing costs if its economic outlook is realised. Elsewhere, the EU has agreed to loan Ukraine €90 billion, or about $106 billion, for the next 2 years. This in order to strengthen Kyiv's hand and keep the war-torn country afloat. The EU will fund the loan through joint debt raised on the capital markets and will be backed by the bloc's budget. And Goldman Sachs flags record gold and weak oil in its 2026 commodity picks. Goldman expects gold to hit a fresh record next year with a base case for a rally to $4,900 an ounce. Meantime, Goldman analysts say that oil faces downside risks burdened by a surplus. Brent is expected to average $56 a barrel, WTI at $52. Well, coming up, suspending the green card lottery, the Trump administration halting the program, saying that it was used by the suspect in the tragedies at Brown and MIT. We'll get you more details on that next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars, Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Now, the Trump administration is pausing the US Green Card lottery program, stating that it was used by the suspect in the Brown University shooting and the killing of an MIT professor. Homeland Security Secretary Kristi Noem posting on X, quote, "I'm immediately directing US Citizenship and Immigration Services to pause the program to ensure that no more Americans are harmed by this disastrous program." Joining us now for more is Jonathan Tamari of Bloomberg Government out of Washington. Jonathan, just talk us through what more we know about this suspension and really any potential economic blowback.
Yeah, we don't know a lot, as is often the case. This is a major policy announcement announced on X with just a few little details. So we'll see how much more of that unfolds over the coming days. But we know that this is a program that allows in roughly 50,000 people annually. And we know that obviously this is part of a much broader crackdown on immigration that the president and the administration has undertaken, including after an Afghan national shot 2 National Guardsmen here in Washington. And so it's part of just increasing restrictions on immigration. And I think we'll have to wait for further details from the administration that go beyond this quick announcement on social media.
Okay, and meanwhile, the president's delivered a raft of pre-Christmas sweeteners in really just 24 hours or even less. What do they tell us about his political priorities?
Well, it tells us that the president or the people around the president think that he really needs to turn his attention back domestically. He's been really focused on peace deals overseas, working on the Gaza war and then Ukraine. He's been traveling. And there's been concern among a lot of the voters and among some fellow Republicans that, he was elected to deal with the economy, to deal with inflation, and that there's concern that voters believe his attention is focused elsewhere. We're heading into an election year. Just in a couple weeks here, we'll be turning the calendar. And Republicans in Congress are worried about their majorities. They want the president to be focused domestically. And this seems to be kind of a splashy way for him to make some big announcements and tell people, yeah, I'm focused on things here on the States too.
Well, let's say he goes ahead with closing the federal government on Christmas Eve and on December the 26th. What would that mean for Treasury sales?
It's another big question. Again, one of these situations where the president makes an announcement and there's not a lot of detail. There's supposed to be a bond sale on the 24th. It includes $44 billion of 7-year notes. And, the administration has not said exactly what they're going to do. This New York Stock Exchange, NASDAQ, say they're going to keep their regular announced hours, but it's unclear exactly what the Treasury Department would do. And again, it's a case of the president making an announcement and the details will have to follow.
And just finally, Jonathan, we're going to talk TikTok in just a moment, but the president's also signed into law new efforts to limit US investment in Chinese tech firms. How far does that legislation actually go?
It goes pretty far. I mean, there was discussion of this for a while. And to be clear, the President Joe Biden had instituted some of this through an executive order in 2023, but now it's actual law. And there had been discussions about to focus on certain sectors, to have kind of a sanctions list of restrictions. And they've kind of adopted, Congress has kind of adopted all of those. So they really want to crack down on U.S. investment in China, and they've taken a pretty broad approach to this right now.
All right, Jonathan Tamari of Bloomberg Government, great to see you. Happy Friday. Hope you have a good weekend. And I want to stay on that theme because TikTok has a new owner. A group of investors led by Oracle are going to buy TikTok, advancing a long-delayed plan to separate the social media firm from its Chinese parent company, ByteDance. Bloomberg Tech Europe anchor Tom McKenzie is back for more. Tom, we've talked about how this might go down in China.
Yeah.
We just heard there about the president signing into law these new efforts to limit US investment in Chinese tech firms. How much can the TikTok deal go to easing the tensions between Washington and Beijing?
Well, it certainly has. To your point, it has been an impediment towards improving relationships. It's been a stone in the shoe for both sides. And now it seems we are materially getting closer to at least resolving this issue of tension between Beijing and Washington. We're looking at towards the end of January for this deal to close on current reporting. And this would, to your point again, involve Oracle, involve Silver Lake and MGX taking a almost 50% stake, along with some others, US investors in TikTok US, which at times has been the most downloaded app on the App Store, on the Apple App Store, just to give size and scope. The value of the deal had been flagged around $14 billion US. We'll wait to see if that is confirmed, but that is maybe part of the calculus for investors in Oracle pushing up the share price today, because for some that's seen as quite a bargain for an app that has so much potential in the US market going forward. What they're trying to do, of course, the US with this deal is address those data security concerns and concerns about the way the algorithm could be used to manipulate content and targeted at the US, and make sure that's all sitting essentially in the US. You're right. Look, we need to get an answer from China and an official response to this, but you would assume that ByteDance, the parent company that sits in Beijing, that they wouldn't be going ahead with this if they hadn't given at least tacit approval from Beijing. The other element to this is to what extent lawmakers in the US respond to this as well, because it's been something that was a bipartisan bill pushed by and signed off and advocated for by Democrats and Republicans. So whether or not they're comfortable with the structure remains a question, because ByteDance will still have a 19.9% stake in this entity. Whether that is enough to address those concerns, I think, is a key question.
You mentioned Oracle. We've also had the news that Michigan regulators have approved Oracle and OpenAI to power these massive data centers in that state. Does that kind of show that Blue Owl's concerns were maybe a bit unfounded, or are there still lingering concerns about this?
Yeah, so Blue Owl was one of the parties looking to invest in a particular data center. They had concerns, and they decided to rethink that. And the reporting suggests that there was the terms of the deal that was a concern, rather than necessarily the broader picture around what's happening in terms of the financing of these data center projects. But for many, that was seen as a uh-oh moment. And there is going to be greater scrutiny on the terms of these deals, on the leases that companies like Oracle commit to. They've committed to almost $250 billion of leases. That far outstrips any of their competitors, any of the other hyperscalers. That is a massive commitment from Oracle. And for many, Oracle is going to be the canary in the coal mine. For many, Oracle is the proxy through which you play the OpenAI story, until that company lists, of course. And there's a big question about how much OpenAI can continue to have that competitive lead as Gemini 3 and others come through. They have done this data center then in Michigan, 1.4 gigawatts of energy. That is enough, or the equivalent energy that would come from a nuclear power plant. And OpenAI, longer term, want to be building 8 gigawatts in the US longer term over a three-year period. This is a $14 billion project, contentious locally, and you expect these data center build-outs will continue to be ever more contentious among local populations and local businesses, given the constraints on the energy grid.
Well, yeah, speaking of whopping great numbers,
Yeah.
the Wall Street Journal reporting that OpenAI aims to raise as much as $100 billion in an $830 billion valuation. How significant is that in a world when we're talking massive numbers all around?
Yeah, and it ties up some of the reporting that our own team have been doing. For example, Amazon in talks with OpenAI. That was was Bloomberg reporting around $10 billion US. So Wall Street Journal looking at 100 billion is what they're saying. Ultimately, this investment round is going to come through potentially in the first quarter of 2026 with a valuation of north of 800 billion US dollars for OpenAI, which for the context would make it probably the second most valuable startup on the planet after SpaceX. So it's a reminder that Sam Altman and the team continue to fundraise aggressively at a time when, according to reports from The Information, they are set to beat their revenue targets for 2025, which could go some way to alleviating some of the concerns there about just the prospects for OpenAI. $14 billion US is the revenue that they expect to get for this year versus $4 billion last year. 13 billion this year versus 4 billion last year. So that is progress on OpenAI's front as they continue this fundraising round, potentially, as you say, $100 billion US.
Okay, Tom McKenzie, our Bloomberg Tech Europe anchor, who of course has spoken to Sam Altman not so long ago. Well, coming up, we're going to get you set up for your trading day, so do stay with us. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Now for a look at what's ahead today. First up, the UMich Sentiment Survey. That's coming in at 10 a.m. Eastern, along with US existing home sales also at 10. And then earnings from Conagra Brands, that coming before the bell. Let's have a look at your micro movers this morning. We start with Nike extending its loss after warning that sales will decline this quarter, citing persistent weakness in China and at its Converse brand. We also have FedEx lower after reporting earnings as cost headwinds linger. And then, as we were just discussing, Oracle signing agreements with TikTok and its parent company ByteDance to form a new US joint venture. Putin just now saying that he's ready for talks to end the war in Ukraine. He says it's wrong to say Russia's rejecting anything. This is your Bloomberg Brief. Surveillance next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The news flow on the AI story will remain volatile.
Scale is getting to be even more important given the investments that are needed in AI.
Anyone investing solely in AI right now is taking risks they don't need to be taking.
There are some tailwinds for U.S. companies into next year. The earnings engine in the United States is on.
In the end, the fundamentals will dominate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is Friday. Good morning. Welcome to Bloomberg Surveillance. Finally getting a spot of positivity, an unusually skeptical December, with stocks building on yesterday's rally. A renewed focus this morning on TikTok, with an agreement being signed with firms including Oracle about a joint venture. Oracle shares higher this morning, and a Bank of Japan rate hike, capping a big week of central bank decisions with Japanese yields at the highest levels going back 30 years. You are seeing just a bit of yen weakening this morning. Danny Berger alongside me this morning. I'm so pleased to say, Danny, it really does seem like such a huge divide between the rest of the world and the United States when it comes to the rate cutting or rate hiking type of backdrop.
100%, because you have, as you say, the Bank of Japan hiking rates to a 30-year high. The ECB yesterday putting things on hold, in a Bloomberg story out shortly after of officials saying the rate cutting cycle is over. Then you had a more divided and hawkish BOE decision. For now, the U.S. is concentrating on CPI. But as we get into this quiet period, how much of the narrative turns into there are holes? So maybe the more important thing is what's happening to bond yields abroad and that pressuring us here at home.
Right now, it seems like people are saying, yes, there were holes in that CPI report. Yes, it was completely unreliable. Yes, you cannot look at this and say that that is how much CPI actually did go down relative to the month before. However, we don't care because it's going to give this Fed a chance to run this economy hot, which is the thesis heading into 2026.
To be fair, Austin Goolsbee, who was one of the FOMC members who dissented in the last decision, he was out yesterday saying that there was a lot to like in the CPI data. He said, yes, you need more than 1 month, but having someone who's maybe on the more hawkish side, kind of confirming that the data's looking better, that was just another feather in the dove's hat. But maybe it's enough just to kind of get this narrative shift that things are cooler, even if, you know, owner's equivalent rent is, you know, some people saying that someone should be fired for it.
Yes, we saw that report yesterday coming out because there just is a zero put there if you don't have the comp. Meanwhile, we are looking ahead to a big year of geopolitics and a question of the government's role in really supporting big tech in the United States. We saw finally there does seem to be some sort of joint venture with TikTok. I think this is really interesting in light of some of the bigger questions about the U.S. government's involvement in big U.S. companies that are considered strategically important.
And Oracle and the Ellisons just keeping a thread in so many of these deals, whether it be this, whether it be Warner Brothers Discovery. How much of this deal making is away from the world of we're buying things because they grow well, versus we're buying things because we're closely connected to the government and we want to be involved in whatever national security concerns that the government also has.
I want to hear what Larry Ellison is hearing, because let me tell you, I think that would be actually quite instructive right now in markets. A question about whether we can reprise the Santa Claus rally that isn't this year. We're down about 1% on the S&P so far this month, even with yesterday's bounce this morning, trying to build on that, up about 0.25%. I feel like every morning we're up between 0.25% and 0.5%, and then it's a wild ride for the rest of the day. Meanwhile, that euro-dollar cross around that 117 mark, man, it has been pegged there. And you're looking at 10-year yields just marginally higher, up 2 basis points after the Bank of Japan rate hike to 4.14%. Coming up this hour, Kevin Mann of Henian & Walsh with stocks coming off their best day in 3 weeks. It's a low bar. Heidi Kribo-Redeker of the Council on Foreign Relations on what's next for peace talks between Russia and Ukraine. And Krishna Guha of Evercore ISI on potential holes in the CPI inflation data. What, Swiss cheese? I think, that was one thing, or take it with the entire shaker of salt. We begin this hour with stocks rising as markets close out the last full trading week of 2025. Kevin Mann of Henian & Walsh, writing his macro theme in 2026 is follow the money, saying we believe that the bull market will celebrate its 4-year anniversary. However, there will likely be short-term bouts of volatility. Kevin joins us now. Volatility seems to be the theme, and yet money is the Trump factor. What we're seeing right now is people flooding back into equities. Is it enough to get the optimism back before the end of the year?
I think optimism will continue in certain areas of the market. And to my quote earlier, I think the areas of the market that led this bull market over the first 3 years may very well not be the areas that lead this bull market over its next 3 years, if in fact it continues that long. But if you follow the money in terms of where all the money was spent in 2025 and will likely be spent in 2026, I still think there's more growth opportunities ahead.
How much is that predicated on this idea of running the economy hot? The idea that the Federal Reserve is going to cut rates on any excuse, even a very holy CPI report, I mean, full of holes, not necessarily religious. There is this feeling that they are looking for reasons to cut rates, even with inflation higher than expected. Is that sort of the base case for you?
Not for me. In fact, if I look to just a week ago from the Fed's dot plot chart at that point in time, they're forecasting just one rate cut in 2026 and one more rate cut in 2027. Now, that could all change next May when we have a new chair of the Federal Reserve. Perhaps we get both of those rate cuts in 2026, but I wouldn't expect too much during the first half of the year. But regardless of what the Federal Reserve does, we know that this AI infrastructure spend is going to continue, albeit through some circular financing levels. We know that the spending on aerospace and defense is going to continue. President Trump announced, I believe, $901 billion going towards defense in the U.S., and we know that NATO countries have committed to spend up to 5% of their GDP on defense by 2035. That's a lot of money going towards defense contractors. And how about power? The AI revolution stops without power. So we need to look at nuclear. We need to look at natural gas, and that brings the utilities into play. And then my biggest theme for 2026 is healthcare. And not traditional healthcare like large cap pharma, but small cap biotech. I think there's going to be more M&A activity. It's going to be focused on those areas such as oncology, obesity drugs, cancer treatments. If you look at the gene editing and gene splicing, that's where all the activity is going to take place. And here's a great stat for you. Over the upcoming years, over 200 drugs are scheduled to come off patent. Associated with those 200 drugs is over $300 billion worth of revenue. As all of those drugs now get subject to generic pricing, where's large cap pharma going to turn to replace all that lost revenue? They're going to have to be acquisitive, and small cap biotech is going to ride that tailwind.
You know, in all of these sectors that you're talking about, you could tie some sort of AI element to it. And usually people talk about it as a benefit. But can you talk about the other side? When you think about AI disruption, are there things that you wouldn't touch for fear of disruption, be it enterprise software, be it a radiology company? What do you want to back away from as we try to figure out how AI impacts things?
Sure, I'm going to answer that question a little bit of a different way. To provide a smoother road for investors along this AI revolution, which is going to be a very long road, as we know, filled with many potholes, I think you need to build a diversified portfolio across the entire ecosystem. Don't lean so much into semiconductors and chips and software plays right now. We're still in the infrastructure build-out portion of this revolution. I've said on this program before, I think we're in batting practice of a doubleheader. Batting practice involves infrastructure. The games involve the actual spending and deployment of AI. So I would shift more time and attention to the data center plays, data center construction, electrical connectivity, cooling solutions like a company like Comfort Systems being added to the S&P 500 next Monday. Their stock's up over 100% year to date, yet they're only trading at a forward PE of around 34. Not too rich, and then bring in the utility plays as well and some of the small modular reactors. I think that's a better ride.
Kevin, it also strikes me that a lot of what you're talking about is also happening in private markets, just
Yes.
not in public markets. Can you get the exposure you want just through public equity? Or do you need exposure to private credit, to private equity, to other parts of this ecosystem?
Yes. I've been resistant so far on private credit and private equity because liquidity is paramount to me in our portfolio structures. Liquidity doesn't matter until it matters, and generally during that periods of volatility and crisis, so I don't want to subject to my clients to liquidity concerns. But I think you can find exposure to all those areas of the ecosystem through the public equity market. And I think there's an abundance of opportunities out there, but valuations do matter. And all the means by which these companies are financing the way that they play the AI revolution is important, right? Because to me, there's going to be more losers than winners in the AI revolution. But the best way to find and identify those winners are those who are deploying capital strategically, smartly with the balance sheet to sustain themselves throughout this entire revolution. But don't just look for the next NVIDIA of the world. Look to those ancillary benefactors.
Can those ancillary benefactors win without government support? And I say this as the U.S. government gets more involved in picking the winners and losers, and a lot of the issues that we're talking about, in particular in the power area, become increasingly politically motivated. You think about power prices rising 10% in the first 8 months of the year. This raises a question, especially for an administration that wants to bring down costs.
Yes.
How does that factor into the calculus of what some of the profit landscape looks like for these companies?
I would think that the utility sector is an excellent example of an area that will benefit because of government failures with respect to upgrading and maintaining our power grid. Before the AI revolution, our grid was frail, and it was ripe for shutdown. Now, these utility companies aren't going away regardless of the AI revolution. But as we saw with the deal between Microsoft and Constellation Energy to reopen 3 Mile Island, large cap tech's not waiting for the government to fix the grid. They're going out and forming their own strategic partnerships. And then we see the evolution of these small modular reactors from a company like NuScale Power, ironically enough with a ticker of SMR, building these small modular reactors so that data centers can get nuclear power off grid. That's the future, regardless of what the government does. So some of these themes can persist with or without government intervention.
Before we let you go, Kevin,
Yes.
because you're so optimistic, it's been a pretty pessimistic
Cautiously
December.
optimistic.
Cautiously optimistic. Okay,
optimistic.
fine, but cautiously optimistic, but optimistic nonetheless.
Yes, yes.
And we're looking at a lot of pessimism to close out the year. Even good earnings reports. Nike's could have been thought of as a good earnings report. Absolutely, stocks tanking. There is this feeling, show me, and then when you show me, it's not going to be enough. What's it going to take to turn around the sentiment?
I think there's a large contingent of investors on Wall Street who really want this perceived AI bubble to burst. And I think for those investors who are waiting for this bubble to burst, they're likely to miss out on the most significant returns that the AI revolution has to offer. But there's going to be a lot more volatility next year than there is this year. We got midterms, we got the partial funding of the federal government coming due at the end of January, we got the debt ceiling debate. All that's going to create some choppiness. But I think this bull market continues into its 4th year in 2026.
Kevin Mann, thank you so much for being with us.
My
Great to
pleasure.
see you.
Thank
Kevin
you.
Mann of Hennian and Walsh here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. TikTok and ByteDance have signed agreements to create a U.S. joint venture that will be majority-owned by American investors. According to an internal memo seen by Bloomberg, Oracle, Silver Lake Management, and MGX have all signed onto the deal. It is expected to close on January 22nd, if approved by Chinese regulators. Oracle shares are up nearly 5% in the pre-market on the news. Meanwhile, the suspected shooter in the Brown University attack and alleged murder of an MIT professor has been found dead. Claudio Manuel Neves Valente was a 48-year-old Portuguese national and former Brown student. The motive for the attacks is unclear. The Trump administration has halted the U.S. green card lottery program, which it claims was used by the suspect. And the Bank of Japan delivering an interest rate hike to raise levels to their highest since 1995.
The move is part of a continued shift from ultra-loose policy. Governor Kazuo Ueda signaled markets should expect further gradual increases. A fresh read on consumer prices in Japan also showed inflation rising 3% for November, above the BOJ's 2% target. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. More on the Bank of Japan coming up. Up next, though, standing behind Ukraine.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years.
Heidi Kribo-Redeker of the Council on Foreign Relations joins us next as we do get some insight into the financing of Ukraine from Europe. From New York City, this is Bloomberg Surveillance. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Try this every single day. Let's try this again. Yesterday, we actually did get a rally, the first one in 5 trading sessions. We had the best day in 3 weeks. We're going to try to build on that, up 0.2% on S&P futures. Just as a reminder, December tends to be a great month, tends to be positive for equities right now. S&P is solidly in the red, down about 1%. The NASDAQ down about 1.5% so far on the month. Yen weakness. Explain this to me. Riddle me this. The Japanese, the Bank of Japan, raised rates to the highest levels going back 30 years, and there is a softening in the Japanese yen, even with a discussion of further rate hikes. Danny Berger, please explain.
I wish I had a good explanation. I mean, to be fair, the one people are offering up is people wanted more hawkishness from Ueda and the Bank of Japan. How much more hawkish could you realistically have gotten? This is a governor and a Bank of Japan who, upon their decision, said that they're going to keep raising rates if the outlook is met, and it looks like the outlook is going to be met. This is not a Bank of Japan or a central bank that typically gives much more forward guidance than that. So I don't really know what else we could have done.
People were looking for more clarity on when they were going to hike rates next, even with the neutral rate estimated between 1% and 2.5%. It just wasn't enough. Will it be enough turning our focus from Japan, from Asia, over to Europe with what the European Union has promised to Ukraine? Under surveillance this morning, standing behind Ukraine.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years.
Here's the latest. The EU leaders striking a deal to provide a 90 billion euro loan for Ukraine's defense efforts against Russia. This as U.S. and Russian officials gear up for negotiations in Miami this weekend. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington. and Oliver Crook in the EU Council in Brussels. Ollie, I want to start with you. Can you talk about how surprising this agreement was that they signed on to a 90 billion euro loan financed through group debt rather than seizing Russian assets?
It was fairly surprising, given that Chancellor Merz, the most influential of these leaders in that sort of room, came into the meeting yesterday saying that basically the only real option there was to getting this financing to Ukraine was seizing those Russian assets and getting them to the Ukrainians. What we have got instead is something of, I think we can say, typically European solution to the problem, highly complex, a little bit convoluted, but does take us to where we need to be from the European level. So this is a 0% loan to the tune of 90 billion euros. This will come from the European budget, so this will be backed by joint debt, which is ultimately backed by the Russian assets. Now, to explain that a little bit further, the idea is here, you give the money to Ukraine. Ukraine only needs to pay that money back if they get reparations from Russia. If Russia does not pay those reparations, then the assets come into play. So this solves the problem of getting the money to Ukraine. It solves the problem of Belgium and some of the other countries that had objected to this, because this is a loan that is not backed by all of the EU countries. It's backed by 24 of them, with the exception of Hungary, the Czech Republic, and Slovakia. And then the last point here is that then the member states and the European countries like Germany can say that this sort of risk does not sit on their balance sheet, which is not true, but it's a little bit more complicated than that. So on the one hand, one might say this is an intensely elegant solution to a pretty complex problem. One might also say it's a sort of elaborate can-kicking exercise to figure out what to do with the Russian assets, but later on.
Tyler, from Washington, D.C.'s standpoint, do we have a sense of how much patience President Trump has with Russian leader Vladimir Putin as this discussion goes on?
Yeah, hey, Lisa, good morning. Well, it is increasingly clear that the Trump administration has grown frustrated with Russian President Vladimir Putin and the pace that these talks have been progressing. In fact, though, that is part of why we heard from EU officials that this deal Oliver was just outlining came at a crucial time amid concerns that Ukraine may be forced to agree to some unfavorable terms amid this pressure from the White House to get a deal done. And these talks happening in Miami between U.S. and Russian officials this weekend, because while we have seen some progress when it comes to the talks on the European side with Ukraine, including the U.S. this week pledging that we could see a Article 5-like security guarantee in reference to NATO's mutual defense clause, U.S. officials say that that pledge is only on the table for so long. And we know that territory remains a major sticking point, which has put pressure on Ukraine, as President Trump himself has suggested that the country may need to cede land in the eastern Donbass region. Now, ultimately, this weekend, we're going to be watching two separate meetings. It's our understanding that Ukraine will have a meeting with U.S. negotiators that is separate from the one happening in Miami, led by Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner. Because, Lisa, to your question, the big question really is, what is Russia going to agree to? What will actually get them to the table amid the developments this week about these bolstered security guarantees and a plan to keep Ukraine's army capped at 800,000 troops?
Tyler Kendall, Ollie Crook, to both of you, thank you so much and have a wonderful weekend. Thank you for all the work so far in December. Joining us now is Heidi Kriebel-Redeker of the Council on Foreign Relations. Heidi, thank you so much for being with us. You recently wrote a piece about how the structure of financing the European Union agrees on for Ukraine matters. So what have we learned overnight when it comes to the structure they have laid out?
So, I mean, first of all, there was not a question in my mind as to whether or not Ukraine was going to get the financial support from the EU. It was just basically how. And they did it through collective borrowing, which I think, it's a step towards mutualized debt. But it's not. But it is absent. Three of the EU countries, namely Hungary, Slovakia, and Czech. And so I think on the one hand, that's good. They came through with the 90 billion. This is just from a timing perspective. I think it had to happen because the IMF is finalizing an $8.1 billion loan to support Ukraine, and there's a huge gap in their financing, and so the EU really needed to step up to provide support, and the 90 billion is going to go a long way there. It's not all the way there, because I think the gap that is projected over the next 3 years is 136.5 billion, which is huge, and but this is a big step in the right direction. It also, I think Oliver pointed out, I mean, it's an elegant solution in a way, because it takes the burden off of individual countries to actually provide the budget finance from their own individual budgets. So there is a bit of a collective shift. But at the same time, it would have been a lot more powerful to use the Russian sovereign assets. This was something they've been negotiating it for a very, very long time, and it was, I believe, politically a big failure for Chancellor Merz that this didn't get done.
And that's something that Ukraine and Zelensky had been arguing, that it becomes a powerful negotiating force if they were to use the frozen Russian assets. Heidi, on the other side of things, the Belgians had been arguing that it would face legal retribution and just retribution in general if they had used these Russian funds straight up. Is there any merit to the arguments coming from the European capital?
So, Belgium, I think at the end of the day, just really didn't want to do this. They had a lot of popular support in not moving forward to use these immobilized Russian assets. And Euroclear obviously, has the Russians just sued for, in case Euroclear was planning to use any of these assets, even though the structures that were being discussed would have taken the legal burden away from both Euroclear and Belgium. But at the end of the day, this is something where Merz was standing by himself. France and Italy went lukewarm and did not support him, and Belgium just pushed through and decided that this was something that they cared a lot about. I'm of two minds. I think that the EU needs to move towards collective borrowing for its own national security in order to be able to fund, for example, its own defense. But for this, it just needed to get done, and it got done by hook or crook.
What does it change, if anything, Heidi, though, to the political situation of the very highly indebted nations of France, of Italy, of others?
Well, I mean, this is going to be a burden on them, and ideally this would have been, an exercise where you didn't have to have any additional funding coming from, in particular, countries like France and Italy and others that are struggling that don't have the headroom to really borrow or put too much up to support this loan. It's unfortunate because they had an opportunity to actually use a sizable amount of Russian funds and they weren't able to get there.
Heidi Kriba-Redeker of the Council on Foreign Relations, thank you so much for being with us this morning. And great piece over the weekend that we're going to be reading and parsing through. Right now, we are seeing rates in the Euro region rising. Is this because of the Bank of Japan, or is this because of the collective debt issuance that people are expecting?
Yeah, and that's on top of Germany also saying it would be a record year for their debt issuance in 2026, off the back of an ECB that's also finished with their rate cutting cycle. Again, it adds to the political pressure that's already very present in a lot of these highly indebted European countries. Heidi was talking about some of them, France, Italy, facing those issues live.
Yeah. Potentially Germany, though, also facing those issues, given the fact that their growth has not picked up. Coming up in just a minute, Alicia Reese of Wedbush as Netflix gains ground in the fight for Warner Brothers Discovery. We'll get the latest there. Plus, Yahira Anand with your morning movers. Nike plunging on a weak sales forecast. Those shares lower by about 10.5%. Running was good. China was not. This is Bloomberg Surveillance.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Santa Claus just wasn't in the mood this year. Maybe he'll get a little bit more in the mood. What we are seeing is that lift across the board ahead of the open, similar to what we saw yesterday, and it actually came to fruition yesterday. Can we make that day two? NASDAQ futures leading the charge up 0.4% as some of those areas get inflows once again, people pouring money into U.S. equities with the idea maybe the tech sell-off has gone too far. When you take a look at the bond space, that really is where the interest is, especially in 10-year denominations, given the fact that we saw a Bank of Japan rate hike, as well as potential questions about the fiscal build out in Europe. Right now, we're looking at yields higher over in Japan at the highest levels going back to 1999, and we're looking at yields over in Germany also higher after the joint borrowing plan, up to almost 3%. In the U.S., a sympathy sell-off, right? 4.15%. But how much can we see divergence, Danny, between what the U.S. central bank is doing, what the Bank of Japan is doing, and what the ECB is really coming to fruition with?
It's going to be such a push-pull as we continue into 2026, because that is what we have seen yesterday. It was U.S. CPI that dominated the story. You can have a separate debate over the validity of that U.S. CPI, but at the moment, to your point, it's global bond yields which are pressuring things. And that had been the story of the last month. You add that into inflation concerns, and it was a long end of the U.S. curve that was doing the exact opposite of what U.S. policymakers, both in the White House and at the Fed, had been hoping for. So how much does their mission get challenged if you do have an ECB whose rate-cutting cycle is done, a BOJ who is hiking, a BOE whose rate-cutting cycle maybe is also done? Do you need to see more aggressive action and maybe some fiscal dominance coming from both the Treasury and the Fed working together?
Yeah, hello, balance sheet. 3 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Cracks are emerging in the Nike comeback story, and shares are falling sharply, down more than 10% in the pre-market. The company warning that sales will drop in the quarter, and that's due to two main drags. It's China sales and its Converse brand. But as you mentioned earlier, Lisa, it wasn't all bad. It beat on earnings and revenue in the last quarter, yet not enough to satisfy investors this morning, with shares, as I said, down 10%. Meanwhile, it's a morning of turnaround stories, or attempted turnarounds, and we have FedEx falling 2.6%, yet the company results showed the company is showing signs of success, with the CEO's overhaul and cost-cutting plans starting to bear fruit, with the company beating on earnings and raising the low end of its profit outlook for the year. Yet a tough market this morning, with shares down 2.6%. And we end on CoreWeave, the tech trade gaining steam this morning. Shares are up 5.6% this morning on renewed confidence in its growth trajectory. And it's really for two reasons. First, you have OpenAI looking to raise more than $100 billion in a new funding round. That's according to the Journal. And of course, CoreWeave is one of its most critical infrastructure partners, so it could stand to benefit from that. At the same time, CoreWeave is joining a major U.S. government AI initiative called Genesis Mission, so showing its footprint is growing. Lisa.
Thank you so much, Yahaira. We'll keep watching those names, the more leveraged of the tech space. On our radio this morning, the Bank of Japan raising its benchmark rate to the highest level in 30 years and signaling more hikes could be on the way. The move reflecting growing conviction that the Bank of Japan can reach the inflation target it's pursued for more than a decade. It has been 40 months, Danny, since we've seen inflation above that 2% target. A real question here around the neutral rate being somewhere between 1% and 2.5%, according to Ueda. At the same time, people taking this as not as hawkish as they were expecting based on the move in the yen.
I'm so glad I'm not an FX trader, because just on the surface, I would have looked at this and said, yeah, of course, stronger yen. Not only the discussion around the neutral rate, but saying that if their expectations get met, they're going to continue to hike, and it looks like expectations are going to be met. It does introduce an interesting structural change, because bond yields are still moving higher despite what the currency is doing. And that means for the first time, Japan doesn't have the lowest yields. It's now China. So it does mean things are shifting around, even if the yen isn't playing ball.
And it goes to the point you're making, which is how much does that change the landscape? Japanese buyers were a huge source of investment for U.S. Treasuries. How much does that shift that and push yields higher in the United States? That continues to be a focus heading into year end. That, to me, is going to be one of the big questions for 2026.
It really will be, because we've seen other times where the carry trade fails and it has a big impact on U.S. equities. We haven't seen that as much this year. But if you are seeing changes and a Bank of Japan that does become more aggressive, you have to assume that those risks get reintroduced along with, I don't know, what, like the other 1,000 risks that are currently on people's minds for 2026.
And then the question for the United States, how much can the Fed continue to cut rates given this split screen that we see around the world? Economists raising doubts on yesterday's CPI print that showed inflation cooling to a 4-year low in November. The report, which was impacted by the government shutdown, showed inflation rates plummeting in several categories that had long failed to see prices fall. Think about, for example, owner's equivalent rent, the Swiss cheese report that really is leaving more questions about how valid it is to even depend on for the Federal Reserve in January.
It definitely was shelter and owner equivalence rent that everyone zeroed in on, because the type of moves we saw were consistent with recessions. And in order to get the moves that we saw in the very, very tiny gains, you'd have to assume 0% for the month before. It led Omar Sharif at Inflation Insights, I think this was maybe the quote of the day, saying, "I'd fire someone, absurd." But what does it mean for data going forward? What does it mean not just for this month, but months to come? In the words of Powell, the data is not just more volatile, it's distorted. So how much faith can you really take in the data we're getting, especially to make decisions that feel like they're on a knife edge, whether to cut or whether to hold?
Yeah, data dependency taking on a new meaning. Meanwhile, TikTok beginning its separation from Chinese parent company ByteDance. Sources telling us here at Bloomberg that the social media giant signed an agreement with U.S. investors led by Oracle to create a new American majority-owned joint venture that will operate independently. More on that coming up. We also have a conversation with Jamison Greer, the trade representative who has been negotiating a lot of the different deals with China, with Europe. He'll be joining us at 8:15 a.m. Eastern. Sticking with media, traders raising bets that Netflix will win the battle for Warner Brothers Discovery after Warner Brothers urged shareholders to reject Paramount Skydance's offer. Alicia Reese of Wedbush has an outperform rating on the stock with a $140 price target and writes the following. While we're skeptical that the deal will pass regulatory scrutiny, a completed deal would allow Netflix to leverage its streaming and production expertise to broaden HBO's reach. Alicia joins us now for more. Alicia, as we see this grind on and some of the latest rhetoric coming out of Warner Brothers, how much does it look like Netflix is ultimately going to be the winner?
Yeah, it looks like shareholders have a big decision to make between, taking Paramount's hostile bid and opting for Netflix. I think listening to the Warner Brothers board, who has rejected Paramount for its financial backing, uncertainty in favor of Netflix, who has more certain financial backing for the deal. The combination, though, and the regulatory issues will be pretty high for both. If it's a Paramount deal, you have a CFIUS review that is not going to be easy, given the sovereign wealth funds that are signed up to back the deal. For Netflix, it's more DOJ on competition, not just on the side for the consumer, but also on the side for those buying content. Netflix would like to put the deal in line with other content purveyors like YouTube, but on the buyer side, YouTube only buys user-generated content for the most part, or pays for rather than buys, and the Hollywood production that would create quite a bit of concentration for U.S. buyers of content. So that really puts the deal in a difficult position to pass all the regulatory scrutiny, as well as just the impact to Hollywood overall, movie theaters and so forth. So I do think that 12 to 18 months will be long and a long dragged out process if they do win the bid.
Alicia, what do we learn just in general about the consolidation that we're expecting in the media space on the heels of this deal? The idea that size really is necessary for survival. How much more are you expecting come in 2026, given the pipeline of M&A that we keep hearing about?
Yeah, I think it's necessary because these standalone studios are having increasingly challenging times trying to keep up with being competitive in this space. Content production is not inexpensive, and a lot of these studios that have legacy media properties, it makes sense that for instance, Warner Brothers wants to spin that off and move forward. Netflix just wants to move forward with the studios. And the streaming service. That is probably going to continue. We have a few more, standalone studios left, and I think that, the tech companies that have the cash are going to take those over and take those into the next phase of the future in media.
Alicia Reese of Woodbush, thank you so much for being with us. It seems like we are wrapping up with a whole bunch of loose ends, whether it's the TikTok and the Oracle involvement, whether it's the Warner Brothers and Oracle involvement. I feel like Larry Ellison has his fingerprints in absolutely everything as we head into 2026.
It's so true. First of all, how does he find the time? And maybe more importantly for investors, how does he find the money? I mean, Oracle is outright burning cash now with all of the amount that they're spending. So what does it look like them to do a TikTok deal on top of all the data center spending that they're doing, which, by the way, we learned this week some of their financing was getting pulled back in the form of Blue Owl. So they're incredibly busy, and it's kind of this idea that everything has a flavor of some national involvement, whether it be Trump interested in the outcome of CNN, whether it be TikTok and the negotiations with the Chinese, and that's the kind of web of Ellison being tied to all these various deals.
Yeah, I looked at a map of the web of Larry Ellison and, frankly, ChatGPT, OpenAI, and their involvement, their integration in some ways, and my mind started to hurt. It became very difficult to keep track of all of the different financing pathways. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. OpenAI is seeking new funding, valuing the AI startup at up to $830 billion. According to the Wall Street Journal, the company is aiming to raise as much as $100 billion by the end of the first quarter of 2026. With renewed scrutiny over AI investment, it is unclear if OpenAI will reach that goal. Meanwhile, in a major regulatory shift, President Trump signed an executive order directing his administration to move cannabis to Schedule 3. That's a tier reserved for drugs with accepted medical uses and lower abuse potential. Rescheduling the drug could open the door for more clinical research and ease headaches for the cannabis industry by eliminating a punitive tax rule. And Toyota is increasing efforts to appease President Trump. The Japanese automaker shared it will ship 3 models produced in America to Japan next year, a move the company aims to use to meet the needs of its diverse customer base and improve trade relations with the U.S. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, questioning the data.
You do need to be skeptical about the magnitude of those surprises in these data points, given what we know about the government being shut down and how that impacted data collection.
Krishna Guha of Evercore ISI joins us next for the Swiss cheese CPI report, understanding where it was completely non-instructive and where we could actually glean some insights. From New York City, this is Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Trying to build on what we saw yesterday, a rally finally after 4 straight trading sessions of stocks heading lower after already seeing losses for the month during a period of time that typically is really positive for risk assets. This morning, trying to build on nascent optimism led by the tech space. NASDAQ futures up 0.4%. Both the S&P and Russell 2000 futures up about 0.2%. The action really lies in the bond space. When you take a look not just at the United States, but around the world, you see yields higher after the Bank of Japan raised interest rates to the highest levels going back to 1995 at a time when globally central banks seem to be ending their rate cutting cycle. The U.S. might be moving in a different direction, but Danny, this to me is the theme. How much can the U.S. diverge at a time where global rates are not exactly inflected significantly lower?
It's so true, whether it be German rates, UK, Japan, as you pointed out, also ECB and BOE decisions, to your point, suggesting that maybe we're nearing the end of the rate cutting cycle. So what does that mean as this central bank here in America tries to ease policy if it's getting pressure from abroad? And I should say, it's a bond market right now that doesn't seem to be fully pricing in the risk of that. And I say that just through bond market volatility. The MOVE index is currently at its lowest level since 2021. Maybe it's because it's the end of the year. We have CPI out of the way. Who can even trust the data? I know we'll get into that. Maybe that's why it's calm, but it does feel like there's a real risk coming from abroad to this American bond market.
Maybe it has to do with faith in exactly what you were talking about earlier, Danny, which is fiscal dominance. This idea of the Treasury and the Federal Reserve working together to suppress some of this volatility and some of the longer end sell-off that we've seen elsewhere, simply because this is such a political issue. So this is a reason why people are saying, what do we do with the data that we got yesterday? Under surveillance this morning, questioning the data.
The surprise on the inflation side, inflation surprise to the downside. Again, that makes sense to us. We are seeing a lot of leading indicators on the service inflation side that continue to suggest that outside of the tariff story, we should start to see further normalization in inflation towards 2%. You do need to be skeptical about the magnitude of those surprises in these data points, given what we know about the government being shut down and how that impacted data collection.
Here's the latest. Economists casting doubt on November's CPI that showed inflation cooling to a 4-year low after several categories with stubborn prices seemed to nearly evaporate. Krishna Guha of Evercore ISI among the skeptical, writing, "It looks as if the BLS put in zero inflation in multiple categories, biasing the read lower. The Fed will be focused on December and subsequent inflation reports to clarify whether this is noise." Krishna, I am so pleased to say, joins us now. Krishna, great to see you. Thank you for being with us. Let's start there.
Great pleasure.
Did we learn anything from yesterday's CPI, or is it just a shrug and forget and next?
So look, the report could have been hawkish. It could have had some ugly hawkish surprises. It didn't. Instead, it had what on the face of it looked like dovish surprises, though with very, very big question marks about technical decisions that may have biased this significantly lower. So I would say that from a market perspective, from an inflation perspective, the fact that we're discussing whether there is or isn't some good news here is at least better than discussing how seriously we should take some bad news. But I think that's all it is at this juncture. The Fed and the rest of us will really be waiting to look at the data from December onwards to get a sense of what the real signal is here.
Do you think, Krishna, that in general, Fed officials are going to be more willing to look past any kind of aberrations in the data collection and say, look, this just gives us a sense that inflation's moving in the right direction, the employment mandate is moving in the wrong direction. We need to keep more heavily weighting that, which is going to keep us on more dovish footing heading into next year. How much is that an accurate read of what we've seen over the past couple of weeks?
So I think there's certainly some elements of what you said, but I would be wary about thinking that the data we've gotten, since the December meeting is really going to bias the Fed significantly more dovish, right? The labor market report was not too bad, considering that it covered the period of the shutdown pothole plus that big one-off set of lagged Doge layoffs. An unemployment rate of 4.56 or 7, whatever it was, with an increase in participation. That's very consistent with what the Fed's forecasts were predicting for the end of the year. So nothing there that really, I think, pushes them more in the direction of cutting. Remember also that the private sector payroll gains for October and November were not bad, weren't great, but they certainly were on the less bad end of the range, I think, of potential outcomes. So certainly the labor data continues to be soft, but it could have been a lot worse with that pothole. So I think the Fed will be focused on seeing from the December data, from the January data, is the labor market recovering from that pothole in line with their expectation? On the inflation front, as we just discussed, the data on the face of it looks dovish. There are massive question marks around that calculation. So I think for most Fed officials, they'll be in, again, wait and learn mode. Let's see what December brings. Let's see what January brings. I don't see anything here that really pushes them into near-term action.
Krishna, you say most Fed officials, and this is where it gets complicated because this has turned into a divided Fed. We saw that with the dissents in the last decision. I have not been able to stop thinking about research and a note that you put out to clients last month where you talked about the discord among the Fed, that it risks evolving into just a healthy discord to a crisis of governance at the Fed. What would that crisis actually look like, Krishna, and how close are we to something of that nature?
So I think, at about the midpoint of the period between the October meeting and the December Fed meeting, we were really in a pretty bad place. And the risk of that kind of crisis of governance, where the Fed chair is no longer able to craft a central view that most people will sign up to, and the Fed ends up becoming more like the Bank of England, where it's a majority vote, counting heads, how many for this policy, how many for that policy. There was clear and present danger of that breaking out at the Fed. I think in the weeks just running up to the December meeting, Fed officials of all kinds pulled back from the brink some and allowed Powell to try to craft a central view, which was, of course, the hawkish hike that we got in December. Not a very hawkish hike for sure, but the idea of combining the hike with a pause, a timeout to wait and learn, and just one cut in the median projection for next year. So I think at this juncture, we are back in a somewhat more stable mode, but the reasons why that crisis of governance of the Fed was threatened in the last intermeeting cycle haven't gone away. The deep divisions over the economic outlook, the political pressures on the Fed that are polarizing people as they worry about independence and others move to align with policy objectives coming out of the administration, perhaps out of sincere conviction themselves, and the looming Powell endgame, they're all there. And so I think the real question is, as we get closer to Powell endgame and the new chair is seated perhaps ahead of taking over as Powell's replacement, what happens then? Do we see that what we saw in the run-up to December turns out to be just the tremor that suggests the earthquake ahead? Or can the next chair keep things together in the way that Powell has been able to in the end at this juncture?
What distinguishes whether a chair can do that or not, Krishna? Just looking at the candidates going forward, which candidates would you be most worried about unable to keep that kind of consensus building happening and preventing any sort of crisis of governance? And then if you do get that crisis of governance, just what does it mean for this all-important body of policy decision-making, not just here in the U.S., but really globally?
So really, in order to be able to continue in the chair-led central consensus building way of making monetary policy that has defined the Fed for at least 30-some years, the chair needs to have the trust of the committee. The chair needs to be credible with the committee. And that means, of course, above all, following a technocratic data and analysis-based approach to monetary policy, rather than appearing to follow political direction or a set of priors that aren't well supported by the data. Now, obviously, the market knows some of the potential candidates better than others, but I think whoever it is, given the unique circumstances that we are in now, with President Trump putting a lot of pressure on the central bank to do what he thinks is right, to cut rates faster and deeper, the new chair will have to show to the rest of the committee that he's willing to make policy in a technocratic way. That will really determine whether there is then enough goodwill among the others to give the chair some slack and to follow the chair within reasonable tramlines.
Krishna Guha of Evercore, thank you so much for being with us, and we look forward to having you on again next year as we look toward that Fed debate, that Fed race. To me, that really is going to be the key question. How much does that reshape some of the Fed expectations for the entire market?
And it was just interesting to listen to Krishna saying that the reason we didn't get to that brink of crisis of governance is because of Chair Powell. It's because it was a committee that wanted to be able to rally around him as he delivered that cut, be it, a hawkish cut or whatever it is. So what happens when you don't have that? Are we going to see hawks dig in their heels to try to prevent a Trump takeover or political influence, and you get even more divide from the Fed?
The next episode of The Bachelor out next week. Coming up next, Anastasia Amoroso of Partners Group, Jennifer Lawless of the University of Virginia, Amrita Said of Energy Aspects, and Osang Kwan of Wells Fargo as we look ahead to what some are calling is going to be a volatile 2026. From New York, this is Bloomberg Surveillance. Good morning.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
It's been narrow, both in the economy and the markets.
It's almost like the stock market is like the tail that's wagging the dog of the economy.
We are expecting that for 2026, inflation is going to be somewhat elevated.
We've talked a lot about the K-shaped economy, but who's been dealing with inflation since 2021? It's been the lower end of the K.
The macro environment is unusually uncertain.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks trying to get into the holiday spirit with futures building on yesterday's rally. Investors pouring into equities to end the year ahead of what some will say is going to be a volatile 2026, as you just heard there. And the Bank of Japan's rate hike, sending rates higher despite dovish hopes for the Federal Reserve. To me, Danny Berger, this is the question of the day. How much is the U.S. market at the behest of global rates, which are inflecting away from some of the hopes and dreams that we're hearing from this central bank?
Because, again, it goes in contrast to not just what the U.S. central bank wants, but what this White House wants too. They've been squarely focused since day one on what's happening to yields. So should President Trump get his wish that he gets a Fed of the chair coming in who's going to move rates much lower, what happens if that's not enough because of what's happening globally?
Yeah, and there has been this shift where an increasing number of investors and frankly strategists who come on this show talk about the bull case for stocks and the lack of clarity around bonds. We've heard that time and time again. We see that again this morning in early trading. We saw that in the flows overnight with some huge flows into equity funds. And at the same time, bond funds getting kind of tepid reception as people think about what this global trend actually looks like.
It just feels awkward. And I think that's why it's so uncomfortable, even as we get investors, both institution and retail, happy to pour money into this market. Because on one hand, you have bond yields moving higher, which historically has been bad for stocks, I guess not at the moment. And then you continue to talk, especially at the end of the year, of just the pain in some parts of this economy, how the consumer is not doing well, that the job market is slowing, but stocks nearing a record high too. Something about it feels uncomfortable, but even so, all the bullish projections are piling up for 2026. As high as 8,000 for year end.
Well, maybe you just need to look at the data. And we got data. Yay. And then people looked at the data and said, actually, maybe we can't count on this in any way, shape, or form. It's sort of adding to this cloud of mystery. It seems like people are continuing with this feeling the Fed could cut rates early next year, despite the fact that they also are throwing a whole lot of shade, a lot of skepticism on what we got yesterday.
Yeah, one of my favorite turns in the discourse, and I have to say I was among these people who were like, why wouldn't the Fed just delay their decision? Delay it by a couple of weeks, get the data in hand, and then they'll have the certainty to move. Oops, looks like if you had done it, it still would have been the same thing. It's foggy, we don't know what's happening, it's distorted, it's confusing. here we are, same place as we were before the data.
Well, confusing maybe for the bond space, for the equity space, trying to inflect up after what we saw yesterday, a rally for the first time in 5 trading sessions, building on that this morning, although coming off some of the earlier enthusiasm, up just about 0.2% on the S&P, seeing that euro-dollar cross at that 117 level, yields higher across the board. In the United States, 10-year yields are higher by less than what you're seeing over in Germany and Japan, nonetheless, up by about 3 basis points to 4.15%. Coming up this hour, Anastasia Amoroso of Partners Group is investors de-risked from big tech. Jennifer Lawless of the University of Virginia's President Trump's affordability pitch appears to fall flat, and Oh-Sung Kwon of Wells Fargo as doubts grow over U.S. inflation data. We begin this hour with stocks slightly higher as Wall Street looks to end the week with a win. Anastasia Amoroso of Partners Group writing, "We don't believe investors should give up on AI into 2026. The current pullback may present opportunity." Anastasia joins us more. Anastasia, great to see you.
Good to see you.
Very much the holiday spirit, I see.
Yes, I brought the holiday spirit.
I think it's great. So coming up, it does feel like people over the past couple of days at least have come back to this idea. Maybe the sell-off is a good thing. It highlights skepticism. It highlights a better entry value. Where are you on that? What have we seen over the past couple of weeks that gives you more confidence?
Right. Well, first of all, as you were saying, maybe the volatility is normal as we get higher and higher at market altitude, so to speak. So maybe that is what we should be accustomed to seeing in 2026. Investors scrutinize things more, investors question things more. So maybe that is, to your point, a healthy development. I do think it's nice to see the AI trade pull back by 5 or 7 percentage points over the last couple of weeks. Having said that, as I look at what's really driving the AI trade, it is demand, the adoption, it is productivity, and it is monetization. And when I look at all 3 of those categories, I see positive developments there. First of all, let's talk about adoption. Around this table, I'm sure you're using more AI now versus what you did at the beginning of the year. And if you look at kind of the adult population in the United States, 55% is the percentage that use artificial intelligence today. That was about 45% to start the year. We went from a 10% adoption rate economy-wide to about a 17%. So we are moving up that adoption curve, which is great. The second thing, Lisa, that I looked at the other day was the productivity increases. Coming into the year, we were sort of hoping, expecting to see the productivity gains due to artificial intelligence. And when I look back at the last, call it 3 years, you have actually seen measurable productivity gains. Productivity has been average about 2% year-over-year growth versus 1% that we saw in kind of the decade, after the financial crisis. So these are not just wishes, these are tangible productivity gains. We hear that from companies, we see that in our portfolio companies as well. And then the last point, it's all about the monetization. And there too, whether you look at cloud revenues, whether you look at some of the AI LLMs, the likes of OpenAI, their revenues are surging. And I think that trend can continue into 2026. So with all of that, the AI trade is priced better today. So I would step in here for 2026.
The AI trade in pockets, right? I mean, are there areas that are the winners and areas that are the big losers as you do see a consolidation of profitability in a select number of cohorts, right? I mean, at what point is the gain of some players the pain of everybody else? And I point to Micron yesterday doing really well because guess what? They can charge a whole lot more for their chips.
Right. No, that is a really good point. It's not going to be just everybody is a winner. It's not the tide that lifts all the boats. And that's what we think about in our investment committees. We think about whether a company is going to be disrupted by artificial intelligence or is actually going to be helped by artificial intelligence because they're quick enough to embed it. So that's one way to think about it. The other way I would say, Lisa, we should actually draw the distinction between, no, I don't think AI is a bubble, but are there signs of bubble-like valuations in certain parts of the ecosystem? Absolutely. I mean, if you look at, for example, the late-stage venture valuations for AI companies versus non-AI companies, they're trading at a premium of something like 250%. It's not the case for earlier stage, but it is the case for later stage. So I think you have to have a question mark around those valuations. But we are finding, I think, winners in artificial intelligence, I would say, in several different categories. The first one is infrastructure. And the shift is now really sort of, yes, we've done data centers for the last 5 years, but it's really more of a focus on energy because that's the bottleneck. We also think about investing in AI companies that have proprietary data. They have vertical expertise and they can leverage that. That's what we think gives them the competitive moat and the best chance to embed artificial intelligence and kind of, invent AI-powered services. And then the last thing is across our portfolio companies, we also have a concerted effort to boost productivity, drive revenue growth, and also enterprise value creation by infusing AI. So that's where we identify the winners. But you're right, there's going to be lots of disruption, lots of companies to avoid as well.
How much of the avoidance doesn't just have to do with, are you producing revenue? Are you being disrupted by it? And maybe there is promise there, but debt loads are getting unmanageable. I mean, Oracle's been the poster child for this, where their spending increases 11-fold and their cash growth has turned into an outright cash burn. Even, you can pick into any company, but even if the promise is big to you, do debt piles like that and cash burn make it enough to make that kind of company no longer attractive?
I mean, look, once again, I think investors should look at Oracle and the likes and scrutinize anybody who is quickly taking on debt and maybe not scaling revenues quickly enough. So I do think that's a healthy development. But when I think about, let's say, the rest of the hyperscalers, they don't have the issue that the market is sort of punishing Oracle for. They have plenty of free cash flow. They have plenty of cash on the sidelines to finance the data center spend. So, and the other thing I would point out, Danny, going into 2026, I certainly would not give up on all the hyperscalers, because what you actually see is their earnings trajectory keeps on accelerating towards the tail end of 2026. And we talk about this gap narrowing between the Max 7 versus the 493, but that gap is actually going to widen out once again. For most of the Max 7, perhaps not the specific companies.
But even for the hyperscalers, and specifically the LLMs, the Googles, OpenAI, why isn't it just a Google being the ultimate winner? Because they have the ability with their balance sheet to not charge for their AI models. Why not just run OpenAI into the ground with the inability of them being able to produce revenue, of Google just offering it for free, and then once they're gone, then maybe they can turn around and become a monopoly? Why isn't that the future road that this might go down?
Well, you bring up a couple of good points. Google, first of all, has been investing in artificial intelligence and working on developing artificial intelligence for years, prior to OpenAI. So Google, by all means, should be one of the winners of this AI trend. But the other point I would say is, whether it's Google, whether it's OpenAI, whether it's another platform, it is about that. It is about the platforms. I remember, talking about artificial intelligence back in 2019, and the biggest winners were always going to be the providers of the picks and shovels of AI and a lot of these LLM models. And who is that going to be? Those who have the massive treasure troves of data. And so it's the likes of Google and Meta and others. So I'm not surprised to see, perhaps Google kind of be in the lead once again, as I think they kind of were back in 2019.
Anastasia, there is a big discussion around if there is risk building. And yes, sure, there is risk building, but the question is where. Most people have pointed to private markets as a place of potential risk. I know you're focused on financing companies and financing infrastructure projects through the private markets. How much risk do you really see building heading into 2026?
Right. Well, if you take a step back, Lisa, if you think about the sheer growth of private credit, for example, it went from being a $600 billion asset class to a $1.7 trillion asset class. So by the sheer kind of virtue of growth that we've seen, there's going to be more and more risks. And I think that's what we've seen is some of these idiosyncratic headlines are representative of the growth of the asset class. But when I think about it from the interest coverage ratio perspective, for example, yes, it is dipped from where it was pre-2022, but it's actually troughed and is starting to improve. So the fact that the Fed has cut interest rates actually alleviates, I would say, some of the pressure on private credit. I think what you have to look out for is, there's been lots of money raised in private credit. That money had to be deployed quickly. And, in some cases, it was deployed in large chunks of capital. So was it always appropriately deployed? Was it always properly covenanted for everybody? I don't know. But for us, if we look across our private credit platform on the U.S. side and the European side, on average, I would say 90% of the loans that we've done have a covenant attached to them. So I can't speak for the industry as a whole, but I think, if you had the prudent underwriting standards, despite the growth in the industry, we're in a good place today.
Anastasia, great to see you. Have a wonderful holiday season. Thanks Anastasia Amoroso of Partners Group here in studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira on it. Yahaira.
Hi, Lisa. EU leaders have agreed on a more than $105 billion loan package to Ukraine for the next 2 years. The interest-free loan will help the country finance its military and economic needs amid its ongoing war with Russia. The loan came together after European leaders failed to agree on a plan to use frozen Russian assets to raise the funds. Meanwhile, the Justice Department has until today to release its files on Jeffrey Epstein. President Trump signed a bill last month giving the agency 30 days to release most of its files related to the late convicted sex offender. The records could show federal investigations into Epstein's sexual abuse and whether any of his associates knew about it or participated. And several drug makers are expected to announce agreements with the Trump administration to cut some drug prices. That's according to Reuters. AbbVie, Bristol-Myers Squibb, Merck, and more are expected to announce a prescription price agreement. This as President Trump ramped up pressure on drug makers as he makes his affordability push. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next to what Yahira was just talking about, the fight for affordability.
We inherited a mess, and part of what we inherited was the worst inflation in 48 years, and now we're bringing those prices down, but I'll be talking about that.
Jennifer Lawless of the University of Virginia joins us next as President Trump continues his push to get his message through. From New York City, this is Bloomberg Surveillance.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. Coming into Friday with a bit of a better tone, we are seeing futures higher pretty much across the board as people reassess some of their fears around AI. AI has been leading this morning as people pile money back into the trade. S&P futures higher by 0.2%. Watching global yields. Watch this space. You're seeing a 2 basis point increase on the 10-year yield to 4.15% rounded up, led by the Bank of Japan, led by what we're seeing in the Euro region with yields squarely higher across the world. Meanwhile, a real question here about the Bank of Japan, around some of the other central banks. If they're done with the easing cycle, I mean, this to me really is the question: how much could the Federal Reserve continue to diverge?
I mean, they can attempt to. And how much is the bond market going to allow them to? And how much does it send a global signal that central banks are saying that inflation is still a problem? If you get a U.S. central bank that is cutting, what if this is a bond market that doesn't just price in what's happening globally, but a fear of inflation? And maybe a fear that the central bank, we're talking with Krishna Guha of Evercore ISI, a fear that there would be some breakdown in the consensus building activity of the Fed. There are multiple things that could pressure yields higher and undo any central bank or any government that's attempting to ease conditions. The two would fight against each other.
Inflation's still very much in people's psyches, which is the reason why there is this real dissonance in polls where people feel like affordability prices are out of their control. Under surveillance this morning, the fight for affordability.
We've had tremendous success. We're bringing prices down. We inherited a mess. And part of what we inherited was the worst inflation in 48 years. I say history, but we had the worst inflation. It drove prices up. And now we're bringing those prices down. But I'll be talking about that.
Here's the latest. President Trump heading to North Carolina today as the administration looks to reassure Americans about the rising cost of living. Bloomberg's Tyler Kendall joins us now. Tyler, thank you so much for being back with us. I'd love your thoughts on how he could develop on some of the initiatives that he laid out earlier this week in terms of trying to alleviate some of consumers' concerns.
Yeah, hey, Lisa, good morning. Well, this is expected to be part of a series of domestic stops for President Trump, so we can probably expect his rhetoric to develop as this continues. It's all designed, of course, to try to tamp down on concerns around the White House's economic policies after a week where we saw them try to change the narrative amid, of course, falling polling numbers. In fact, I was going to mention how we just had the head of the Ipsos polling on Balance of Power who told us that President Trump's support among U.S. adults has now sagged to 39%, and that support is eroding among Republicans. Now, President Trump himself tried to use his primetime speech earlier this week to reassure Americans on the economy, but he also used it to say that his policies haven't fully kicked in yet, right? He spoke about tax cuts under the One Big Beautiful Bill. He spoke about drug pricing coming into effect in the new year, and he spoke about what policy may look like under a new Fed chair he's weighing announcing, of course, in the coming weeks. But there's other ideas that he's floated that we know might not be as tangible, right? The idea for tariff revenue rebate checks that will need congressional approval. But after weeks of really focusing on foreign policy, in the last 24 hours alone, we have seen a slew of domestic policy announcements, everything from the service members getting checks to wins for the cannabis industry to even declaring the days around Christmas a federal holiday this week. There's just a lot being thrown out there at the moment, and the White House is trying to see what may be able to stick and may be able to garner that support. Lisa, I will put one other thing quickly on your radar for tonight. This event is happening in the newly redrawn 1st Congressional District in North Carolina. This is a seat that has predominantly been held by Democrats for decades, but it now looks more likely to go to Republicans in the midterms.
Tyler Kendall, thank you so much for that. Jennifer Lawless, professor of politics and public policy at the University of Virginia, writing, Trump is trying to blame Biden, but this is now the Trump economy, so the message might not resonate the same way it did last year at this time. Jennifer joins us now. Jennifer, great to see you. Thank you for being with us. I want to start with a question of how much the message that President Trump is trying to get out there in a series of speeches is resonating so far in early polling.
Good morning. It doesn't seem like it's resonating. And frankly, we've seen this script before. Basically, the American people are willing to believe what is fed to them if there's some indication that that's what they're experiencing. And people are still experiencing high prices. They're experiencing unemployment. They're experiencing an economy that seems stuck. And so Donald Trump saying that that's just not the case, or that they need to be patient, or that the fruits of his policies haven't kicked in yet, is not what the American people want to hear. And the polling numbers reflect that.
Jennifer, what difference does it make if Trump is able to get some of the policy through that he intends to help with affordability, whether it be checks to military families or a $2,000 tariff rebate? And we have seen him start to try to lower tariffs on various food goods via Brazil. Will any of that resonate with an American voter heading into the midterms?
It will if that voter can actually feel it in his or her pocket. When people vote, especially in a midterm election, they're often reflecting on whether they feel better now than they did 2 years ago. And Donald Trump made a lot of promises about the economy. People were very dissatisfied with the Biden economy. Donald Trump blamed Biden and said that he could fix it and that he could fix it quickly. So people will look back to those promises. They'll look back to the beginning of the Trump administration and determine whether they think there's been enough progress. Keep in mind, too, though, that although he has made promises about housing affordability, he's made promises about checks to military members, it's important, too, that he is letting the Obamacare subsidies expire. And as a result, starting January 1st, there are going to be more than 20 million people who see their health care premiums go up if they can afford insurance at all. So he's not talking about the negative policy implications. And I'm not sure that even if the positive policies go into effect, it's enough to mitigate some of the negatives.
Does it just in general, though, create policy volatility, Jennifer? We saw an incredible amount of that in the first half of this year, especially after Liberation Day, where markets and other commentators spooked the president to pull back from some of the most harsh of tariffs. Should we expect more of that type of volatility in 2026 as he faces pressure from the American public, especially on the heels of more recent local elections?
I think so. And there's even a chance that we'll see more volatility because if we look at what happened in New Jersey and Virginia, and we see the way in which the affordability message really did benefit the Democrats, the Republicans are going to kick into high gear to try and counter it. And we've seen over the course of the last 10 months that when Donald Trump kicks into high gear to counter that, he often goes one step forward and two steps back. And that's not good for the markets. It's also not enough to actually make the American people feel any differently about the economy.
Jennifer, there's a lot of overlap between what President Trump is looking to do and frankly what a lot of Democratic Congress members are also looking to do. It seems like whenever there is dissatisfaction, there is a question of what fiscal impulse we can lean on to alleviate some of those concerns. How much does this increase the chance of any kind of fiscal spending next year, given the fact that that seems to be the solution for both sides of the aisle?
So if it was not an election year, I would say that there's a small chance that there would be compromise, but it is an election year, so neither side has any incentive whatsoever, despite the fact that they're supposed to represent the American people, to come together. The Democrats want to make sure that all of Trump's policies fail and that he is saddled with the economy. And Donald Trump and the Republicans want to make sure that the Democrats are seen as obstructionists and that the American people are still blaming Joe Biden for this economy. So the idea that the two parties will come together and try and arrive at some sort of agreement that could ultimately help everybody, frankly, is too unpredictable in terms of its political implications. So I think it's probably a non-starter.
Jennifer Lawless of the University of Virginia, thank you so much for being with us this morning. As we look ahead to that speech, we also are going to be speaking with, coming up in less than an hour, Jamieson Greer, the U.S. trade representative under President Trump, who has been negotiating a lot of the trade deals that President Trump has been touting as evening the playing field globally. It raises this issue of how much some of the efforts in 2026 are hampered by cost of living concerns in the United States. We've already seen a number of different tariffs walked back on trying to alleviate price concerns.
Yeah, and it was especially ones that directly hit the consumer. So things like you'd find in your grocery store, coffee coming from Brazil. And it was noticeable when that shift happened. It was after the elections, after, as we were just talking about with Jennifer, the Virginia, the New Jersey gubernatorial races. You really saw a change from this administration. And I'm curious to know whether Trade Representative Jamieson Greer has also gotten that directive. If that colors and how much it colors some of these negotiations going on where the White House is billed it as matters of national security, maybe there's something more important, and that is their political future in 2026 with affordability being front and center.
Yeah, and how much is that revenue going to go to paying for all of these initiatives that we keep hearing about? Because it's going to take a lot of money. At the same time, we are seeing globally a sense that fiscal is starting to come into play. I mean, we're seeing that in Japan with Sanae Tanaka. We're also seeing that with respect to Europe, with respect to not only the financing of Ukraine, but also Germany. And here in the United States, a real question of how much this is going to be really the story next year.
Yeah, is it going to be fiscal dominance? Maybe not even here, but just globally also as debts build across the world.
Right now, coming up, we're going to be talking about the energy side of this. I'm Rita Sen of Energy Aspects as Chevron continues loading Venezuelan oil amid growing tensions in that region. Plus, you hire on end with your morning movers, Nike, plunging after their earnings announcement. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Getting ready for the holiday week ahead, we are seeing a bit of a lift across the board in futures. Right now, 0.2% gain on the S&P. Take a look at what's going on with the Japanese yen. A weakening trend, 157.30 after the Bank of Japan hiked rates, the highest levels going back to 1995. When you bleed that decision through to the bond space, you have yields at the highest levels going back to 1999 with the 10-year in Japan at 2.02. Why is the yen weakening? Danny, we've been talking about this. Why is the yen weakening? Because people were looking for more guidance about how much they were going to hike rates going forward.
Yeah, but the BOJ never gives that much guidance. So maybe it was all already priced in, really hoping to get more. But what we did get from the BOJ, if you wanted to, you could definitely read it as hawkish, saying that they're still a far way from the neutral rate, that they want to climb up to get there, that should conditions be met, that they're going to continue to hike. And oh, by the way, they said it looks likely that conditions are going to be met. But to your point, I guess the bar was just extremely high. They wanted something very, very clearly hawkish when it came to guidance, and markets were left feeling disappointed.
Meanwhile, markets on the bond space got the message loud and clear. Yields inflected higher across the board, including in the United States on the long end. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. The turnaround story at Nike shows signs of stalling, causing shares to drop now more than 11% in the pre-market. The company warning sales will drop in this quarter due to two major drags. It's China sales and its Converse brand. And we're seeing that spill into the broader footwear sector, with Deckers also down nearly 3% in the pre-market. This is the company behind the sneaker brand Hoka and UGG. Meanwhile, we are seeing Oracle shares jumping in the pre-market, up more than 4% now, on a reporting that it will be part of an American consortium of investors set to take over U.S. operations. Oracle would gain 15% ownership in a deal that analysts say would solidify TikTok as a major cloud customer for Oracle. The development is according to an internal memo seen by Bloomberg, with the deal expected to close on January 22nd. And we end on Lyft. Those shares not getting a lift. They are down 3 3/4% after Wedbush downgraded the stock, with the analysts saying that Lyft is at most risk among the rideshare companies of autonomous vehicles, saying it could sharply disrupt Lyft's business and could hurt its long-term value. Lisa.
Thank you so much, Yahaira. On our radar this morning, OpenAI reportedly aiming to raise as much as $100 billion in its latest round of funding. According to the Wall Street Journal, this could bring the value of the company to as much as $830 billion, much as $830 billion. I just wonder if he'll stop before $1 trillion, or is he going to wait until he gets to that $1 trillion valuation before he goes public?
Well, maybe you need to stay in the private markets in order to get that $1 trillion valuation. So maybe that's what he has to do. I mean, the growth has been crazy. What was it? $500 billion was what they were valued at this fall in their most recent fundraise, according to different reports. Yesterday, the figure was 750. Now we're at 830. In order to get that 66% increase in valuation, what has to have changed for this company? Presumably the today, here and now, not too much has changed in terms of their revenue. Indeed, as they get challenged from Google, It's that promise that's being priced in. And how real will that promise be, especially as they're getting more rivalry and more competition from Google, who has the ability to offer up a model for free and maybe pressure OpenAI and bleed them dry of cash until it's just Google and Gemini left.
Honestly, despite all the skepticism, the fact that they're able to continue lifting their valuation speaks to maybe the lack of broader skepticism overall, maybe a little bit in the past couple of weeks, but overall still a lot of enthusiasm here.
It's like this thing we keep going from like, oh no, everything's over, AI and the world's collapsing, to like, oh yeah, we're back, this is great, the promise is here, the dream is real.
It sounds like the chip shipments from the United States to China and the story that's been going on there. Reuters reporting that the Trump administration is launching a review that may result in the first shipments of NVIDIA's H200 chips being sent to China. The president saying earlier this month he would allow the chip sales to China in exchange for a 25% surcharge. We are seeing NVIDIA shares up more than 1%, and we are going to be speaking in about 45 minutes with Jamison Greer, who is the U.S. trade representative, about what this means for the relationship between these two trade partners. Meanwhile, Nike shares, as Yahira was talking about, falling as the company warns of declining sales this quarter brought on by weakness in China and its Converse brand. The company expecting revenue to be down in the low single digits despite progress in North America at the running category. Initially, when this came out, people were excited. And then they looked more closely at some of the commentary about the path ahead and how they're only halfway through this transition period.
Yeah, especially when it comes to China. And I just wonder how much of this is about a local market, of them not being able to innovate to appeal to a Chinese audience, versus a Chinese consumer that wants more homegrown products, that wants to buy locally produced athletic things. And it kind of relates to even FedEx earnings, where for them the sore spot was also shipments between the US and China. It is the bleed through of the tensions between the two nations and of tariffs. Is there a real hit, as Peter Scheer started 2025 talking about of Academy Securities, that we're about to witness a hit to brand America? Is that what's happening to Nike? Or can you just say it's simply they're not innovating enough?
Yeah, how much is it just that they've got a lot of inventory that they've got to sell at a huge discount? But yes, this is part of the issue. Meanwhile, turning to commodities, Chevron preparing to export 1 million barrels of crude from Venezuela only days after President Donald Trump accused the country of using oil proceeds to fund terrorism. Bloomberg's Will Kennedy joins us now. Will, please give us some clarity. What is going on in Venezuela with oil exports and the U.S. involvement? Who owns what land? Is this the U.S. reclaiming what was taken from them?
Well, with the tanker curbs, what this makes clear, and what they said at the time, is that the restrictions are on sanctioned oil tankers, those tankers on which the US has placed curbs for being part of the so-called shadow fleet. There are some exports which will not be taken on sanctioned tankers, and those include exports from Chevron, which is under license from the US to be able to continue operating in Venezuela. You spoke to the Chevron CEO a couple of weeks ago, and he made clear that they are in Venezuela for the long haul. No matter who's running the country, they see it as a key strategic asset for them. So the oil will continue to flow as long as that's possible. And, you know, Chevron says they're abiding by all the rules and regulations. What the Trump administration has done has placed restrictions on tankers that are sanctioned, which I think is about 40% of those ships that are exporting US crude. It's known not so much as an embargo or a blockade, but as a partial naval quarantine, I think is the phrase. So it does all fit together when you pick apart the policy that the Trump administration has put on Venezuelan exports.
Will, how much is this a model for what we could see from Europe with respect to Russia? The idea that you can enforce sanctions more significantly in international waters, is that something that you expect to be repeated elsewhere?
I think it's probably quite unique to Venezuela. Obviously, it's backed up by this huge buildup of U.S. naval resources in the Caribbean, unlike anything that I think has been seen in modern history. You've got the biggest U.S. aircraft carrier, the Gerald Ford, in the region. So the U.S. is backing this up with serious military firepower. I think that's much harder to do in the case of Russia. The people who are intervening militarily in the case of Russia, of course, right now is Ukraine, which are doing it in a very dramatic way by targeting ships carrying Russian oil exports out of Russia directly and trying to blow them up. And I think we've seen today perhaps that happening, according to some reports, in the Mediterranean as well as the Black Sea. We've seen something happen off West Africa. But I think Europe will continue to impose its sanctions financially. And I think what you've seen is how hard that is and how the shadow fleet finds way to operating by going dark, by using transfers from one ship to the other, that these financial sanctions, they impose costs on the Russians, but they do not stop the flow of oil. It is very hard to stop the flow of oil. There are always techniques, ways that traders can find to try and go around them.
Bill Kennedy of Bloomberg, thank you so much for being with us. Now joining us, Amrita Sen of Energy Aspects, who wrote, "While we believe these flows should be exempt from the U.S. blockade, it is possible Venezuelan authorities may not allow them to continue." Amrita joins us now. And Amrita, you raise a great point, this question of what is the reception in Venezuela of some of the U.S.'s moves? Are they still going to leave U.S. exporters alone during this time?
I think that's the million-dollar question, honestly, and I think that's why you've seen some of the price reactions in the physical market. U.S. Gulf Coast, like Mars, for instance, the crude, kind of medium sour crude that trades in the U.S. Gulf Coast, that rallied quite a bit. It's just in anticipation, we think, from the refiners to suggest that potentially that that Chevron's flow that comes to the Gulf Coast may not be allowed to continue, in which case they would seek alternative spot barrels, and therefore, they'd go for something like a Mars. Like I said in the note, right, it's not that that's our base case. We do think that Chevron's flows are exempt and can continue, but if Venezuelan authorities choose to kind of escalate this, and they've already kind of shown a few signs, escorting some petroleum products from their ports via their own kind of navy, I think that's really the risk over here right now.
Maybe that risk is lessened by the fact that this is a global oil market that is sufficiently loose, Amrita. But could anything change in Venezuela, given the trajectory we're on, even if Chevron assets are impacted? Could it have a larger impact on energy markets?
Look, Chevron's volumes that they export are about 140,000 barrels per day. So by itself, no, because like you say, we are still looking at a surplus. But if you're talking about, let's say, 500,000 barrels per day, not even the full 1 million plus that they are producing right now, just 500,000 barrels per day of exports being disrupted over time, that will have an impact on global flows because the bulk of it is going to China. And, they have built up a lot of stocks in the short term, but beyond 2 months, they will start to feel the pinch as well. What I would say is that Venezuela, in conjunction, by the way, we still have half of Kazakhstan's production/exports down because of the attack by the Ukrainians on the CPC, the SPM there, which is still not back. And we also have an enormous amount of Russian oil that's building up on water, over 1 million barrels per day. I really do feel that while sentiment is very bearish, and I agree that even our balances are showing these big bills, come January, when everybody reruns their balances for December, with Vens, if it's still off, say, 500,000, 1 million from Russia, a few 100,000 from Kazakhstan, suddenly, even if we build, which we think we will, it may not be as big as some of the fears are in the market. Some banks are calling for 3-4 million barrels per day, which I do think is way too high. And I wonder if we just get a recalibration of expectations then.
There is just a lot of questions just because of risks that lay in this at a time when the administration is also attempting to keep prices low, and they are acutely aware of what oil prices are doing. Amrita, is there anything to be gained by this administration, especially in the short term, especially as they face midterms in 2026, from the actions that they're taking in Venezuela?
Yeah, and I think that in some ways the biggest geopolitical wild card for next year is this administration, right? Because they are going after several of this. It's not just Venezuela, it's Russia as well. But at the same time, like you said, there's midterms coming up, and they're very clear that they don't want high oil prices. But with WTI in the 50s, there is probably room. Like, WTI could easily go up by $10 without really making that much of a difference to retail gasoline prices, at least in the winter. Now, summer is a different story. We do think gasoline markets will be tight. And that's when I think some of these could unravel. But there is a period, it's a window of opportunity where foreign policy could tighten oil markets, and there is still enough slack in the system, which will not raise domestic prices.
Amrita Sen of Energy Aspects, thank you so much. And have a wonderful Christmas and New Year and holiday season. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. TikTok and ByteDance have signed agreements to create a U.S. joint venture that will be majority owned by American investors. According to an internal memo, seen by Bloomberg, Oracle, Silver Lake Management, and MGX have all signed onto the deal. It is expected to close on January 22nd if approved by Chinese regulators. Oracle shares are up 4.2% in the pre-market on the news. Meanwhile, the FedEx turnaround story is showing signs of success. Earnings for the shipping giant topped estimates, and the company raised the low end of its profit outlook for the year. The surprise boost was driven by volume and pricing gains in the U.S. However, FedEx is still working through several challenges and expects adjusted earnings to dip this period. And the Kennedy Center Board of Trustees voted to rename the institution the Donald J. Trump and the John F. Kennedy Memorial Center for the Performing Arts. It's unclear if the board has the legal authority to change the name of the facility, with current laws bar additional memorials or plaques from being installed after 1983. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, inflation uncertainty.
I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer-term phenomenon.
Bosang Kwan of Wells Fargo joins us next with his bullish forecast for 2026 from New York. This is Bloomberg Surveillance. Good morning.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Big tech had been in the doghouse. Now it reverts back to being the lead. Right now in equity futures, you do see a bit greater degree of outperformance from the NASDAQ, although it is coming off earlier highs, up about 0.25%, up now only 0.1% on the S&P. And this really is going to be the focus into 2026. Do we get a read over the skepticism that people have of AI truly being able to lead in the next year? Under surveillance this morning, inflation, uncertainty.
I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer term phenomenon. There are still legitimate concerns and questions about, do we get back to 2% inflation absent some sort of economic contraction in 2026, which no one is pricing in right now.
Here's the latest. Concerns over inflation remaining as questions swirl over the accuracy of the November CPI report. The data impacted by the lengthy government shutdown. Oh-Sung Kwon of Wells Fargo joins us now. Oh-Sung has a bullish forecast for next year in the equity space, and it comes to this question of how much does the data even matter if you have a Federal Reserve that is biased to cut rates and a federal government that is biased to run this economy hot?
Yeah, I mean, I think the setup for equities into 2026 is pretty favorable. I mean, the profit cycle is still in an up cycle. We're forecasting 14% growth, EPS growth for the S&P next year, followed by another 13% in 2027. I think liquidity, which we talked quite a lot about, that's going to improve quite a lot in Q1 with the Fed starting to expand its balance sheet. It was a lot sooner and a lot bigger than what we had previously forecasted. And with that, we're going to see a huge uptick in the liquidity environment overall. And I think that's really going to be the bull case for equities as you move into 2026.
But I hear people screaming at the television screen. This isn't actually quantitative easing. This is just trying to ease the technical backdrop for banks that are using the Fed as some sort of backstop. So how does this really increase liquidity? Is this more of a boost to liquidity than some people are accounting for?
I mean, it depends on how you define QE. If QE is really about shortening duration, then it's not a QE. But if QE is about boosting liquidity into the system, because the funding market was really seeing a lot of stress. If you look at the SOFR spread between the SOFR rate versus the Fed funds rate, it blew up back in October to as much as 35 basis points. So there was a real stress that we saw back in October and November in the funding market. I think that was really the main culprit for the sell-off that we saw over the past, or the volatility that we saw over the past 6 weeks or so. And looking at things like Bitcoin, quantum stocks, non-profitable tech, those guys sold off the most, and that's essentially what happens when liquidity dries up. Everyone's risk curve shifts to the left, and the assets that are farthest out the risk curves, the most speculative assets, they get sold the most. I think with liquidity coming back and potentially liquidity conditions overall being actually good in Q1, I think speculation is going to pick back up. I think AI trade is gonna work more in the second half of the year than we're thinking. But I think the overall equity market is gonna be pretty bullish.
Is that why you have the assumption that into next year, you write in your research that inflation reacceleration is going to be worse for equities than a recession would be? Because a lot of people would look at the dichotomy between the two and say, inflation coming off the back of COVID, equities still did well, but it's growth that's really in earnings that's underpinning this equity market. And if we get a recession, then that would be worse.
Yeah, I mean, if I have to think about the probability of recession and inflation, I would assign a higher probability of inflation. I'm not too concerned about inflation either, because I think there's that AI productivity disinflationary pressure that's going to keep inflation pretty low. But there's the physical as well as monetary policy that's coming back in to potentially drive inflation higher. So if I have to choose, I would say inflation has a higher potential than recession. But I'm not too concerned about it either.
But inflation would be worse for equities than a recession would be at this point.
I mean, both would be bad. But I think the probability of inflation is probably higher than probability of recession at this point because of fiscal. We estimate about 80 basis points of GDP contribution for the full year 2026. Most of that is happening in the first half of the year, really through the tax return. So I think consumption is going to pick back up. Consumption is 70% of the economy. So I'm not too concerned about the economic downturn.
What's the sort of break the glass moment in the yield space for equities? And I ask this as you do see longer term yields globally creep up on the backs of a hawkish move from the Bank of Japan, albeit whatever people are thinking in the currency space, but also this idea that the ECB is getting to the end of their easing cycle. How much do you see this sort of line in the sand, let's say at 4.5% for the 10-year, at 5%, where suddenly the bull case just isn't there?
Yeah, I think it's going to matter more for what works within the equity market. So we're more bullish on the reflation cycle into the first half of the year because of the fiscal stimulus that we're going to get. But if rates climb above 4.5% or so, I think that's potentially what kills the reflation cycle and potentially back into AI. I think closer to 5% is going to be actually pretty bearish for equities.
So in this bullish environment for 2026, the speculative stuff starts doing well again. Is that a healthy bull market? Is that a healthy turn in the continuation of the gains we've seen in equities?
I mean, I think, you know, the bull markets typically have a little bit of speculation at least, especially in this AI cycle. There is going to be speculation. It's new technology, and I don't think it's a bubble yet, but I think there's a potential it becomes a bubble in the second half of the year, especially with the Fed continuing with this easing cycle, liquidity being more ample. And I don't think the AI trade is over. I mean, there's quite a lot of concerns around AI CapEx, and because hyperscalers, the market started pushing back on hyperscalers CapEx, there's consensus view is that hyperscalers are going to moderate its CapEx. And that's been basically what drove the semi and the AI infrastructure sell-off over the past week or so. And if you look at semis versus hyperscalers, over the past week, we have seen a 3.5 standard deviation move, meaning hyperscalers outperform semis by 3.5 standard deviation. And that trade has been diverging. If we start to see hyperscalers sort of reiterating their CapEx outlook, the funding issues that Oracle and OpenAI are having, those concerns ease going forward and liquidity comes back, I think the AI trade is going to be back on.
Oh-Sung Kwon, thank you so much for being with us. Have a wonderful end of the year. I know you've been traveling a lot and talking to all sorts of people about the year ahead. Oh-Sung Kwon of Wells Fargo, hopefully we'll see you next year. This really is the question, right? How much can the AI trade participate and keep leading given the skepticism, and how much does it have to given some of the valuations baked in?
Yeah, there's been a real question over this past couple months about whether it is too big to fail or not. I mean, it's completely different than the banks. It's not like you can have a run on the bank of deposits or whatever. But there is a scenario where the AI spend is doing so much work in this economy. And I think that's why the fears are bigger this time than maybe other high valuations in markets, because we've gone through so many periods where there are really high valuations. But what happens if some of that cracks? And the cracks mean that these players don't get financing, they're punished for CapEx, so they pull back on their CapEx. We're obviously far from that, but it is a real risk.
Yeah, maybe people are worried because they just don't like the valuations and they kind of want to sell off because it kind of feels a little bit like that. They want to buy in at a better valuation. Coming up over the next hour, Alicia Levine of BNY Wealth, U.S. Trade Representative Jameson Greer on the path ahead for tariffs next year, Ryan Wang of HSBC, and Eric Johnston of Cantor Fitzgerald from New York. You're watching Bloomberg Surveillance.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
The news flow on the AI story will remain volatile.
Scale is getting to be even more important given the investments that are needed in AI.
Anyone investing solely in AI right now is taking risks they don't need to be taking.
There are some tailwinds for U.S. companies into next year. The earnings engine in the United States is on.
In the end, the fundamentals will dominate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, finishing up the last trading day of the last full trading week of 2025, finally getting a spot of positivity in an unusually skeptical December, with stocks building on yesterday's rally, although fading from the earlier gains. A renewed focus on TikTok, with an agreement being signed with firms including Oracle about a joint venture, and a Bank of Japan rate hike capping a big week of central bank decisions, with Japanese yields at the highest levels going back to 30 years. And it really raises this question about how much the yield space can drive the optimism that's trying to bleed back into markets, but kind of struggling to do so this morning.
Yeah, and you were just talking about this with Osan Kwan of Wells Fargo, asking what is the level at which equities care yet again about what yields are doing? Why don't equities care about the risk of inflation? Why don't they care if easing that's supposed to be happening in the U.S. is curtailed by what's happening abroad? A lot of the answer would be because we believe in the promise of AI. And even that has had its wobbles this year. But for now, OpenAI gets another big funding round. We had Micron earnings that were great, so the trade's back on.
Yeah, people looking for reasons to get back invested actually flows into equities, resurging over the past week. The second biggest ever, I believe, into U.S. equities over the past week, trying to capitalize on the sell-off because maybe it's a better entry point, seems to be the theme for a lot of people out there.
And it's remarkable because it's not just institutions, it's retails, it's across the spectrum. People are still buying equities, and you pointed out globally, it's something like a record inflows coming into stocks too. So it's not even just the U.S., it's also been an outperformance year for international stocks too. And I think that's leading people to say, hey, maybe we can repeat this thing in 2026. Of course, the bite of humble pie would be that what we thought would happen this year is not at all what happened. So things can change quickly, especially with the weight of politics in mind.
Maybe people are just putting on pause some of that optimism right now in equities. You're not seeing that gain really lifting throughout the session as the session grows older. Now we're looking at S&P futures that are unchanged. The Japanese yen weaker, dollar stronger, 157.23. There wasn't enough guidance, evidently, with the Bank of Japan promising more rate hikes on any kind of schedule. Nonetheless, the bond market got the message. 10-year yields climbing to the highest level since 1999 in Japan, 2.02%. And in the 10-year, you do see that kind of similar move in the United States at 4.14%, up 2 basis points. Coming up this hour, do not miss this. A wonderful lineup to end the week strong. Alicia Levine of BNY Wealth as equities look to shake off AI volatility. She'll be with us for the hour. U.S. Trade Representative Jamieson Greer, do not miss that as TikTok takes a step to avoid a U.S. ban. And Ryan Wong of HSBC as investors begin to see holes in the latest CPI data. We begin this hour with stocks holding steady on the final day of the last full trading week of 2025. We are all ready for it to be over. Alicia Levine of BNY Wealth is bullish. Heading into 2026, she writes, we see a non-linear year with enough fiscal, monetary, and earnings support to move the S&P higher. Alicia joins us now for more. Alicia, great to see you. Thank you for being here.
Great to see you guys.
So everyone's talking about optimism for next year with a bunch of different risks. Volatility, yes. Does the sell-off that we've seen over the past couple of weeks give you actually more confidence heading into 2026 about that bullish outlook?
So I think that investors have learned that sell-offs tend to be buying opportunities. We thought so as well, but I don't think we've seen the final absorbing of volatility in markets in the next 12 months. We do see lots of issues out there for next year, even as we talk about, the Fed is in a cutting cycle, earnings are in an upcycle, margins are in an upcycle, and of course, fiscal support is in an upcycle. So there will be lots of supports out there for earnings and therefore for markets, but it'll be a volatile year. So what investors have learned over the last 10 years, anytime you see a 15 to 20% drawdown, it becomes a buying opportunity. And I think, next year, should we get that kind of volatility, it'll be the same.
It does feel, though, that those opportunities are rare, that you get like one day of a pretty harsh sell-off and people are saying, oh, we're buying the dip and it's something like 1%. Would you want to wait for those bigger sell-offs to get into the market? If you do have more money to be put to work, would you wait for that moment in order to buy in?
So our message to clients is never time the market, because it's actually quite impossible to do that. And actually, this year was the perfect year for that. So we have a chart where we show clients if you miss the 10 best days every year over the last 25 years, and basically your returns double if you just stayed in the market. But this year is actually more extraordinary because it was so volatile. If you tried to time the market this year and you were out because of tariffs and you were concerned and you were waiting for data to help you, if you missed the 10 best days this year, you're actually down 12% year to date. Versus if you just stayed in the market, covered your eyes and sat there, you're up 16 to 17%. So that is a 29% difference in your return trying to time the market and feeling like something really noxious was coming out of policy. So we see something like that for next year as well, meaning don't time this. Ultimately, investors have to say, what are the fundamentals? Where are earnings going? Where are margins going? We see 13% earnings growth next year. Therefore, if you take a 12-month view, we end the year higher, but that's not without fits and starts along the way.
Can you extend that to small caps? They're on, I believe it's something like an 8-month run. They've been up a lot, the most since 2021.
Small caps are now pretty close to the return of the S&P, and I think most people wouldn't have realized that. And that was all the work was done in the last few weeks on the small cap side. So yes, so we are telling clients that the market is overly concentrated on concentration because the earnings growth is actually coming from the other 493 going into 2026. And with the kind of fiscal support that we have and the Fed cutting cycle, that's great for down cap markets. And the deregulatory agenda and the M&A that we see happening, Merger Monday, every week now, is actually quite good for down caps. That means mid cap and small cap, and these indices are chock full of cyclicals, financials, healthcare, and industrials. And that's what's been working, and we see that continuing into next year. Don't forget, these indices really underperformed for the last 3 years, and markedly so.
Alicia Levine of BNY Wealth sticking with us for the hour. We're going to be talking about policy, some of the loosening on the fiscal side, as well as potential hiccups coming up. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. OpenAI is seeking new funding, valuing the AI startup at up to $830 billion. According to the Wall Street Journal, the company is aiming to raise as much as $100 billion by the end of the first quarter of 2026. With renewed scrutiny over AI investment, though, it is unclear if OpenAI will reach that goal. Meanwhile, several drug makers are expected to announce agreements with the Trump administration to cut some drug prices. That's according to Reuters. AbbVie, Bristol Myers Squibb, Merck, and more are expected to announce a prescription price agreement. This as President Trump ramps up pressure on drug makers as he makes a push on affordability. And President Trump signed an executive order giving government employees a 5-day weekend for the holidays with days off on Christmas Eve and December 26th. Not everyone getting extra days off, though. The New York Stock Exchange and the NASDAQ both say they will not alter their trading schedules on those days, so we will be here too. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I imagine a lot of people were saying, yes, please, make that happen, right? I mean, how many people were like, okay.
Okay, my mind went to people who are holding options that would have expired then and were like, uh-oh, this isn't good for me. I need to rethink some things.
Well, up next, we're going to be taking a shift to the international, the morning calls, plus U.S. Trade Representative Jamieson Greer as TikTok takes another step to avoid a U.S. ban. Now the question goes to China. Will they sign off? This is Bloomberg Surveillance. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The enthusiasm fading throughout the morning. Good morning. We are seeing really a struggle to try to generate the kind of gains we saw yesterday, flat essentially on S&P futures after having been up by about 0.2%. Yields higher by about 2 basis points here in the United States, 4.14% on the back of a Bank of Japan rate hike that left people wondering about long-term yields globally and how much that is going to drive what happens here in the United States. Turning to deals, TikTok saying it reached binding agreements for a new U.S. joint venture, majority owned by American investors. The company's CEO telling employees agreements with Oracle, Silver Lake Management, and MGX have been signed. Joining us now as we parse through everything that has happened in 2025 around the trade story is the 20th U.S. Trade Representative Jamieson Greer. Representative Greer, I want to start on how busy 2025 really was. Looking ahead to 2026, do you expect the same kind of pace with respect to trade deals, with respect to trade announcements?
Well, during 2025, President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. We've announced lots of trade deals. We've announced lots of tariffs, as you know. In the coming year, we expect to finalize a bunch of those trade deals as well. I think that the tariff plan is in good shape. I think we have a lot of the tariffs we want in place. If there are countries here and there that don't comply with their deals or don't want to finish a deal, then maybe we have to have another conversation. But I think the economy's booming, inflation's down, wages are up. We're on a really great track.
How much are you potentially at risk should the Supreme Court overturn some of the tariffs that have been enacted under the IEEPA provision? Do you have something in place to get those tariffs through other measures, or will there be a rethink about what will be put on and what won't?
Well, it would be terrible if the Supreme Court overturned the case, because we have built a new global trading order on the back of these tariffs and the tariff system, and our trading partners have accepted it, and they've made deals, and they've accepted there's going to be some tariff level to help protect U.S. industry. So it would be disastrous if this was pulled out. All that being said, we will do whatever we need to do to make sure that we can maintain the tariffs we need and keep the deals in place. Obviously, we want the flexibility of the emergency powers that Congress has given to the president. That's the most effective way to deal with it. It's what's made him so effective this year in negotiating. But absent that, we'll work and we'll find a way to make sure we can keep all these gains we've made over the past year.
Representative Greer, there's also a feeling right now that cost of living concerns are coming to the fore, and President Trump has talked about removing some of tariffs on specific goods, particularly having to do with food, as a way of alleviating some of the price concerns. How does that factor into discussions going forward? Do you think that will be an increasing part of your thought process as you go through some of these trade negotiations?
Well, any good president wants to address affordability, and our president is. And over the past month, we saw dairy, fruit and vegetables, all kinds of prices go down for basic staples. So that's a great development. Going forward, the president removed some tariffs in connection with some deals related to food coming from abroad, bananas, coffee, cocoa, the kinds of things we just don't make in the United States. The United States is a food powerhouse. When we saw inflation earlier, it's really about housing, health care, driven by Obamacare disaster. So I don't think that, food imports are really going to be an issue for us. The tariff program is really about creating jobs, and the president's regulatory approach is really about bringing prices down and bringing affordability.
Ambassador, have you had any specific directives from the president, though, as you carry out your negotiations to make sure any tariffs you put on from here or any ones that you negotiate specifically are not having an impact on affordability?
So the way you put it there, a specific direction, I would say no. Whenever we're imposing tariffs or doing deals, the purpose of the trade program is to reshore American manufacturing and protect American food security. It's really about jobs and increasing wages, which we've seen over the past few months. When it comes to prices, the president is undertaking a lot of other actions, energy policy, tax policy, regulatory, gas prices are down, et cetera. So we don't see the trade policy really as driving prices. We see it as driving jobs.
Ambassador, I'd love to go back where Lisa started, and that is, it looks more likely that we indeed have something of a TikTok deal where U.S. buyers will take the American portion. You, after some of the negotiations in Madrid, were talking about how this deal, how this company was part and parcel of a variety of matters when it comes to negotiating with your Chinese counterparts. So have you had more discussions about this deal with TikTok? Does it seem likely that China will let it happen?
So there are two layers to the TikTok deal. One is the private sector layer, where the private parties are concluding a deal. And then there's a layer of government approvals between the United States and China. And so my conversations with the Chinese government over the past few months, as you mentioned, have covered a variety of issues. One of them has been TikTok. Back at our discussions in Madrid, we came to an essential agreement that if the private parties came to agreement, that the Chinese would approve it. So we expect approval by the government of China in alignment with that agreement we reached earlier this year.
We're hearing about not only this deal with respect to TikTok and some investors in the U.S., but also a review process to sell H200 chips into China. And I'm just wondering, stepping back, if all of these are pieces of a bigger deal that will come to fruition in 2026 between the U.S. and China.
I would say with the H200 export control issues, those really are standalone. That was not a negotiated outcome in the United States with respect to export controls. Those are not something that are really subject to negotiation. Those are national security and commercial decisions made by the federal government. So that's kind of standing on its own. With respect to the rest of the China deal, right now we're trying to make sure that rare earths continue flowing from China. You know, they've bought over 5 million metric tons of soybeans at this point, and we're trying to keep trade flowing between the two countries in a way that makes sense.
Do you expect a bigger deal other than just sort of steady reset kind of idea that we've talked about with respect to the U.S. and China? Do you expect something more comprehensive to be outlined next year?
It's a little hard to say at this point. You know, goal one is stability. For me, and everyone's heard me say this before, we need trade with China to be much more balanced. Our trade deficit with China has decreased by 25% this year alone under President Trump's policy, so that's going the right direction. I can foresee a situation in the first half of next year where we come to some kind of agreement with China on exactly what we should be trading with each other, and even in what volumes. It's a little bit of managed trade, but it's the kind of thing that can be healthy and stable. You know, given the way that Chinese government runs its economy, it just doesn't mesh very well with the way we want to run our economy. That just means we have to manage it a little bit more, and I think there's a possibility of that. I'm not sure I'd call it comprehensive, but I'd call it confidence building.
Ambassador, I think a lot of the confusion for many people comes around national security. One of the points that you mentioned just a moment ago, especially things with H200 chips, giving chips to China was seen an issue of national security, even giving F-35s to Saudi Arabia. What does that mean for national security? Because critics would say that it means that national security is up for sale. What would you say to those critics?
So with respect to the F-35s, that's not my. I used to be in the Air Force, but it's not my wheelhouse. On the H200s and export controls generally, export controls have always been fluid. They've never been static. The very nature of export controls is that the U.S. government is constantly reviewing the state of technology and assessing what technologies can be sold and which ones can't, and balancing national security and assessing whether or not there's foreign availability. Everyone knows that the Chinese are quickly also trying to develop their own AI chips, semiconductor tools to make those chips, et cetera. It's a race. All of those H200 approvals still have to go through the Commerce Department to make sure that any licenses that are granted really respect U.S. national security and make sure that it's not violated, and there can be conditions on licenses, et cetera, to make sure they go to end users and end uses that don't jeopardize U.S. national security.
Is it fair to say then, Ambassador, that even if this does go through, the kind of cases where this is allowed, where it's approved, will still be quite limited in scope?
So it's hard to say at this point. That these types of license applications are typically case by case and reviewed. So, you know, we'll see. The way it's set up right now is if the chips are going to go to China, they come back to the U.S. for a security inspection to make sure that they are indeed the types of chips that are being allowed to be sent to the Chinese. We know there are a lot of Chinese companies that want them. We know the Chinese government's pretty interested in having their own domestic champions build them. So the Chinese themselves right now are having a conversation about the types of chips that they want from the United States. We think that they want the H200s. They've shown an interest in that. So we'll see, you know, between their process and ours, we'll see where it goes.
It seems like the tech wars have been behind a lot of the negotiations over the past 12 months, in particular, not only with China, but also the European Union. I'm just wondering where some of those discussions are with respect to some of the restrictions and regulatory investigations Europe has been making toward U.S. tech companies. Where are some of those discussions?
So I just had a conversation yesterday with my counterpart in the European Commission. yesterday to reinforce some of the strong concerns we're hearing from U.S. stakeholders. U.S. tech companies are the most competitive in the world, and Europe, frankly, doesn't have those types of competitors. If you talk to the Europeans, they'll say that's why we have to regulate and have these protectionist measures against U.S. tech companies. Unfortunately, we see in the way that they've developed those measures, they're discriminatory. They only capture companies above a certain threshold of revenue globally or certain business models, and magically it only happens to capture U.S. companies. They'll say that they're Chinese companies too, but we only see actions against American companies, so it's a problem. It's discriminatory in fact. You'll hear the Europeans say, well, it's fair, but it's discriminatory in fact and in intent. So I want to talk to these folks. I want to negotiate over it. They've been somewhat resistant to that, but again, I had a great conversation yesterday with the European Trade Commissioner, and I think we just have to be able to talk about why they're doing this, why they're purporting to regulate American companies and their global business models.
Ambassador, coming into 2025, a lot of people were wondering who our allies and who our adversaries would be on trade. And we were talking about who traditionally have been U.S. allies and who haven't. Have you been surprised at who's been most difficult to deal with in 2025? It has surprised a lot of people in the markets to see the likes of Europe be a more contentious discussion than other regions, even sometimes China.
That's because they haven't been trade negotiators. I have not been surprised at where it's been more challenging. Take India, for example, who's an important partner and a strategic partner in a lot of ways. We started negotiating with them early in the year, and we're still negotiating with them to try to find a good landing zone. During that time, we have other trade partners who have come in, started, proceeded with, and concluded trade negotiations with us, et cetera. The reality is somebody like Europe, and frankly, some jurisdictions that want to emulate them, they might have relatively low tariffs compared to the rest of the world, but they have non-tariff barriers, regulations that exclude American agriculture, which is one of our major exports, and regulations that exclude our industrial exports. And so you get into and this is why we have giant imbalances. It's not because Europe is really competitive. We know they're not. It's because they have a lot of these rules that prevent U.S. goods and services from going into the continent.
Ambassador Greer, just to finish up on Mexico, which has been negotiating from what we understand, they just recently gave final approval to put tariffs on certain Chinese imports, and a lot of people are expecting there to be some sort of reprieve with respect to aluminum and steel tariffs on Mexico. Is there any discussion about that going on right now?
So first of all, any country in the world who exports steel and aluminum to the United States wants to have a modification to that regime, because the United States for many years has been the consumer of last resort, and this is why the president put steel and aluminum tariffs on in the first administration. The Biden administration kept them, and the president has tightened them further in his second administration. Of course, the Mexicans are asking for this. We have found the Mexicans to be quite constructive in some of our recent discussions in looking to change some of their laws and regulations related to longstanding U.S. concerns. So have the Mexicans asked about this? Yes. I won't give any further detail beyond that, but it's certainly something that they would like to see. It's not surprising.
Ambassador Greer, thank you so much for being with us this morning, and have a wonderful rest of the year. Ambassador Jameson Greer speaking with us, really indicating how much we're seeing this kind of shift to not exactly the hot boil that we saw this year. And I would love, Alicia, your take just quickly on how much people are expecting peak uncertainty with tariffs behind us and smooth sailing going forward.
So despite the fact that everybody's waiting on SCOTUS, I'm not sure that's really the game changer here, even though it'll introduce some uncertainty on the how, but it seems clear the administration is intent on having tariffs. Peak uncertainty on tariffs was May and April of 2025. And the market has told us that it's essentially behind us now. So I guess you could say one of the risks would be if it just reemerges as an issue, because right now the tariff collections are coming in far lower than the statutory rate.
We'll continue this conversation in just a minute. Coming up, Ryan Wong of HSBC as some analysts cast doubt on U.S. inflation. Plus, Yahaira Anand with your morning movers as we try to get some sort of rally to end the last trading week of 2025.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Beirut, and this is Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is
The
here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Trying to build on what we saw yesterday with a little bit of positivity, at least in the tech space, not so much everywhere else, just really fading as the session grows older. NASDAQ futures up 0.2%, Russell 2000 also up almost the same amount. Curious, given what we're seeing in the bond space, 2s, 10s, and 30s, yields climbing at the longer end of the yield curve, not because of CPI yesterday, but because of what we saw from the Bank of Japan, hiking rates to the highest levels going back 30 years, 30-year yields rising in sympathy, 4.83%, really have been pinned there. Danny, to me, this is really the story. They've been pegged at this higher level, and people saying it's okay because ultimately the economy is strong enough to look past this.
Right, it's been trading in a really tight range too, in that same level. So maybe that's why it's like, okay, maybe the level isn't great, but the direction is not concerning. But then you also have volatility trading really low. How much of that though does get disrupted from what we're seeing globally? And that is the story of this morning, and likely it's going to be the story of 2026, with Bank of Japan, BOE, and ECB signaling that either they're hiking in the case of Japan or that their rate cutting cycle is over.
Yeah, the global story also very much front and focus for corporations. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. The housing market continues to challenge the home builders. We saw that with Lennar earlier this week, and now with KB Homes, shares are falling 4.25% after they delivered fewer homes than expected, while profit also weakened in the last quarter. That's thanks to those big incentives that they've been offering buyers to get them in their homes. KB Homes also issuing a weaker outlook than expected as those challenges around affordability and mortgage rates look set to remain. Meanwhile, we are seeing Oracle shares rising near 4.6% in the pre-market on a reporting that it will be part of an American consortium of investors set to take over TikTok's U.S. operations. Oracle would gain 15% ownership under the deal, which analysts are saying would lock in TikTok as a major cloud customer for Oracle. This is all according to a memo seen by Bloomberg, with the deal expected to close on January 22nd. And we end on Nike, big mover to the downside, down now 11.6% after the company warned that sales will drop this quarter, and that's thanks to two major issues. It's China sales and its Converse brand. The weakness surprising investors after 2 straight quarters from Nike of growth. The negativity also spilling into the broader footwear sector, with Deckers, which makes the UGG and Hoka shoe brands, also falling down 3% in the pre-market. Lisa?
Thank you so much, Yahairo. Meanwhile, Wall Street casting doubt in November's CPI report, hitting a 4-year low after several categories with previously stubborn inflation appeared to nearly evaporate. Bloomberg's Michael McKee joins us now. Mike, what's the latest when people parse through this, particularly with respect to owner's equivalent rent?
Basically, you just have to look past this, and that's what most people are going to do. Nobody thinks that BLS did anything wrong, illegal, put it that way, or conspiratorial editorial, but they did have a statistical issue with how you deal with the fact that there were no October data. And so what they did was just move September data into the October boxes, and that ended up meaning that there was, for housing, zero change in prices, which is not likely at all. So everybody's looking past this, and we'll get the December CPI numbers in January, and that'll be much more dispositive as far as what the Fed's going to do.
Thank you so much, Michael McKee, and we'll be looking forward to that data with possibly more clarity. Alicia Levine, Head of Investment Strategy and Equities at BNY Wealth, still with us. I'm just curious what your takeaway was from the CPI report we got yesterday.
Well, of course, there was that first shock, like, wow, you know, it's much lower, but then it became clear that there are donut holes there. So I think overall, better that that inflation report was weaker than stronger, and really good that we don't have to debate whether or not the higher readings are real or not. But I think ultimately the market told you yesterday, the bond market told you yesterday that we understand that this data is not quite firm enough, and we'll have to wait and see. I think overall, the last 2-3 months, and all the data reads, the comparisons have been very hard. The collections have been difficult. So the Fed is working in a little bit of a data vacuum still, because it's very hard to have a month-over-month read when you're not quite sure if the collection was the same as it was historically.
How much does inflation boost the case for equities beyond the case of fixed income, beyond the case of almost any other asset class?
So I think you really have to separate it here, because clearly inflation reads for fixed income are quite difficult, and small changes can matter a lot in market pricing and in portfolios. On the equity market, it's a very different thing, because earnings are nominal, meaning it takes into account inflation. And so any bit of inflation that does not cause a Fed pivot, right? The key here is the Fed pivot. And the pivot meaning from a cut or a hold to a hike. So as long as inflation is somewhere in that place where the Fed is not pivoting, then it's actually fine for equities, and that inflationary piece gets reflected in market pricing because it gets reflected in earnings. So very different in your asset classes, which asset classes can handle a little bit of extra inflation and which not.
Yeah, and the idea of a hike right now, very much not on the Fed's picture.
And of course, that would be a risk.
That would be a risk.
That would be a risk.
But right now, doesn't seem to be in anybody's bingo card for next year. Ryan Wong of HSBC joins us now to parse through what we have heard. Ryan, do you think it is appropriate to just look through yesterday's CPI report?
Well, I'm not sure we can just entirely look through that release. Now, it's true that the most analyzed portion of that report did relate to the rental inflation, and I do think it's fair to say that the number itself was likely distorted on the rental side. But we still have to build a new fact pattern for what rents will look like as we go into next year, because actually there had been some evidence even prior to yesterday's report that rental inflation has been slowing gradually. So I don't think we can entirely dismiss it. And then, yes, if we look at the other components of the report, they also surprised the downside. Maybe there were some seasonal distortions. Of course, we are going into the holiday season, so therefore the timing of when that data collection happened might have led to some of that downward distortion.
How are you thinking more generally, Ryan, about the data and the quality of data itself, whether it's good enough to make decisions by the Fed, or whether this is a Fed that is in hold not just because of the pressure from the dual mandates, but because of the lack of clarity from the numbers themselves?
Well, I think in the United States, the one thing is we do have an extreme wealth of data, right? We have so many numbers. That's why, we had this historic week this week where we had these highly unusual jobs reports and highly unusual inflation numbers. But then we have all this other secondary indicators and private sector indicators. And then we have the anecdotal information from the Beige Book. So there's plenty to analyze. I don't think that's really the issue. I think, the disagreements on the Fed are fundamental. They are about, what is the better approach for policy rates? Do you still need to slow down the economy to bring down those inflation numbers even further? Or is it fine to just sort of sit where you are for some time and allow the economy to adjust to the current level of interest rates?
We were speaking with Krishna Guha of Evercore earlier, who said that he was worried, not as much at this moment, but it is a real threat to have some breakdown in the Fed. A crisis of governance is what he called it, when Powell is no longer there, and you have someone at the head of the Fed who can't coalesce a consensus. That it's not just an issue of disagreeing opinions, but it's about a lack of ability to communicate. It's about politics getting more deeply entrenched. Is that a risk for you in 2026?
Well, it's something to watch for. I mean, we heard from Fed Chair Powell that he wants to deliver the economy in a strong place to his successor. And so look, the new Fed chair is going to have a new communication style, is going to have a new way of doing things, may have a new approach to all of these issues, assessing the economy and then delivering that message to the markets and to the public more broadly. So, look, we have to wait and see who that next Fed chair is, and then after that occurs, the markets will have to adjust to a new style.
Look, on the question of Fed independence, which is really the question you're asking, look, I think that in some ways politics has been part of this for a while now. In the end, the person who's chosen is going to be part of the institution. And nobody wants runaway inflation on their watch. That's the role. So ultimately, I think the person, whoever is chosen, will be aware of the inflation rates. I think the data is going to normalize going into next year, and we'll be able to tell.
Well, taking a step back, it seems like people are betting on that. People are betting on the credibility of the central bank. Particularly, you can see this in the dollar. There has been a sense that the dollar has not weakened more. It's basically traded flat since that April-May period of time. I mean, are people looking past any kind of Fed compromise here? And I guess that I would ask you that, Ryan. I mean, how much are you looking at a market that has essentially said, yes, this is a Fed that's a little less independent just because of the fiscal backdrop, but the reality is that it is a committee and it will ultimately do something that won't denigrate the superiority of the dollar too much?
Well, I think fiscal issues are still highly relevant. I mean, next year we anticipate that we're going to have a budget deficit that is close to 6% of GDP for the 4th consecutive year. Now, in order to offset that, you need extremely strong GDP growth. Now, on the positive side, we are going into next year with some positive tailwinds. You know, we'll probably get a little bit of a V-shaped pattern in the GDP numbers, high in the 3rd quarter, low in the 4th quarter, and then strong again in the 1st quarter of next year, partly because of the positive effects of fiscal impulse, right? So that can be supportive of growth. But at the same time, we know that the drivers of growth for the U.S. economy and maybe the global economy are somewhat narrow. You know, there's obviously a lot of this benefit that's come through from AI capital expenditures. And there's a question about how much that can really support tax revenues for the federal government if that's all that's driving the economy in 2026.
Ryan Wong of HSBC, thank you so much for being with us and have a wonderful holiday season. Alicia, from your perspective, how much are you seeing a real pushback against the American first kind of idea here? Do you see a lot of clients saying it is the time for the rest of the world to perform much more significantly?
So in our client base, the answer would be no. Right, our client base is committed to American exceptionalism, American businesses, American productivity. You know, what we do is tactical changes in portfolios, and ultimately outperformance of rest of world is really tied to the U.S. dollar. And that's what we saw the 1st quarter of the year. The U.S. dollar dropped 10% swiftly. Rest of world outperformed enormously, and ultimately the S&P has outperformed rest of world since April 1st. And as you point out, the dollar's gone nowhere since July 1st. So it's very much tied to the dollar. So when we talk about allocation in portfolios, the question we have to ask, at least within the equity space, is what's your view on the US dollar? The Japan issue is interesting, of course, because as the yen weakens, dollar is stronger. Do you get the trade back to US outperforming rest of world? So our client base is committed to U.S. assets, large, small, mid, but ultimately we are allocated emerging market debt, emerging markets, and rest of world as well, because we do see the impact of the cutting cycle in the past year or two affecting real growth.
Japan is an interesting one, especially off the back of this rate decision, because bond yields are moving higher. How are you thinking about global allocation if we continue to get that? Because there have been past episodes where U.S. equities are challenged by when the carry trade is challenged in Japan, or repatriation back home as yields are all of a sudden attractive. Could that be a factor yet again in 2026?
It could definitely be a factor in 26. You know, as the Japanese 10-year moves higher, what does that do to the U.S. 10-year here? I think that's one of the risks for next year. Ultimately, if you get steeper yield curves globally, as you know, it's great for financials. And so all these other markets are chock full of financials. So European equities, financial, and Japan equities. So that'll be very good for markets as well. That's why we see bouts of volatility, because ultimately it's the surprises that give you the vol in markets, and something that happens with the Japanese bond market would ultimately affect here. The other thing is the most consensus trade out there is a weaker dollar for next year, which was what we had this year. And so if that changes at all, then you have global allocations that really are not working in portfolios.
Alicia Levine, you're going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa.
EU leaders have agreed on a more than $105 billion loan package to Ukraine for the next 2 years. The interest-free loan will help the country finance its military and economic needs amid its ongoing war with Russia. The loan came together after European leaders failed to agree on a plan to use frozen Russian assets to raise the funds. Meanwhile, former NASCAR driver Greg Biffle and his family are believed to have died when their corporate jet crashed just minutes after taking off on Thursday from a regional airport in North Carolina. A definitive list of the victims will be released once their identities have been confirmed. The FAA and NTSB are investigating the crash. And the FedEx turnaround story is showing signs of success, though shares are in the red. Earnings for the shipping giant topped estimates, and the company raised the low end of its profit outlook for the year, driven by volume and pricing gains in the U.S. However, FedEx is still working through several challenges and expects adjusted earnings to dip this period. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira, and thank you so much for everything this morning and this week. Up next, setting you up for the day ahead, plus Eric Johnston of Cantor Fitzgerald as pressure grows on the already fragile AI trade. From New York, this is Bloomberg Surveillance.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case because we have built a new global trading order on the back of these tariffs. We will do whatever we need to do to make sure that we can maintain the tariffs we need
That was U.S. Trade Representative Jamieson Greer earlier this morning, and it gives us a sense of just how long this year has been. So many machinations, so many twists and turns. Right now, heading into the end of the year, people are a bit dazed and confused, at least based on the price action. Not much on S&P futures. You are seeing, though, that lift for NASDAQ and Russell futures up about 0.25% in the bond space. That's been where the action has been. When you take a look at 10-year yields in the U.S., in Europe, as well as in Japan, you can see that lift higher with a real question about the global rate cutting cycle. Is it over? And is Bank of Japan leading on the hiking scale? Meanwhile, right now, we're looking at a lot of positivity heading into next year. Eric Johnston of Cantor Fitzgerald targeting the S&P to finish next year at 7,400, but saying the risk of a drawdown in the first quarter is high, writing the AI trade is becoming more fragile. The CapEx numbers from hyperscalers at end of January will be closely watched. Eric joins us now. Eric, great to see you. Thank you for being here.
Thanks for having me.
So talking about the fragile story, why do you push back given the fact that ultimately you have seen a lot of earnings come in stronger than expected, and a lot of people have said the sell-off so far highlights it isn't a bubble because there's skepticism, and that doesn't happen at this time?
Well, I think the backdrop is that, everything is being driven by the AI CapEx cycle. And what we see right now, it is very strong. As we know, we're seeing it in earnings from the Microns, et cetera. And I think it's important to realize that the CapEx cycle is driving GDP, right? We're seeing this anomaly of zero job growth, but yet GDP 3-4%. We're seeing it in earnings growth. Earnings, grew sales 8% last quarter. Mid-teens earnings growth, margins are expanding. So the earnings picture is very strong, but highly correlated to this build-out. And as we know, the market is a forward-looking, indicator. And so while everything is very strong right now, I think the risk is, does something happen in 2026 that gives the market pause around the direction of the CapEx cycle in terms of will the growth of CapEx continue as it has been. And I think that just creates a risk for the overall market.
You've started to see some of that risk already creep in, but at the moment it's taking the form of just targeting individual companies like CoreWeave, like Oracle. If the market turns more and starts to question CapEx more broadly, do you anticipate that all the AI names get thrown away? Or will it be a market that's very selective with this narrative?
So I think, and to be clear, I think the cycle is going to continue throughout 26. It's just that I think there's going to be scares along the way. And when you get those scares, there's so much in the S&P, not only in tech, that is tied to it. So you think about some industrial companies that are benefiting from the construction of all these data centers. Obviously in utilities, so many different aspects. And then of course within tech, semiconductors are at the heart of it. So I think if you do see a broad concern around a CapEx cycle that is turning, then it would have a much broader impact on tech. But one of the things we've seen of late is, the picking of winners and losers, and I think that's going to continue. I don't think, it'll ever be sort of a broad, take on just because there's so many different players, and there ultimately will be winners and losers.
I do feel, though, like it's a market that is trying to pick through and find where those winners are. And the narrative has been, we're broadening out. It's not just the picks and shovels. We're looking at people who can benefit from AI. What about business models that are getting destroyed by AI? You see that in the likes of Salesforce, for example. Are there certain sectors where you just would not touch at the moment because of the uncertainty of the impact AI will have on their business models?
So I actually think is going to, hit companies that have products that maybe in the future down the road could be severely negative impacted by AI. But I think the market's taken far too aggressive a view in terms of the timing of it and actually how it's going to play out. So I think names like Salesforce actually could do very well in 2026 as the market starts to take a step back and say, hold on, this actually may take longer. Their products are not going away, et cetera. And there's a lot of names like that that are very similar to Salesforce, and it even goes beyond tech, whether it be the consulting firms tied to labor, et cetera.
Well, there's this idea of dispersion here, right? And Alicia, I'd love your thoughts on this. Alicia Levine from BNY Wealth with us this morning. There is this question about how much people are going to start to question the financial prospects of some of these companies and how much the proof is really going to be in the pudding, and you could get some selective defaults. You could get some real questions around whether the OpenAIs of the world will keep getting the money that they're asking for. How much are you kind of looking to this as being a hiccup, whether it comes through in the financial sector, whether it comes through private credit, or whether it just comes through in specific stock selection?
So I think, look, we're in the middle of something of an industrial revolution here, and not all entities are going to be winners here. And even year to date, if you just look at the Magnificent Seven, which pretty much overall have benefited from the AI trade over the last 24 months, only 2 of the 7 have actually outperformed the S&P this year. So, you know, the market is always trying to pick winners and losers in whatever era we are. I'd say there is risk there. I don't think the risk is going to be overall, but to particular companies, that would definitely be the case. But if you just think about the conversation that we were having around this table, let's call it February and March, when we weren't talking about tariffs, we were talking about the companies, you know, in the top 10 who were not investing in AI, and were they going to be left for dead, or business models were going to go away altogether, being eaten by ChatGPT. And it turns out those are the companies doing great right now. So I think it moves so quickly that piercing through for the next 12 months, which is what you really have to do at deploying new capital today, where the market's going, you can't do it day by day. I think it's too uncertain, but ultimately there will be winners and losers here. But the ones that are winning may not be the ones today that we think will.
All right, both of you, real quick here. What's your highest conviction contrarian trade heading into 2026? Eric?
So I'm not sure how contrarian this is, but a rally in the bond market. So I think in terms of the long end of the curve, I think we see the 10-year yield, drop into the 3s, mid to maybe upper 3s. And that's for a number of reasons. I think inflation has peaked, and I think we see inflation come down throughout 2026 due to weak labor market, weaker wage growth, oil prices at the lows, et cetera. And then I think the Treasury will be aggressive around trying to get back-end yields lower for housing purposes, and there's a lot they can do, especially if you can get the Fed funds rate down to the 3% area, moving issuance and doing things like that. So I think the 10-year yield will go lower, will break 4% in 26.
Alicia?
So growth 2.5+% as a right tail risk. Inflation lower second half of the year, and the new Fed chair fits in just fine, and there's no institutional angst over it.
Alicia Levine, thank you so much for being with us this whole morning. BNY Wealth. Eric Johnston of Cantor Fitzgerald, thank you so much. Both of you, thank you so much for spending the last trading day of the year, at least the last trading day of the last full week of the year in 2025. Danny, what a morning. I mean, honestly, heading
I
into
wish it
next
was
year.
the last day of the year.
I know. Well, I think President Trump is trying to make it so. Coming up on Monday, Marvin Lowe of State Street, Sucharita Kadali of Forrester, Neil Dutta of Renmac, and Fed Governor Stephen Myron. Don't miss that. This was Bloomberg Surveillance. Have a wonderful weekend and have a wonderful holiday. This is Bloomberg Surveillance.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Happy Friday morning, 30 minutes until the start of the last trading session of the week. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming out, the Santa rally still in the cards as Goldman and Citadel Securities join bulls in predicting more gains.
Nike's turnaround loses traction with the stock headed for its 4th consecutive annual decline.
And TikTok's long-awaited break from China is finally underway. Its U.S. data is now under domestic control.
Matt, one of the stocks I'm looking at this morning is Oracle. The ups and downs of this company have been really remarkable. Today, in the pre-market, it is up 4.5%. Concerns about spending be damned, because this time around, they're leading a group of U.S. investors that are overseeing TikTok's U.S. business. The company is valued around $14 billion. So maybe we don't like your debt unless you're doing it to buy TikTok? I don't know.
Yeah, volatility is the key here. I see what you did with the traction thing and Nike at the top.
I wish I could take credit for it, but it's the brilliance of our producers.
Nike warned that sales will decline this quarter amid weakness in China, and with its Converse brand as well, you can see that shareholders are really taking it out on the Oregon-based shoemaker, down 11.4% in the pre-market. And Deborah Weinswig of Coresight Research joined Bloomberg shortly after the results came out on the close.
I've always looked at C-suite changes as an indication of where things are going. Nike cannot hang on to their innovation talent. I mean, it is like a revolving door like I've never seen, to be quite honest, in any company in my entire career. And so I do worry, honestly, from kind of like my essence, that there is something still off at Nike.
Some harsh words. For more on Nike, Romaine Bostick, co-host of The Close, joins us now, who was covering those earnings when they came out. Romaine, the first sense when they came out was like, hey, this isn't too bad. And then things changed.
Yeah, I mean, this is kind of a tale of two cities. In North America, things are going well. They're selling more apparel, selling more sneakers. But there's a lot of concerns right now about the China business, which has been in decline even before Elliott Hill got there. This quarter was no different, a 17% drop. And he addressed this on the conference call. I don't know if we can put up one of the quotes here, because he talked about this idea media, that China, they kind of fell into this sort of lifestyle trap. And he talked about how it's much more of a mono-brand culture over there, and you're competing much more on price. Basically, they had no pricing power, and they had a lot of competition from other brands. The other component of this isn't just what's going on with China, but it's also about Nike's direct sales to consumers. So if you go to Nike.com or something like that, apparently you're not going to Nike.com, because that was also negative as well. So they've got a lot to do here. He's only about a little more than a year right now into this turnaround strategy, and while the last couple of quarters you saw some progress, it looks like this particular quarter maybe just a little bit of a stall.
You know, Deborah Weinswig, your interview with her yesterday, she said they're losing their innovators, right?
Yeah.
But you can do so much on their website, and I don't really see that at the competitors. This market is worried about on cloud and what are the ones that Katie wears? Hoka's.
Hoka's, the big chunky ones, and Nike's got into the big chunky ones too. But they announced yesterday several new products that are coming online in January. They expanded the Nike Skims collaboration that they have with Kim Kardashian. They have something called Nike Mind, which has got much more athletics-focused type of a sort of a prehab type of wear. That's debuting in January. They have this whole Win Now program. So there is a pipeline of, I guess, what would be called innovative products. But to Deborah's point, the problem is this pipeline should have existed long before today. There was a clear gap that they had in that pipeline of innovation. This is something that Elliott Hill has been trying to get back.
All right, Romain, thanks very much. Romain Bostic there on Nike. You can catch his program starting at 3 o'clock this afternoon, the close with Katie Greifeld. Now, TikTok is being bought by a group of buyers led by Oracle, with both parties signing a U.S. joint venture. Bloomberg Tech's Caroline Hyde, I should say, joins us now, and this is just one of a slew of the stories that you guys are going to be covering at 11 o'clock. But a huge one for Oracle, right? And for, I guess, the kids.
And the kids. And me. I love a bit of TikTok.
That's true.
But a lot of the slew of the stories we're going to be covering in Bloomberg Tech involve Oracle in some way, shape, or form. It's just becoming omnipresent across so many stories. Now, what's interesting as to why Oracle's rallying today. Now, you might bear in mind that CoreWeave and other key cloud, neo-cloud players are on the upside today. So there seems to be, after the Micron numbers, a little bit of release of that AI anxiety. But Oracle's up because a lot of the analysts out there say this is a win to own a strategic asset. Remember, TikTok is a big part of their current cloud partnership. The cloud that Oracle has got into and is seen as a winning formula, a lot of that is predicated on TikTok as a big client. So TikTok's not going anywhere. And in fact, they're going to potentially be taking a 15% stake. Sure, that's going to cost them a couple of billion, and that's probably just a drop in the bucket of the $100 billion of debt that they already have on their balance sheet and the overall CapEx spend that they're going to be committing. But the idea that they're going to be able to ramp up, that maybe this is a growth opportunity for them, they're going to have ownership. The question is, there are still so many question marks. Look, we understand from previous reporting by Bloomberg and the White House announcement of this deal earlier a few months ago that, well, 50% of the profits made by this new US TikTok is actually still going to go to ByteDance. What role is ByteDance still going to have? What oversight are they going to have? Is this going to be signed off by Chinese regulators? Is this going to be signed off by US Congress as well?
Part of the, I don't know, hilarity, I'm not sure what it is, the head-scratchingness, irony, sure, whatever, is just looking at something like Oracle and all these AI names that you mentioned is the kind of oscillating back and forth between, like, the world is over to, like, yeah, we're so back. Part of that also is OpenAI and these huge valuations they can still command. The Wall Street Journal reporting $830 billion. What, it was just $500 billion in the fall? What does that huge ramp-up imply for OpenAI?
That it wants to be bigger than SpaceX. You kind of end up thinking, is this just to try and be the world's most valuable market capitalization?
Well, they are growing also at a massive pace in terms of users, right?
Look, this is it. They've got almost 1 billion monthly users. They have seen a revenue increase rate that we have never seen before. Sure, it is tiny in comparison to the $200 billion that they're going to be spending up to 2030, but we are seeing just growth that we've never seen, touched, felt before. This is why VCs are so willing to back them. Look, they're likely to have to go pretty international if they're going to be raising up to $100 billion. That's what Wall Street Journal is currently talking about. They've already tapped SoftBank to a significant amount of money. They've already got Middle Eastern investors. MGX, which is also going to be buying a bit of TikTok, has also been interested and been buying in OpenAI as well. Where else are they going to get the funding? But we keep proving out time and time again, there is a wall of desire to get into private assets right now. There's 16 trillion already going into them. Think of SpaceX, think of Databricks this week. OpenAI, with its growth rate, no wonder people are bandying around numbers like 850 billion. And maybe that's why Oracle, of course, needs to keep on building out its data centers.
Well, Caroline, I'm very much so looking forward to the Oracle show starting at 11
Thank you.
a.m.
Come join it.
Bloomberg Tech's Caroline Hyde, of course, the show is Bloomberg Tech, which you should stick around for. We also got FedEx earnings out after the close yesterday. The stock is down 3.7%, despite upgrading its full-year targets. A string of cost headwinds is weighing on FedEx. For more, Lee Klaskow, senior logistics analyst for Bloomberg Intelligence, joins us. Lee, what were the dark spots for these earnings in FedEx?
Yeah, so their second quarter earnings was actually pretty, I would say, better than expected, but the outlook is a little more clouded, and that is really because of a lot of headwinds that they're facing, whether it's from higher variable comp, incentive comp, or if that's due to the grounding of their MD-11 fleet. Also, they are facing a weaker LTL or less than truckload market, which FedEx Freight, that's their segment that operates in that industry, and they're the largest player in that industry. So those three are the kind of the major headwinds that the company is facing in their second half. But what I would note is that their restructuring plans seem to be going well. Their implementation of their peak plan and the execution of those plans appear to be going well as well. I think that some of these headwinds are short term, especially when you think of the MD-11 headwind. But the freight, their FedEx Freight business is going to face probably weak demand, probably in the first half of the calendar year next year.
Lee, just for those people who aren't very familiar with this story, when you say MD-11, you're talking about McDonnell Douglas, and I can't believe that it's still around. What is FedEx going to do? I mean, do they have to buy a whole new fleet of planes, and why were they using this one for so long?
I mean, they're slowly transitioning away from the MD-11s to more efficient planes. That's just part of their fleet overhaul that they've been doing, and UPS has been doing similar things. Some of people might remember there was a tragic accident of a UPS MD-11 plane. The whole fleet was grounded. Expectations are the inspections will continue, and they'll probably be back in the air by sometime next year. But this is their busy season, and to go out and lease in at least a short-term lease a plane is pretty expensive, and that's kind of what's driving some of these headwinds. And they also might use trucking for some of these volumes, at least domestically, when it makes sense, and that also could add to the cost as well.
All right, Lee Klaskow there talking to us about FedEx earnings and the old McDonnell Douglas. The last time they made one of those was in the year 2000, so it's been 25 years. Quick check on what's going on in the markets on this Friday. After yesterday, we finally had gains at the close, and we're looking right now also at gains in futures, but they are slight. So 0.1% on the S&P and 0.25% on the NASDAQ.
Let's look at some of the individual movers, because this broke in just a few hours ago. AbbVie, Bristol Myers, Merck, and other drug makers, they are expected on Friday afternoon, which is today, that they would announce agreements with the U.S. to lower certain drug prices. That is, according to a Reuters report, shares are as high as 1/3% for AbbVie moving this morning.
Yeah, that broke in our editorial meeting, which I know because Joe, who manages the headlines, instantly sent them.
I wasn't there because I might have
over.
been on TV.
You were on Bloomberg surveillance this morning. KB Home earnings disappointed with profit missing estimates, and its outlook also seen as we can see the shares down 6% in the pre-market.
Now let's look at Coinbase, because they are currently suing Michigan, Illinois, Connecticut over their attempts to regulate prediction markets. It says the states cannot interfere with CFTC jurisdiction over the sector. Shares higher by 2.4%.
Coming up, GM's Sterling Anderson is emerging as a top candidate to succeed CEO Mary Barra at the biggest U.S. car maker. More on that next. This is Bloomberg Open Interest.
Used to be, one would say, what's that got to do with the price of tea in China?
when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. U.S. Trade Representative Jamieson Greer tells Bloomberg the decision to allow exports of NVIDIA's H200 chips to China is a standalone matter within the broader U.S.-China trading relationship. He also weighed in on the tariffs case that's before, right now, the Supreme Court.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade in the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case because we have built a new global trading order on the back of these tariffs. We will do whatever we need to do to make sure that we can maintain the tariffs we need.
The Trump administration has suspended the green card lottery program, which it says allowed the suspect in the Brown University and MIT shootings to come to the U.S. According to Homeland Security Secretary Kristi Noem, the pause is intended to, quote, ensure no more Americans are harmed by this disastrous program. And Ken Griffin's Citadel is on track for its worst annual return since 2018 after wagers on natural gas faltered. Sources tell Bloomberg the flagship fund gained 9.3% through December 18th. This could be the sixth year since Citadel's inception that returned less than 10%, underscoring how much it's depended on commodities trading to supercharge returns in recent years. Citadel Securities is still crushing it. And Bloomberg's Weekend Big Take is also trending. It looks at how John Paulson is getting a gold mine through the revival of antimony mining. The Pentagon pushing to develop domestic supply of the critical mineral after China banned its exports to the U.S. Gold is often found alongside antimony, and the push for domestic antimony production could be a bonanza for John Paulson's Perpetua Resources, which owns an antimony mine. You can read more on this story on the Bloomberg terminal on Bloomberg.com, and I'm sure if you want to know, you can Google antimony because you've probably never heard of it.
I've never heard that word be said so many times in a row, like never in my life.
Today was honestly the first time I'd ever heard of that critical mineral, and I don't know if it's actually pronounced anti-money.
I was going to say, I don't know how to pronounce it, but now I'm going to be thinking about antimony all weekend. Hey, Matt, another big story, which is highly read today. General Motors is eyeing a recent hire as a potential successor to CEO Mary Barra. Chief Product Officer Sterling Anderson is emerging as a top candidate, partially due to his experience in innovation with Tesla. Bloomberg's David Welch broke the news and joins us from Detroit. David, what is the interest as him as a successor to Barra suggest about the direction of GM going forward?
what it says is the company's really looking at software and how it changes a vehicle. Tesla and the Chinese automakers do a lot with software controlling not just infotainment and that sort of thing, but actual mechanical aspects of the vehicle, braking, the suspension and feel and how vehicles drive, steering, all of that stuff. And you're going to see more of that coming into vehicles. So you need someone who understands how to marry up software code and semiconductors and computer controls with the old school hardware that's been mechanically running vehicles for over 100 years. They brought in some software people from Apple who get software, but Sterling Anderson is the kind of guy, having been at not only at Tesla, but at Aurora Innovation, a self-driving trucking company, who understands how to marry them up. So that's one of the reasons they brought him in to run product development. And that's the sort of talent they want for future leadership of General Motors. A lot needs to happen before he gets the top job. First of all, Mary Barra needs to leave, but he also needs to succeed in this role. But he's the kind of leader they're building up and grooming for something bigger in years down the line.
David, I've been asking myself lately, and a lot of people have been asking me, why it looks like GM is doing so much better with EVs than Ford. You know, the Ford Motor Company took a almost $20 billion charge to pivot away from its EV business and only really had two offerings out there, right? The F-150 Lightning and the Mustang Mach-E, whereas Chevy has the Blazer, the Equinox, the Silverado, the Bolt, GMC has the Hummer and the Sierra, Cadillac has the Lyriq, the Escalade IQ, the Vistic, the Optic, the Celestiq. Like, they have a ton, and they're losing far less money. How's that working out?
Well, look, first off, the GM took a $1.6 billion charge, and we're going to see another one. They've already told us in the fourth quarter that I think is going to be bigger. So we'll have to really compare the losses, we'll have to tally up how much General Motors rates down in the fourth quarter. But that Ford number was very big. I think in GM's case, they spent more time developing a battery pack and a platform that could host a variety of vehicles. And it is a lower cost way to do it. Now, they're losing money on their electric vehicle program as well. They've had to close down some plants, get out of some joint ventures, cut back production. So I think they're also having a tough time of it. Everybody is right now, but maybe not as tough a time because they've got more offerings to get higher volume. They've got this platform that gives you better scale. And they've changed that. Like, they're changing how their battery pack, they're changing the chemistry they're going to use. They're changing what shape of cells they're going to use in order to drive costs down. And they've been working at really, getting closer to profitability for a long time. I think Ford just doesn't have scale because they basically had two vehicles that were made sort of as one-offs, and that's a very expensive way to do it.
Yeah, I met Sterling Anderson for the first time with you here in New York at the reveal of the Cadillac Escalade IQ, or actually really the technology that they're using in that vehicle. But they don't seem like they're going to pivot away from EVs, right? I mean, whereas I guess Ford isn't totally dropping that business, General Motors seems really to remain committed. Is that the right read?
I think it is. I mean, they're having to pull back because of where the market is, right? I mean, they have a dozen vehicles for sale with their different brands, and they've got 3 assembly plants that can make them. And they've got 2 battery plants going and potentially a 3rd in Indiana. The building is up, but they're not making batteries there yet. But they are pushing on new battery chemistries. Lithium manganese or rich batteries they think is going to be a breakthrough for them, where it'll drive up driving range above what lithium iron phosphate, which is what the Chinese like to use, and still be low cost. So they're looking at ways to make this profitable and get to scale, even though the market's not really buying right now, and they're hoping to drive that by just making the vehicles better and cheaper down the line.
All right, David, thanks so much for joining us. David Welch is our, well, maybe the foremost expert on General Motors. He wrote the book on Mary Barra, literally, and it's called Charging Ahead, fittingly. Coming up, Crossmark's Victoria Fernandez says there is real concern for a market pullback despite the sentiment around the Santa rally. This is Bloomberg Open Interest.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done. Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Goldman, alongside Citadel Securities, have joined the chorus of bullish notes heading into the new year. Goldman trader Gail Hafif told clients, quote, barring any major shocks, it will be hard to fight the overwhelmingly positive seasonal period we are entering. While we don't necessarily see a dramatic rally, we do think there is room to go up from here into the year end. Joining us now is Crossmark Chief Market Strategist Victoria Fernandez. Victoria, I'd love to know what you are telling clients as we head into 2026. Is it time to start readjusting portfolios or to stay as is and ride out what maybe will be a rally into the end of the year?
Yeah, I do think hopefully that most people, and what we've done for our clients is we've already made those adjustments. So we trimmed back on some of those tech names that had those really high valuations that were going up consistently, trimmed those and found other parts of the market to invest in: financials, industrials, materials. Those are the areas where we've been adding in our portfolio. So hopefully people have already done that. If so, then I think you do ride through this through the end of the year. You're well positioned. You're ready to see what happens going into the first quarter of next year, which I do think there's a lot of tailwinds for the first quarter, first half of next year, and you want to be in the market to take advantage of those. But then I think you have to start being a little more defensive, having some defense in your portfolio as things maybe start to unwind a little bit around the middle of next year.
All right, Victoria, we're going to keep you with us. We got the opening bell coming up on this Friday after a positive finish to the trade yesterday. Victoria Fernandez will join us on the other side of that for a more in-depth look at what she expects for 2026. There's an interesting question of whether or not lower income households, especially in a weakening labor market, are going to pull back too much. Or if the higher end, with its wealth effect in a strengthening stock market, will continue to support earnings. Check on futures ahead of the bell. We're looking at some slight gains today, 0.1% on the S&P, a little more than 1/3 on the NASDAQ, as today the AI story looks great because of TikTok. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing. And because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start the Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We are moments away from the start of trading on this Friday. This is Bloomberg Open Interest. I'm Matt Miller. We had a steady drop over 4 sessions on the indexes. We turned that around yesterday, closing up about 0.8% on the S&P, and now we're up another 0.25% on futures. So NASDAQ futures doing even better, looks to be a positive end to the week. You hear the opening bell and see it here on the New York Stock Exchange. Being rung by a group of people, I guess, planning a basketball tournament this weekend at the Barclays Center. The best college women's basketball players, at least 4 of those teams, including the Huskies, are going to get together and battle it out. You can see that on Fox. Okio Pharma ring the opening bell down at the NASDAQ. They've had a decent year to date. It's been tough if you're with them longer term, but they're an ophthalmology biopharmaceutical company, and I'm hoping they can come up with a cure for presbyopia, which you luckily don't know what it is yet.
And I don't want to know what it is, and I hope I never have to know what it is.
It's no bueno.
Sounds horrible. Sounds very no bueno. On the bueno side of things, Oracle shares, they are up 5.4% this morning. I should say all of the AI hurting trades are up today. Nebius is up, CoreWeave is up. So it might partially be that. It also might partially be that TikTok says that ByteDance and a consortium of investors led by Oracle signed an agreement to bring the social platform's U.S. business into domestic control, Matt.
So it's happening, and shareholders are happy about that.
Has China approved it? We don't fully know it's happening.
I mean, something is happening, and it's better than just dragging on forever. Nike warned that the thing investors want to be happening is not. Sales are declining this quarter amid continued weakness in China and with its Converse brand. They just can't seem to turn it around, and as a result, the shares are getting decimated now, down almost exactly 10%. Let's bring back Crossmark Chief Market Strategist Victoria Fernandez. And I mean, this could be, you know, an example, Victoria, of a company where they really need consumers to go out there and spend. I wonder if a weaker labor market, you know, and real problems for the lower quintiles economically are going to hurt their ability to spend, and then that hurts corporate earnings, corporate margins, or are, you know, the wealthier people who are living off of these gains in asset classes going to be, you know, doing enough to offset that drop? What's your take?
Yeah, Matt, I think both of those elements are going to be happening simultaneously. So you're right. You look at a lower income consumer, their spending is driven by compensation. And when we look at the latest non-farm payrolls, when we look at some of the other private data that we have, we see that wages are beginning to stagnate. People are not quitting their jobs as frequently as they were before. It tells us that wages are going to start to stagnate a little bit where they are, which means you're going to have a slower consumer on the lower income side. But then you do look at a higher income consumer, that's not driven by compensation. Their spending is driven by the wealth effect. Stock market's doing better, housing prices, the value of their homes. Those are the things that really drive a higher income consumer, and they feel pretty confident right now and continue to spend. You see it in the holiday spending numbers. Lower income consumers, negative versus last year. Higher income consumers, positive. So there's definitely a divergence between the two. We're going to have to see what wins out, but right now, it seems like the higher income consumer is able to buffer some of the negative effects that we're seeing. The problem is, how long does that last?
What would undo that, Victoria? What would make that type of environment unsustainable?
I think it really comes down to earnings. So the stock market obviously is being driven by earnings. We look at expectations for fourth quarter and they continue to move higher on earnings growth and on revenue growth. You're up to 13-14% EPS growth expectations for next year. So, you're getting multiple years of double-digit earnings growth. If that holds true, then I think you have a higher income consumer that feels good and they'll continue to spend. But, we've been talking about the tech sector and the dominance that they've had in this market. They're still expected to be 47% of earnings growth next year. So it really comes down to what those companies are doing. Can they generate the cash flow? Can they generate the return on investment that people need to see in order for those earnings to be strong? If so, then I think you have a good support under the economy.
What is your take on the debt picture of a lot of these companies borrowing so much to fuel CapEx? I'm talking about obviously the AI companies or the big Mag 7 companies. Is it a concern at all, especially since a lot of it's being done off balance sheet, or is it too minuscule compared to their market caps?
I know it's not a huge portion of their market caps, but it's still something you want to pay attention to. I don't think anyone is concerned if, with Microsoft coming to the market or Alphabet coming to the market, that they're not going to be able to pay their interest or their principal on their debt. What I do think is concerning, though, is when you have like Oracle, you saw all of a sudden their spreads widen dramatically on existing debt that was out there. And so you have to start being concerned. What do those credit default swaps look like? You're seeing those starting to start to worsen on some of these names. So you have to watch it, because the credit market a lot of times is where you can see the financial stress really start. So that's kind of your canary in the coal mine. We'll be watching it very closely to give us an idea of how concerned the market really is.
And you've seen that divergence start to play out, Victoria. Oracle, though it is up today, it has become a poster child, just considering that the amount of spending has leapfrogged the others in terms of growth of it. 11-fold is how much Oracle is now spending on CapEx. That means that while the other companies, the other hyperscalers, Meta, Alphabet, that they are producing cash, that Oracle has converted into an outright cash burn. Can you still buy companies like that? And as the others start to feel pressure on their cash flow, can you still buy into these companies, even though there is a big promise of AI into the future?
It's a good question, because cash flow is almost, the number one factor that we're looking at when we're looking at companies to add to our portfolios. We have a model with like 55 factors, but cash flow is so important to us. And so when we're looking and we see you get negative cash flow, and what is my return on that? I'm not really seeing a strong return. If you give me a great return on investment, then I feel more comfortable. But if I'm not seeing it yet and you're just promising me something, then I have to be a little more cautious, and I'm not as confident having a name like that in my portfolio. You look at some of the other hyperscalers, those balance sheets still look very strong. Cash flow may not be growing to the extent that it was before because of the spending that they're doing, but there's still strong numbers that you have there, so there's less concern. It is the size that you're seeing out of Oracle and what that's done to its balance sheet that is causing it to be different than the rest.
Hey, Victoria, just because you're in Texas and I believe born and raised in Houston. I got to ask about oil. I'm looking at maps go on the Bloomberg terminal and all the tankers floating around the earth, and there are a lot. It seems we're awash in Texas tea. So are we going to see prices continue to decline from here because Brent now is under 60?
Yeah, I think you look at that 55 to 60 level, and you could be in a range, in between there for quite an extended period of time because of the supply that we have. There is a glut of supply right now globally. The question is, can we see demand start to pick up, which then starts to eat away at some of that supply? The SPR, there's possibly some demand coming from there, but really we've lost a lot of demand out of China, and that's where we need to see things pick up. And as you guys spoke earlier in regards to Nike, the China consumer is not out there spending. That economy is weakening a little bit. So we need to see that demand pick up, and we just haven't seen it yet. And yet we're continuing to have supply out there. So we'll be watching OPEC, OPEC Plus, seeing what supply looks like going forward and hoping demand picks up as well.
Victoria, I have to ask, are you in the Crossmark office or is that your own home? Because that is a perfect Christmas tree, may I just say.
I am in the Crossmark office, so you can thank our employees for decorating that tree.
Well done to the team at Crossmark. Victoria, I hope you have a wonderful holiday season and a new year. That's Crossmark's Victoria Fernandez. Let's get a check on your stock market right now with the hopes of a Santa rally. We are up 0.5%. By the way, the bullishness in this market, it is off the charts. Bank of America pointing out that the flow into U.S. equities over the past week is the second biggest on record. So we're down so far in the month, but maybe we turn things around. NVIDIA doing a lot of work to help us out, again, in that kind of scale to like, we're so on versus the world is ending. We're on the so on portion with NVIDIA up 2.3%, Broadcom, Oracle, Micron, again, all the AI names rallying. What's moving us the lowest is Nike this morning after those earnings, the concerns in China, Meta also not having a great day, nor is Home Depot. Those shares down 1.4%. Here are your sectors this morning. Infotech does the best. Again, it's those AI players that's really helping us, and just because of the size and concentration in that. The overall index is up 0.5%. Consumer staples, utilities, discretion, again, those consumer names at the bottom hurt by Nike earnings alongside FedEx, Matt.
All right. Interesting look at the end of the week after the volatility that we've come through. Coming up, data center stocks are staging a rebound after the sector sold off on financing concerns in the AI supply chain. We'll dig deeper into this story that we cover every single day. This is Bloomberg Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Let's get you some top calls. The analyst action that we're focusing on this morning. First up, Wedbush has downgraded Lyft to underperform. The analysts there point to concerns about the impact of autonomous vehicle disruption. Shares down 4.5%. Next up, Truist raises its price target on NVIDIA to $275. They see more upside for AI capital expenditures in 2026. And as we'll talk about in a moment, all of these AI names doing really well today. That includes CoreWeave. Citi has resumed their coverage of the company with a buy rating, highlighting a robust demand outlook for the company. Shares up almost 11%, Matt.
All right, so it's an up day for AI data center builders. Data center stocks in general climbing this morning as risk sentiment improves. Let's bring in Bloomberg Intelligence senior analyst Anurag Rana. And Anurag, as Danny points out, you know, the news of the day moves these stocks a substantial amount, 10% gains and drops. Is the outlook that uncertain?
No, the outlook is that uncertain. These are highly beta names, and you should expect the same volatility next year for the entire group, frankly, because you'll hear one news of a data center delay, a lack of power, or some grid lockup, and all of these things would go downwards. But then the next day you could see that, okay, they have signed a deal with somebody, and it's going to go the exactly opposite way. So this is a group with high beta and extreme volatility.
Anurag, as Matt mentioned, we're going to be talking to Sixth Street in just about under an hour's time. They've done some data center deals before. When it comes to private credit and their involvement in data centers, the big news of this week was Blue Owl and Oracle and the breakdown of a deal there. Are we sensing a shift in the willingness of private credit markets to fund the data center build out?
I really think depends on who the end client is. Danny, there's the biggest question is whether the end client is somebody who has good funding and credibility, or I should say more, not just credibility, I would say visibility. Because, if Microsoft goes and signs a deal with Nebius to give them, let's say, $17 billion, I don't think anybody in the private credit would have any issue with that because I think Microsoft is good for that money and good for those workloads. And even if, let's say we go into a massive slowdown next year and, AI workloads, there's an issue, Microsoft can still use that funding for their own work, for the kind of their legacy business. So it's not an issue. But if you go for a brand new, let's say, a LLM provider, which we don't know how things will shape up over the next 3 to 5 years, that actually has a different impact. So I think it depends on who the end customer that's funding the expansion is.
I look at the growth of OpenAI, and even though we talk about it every day, the growth in terms of users always surprises me to the upside. It's incredible. And I wonder if you're seeing these same kinds of numbers at Gemini or at Anthropic. I mean, are people just adopting this technology at an incredibly rapid pace?
Absolutely. In fact, one of the surveys we did recently, OpenAI ranks as the top model of choice for 9 different industries. After that, it was Gemini, and then after that, it was Anthropic. But one of the good things we saw was when it comes to the software sector, Gemini and Anthropic are very close. We think Anthropic's enterprise presence is going to be a big factor both next year and the year after.
Hey, Anurag, just thinking about next year, too, one thing that's really been on my mind is so many guests come onto this show and they say something along the lines of the AI trade is going to broaden out. We're thinking about all these winners. People never talk about the losers, about business models that might be disrupted, about software companies that maybe become irrelevant. How are you thinking about that for 2026, and what type of companies maybe won't benefit, but on the other hand, will feel some serious pressure from AI?
Yeah, I mean, you can honestly go back to the last 2 years and see the entire application software space. It's been crushed. I mean, it's not seen anywhere the same level of love it used 2 years ago. But at the same time, their revenue growth rate has been good. We have talked about Adobe, for example, for so long. They've done very well in terms of the KPIs and the different metrics. But year to date, it's down, I think, 20%. But if you go back and even history, it's well below its historical highs. You could extend that discussion to lately, there is all this headache about ServiceNow. So you pick any of the application software company, and there is some, you could say negative news about it in terms of that getting disrupted because of the LLMs that we just discussed.
Hey, I've been playing around with MapGo today. It's a great function on the Bloomberg terminal, but you can, with this tool, visualize all of the data centers. Well, this is global, but you can even zoom in and look at the US, and there's so many different flavors: retail, wholesale, public cloud, telco, financials, build-to-suit, crypto, etc. This looks already getting crowded in the Northeast, but is this going to just be completely full in 5 years?
Yeah, I think that the localization is going to be very important because, we have had some good conversations with DI's energy team, and I was led to believe that, when you look at the entire landscape, residential areas where there is a power shortage, it's going to be very hard to add new data centers. But the Midwest, where there could be some excess supply of power for people, there could be an expansion over there. So it's a question of where to place these data centers. And the other part is whether it's for training or for inference. If you need it for inference, you need it to be where the users are or close by it, unless we see some tech developments that can help us with that. So we do anticipate a much bigger footprint of data centers in the coming years.
And a lot of that is happening in my home state of Virginia, where I know Joe was so wisely zooming in on the map there. Anurag, we're going to have to end it there. Thank you so much. Bloomberg Intelligence's Anurag Rana. Coming up, SpaceX launching an obscure ETF into the spotlight. We're going to take a look into the ER Shares private-public crossover ETF. That is a mouthful. We'll break it down for you next. You're watching Bloomberg Open Interest.
Vehicles pitching downrange. Good call out. Healthy system on the booster as it starts to push over the Gulf.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. Just about 22 minutes into the session right now. And we're seeing increasing gains. I mean, futures at the top of the hour were up only 0.1%. The cash trade were up 0.7, back to 68.23. The closing high from last week was 69.01. So we're clawing our way back there. The NASDAQ up more than 1% as the AI data center trade, as well as the TikTok celebrations are on. NVIDIA up 3%. Obviously a huge part of the moves on any index it's listed. Oracle gaining more than 7%, also a boon to the S&P 500 and the NASDAQ. Nike is getting decimated this morning, showing investors that they really are having a tough time with the turnaround, having a tough time in China, having a tough time with the Converse brand. And FedEx also down on earnings, 1.5%. KB Home, a similar story, an earnings story, down 7.33%. We've been talking a lot on this program about the woes of the housing market. The hope is that more rate cuts are going to solve that issue. And then Coinbase Global right now up 1.5% because Bitcoin is gaining today 2.7% to $87,892. Danny?
Because at least for today, we are so back. By the way, as investors are gearing up for a potential SpaceX IPO, it is pushing an obscure ETF into the spotlight. The ER Shares private-public crossover ETF has taken in more than $470 million this month. The fund holds a small, very small piece of SpaceX through a special purpose vehicle, potentially making it the only U.S.-listed ETF with exposure. Joining us now is Emily Grafeo, ETF and cross-asset reporter for Bloomberg News. Emily, what is this thing?
Okay, so this is an ETF that's been around since 2017. It was pretty small in terms of its asset size. Over the last several weeks, now that we've gotten this news that SpaceX is potentially going to IPO, potentially soon, it has ballooned in size. It's now over $1 billion in AUM. It just got its biggest daily inflow just yesterday, $258 million into the fund. Investors are buying it because when it first bought this SpaceX exposure a couple months ago, it was a 12% exposure. So you could get a pretty decent price exposure to SpaceX. And it was novel because typically we don't see ETFs holding shares in private companies. Now that the fund has ballooned so much in size, the ETF really holds only about 3% of SpaceX exposure. So it's showing us the limits here of putting private shares into an ETF, which trades every single day.
Yeah, it is, I think, absolutely fascinating. I'm looking at the holdings on the description page, and it's SPV exposure to SpaceX, SPV exposure to Klarna. So these are the special purpose vehicles that we talk about with the hyperscalers borrowing money to build out data centers. There are also a ton of publicly traded companies in this ETF. So it seems to have a particular focus on obviously tech. It's got Tesla, it's got Oracle, and Rocket Labs.
Yeah, if you look at the top holdings, they are public companies. So the idea here, it's this ETF, the ticker's XOVR, it's definitely becoming known as the SpaceX ETF.
NVIDIA is the biggest holding,
right? But NVIDIA is the biggest holding. It is a tech focus. This company that issues the ETF, ER Shares, they focus on companies that are led by entrepreneurs. So that is the push here. But again, it's really demonstrating that this push to put private illiquid assets into an ETF isn't as simple as you might think.
All right, Emily Grafeo, thank you very much for that. By the way, Emily is going to host this program on Wednesday next week. And I'm looking forward. I'll be home and I'm going to tune in and watch it. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks happening everywhere, and that's what AI is most helpful in improving.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. The manhunt is over for a suspect in 2 deadly attacks in New England. Police say they found the body of the suspect in both the mass shooting at Brown University and the murder of an MIT professor in a storage facility in New Hampshire. Special agent in charge, Ted Dox.
Even though the suspect was found dead tonight, our work is not done. There are many questions that need to be answered. There's a lot of evidence that needs to be processed, and most importantly, the victims and their families deserve special care.
Brown student Brian Vu is relieved.
We're all starting to get back into the flow of things, going back to regular daily motions. It's still a little bit hard, but we're, making our way there.
The DOJ is supposed to release all of its files on Jeffrey Epstein tonight. USA Today's Aisha Bagchi.
The Justice Department should have investigative files that feature witness interviews, investigative trails that might not have resulted in any charges and any grounds to prosecute someone.
Deputy Attorney General says hundreds of thousands of pages will be made public, but Todd Blanche tells Fox several 100,000 more will be released later to block information that could hurt Epstein's victims. President Vladimir Putin is holding his annual hours-long news conference to close out the year. He insists if Ukraine doesn't agree to his conditions in peace talks, the Kremlin will use military might to achieve Russia's goals. Putin insists, through an interpreter, it will not go beyond that.
Are we truly going to attack Europe? This is nonsense. This is done based on the political reasons. And this is done to create the image of an enemy. They are creating an image of an enemy, and they're making Russia the enemy.
Federal prosecutors have indicted the leader of the notorious Tren de Aragua gang.
Prosecutors allege Hector Guerrero Flores ran a multinational crime syndicate for more than a decade, responsible for drug trafficking and terrorism worldwide. The indictment charges him with crimes including participating in a racketeering conspiracy, conspiracy to provide material support to terrorists, and cocaine importation conspiracy. The State Department has offered up to a $5 million reward for information that leads to Guerrero Flores' arrest or conviction. Linda Kenyon, CBS News, Washington.
Letting your inner potty mouth out could help you get a better workout. CBS's Michael George.
A study in the UK found people performed better in physical challenges, including exercises like push-ups, when they used swear words to release frustration. Researchers speculate cursing can help people overcome their inhibitions and push themselves harder.
This is CBS News. College football playoffs are kicking off.
Tonight marks the second meeting of the season for the SEC foes. 8th-seeded Oklahoma will be taking on 9th-seeded Alabama after already upsetting the then number 4 Crimson Tide in Tuscaloosa back in mid-November. This time, though, Alabama head coach Kalen DeBoer knows the stakes are much higher.
Awesome opportunity for our football team to go up against, a very good football team in Oklahoma and Coach Venables. And so looking forward to everything that comes about.
The winner advances to the quarterfinals to face top-seeded Indiana in the Rose Bowl on January 1st. Kickoff is set for 8 p.m. Eastern. Erica Herskowitz for CBS News.
Prized possessions of a former president and first lady are going up for auction.
I, Jimmy Carter, do solemnly swear.
People says Christie's has partnered with former President Carter's daughter Amy to choose a nostalgic collection, including a love letter her dad wrote to her mom in '78 that reads, "It's nice to be growing old together with you." Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, I've been in this town 45 years. I've never heard of Turtle Bay. I mean, who's kidding who here? Good Friday morning from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Check us out there. Coming up, we got some green on the screen here today. We got Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. We're going to check in with Joanne Shu, get the latest UMich data coming out this morning. We'll get what's happening there. Will Harris, Bloomberg Intelligence Senior Equity Research Analyst on British Petroleum. They had a change there in the CEO ranks. What does that mean for BP? Phil Orlando, one of our faves here, is the Chief Equity Market Strategist and Head of Clank Portfolio Management, Federated Hermes, will give us his 2026 outlook on these markets. So we got a lot coming up over the next 2 hours. Markets trading higher today on the back of a very strong trading session yesterday. So we've got a lot to talk about here. Right now, let's go to Lisa Mateo for a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Well, we've got stocks on the rise this morning. This is on this last day of a busy week on Wall Street. CPI yesterday, now more eco data just coming out. We have existing home sales in the U.S. Well, they barely rose in November. Contract closings ticking up 0.5% to an annual rate of 4.13 million. We go to UMich sentiment right now. The expectation was for 53.5, came in a tick lower at 52.9. Right now, the NASDAQ up more than 1%, 237 points. We have the S&P 500 rising 0.7%, and the Dow up about 0.5%. The 2-year yield, 3.48%, that's up 2 basis points, and the yield on the 10-year, 4.14%, and that's up 2 basis points. Japan's 10-year yield that climbed to the highest level since 1999. That's after the central bank had lifted its interest rate to the highest level in more than 3 decades. It also signaled more hikes. Yeah, could be on the way too. So with that said, we look at the Japanese yen weakening by more than 1%, 157.38 against a dollar. The Bloomberg Dollar Spot Index strengthening by about 0.1%. Shares of Oracle jumping more than 7%, part of a group of investors in a U.S. joint venture. It's going to take control of TikTok, the social media app. It's really been under pressure to separate from its Chinese owner, ByteDance. Nike shares sinking down more than 9%. The company warns sales are going to decline this quarter because of persistent weakness in China and also Converse brand not doing so well. FedEx not doing so well either. Its shares are down 2%. It's raised full-year targets. It just didn't meet those higher investor expectations, and that's why its shares are lower this morning. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, number 4 Offsprings soon is going over to Japan for like a semester abroad type thing.
Good timing, because you see where the yen is at?
I am, and he actually just pinged me this morning talking about the yen, so he's become like a currency aficionado recently.
He's an FX expert right now.
Yeah, so I'm saying, all right, so at least that's working for you. So that's good news. All right, let's see what's happening in these markets here today. We got stock market trading higher, as Lisa Mateo was just reporting. Let's get a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Bloomberg's Emily Griffeo. Emily, what are you looking at today?
Okay, so I'm looking at shares of Nike, ticker NKE. They're down about 10% right now. Reported earnings on Thursday. Their third quarter guidance disappointed investors. It wasn't that bad, but they expect third quarter sales to be down low single digits, gross margins to shrink by roughly 2 percentage points due to tariffs.
Yeah,
I can't believe we're still talking about tariffs, but they are still something that is absolutely weighing on companies here. The company also reported weak sales in China and weak sales in the Converse brand, which anecdotally feels right.
You don't wear Converse, Chuck Taylors?
I love Converse. I was a big Converse person, like in high school. But I don't see them on the street anymore.
Yeah, because you're not in high school anymore, and nor is most of them.
Do high schoolers wear? You know some high schoolers.
Right? You know, I think they wear Uggs.
Yeah, yeah. I feel like other sneakers are trending right now. Adidas, the Sambas, some of the the Converse. Not so much. The Hokas.
That's a Deckers brand.
Yeah.
Okay.
Yeah. You think maybe they'll come back in style, but we did see that those shares down, and then a cut over at Citi. So they had their price target cut to $65 a share from $70.
So it's proving to be a choppy or rocky turnaround. It's not very linear at this point. What's next?
So this is another turnaround story, FedEx, because their CEO is looking to turn around the business here and push FedEx ground and air freight networks together and slash costs. The latest earnings giving us maybe a mixed picture on how well that's going, at least in the near term. The stock is down about 2% right now, ticker FDX. It was down as much as 5.6%. It was the biggest intraday drop since June. Pairing losses, they did upgrade their full year targets, but to a lower magnitude than the second quarter earnings beat. And then they raised the low end of the profit outlook. So helped by volume and pricing gains in the US, but the company also said they expect a $600 million hit to adjusted earnings due to higher costs from the grounding of some of their cargo
MD-11s.
jets. Yeah, the MD-11s. You're a big shipping person, right?
I love the MD-11. It's a great plane, but boy, it's old. One more.
Okay, finally, a biopharma company, BioMarin, ticker BMRN. It's up 17%, biggest jump since November 2016 on Deal News. They agreed to buy Amicus Therapeutics for about $4.8 billion. And this is a company that has treatments for rare diseases. So investors are taking this as now BioMarin is going to be able to expand its portfolio of treatments.
And it has pricing power for these rare diseases.
Oh, okay.
They all do.
Yep.
Yeah, so shareholders of Amicus will receive $14.50 a share in cash, 33% premium to the last closing price. So that stock is also up, but BioMarin is up.
All right, Emily, thank you so much. Appreciate that. Emily Griffeo, she covers all the stocks for Bloomberg News, probably cross assets too. I don't know. I can't keep track of what she's doing.
I think she's doing credit right now.
Yeah, credit.
It's an embed.
Bitcoin tomorrow.
It's an embed. That's what they call it back in Bloomberg News. They're very stylish back there. All right, for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. UMich out with some sentiment data today. A little bit better than expected, but I think it's still okay. But what do I know? It's still above 50. That's good for me. Joanne Shu, she is the Surveys of Consumers Director at the University of Michigan. Joanne, the headline number, 52.9. Consensus was 53.5. What do you make of it?
Essentially, we're seeing very little change between November and December. Consumers saw a few small improvements on a number of dimensions, but overall, whether it's on inflation or labor markets or business conditions, consumers still think that we're considerably worse off than we were about a year ago.
There's also a current conditions component and a gauge of expectations. And there's a bit of a contrast here because the current conditions gauge fell to a record low of 50.4, while expectations climbed to a 4-month high. Is that pointing in different directions, Joanne?
Yes and no. So the reason why current conditions fell this month is because consumers continue to tell us that buying conditions for big ticket items are really poor. And so specifically buying conditions for large household purchases, that went down quite a bit between last month and this month. And that's partially why we see that with current conditions. And consumers are really pointing to two different things for that. They are frustrated by the persistence of high prices. They think it's a terrible time to buy these big ticket items. And they're also pointing to tariffs. They're not nearly as concerned about tariffs as they were just a few months ago, but they still see that as something that's weighing on the present. As for the future, we saw a few upticks between last month and this month. We have slightly fewer people expecting unemployment rates to rise in the year ahead, but it's still at 63%, still a solid majority who are expecting labor markets to weaken, and that's something that's weighing on consumers.
Joanne, we got a much lower than expected CPI print yesterday, and granted the quality of that data may not be very good, but I'm looking at your University of Michigan 1-year inflation outlook, 4.2%, 5 to 10-year inflation outlook, 3.2%. Both of those are handily above where the Fed would like to see things. What do you make of that?
Consumers' views of inflation have been trending down over the last few months. So that part is certainly good news for policymakers. The huge spike that we saw in inflation expectations in May and June, that has come down. And I think it's 4 straight months of declines for short-run inflation expectations. However, like you said, we're still well above where we were in 2024 as well, not even to mention where we were prior to the pandemic. So consumers overall, they don't feel like we're as worse as they don't think that things are as bad as they were back in May and June, but they don't think we're out of the woods yet. They are still expecting inflation to remain high for the foreseeable future.
Joanne, do you see any lingering effects from the government shutdown in these numbers at all?
We're not really seeing anything direct. And even during the shutdown was only mentioned spontaneously by about 10% of consumers, in contrast to the majority of consumers that mentioned tariffs unprompted. So, we're not really seeing direct evidence of lingering effects of the government shutdown, but certainly with the shrinkage of the federal government and of the federal workforce, that's certainly going to be weighing on unemployment as we have seen so far, and consumers are expecting unemployment to worsen.
Joanne, we're the one big beautiful bill. A lot of folks are saying we're going to see some real benefits from that in 2026, maybe tax refunds, maybe just some more pro-business type of policies here. Does that factor into kind of your survey at all?
We're not seeing much evidence that it is high on consumers' minds. Typically speaking, I would say that consumers will react to that when the provisions actually roll out, when they actually see their tax refunds, when money actually hits their pockets. We're not seeing much in terms of an anticipation of things kicking in. I don't think there's a huge awareness about the details of that bill at this time.
So when you put it into perspective and you look at 2025 as a whole, what is your takeaway here about how consumers are feeling as we close out the year?
Consumers are telling us that they're feeling strained on both sides of their budgets. Of course, they remain extremely dissatisfied by the persistence of high prices. They are really worried that inflation is going to continue. That's not new. We've been seeing that for the last few years. What is new for 2025 is that consumers perceive a weakening in labor markets. That is in stark contrast to what we saw in 2022, the last time sentiment was around these levels. Back then, labor labor markets were super strong. Anyone who wanted a job could likely find one. This time, consumers just aren't confident about that. They are worried labor markets are going to weaken. They're worried their incomes aren't going to grow. And many people are worried about layoffs as well. So that is something that has really been weighing on consumers now with their focus on pocketbook issues.
Joanne, thank you so much. Really appreciate it. Joanne Shu, she's the Surveys of Consumers Director at the University of Michigan in Ann Arbor here. So,
you know what didn't factor into anyone's thinking in 2022? AI, and now it does.
Yes, that's a
now
great point.
Now it looms over everything.
That is a great point, and that has been a big issue. And will the AI, I guess, help out the economy in tangible forms in 2026?
Or kill our jobs.
Yeah, or kill our jobs, exactly. I'm actually in that camp a little bit concerned there. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio. I'm Lisa Mateo. NASDAQ leading the gains as after it logged its biggest jump this month. Let's go to it. It's up nearly 1%, 212 points. We have the S&P 500 up 0.7%, 46 points, and the Dow up 0.6%, 286 points. In the yield space, the 2-year 3.48%. That's up 2 basis points. The yield on the 10-year 4.14%, and that's up 1 basis point. The Bloomberg Dollar Spot Index strengthening by about 0.1%. The Japanese yen weakening by more than 1% at 157.41 against the dollar. We go to Bitcoin up more than 3% at just above 88,000. To earnings, we'll start with Carnival. They reported a beat on adjusted earnings per share for the fourth quarter. Its shares are up 9%, but it's also pushing up some of its peers. So we look at Norwegian Cruise up 6%, Royal Caribbean up more than 4%. Conagra Brands, that's the company behind Slim Jim, Duncan Hines brands. Their shares taking a hit down 2.5%. It recorded lower sales its latest quarter. Consumers continue to pull back on spending. That's according to its CEO. And finally, shares of KB Home down about 7.5%. A weak housing revenue forecast. The home builders results, it just comes days after Lennar gave that sluggish outlook and said the housing market is kind of challenged. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, Lisa Mateo, with our Bloomberg Business Flash. TGIF, everyone. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. And, you know, given that we're so close to the holidays, it's surprising how much news flow there is.
It is nonstop.
Nonstop. You had BP, the oil giant, making a sudden CEO change. It ousted its CEO and filled the role with an outsider. All of this was kind of a surprise. There was no warning, no heads up on any of this. Will Harris is Bloomberg Intelligence Senior Equity Research Analyst and joins us now for a little bit more context on what's going on here. So, Will, how are you thinking about this? What does this signal to you?
Yeah, so the big change up here is it's I think it indicates a complete strategy overhaul for BP, which has really struggled in the last 5 or 6 years since I think what can be seen as a completely failed energy transition strategy. And ultimately, we think the outgoing CEO, Murray Auchincloss, was just too tied and really struggled to distance himself from being one of the key architects of this failed strategy. And ultimately, the patience of the board, and in particular some activist investors, was wearing very thin with what they thought was inadequate progress being made on costs, on capex, and the balance sheet. And I think that's why, while this wasn't totally unexpected, I think some of the timing was somewhat surprising, as you mentioned.
Well, you know, this transition to cleaner energy seems to have lost some of its momentum, particularly here in the U.S. And by the way, I watch Landman in the second season, so I'm all in on all things oil and gas. But here in the U.S., it seems like politically, economically, it seemed to have lost some of its momentum. But I thought in Europe, it was full speed ahead to an energy transition to cleaner energy. But boy, this appointment of Meg O'Neill kind of surprised me because she's kind of a fossil fuel kind of person, isn't she?
Yeah, absolutely. She comes from Woodside, which is one of the largest Australian E&Ps, and prior to that, she had 2 decades at Exxon. So she's a tried and true fossil fuel executive, and we expect her to really put an end to the integrated energy experiment that has really been going on at BP and to a lesser extent at some of its European peers. And as you mentioned, Paul, the energy transition is progressing in Europe, but I would caution that by saying it's been slowing or even the brakes have been slammed on for energy transition investment at these large energy majors. They have just not been able to deliver the returns that they thought these projects could. And as a result, we are seeing a slow pivot or much quicker in some senses, which we think is going to occur next year for BP, back to oil, back to petroleum.
Is BP a leader or a follower among its European peers?
Well, it has unfortunately been a leader in energy transition spending at a time when these projects just were not returning any free cash flow whatsoever. So it was leading on the energy transition, but it was faltering on delivering on that promise. And I think all you have to do is look at the market and see the investor reception. It is very, very clear how the market has viewed the energy transition over the last several years. You can just look at Exxon and Chevron, who took a much more business as usual approach, continuing to grow oil and gas production, and the valuation has just for BP and the European peers has really suffered compared to the European counterparts, and we think this is one of the main drivers behind that investor impatience. They're concerned about the share performance. BP is now a third of of its value in 2000. So I think it's understandable for some of these investors to be for their patience to be wearing thin.
So I mean, is this a sea change for your European energy companies that, all right, we're going to kind of put the brakes on a little bit, this transition?
Yeah, so I think that's the main takeaway here. But more specifically for BP, I would not be surprised to see Meg O'Neill put a full halt on the buybacks for BP. These were already pared back significantly earlier this year. I expect her to cut costs even more heavily. That'll be headcount reduction. We expect there could be ultimately $5 billion in extra costs that could be slashed out here, and cut this green capex. So there's another $3 to $4 billion here a year from on solar, on offshore wind, on hydrogen, CCS, which I think she will view as completely not necessary. And asset disposals. We think she could look to pair off some of these renewable assets. We expect a simpler, smaller, and leaner BP moving forward that looks essentially like a smaller Exxon.
Will, great stuff as always, my friend. Will Harris, Senior Global Energy Analyst, Bloomberg Intelligence. He's based over there in London somewhere, but I think he's in Geneva today. We hired him. He was just a pup like 10 years ago. Now he's like one of our leaders in research.
Pro. He's a
seasoned pro, one of the leading energy voices in Europe. We appreciate getting a few minutes of his time here. Boy, we got a nice kind of a confirmation of yesterday's trade in today's market. We got the S&P up 0.7%. I guess this might be the Santa Claus rally that some people talk about. Let's check in with somebody who does this for a living, Phil Orlando, Chief Equity Market Strategist over there at Federated Hermes. Phil, we had a lot of economic data this week. We've heard from the Fed. How are you kind of putting all these pieces together as you think about where we go in 2026?
Well, first of all, thank you very much, Paul and Scarlett, for having me back on. Merry Christmas to you. You're quite right. It's an important week, and all of the data that we're putting together falls into a couple of important buckets. How's the labor market doing? What's going on with inflation? How is the Federal Reserve going to respond to that? And how does all of that impact the financial markets? The note that I wrote, I guess yesterday, reflecting the changes that we've seen in the labor market and the inflation data most recently, I would say directionally is all very good. The rate of unemployment, the U3 for the labor market is sitting now up at 4.6%, a four-year high, which suggests that the deterioration in the labor market over the course of the last 7 months has continued. But on the positive side of the ledger, the inflation statistics have improved. Taking a step back, looking at the bigger picture, 3.5 years ago, we were sitting at inflation at a 40-year high. Inflation generally right now is sitting at about a 4-year low. There's some question as to whether or not tariffs are going to have a deleterious impact in coming months. There's a question, given the government shutdown, whether or not the data collection can be believed. Those are legitimate questions, and as a result, I think the Fed is likely to pause at its next meeting at the end of January. But by the time we get into that mid-March meeting, we think that the government will have done a good enough job of getting caught up on its data collection that the trends will become more apparent. Softening labor market, softening inflation, therefore some additional Fed cuts in the pipeline next year, in our view, seems reasonable.
Right. We know the Fed has penciled in 1 cut for next year. The market is pricing in 2 full cuts right now. But of course, a lot of it depends on who becomes Fed chair overall once Jay Powell's term ends in the end of May. You mentioned once we get past the shutdown tainted data, There's a possibility, Phil, of another government shutdown in January. Is that priced in at all?
No, I don't think so. We're hopeful, once bitten, twice shy that the leadership within Congress has realized that they got absolutely nothing by shutting the government down for a record 6 weeks, earlier this year, other than the angst of American voters. I'd love to think that cooler heads will prevail and folks will sit down and actually do what we pay them to do, which is come up with the hard negotiations and the compromises to move the country forward. But Scarlett, you're absolutely right. There's more than a legitimate chance that they decide to shut this thing down again on January 30th, and we're right back into the soup that we were in back in October and November.
Phil, I guess everybody now considers himself an AI expert here. It's been the theme in this market for 2-3 years now. In 2025, is that still going to be the driver here, or dare I say we might broaden out a little bit?
I don't put myself in the category of AI expertise, Paul, so that's a committee of one.
Gotcha.
We hold meetings regularly. But our view has been, and you and I have been talking, you've talked to Steve Auth and Steve Chaperone from my shop as well. Our view this year has been that the AI trade was not going to go vertical. It was not going to be a hockey stick, with an unlimited roof, that there was sort of a rotational broadening out trade that we felt was going to start this past year. International, we felt would do better. Small caps, we felt would do better. Domestic large cap value, we felt would do better as the valuation levels of the growth and technology names, sort of expanded and reached the limit that we felt comfortable with. I think that absolutely got started this year. We would expect to see more of that in calendar 26.
Okay, so more of a broadening away from the Mag 7. Yeah. You could even argue away from like the top 5 now, since a couple of those Mag 7 names have fallen off. Where do people broaden out to? Is it by sector? Is it by certain qualities, certain factors? Is it by size?
Yes to all of those questions. So I'd look at the 3 key asset classes. International, specifically emerging markets, dramatically undervalued. Half of what it normally has a discount to in the U.S. Dividend yield that's more than double what the domestic dividend yield is. Dollar weakness was an important driver. Last year, we think dollar weakness continues in calendar 26, in part because we're expecting 3 more quarter-point cuts from the Federal Reserve over the course of next year. Small cap stocks, significant beneficiaries of lower interest rates. We think that continues, and there's a valuation imbalance between valuation and growth. Value continues to work.
Phil, thanks so much. Appreciate getting some of your thoughts here. Phil Orlando, Chief Equity Market Strategist, Federated Hermes, joining us here, giving us his thoughts on the markets. A strong market today. S&P up 50 points. That's 0.75%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brooker Studio, I'm Lisa Mateo. This Bloomberg Business Flash brought to you by Harvard Business School Executive Education. It's a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. Well, we've got big tech leading stocks higher. NVIDIA shares gaining over in the mega caps right now. Their shares up nearly 3%. Oracle shares up as well, more than 6%. So we go to the NASDAQ, up more than 1%. S&P 500 up 0.8%, Dow up about 0.6%. Over to the yield space, the 2-year 3.47%, that's up 1 basis point. The yield on the 10-year 4.13%, and that's up 1 basis point. The Bloomberg Dollar Spot Index strengthening by about 0.1%. The Japanese yen weakening by more than 1% at 157.48 against the dollar. Bitcoin up nearly 3% at just above 88,000. Over to company news, and we have the Wall Street Journal reporting OpenAI seeking up to $100 billion in new funding. It's at a valuation as high as $830 billion, and that's above earlier estimates. And Toyota, they plan to ship 3 models produced in America to Japan. That's a move that's designed to please President Trump. You have the Camry sedan, the Highlander SUV, the Tundra pickup truck. They'll all go on sale in the country from 2026. And finally, DraftKings releasing a new app today. It's going to allow customers in 38 states to trade contracts on sports and financial events all through the prediction markets. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
Lisa, you know what I'm going to do on my lunch break today? I'm going to go across the street, and I'm going to lease that space. Lexington Avenue, 58th Street, Prime, Midtown East. It's been vacant since the pandemic. I mean, what's going on out there?
What are you going to put there?
I don't know. I mean, it was a Victoria's Secret. I'll put something in there. There's got to be some retail. I mean, it's unbelievable. I don't know what these people are doing in commercial real estate. So let's check in with our next guest. Maybe she can help us out here. Lisa Nee, managing partner and head of real estate at Eisner Amper. Lisa, I'm frustrated with some of this commercial real estate in New York City. What's your view of the commercial real estate business as you head into 2026?
I mean, I think we've had this conversation before about that empty space across the street that's been frustrating you since 2020, from what I remember. But for outlook for 2026 is certainly a recovery, but not a boom. So you're not going to be looking at you're going to be looking at more proactive recovery and gradual rebuilding. I don't think you're going to be seeing some rapid expansion out there. You're going to see stable interest rates that we have, and the Fed just lowered them again, and some investor appetite. Fourth quarter has actually been pretty decent for real estate. We've had 5 deals that are supposed to be closing in the next week. But again, it's back to that same fundamentals that we always talk about. It's sector-specific momentum by region. And so that's going to provide the solid foundation. And so really looking at each sector in the region and that asset class is going to be super important for investors to make sure that they're making those smart investments and looking really to create and analyze those underlying conditions. And you talk about that office space across the street. The office to residential conversions really are incrementally moving the needle out there. And so we are going to see a lot more office availability that is out there. And retail, although it's not moving as quickly as you wanted to move, there has been, because there's less that was under construction, there's less availability out there. And so those retail space, hopefully for you, will get rented up shortly.
Lisa, which sector is going to see the biggest shift in momentum? And I ask because it feels like data center had a huge tailwind. Everyone wants to be all in on this AI build out, but you're starting to see, at least in the credit markets, for instance, investors be a little bit more discriminating. Blue Owl, for instance, is not going to be part of Oracle's newest data center that it's constructing in Michigan. So what was once a no-brainer has now become a little bit more just idiosyncratic.
Yeah, so each sector has its own darlings and its own rating. And when you look at something with data centers, you saw some heavy leasings, but again, the power supply for those data centers, and there's tons of community barriers in there as well. And so the data centers, for those investors, are really taking a look and saying, what is the longevity of those centers and how many and where are they going to be? when we look at sectors and darlings, everybody has its webs, its highs and lows, depending on where we are in the cycle. So I mentioned before about retail, because we've had tightened supply and steady demand and been really, really disciplined in expansion, it's going to support some rent growth in there. So retail is faring nicely. Multifamily has been the darling for the last few years, and it's still going to be a darling depending on where you are, because with high home prices and low sale inventory, it's going to keep that rental market strong. And whether, depending again, where people want to live and where they want to be. Do they want to be in the Sun Belt? Do they want to be in the mountain regions? Are they going back to the gateway cities? I talked about office earlier. That supply imbalance is really going to get rectified by not a lot of office coming by on the market, and also with people returning to the office and really getting back in there. And so that should help the supply on that. So industrial, we started with data and life sciences, but again, build to suit and that infill dominates that sector of industrial. And so since construction has been down in most of these areas, that really should stabilize the marketplace.
Lisa, if I want to go out and buy an office tower or develop a mixed-use retail space, where am I going to get the financing for that? Do I go to my local bank? Where do I go?
That's a great question, and we have seen the banks coming back into the market in this last quarter. So the banks are back in, and they're looking at those selective deals, and also private markets. The money's out there. They've been raising capital, and they are looking for that project. And so when you say office, your office needs to have a story with it. It needs to be the office with all the amenities, or if you're building a community around the office. So they're looking for more of a specialized than the one-off towers for the investment. But the capital is out there, and it is going to get deployed. It's just how and when and what the right investment is going to be. They're really, really looking to make sure that it's a selective buy.
Right. What is the process of getting that money, whether it's from a big bank, like a big money center bank, versus one of the regional lenders that has an expertise on certain areas, or private credit?
So, fundraising is never fun. And when we talk about fundraising, it can either be, wherever it is in the capital stack. It could be with the banks or outside investors or even debt funds. And so it could take, however long someone thinks it's going to take to raise capital, it's probably double the length of time for that. And so that's really where the developers and owners are really struggling, is the length of time that it takes to get that money to start building or acquiring the asset. It's that length. The money's there. It's just taking longer to get people, to get that first investor, to get the first bank signed on for that.
Lisa, one of the poster childs for, a COVID-impacted market was San Francisco. Now I'm hearing that AI and the companies associated with developing AI, they're really flocking to San Francisco, and it's kind of turning that city around. Is that impactful?
Yeah, it's super impactful. I was just out there a month ago, and I think I made some bold prediction that I think San Francisco's coming back. Maybe it was a year ago on this show, is that 79 cents of every AI dollar is spent in San Francisco or in the region. And so when you look at it and you look at AI, that VC capital is demanding them to be into the office, and they want them in San Francisco proper to make sure that those dollars are being spent wisely. And AI is really, we've seen it in every sector and in every industry, how much of a difference it's making to the future of every industry. And certainly real estate, the impact AI is having.
Lisa, we only have about 30 seconds left. So just very quickly, what is the one thing that you worry about heading into 2026?
I think planning. Really getting people to selectively plan and really sit there and understand the asset. If they're an investor or an owner-operator, making sure that the foundation for the asset is strong. And I don't mean that from a real estate standpoint. I mean it from an ownership standpoint. Whether you've got the right capital stack in play, the right cash flow modeling, really understanding where those investment dollars are going, communicating with the team, and understanding where AI can help save and where you need to spend. And so I think it's really that solid foundation going forward.
Lisa, thank you so much. We always appreciate chatting with you. Lisa Nee, managing partner and head of the real estate practice at Eisner Amper, talking about commercial real estate out there. Again, I'm going to go out there, and that's at least some space there on Lexington Avenue. This is Bloomberg.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, a bellwether for some, including myself, for the U.S. economy is FedEx. FDX is the ticker. They reported some numbers. Stock trading a little bit lower here. They had some issues with some of their aircraft, but I don't know. I kind of think it's just an awesome company. The stock is it's about flat this year. It hasn't really done anything here, but it's got a market cap of $67 billion. I've always been a big fan of FedEx. The MD-11 is a great aircraft, but it's an old aircraft, and they have some reliance on that. Lee Klaskow does this stuff for a living. Senior transport, logistics, and shipping analyst for Bloomberg Intelligence. Lee, I know FedEx reported some numbers. What did you learn?
Well, I mean, their second quarter, they performed pretty well. And, they gave us some color about the peak season from an average daily volume growth. They're looking at mid-single digits. That could increase to high single digits because there's one extra operating day in the quarter, or during peak season, I should say. So, they seem to be executing on their restructuring plan. The problem is that in their second half, they're going to be having a lot of headwinds that they're going to have to deal with. And those headwinds relate to, higher variable compensation expenses, and a less than truckload market, which they're the biggest player in that market, that has been pretty depressed over the last couple quarters, and it's going to probably continue to be depressed. And then you have, as you mentioned, the grounding of their MD-11 fleet following the tragic accident of a UPS plane a couple of weeks ago. So, you add those three things up, plus some other things, it's about a $600 million headwind to its earnings. So they have to deal with that, and some of the restructuring that they've done, probably, you're probably not going to see hit the bottom line, at least really directly, until their 2027.
So the $600 million charge clearly not impressing investors, even with the beat in the quarter that ended. Is this a one-time thing, or is this something that could drag out beyond the second half of next year, excuse me?
Yeah, so on the MD-11s, I think expectations are, they should be back in service sometime early next year. I don't really know exactly when that's going to happen, but so you could view that as a kind of a near-term headwind. The variable compensation, that also is against difficult comparisons, so that's also short-term in nature and not something that is going to continue. The biggest unknown for me, at least, is the less than truckload demand. The ISM manufacturing index, which has been in contraction territory for 35 out of the last 37 months, is indicating that less than truckload demand, which is mostly industrial manufacturing, is going to continue to be weak in the coming months ahead, because that index, the ISM index, is really a bellwether to an early indicator of where LTL demand is heading.
Lee, as you know, I am an expert on trucking. I know what LTL means and TL means. I had no idea that FedEx was the largest LTL provider. Do you like them, that they're in that business, or would you rather them farm it out to somebody?
Well, that's a great question, Paul, because they're planning on spinning that out in June of next year.
Boom, banker.
Yeah, there you go. The argument always was that, maybe they could cross-sell their LTL and get more profitable parcel business. That model really might have not played out as much as they hoped. And so they also hope to get a better valuation, because that LTL business, while it's been pretty depressed, it does trade at a higher multiples. And so they're trying to unlock kind of some of the value there. So, it'll be pretty interesting to see how that company operates as a standalone provider. That industry is pretty consolidated and has a lot of pricing discipline. And we just hope that, once FedEx Freight gets out there and they're on their own, they're not going to try to use pricing to gain share. But we would note they are still the largest player. So it's not like they're looking to gain a lot of share anyway. So, but, it will be an interesting thing to see once that gets spun out in June.
I'm looking, Lee. Mm-hmm. I'm looking at Paul and talking to Lee. In the past 6 months, FedEx shares up about 29% total return versus UPS up up almost 6%. Can you compare and contrast their approach to some of the macro challenges that faces the industry?
Yeah, so they're both in the process of restructuring their networks to deal with the new realities that, B2C or e-commerce is really where the growth is going to come from. And these networks were created a long, long time ago with the idea that, a carrier would go to a lawyer's office with 100 envelopes, drop off those envelopes, and pick up 50 envelopes. And that density really can drive profitability where, as you know, if you get if you order rubber bands from Amazon, that one package that goes to your doorstep is a lot more expensive to deliver. So they're just dealing with that reality, and they've been slow to kind of change their networks. And UPS and FedEx are both in that process. UPS has done things a little earlier, I would say, and whether it is they spun out, or I should say sold their less than truckload business, the TFI, a Canadian provider, a couple of years ago.
Right.
They're all looking to try to gain more share of the small and medium-sized shippers and get away from the large shippers like Amazon, which really aren't that profitable.
Yep. All right, Lee, thanks so much. Always appreciate chatting with you. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. I almost missed my own wedding taking Heartland Express public, believe it or not. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Mic is on. Is it on? There we go. Good Friday morning, everyone. It's a Friday morning here. Yeah. And I wanted to welcome you all to the second hour of Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are live in the Bloomberg Interactive Brokers studio here in Midtown Manhattan, rainy Manhattan as well. We've got a lot going on in the second hour, starting with a recap of earnings. Nike reporting results. The stock is lower. Poonam Goyal, the senior U.S. e-commerce and retail analyst at Bloomberg Intelligence, will recap those results for us. Brian Egger talking to us about Carnival's fourth quarter results as well. And we're going to get a glimpse into what's going on in the muni market with Eric Kazatsky. He's managing director and client portfolio manager at Mackay Municipal Managers. Following that, we will be speaking with Carol Schleif, the chief market strategist at BMO Private Wealth, to get her take on how things are closing out in 2025 and how we're setting up for 2026. But first, let's go to Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, Scarlett. You mentioned Carnival stocks surging after earnings, sailing higher now by 9.3%. This on a day when the Dow, the S&P, NASDAQ are all advancing. S&P right now up 43.68.18. That is a gain of just about 0.6%. Tech rally lifting stocks this morning. The Dow up 235, up 0.5%. NASDAQ up 185, up by about 0.8%. That's the composite index. The NASDAQ 100 index doing a little bit better, up 0.9%. And our Mag 7 index pushing higher by 0.3%. The 10-year at 4.12% with the 2-year 3.47%. Gold at $43.51 the ounce, up $18, up by about 0.4%. Silver now trading at $67 the ounce, up 2.4%. West Texas Intermediate Crude, 56.31, gain there of 0.3%. And a 3% jump right now for Bitcoin, 88,200 on Bitcoin. Consumer sentiment rose in December by less than expected, remaining depressed amid lingering affordability concerns. Joanne Shu is the school's director of surveys of consumers, and she was a guest right here on Bloomberg Intelligence.
Consumers saw a few small improvements on a number of dimensions, but overall, whether it's on inflation or labor markets or business conditions, consumers still think that we're considerably worse off than we were about a year ago.
Joanne Shu of the University of Michigan. Earnings news, we're going to be talking a lot more about this right here on Bloomberg Intelligence, but Nike down now by 9.2%. FedEx after earnings down 1.1%. Rival UPS down by 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan, streaming live on YouTube as well. As Charlie was just reporting, lots of green on the screen here. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's markets correspondent, Nora Melinda. Nora, what are you looking at today?
Lots of green on the screen today, but I'm going to give you some names in the red. I'm looking at shares of Nike, that's ticker NKE. This was an earnings report that we received last night. We are seeing shares lower, down about 9% right now as we speak. This is after the company is really warning that sales will decline this quarter. They're talking about weakness both in China and its Converse brand. I completely forgot they own Converse. Yeah, see, but I thought that was the thing, right? I thought everyone was wearing Chuck Taylors. Apparently not so much. They're saying that sales plunged 30% in the latest quarter. Greater China was down about 17%. So I don't know. Maybe they need another comeback story here for the Chuck Taylors.
Yeah, well, I'm loyal to my Chuck Taylors. Speaking of comeback stories.
There you go.
Speaking of comeback stories, you're tracking another one that is waiting for a turnaround to take hold.
Absolutely. We're looking at shares of FedEx. This is ticker FDX. Shares are down more than 1% right now. It did raise the low end of its profit outlook for this year, and it reported earnings that topped expectations. This, of course, was really helped by volume and pricing gains in the U.S. But, you know, we are seeing some weakness, especially as investors are trying to see whether or not the CEO's plan will really map out. They're seeing a string of cost headwinds, including the grounding of its MD-11 plan. So that's really weighing on sentiment today in the trade. Shares of FedEx, though, up about 1% so far this year. So not too much action there. KB Home, you know, I have to always hit my real estate sector. We're looking at shares of KB Home. This is ticker KBH. We did get results out of Lennar yesterday. KB Home is one of its peers. We're looking at the home building industry. They did post fourth quarter profit that missed expectations. The midpoint of that outlook range for fiscal 2026 housing revenue also did fall short of expectations. So you are seeing the stock taking quite a breather, down more than 8% right now. And it's been a pretty rough year for them as well, down about 12%. Really just still seeing a locked housing market. Rates still remain high, and there's a lot of pressures when you think about tariffs, when it weighs on materials and all those things. So we're really got to see whether or not these home builders are really able to turn it around.
Yeah, the affordability remains a big issue for them. All right, Nora Melinda, Bloomberg Television Markets Correspondent, thank you so much. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and the biggest losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. One of the big losers in today's session so far is Nike, down 9.5% right now. Quite a bit going on there. So let's bring in Poonam Goyal, the senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Poonam, Nike is in turnaround mode. Elliott Hill is no longer a new CEO. He's just the CEO because he's been there for about a year. How is his effort to turn this company around shaping up?
I think his efforts to turn U.S. business is shaping up quite nicely. We are seeing momentum rebuild in the U.S. The issue is outside of the United States, in China specifically, where sales have really plunged. And we don't think that they can, quickly rebound those sales anytime soon. It may be a 2027 story to see any resurgence in China, if that.
What is the issue in China? Is it their brand specific? Is it the Chinese consumer? What's going on there?
I think the biggest issue is brand specific. So unlike in the US, the Nike brand isn't perceived as a higher end athletic brand. In fact, it's sold way too much and off price and at discount. So the brand needs to build brand momentum and brand heat. And yes, the Chinese consumer isn't particularly, on its best feet right now. But if you compare what's happening in China and you look at Lululemon has had outstanding results in China, much smaller, but they've been able to do really well there. So Nike really just needs to get its stuff together when it comes to product, branding, and marketing in that region.
What is the playbook for that? Have they outlined something that sounds reasonable, or is it kind of still throwing things at the wall?
I think the playbook will be similar to what they did in the US. The first thing that they've done so far, and we'll see how that works out, is changed the reporting structure. So now all regions report directly into Elliott Hill. So I guess he just has more authority over those regions, seeing things, firsthand. The other thing that they're going to try to do is just clean house there, right? They have to get rid of the inventory that's just not speaking to the customers and has been aged for some time. They have to get out of off price and they have to stop discounting. And then once you get new product to flow in, you get the right brand message across. It's retail playbook 101. They just need to execute. So execution is huge here.
Talk to us about the Converse brand within the Nike household there.
So the Converse brand, yes, it's struggling, but to me, it's less of a concern than China. The brand is less than 10% of their total revenues from what we see. And while sales are down, and while it is a brand that we'd like Nike to see step up, especially when it comes to lifestyle, other companies have done particularly well there. We'd say the focus, if I needed them to put focus on one thing first, it would be China right now, Converse after that. And that's what we're looking for.
And I know that there's been a lot of discussion between performance and lifestyle over at Nike. What is the path forward for Nike? I mean, has it chosen performance across all of its markets, or are some markets better for performance versus lifestyle?
So they're sticking to performance, and I think that's the right choice because performance is what Nike is about. It is what drives the sport's momentum. What we'd like to see happen is that performance turns into lifestyle. So a lot of shoes that are worn for the sport or for the game have become lifestyle shoes too. So that's a natural shift that we'd like to see with the new innovation that Nike is launching.
So we have some experience now, 9 months, 10 months, 11 months of just tariff discussion. Poon, I think you were one of the first analysts we talked to say, oh boy, what's this going to mean for various industries? What's it mean for your business, the athleisure business, kind of the Nikes of the world, the Adidases of the world?
Yeah, so footwear is largely imported into the U.S., and so is apparel. When you think the athletic wear space, notably the footwear, it's predominantly made in Vietnam, and the current tariff there is 20%. It will have an impact on margins. In fact, Nike's gross margin, if you look at it, even what was recently reported, more than half of it was due to tariffs, and same with their guidance. So I think 20% exposure, they are increasing prices selectively. They probably will have more efforts in place in 2026, that's calendar 2026, to mitigate some of this, but it's not going entirely away. It is a headwind to margin.
Poonam, thanks so much. Appreciate it. As always, Poonam Goyal, she covers all the retailers, e-commerce, all that kind of stuff for Bloomberg Intelligence, a real pro. We appreciate getting a few minutes of your time. Scarlett, I have breaking news. You may want to get the red headline ready for this one.
Okay, tell me.
Today, I put a deposit down on my first cruise ever.
What? What prompted this?
Well, my partner, my girlfriend, we're going. We're doing it in the fall.
She just told you.
Viking cruise. Yeah, basically. Viking cruises, Europe, France in the fall.
And how are you feeling about this?
I'm a little nervous, but it's baby steps, she says. It's not like a big carnival cruise. We got like 5,000 people on. It's a little riverboat, kind of cruise.
Okay, but so in 2 years, we should look for you on a carnival cruise.
Could be. But that brings us to our next guest. I mean, Brian Egger, he's reading the research note right now as we speak. Sweeney in the cruise business. Brian Egger, he's a senior gaming and lodging analyst for Bloomberg Intelligence. Brian, we had Carnival Cruise Lines reported some numbers today. What did they have to say?
Yeah, so I mean, the fiscal fourth quarter ended November 30th, was a pretty decent quarter in terms of yield growth. And I think more importantly, going to next year, they are expecting to see about 2.5% revenue yield growth or so with good cost control. And that's encouraging because there were some concerns that industry growth of supply, particularly in the Caribbean, not by Carnival, but by its competitors, might dampen yield growth going into next year. So while there's still some uncertainty, I think overall the takeaway was fairly encouraging on that front.
How much of their business depends on converting people like Paul Sweeney from a never cruiser to a maybe cruiser to a reliable cruiser? Basically increasing their market share by bringing in new customers.
Yeah, historically, it's been a big factor in North America trying to attract that first-time cruise customer. It's far less penetrated than other forms of vacationing. That's even more true if you go into other parts of the world like Europe and Asia. but it's definitely part of that first-time customer. On the other hand, much of what they do depends on loyalty programs and getting repeat business as well.
So, Brian, give us the consumer's kind of wavering a little bit there. I mean, the K-shaped economy. How does the cruise industry deal with that? Because I know there's different tiers of cruising out there. How do you see that in the cruise business?
I mean, if you go back historically, the cruise industry is moderately cyclical. Probably yields have been more resilient than, for example, business travel-oriented hotel room rates. So there's obviously some vulnerability, but that being said, the leisure consumer of travel has been really resilient and held up extremely well throughout this period of economic uncertainty. Historically, passenger growth has kept up with supply. I mean, the good news for Carnival is they've only looking at about 1% supply growth in 2026. There's certainly more coming from their competitors, but that supply outlook for them specifically is a healthy backdrop, even if we do see a setback in consumer spending.
Speaking of their competitors, I'm just looking at a comparison chart of all the big cruise operators, and Paul's Viking is up about 64% so far this year. Carnival up about 23%, Norwegian Cruise Line down 11%, and Royal Caribbean up 30%. How are their strategies different? I mean, for those who don't cruise, it might seem like they're all one and the same.
Yeah, I think there are different ways you could interpret those disparities in stock price performance, but I think the way I think about it is Viking certainly very focused on the luxury kind of niche cruise segment.
Paul is fancy.
Yeah, good for Paul. And I think generally speaking, that part of the business has held up well. Carnival probably is maybe gained some note because it's done a good job at achieving its return on invested capital goals, done so sooner to get to that 12% range than they expected. And because they've got so little supply growth, that does provide a little bit more conservatism. But, there are certainly some differences across the brands.
All right, Brian, how are my friends on the Strip in Vegas doing these days?
Yeah, I mean, Vegas is finishing up the year with modest growth, but it was a tough summer period in Las Vegas, particularly kind of the mid-market segment. Much like I said about cruising, the high-end hotel business, luxury-oriented demand is held up better, but the mid-market, midweek demand during kind of shoulder periods and the mid-market has experienced some disruption, partly because of construction, partly because of difficult comparisons, partly because we are seeing that luxury end of the market holding up a bit better.
So is everyone then going to double down on chasing after the luxury customer?
Yeah, it really depends on what part of the business companies are in. On balance, Wynn, which is more high-end, has performed better in terms of its RevPAR, let's say, in Las Vegas than some of its rivals. But, those are these trends shift. But I think that's been notable across the leisure travel sector is the relative outperformance of luxury high-end with perhaps a little bit more challenging comparisons and difficult conditions for kind of the mass market or those dependent on other sources of business.
And we know that these gaming companies, these casino companies rely a lot more on China than they do on the Strip overall. How's Macau looking for them?
So, I mean, Macau has been recovering, particularly what we call kind of the mass business in Macau. That has some ancillary effect on Las Vegas as well. Although, low luck levels and baccarat in Vegas have been a bit soft in some periods this year. But, that business is certainly coming back in Macau. It's coming back a lot after, obviously, the pandemic. It's a different type of business.
Brian, thanks so much for joining us. Really appreciate it. Brian Egger, Senior Gaming and Lodging Analyst, Bloomberg Intelligence, joining us via the Zoom thing. Bellagio, that's my place in Vegas on the Strip. I just get the
You
high
and the
rollers.
Ocean's 11 guys.
The high roller suite. That's where I go. And they
So it's the one with the big fountains, right?
Yeah, it's good. It was, but now since that was built, what I find amazing about Vegas is they're always building, they're always adding capacity.
Yeah, that's true.
Now, I know they take some offline, they take some of the older casinos offline, but it just seems like they're always adding
well, they're also building sports arenas as well.
Yeah, exactly.
That's a whole new part of that market.
Yeah, that's, you think about a 20-year growth story there, looking ahead. Vegas is one of them there, so we'll keep an eye on that. S&P up 54 points, 0.8%. The NASDAQ up 237 points. That's up 1% across the board. Yields pretty steady here. 10-year Treasury 4.13%. Oil steadies finally. Got a little bit of a steadiness there. WTI crude oil 56 and change. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for its stability. To get a free gold and silver info guide and to learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. We got a tech rally underway, wrapping up the trading week with the Dow, the S&P, NASDAQ all higher last full trading week of 2025. S&P right now higher by 54, up by about 0.8%. The Dow up 290 now, up 0.6%. NASDAQ up 241 for the NASDAQ Composite Index. index. That is a gain of 1%. The NASDAQ 100 index higher now by 1.1%. The Bloomberg Mag 7 index up 0.5%. 10-year at 4.13% with the 2-year 3.47%. Gold up $10 the ounce, up by about 0.2%. 43.42 the ounce on gold. Silver up 2%, 66.74 the ounce. And West Texas Intermediate crude 56.49 a barrel. WTI up by about 0.6%. Bitcoin at 88,300. Bitcoin now up by 3.2%. Friday deal news: BioMarin Pharmaceutical has agreed to buy Amicus Therapeutics for about $4.8 billion, helping the biotech company expand its portfolio of treatments for rare diseases. BioMarin shares, they are surging 19.8%. And as for Amicus Therapeutics, that stock up by 30.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
Today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. It is that time. It is Friday. It means we talk municipals. It means we're going to chat with Eric Kazatsky, Managing Director and Client Portfolio Manager at Mackay Municipal Managers down there. He's down there in Princeton. Hey, Eric, we're coming up on the end of the year here. Give us a postmortem about the municipal bond market in 2025. How was performance?
Performance was really good down the stretch. I like to think of this year as really sort of a tale of two markets, right? So you had the client experience between January and let's call it late June, early July. And then you had the second half of this year, which was really a turnaround story, and returns have been overwhelmingly positive down the back half. And, munis have largely outperformed the ag, which they get compared to a lot in client portfolios. So really good timing to be talking about things right now.
Eric, there was a lot of concern at the start of the year that munis were going to lose some of their tax benefits, and then that ended up not being part of the One Big Beautiful Bill. Has that concern completely disappeared, or is that something that could rear its head again at some point?
And I think for us, it was never really something that we thought was going to come to fruition. But, it did have an overhang on the market the first half of this year. Right now, we're of the opinion that the tax exemption is going to remain. For us, sort of looking at the market organically, the ability for these local governments, especially now as they come into more fiscal stress, to borrow at cheaper rates and really subsidize the things that go on in everyday life, is really a bipartisan issue, especially when it comes to schools and local services. So we think it's going to continue to have support.
One of the areas of growth, obviously, in this economy has been AI. And on the data center side, how does a municipal bond market play in that, if at all, here?
Good question.
Yeah, so we actually had a visit from the strategist over at Barclays yesterday, and he was talking about this very subject. And he said on the corporate side, they're expecting like $2 trillion of new issuance solely going into that AI data center space, and he thinks a portion of that is going to find its way into the muni market. But look, as we saw this year, the muni market is willing and able to absorb more new issuance. So, as far as we're concerned, bring it on. The market's ready.
So he expects some of it to spill over into the muni market. How might that look? Where would that be most evident?
Yeah, it's going to come on the IDR side, maybe some public-private partnerships. Some of it might come onto the utility side of the market. Really yet to be seen. We haven't seen any big-name projects come online for solely building data centers yet, but that's how I imagine it would sort of shake out.
New issuance, the municipal bond market, as I understand it, had, as we were told by our friends at BAM Mutual, record issuance in 24, record issuance in 25. How about 26? What's the outlook?
Yeah, from what we're hearing now, by far and large, next year is going to be another year of growth on the new issuance side. So this year was a high watermark, even going back to the previous high watermark in like 2010. So, everything was well absorbed. A little bit of softness in the beginning of the year, some of it with the overhang of the question about the tax exemption and some institutional buyers sort of sitting on the sideline until they got some certainty. But that's really been ironed out right now. So I think the market's well poised to take on more issuance next year as well.
You sound positive for the muni market in 2026. If people don't have exposure to it, where are they most likely to give up some exposure in order to make room for munis in their portfolio?
Yeah, look, I think for us, the allocation to munis really serves a couple different fold, right? So one, it serves as an uncorrelated asset class. So people who have corporate exposure, they can lower the standard deviation and have a satellite exposure to munis and bring their risk down overall, right? Because munis are uncorrelated, a lower historical default ratio. So they check a lot of different boxes. But if you're just looking at it from a straight yield advantage, as rates are coming down in the front end of the curve, munis are going to look very, very attractive on a tax-adjusted basis, right? So people who are in money markets still, people who have bills rolling over, they should really take a harder look at tax exempts.
I have plenty of New Jersey municipals in my portfolio. I'm the largest private creditor to the state of New Jersey, I like to think. Eric Kazatsky, I call it the governor, and they pick up first ring, Eric Kazatsky, Managing Director, Client Portfolio Manager at Mackay Municipal Managers. I appreciate getting a few minutes of your time. Back on the technology front, a news story that's got a lot of people's attention, like my kids are paying attention. TikTok is being bought by a group of buyers led by Oracle Corporation, with the company and ByteDance signing binding agreements to create a U.S. joint venture. I don't care, but a lot of people do. Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joins us. Mandeep, talk to us about this structure here. I know that the government was either to ByteDance, which is a Chinese company, either sell this thing or shut it down. Does this satisfy kind of the requirement here?
I think so. And look, the main point of contention was the algorithm. So clearly, there is a decoupling of that versus the app. And, in terms of the ownership, Oracle was the most likely sort of candidate when it comes to leading this joint venture. And that turned out to be the case. So from that perspective, I do think this should be palatable to both the U.S. and the Chinese government.
Although we don't know if the Chinese regulators will definitely approve it, right? They have yet to say whether they'll approve this transaction.
We have seen that many times. A lot can go wrong, but in this case, at least, the joint venture that was formed here had the blessing of the U.S. government. So it sounds like, this was the intended proposal, and that's how it turned out to be in terms of ByteDance, agreeing to sell the app to this joint venture.
What I like about this is it includes Silver Lake, and from my money, but based upon my career, the smartest technology PE money out there by far is Silver Lake. Some really smart folks there. So if they're involved, it's got to be a good deal. That's how I look at it. Mandeep, talk to us about what the competitors are thinking here. Is TikTok still as formidable going forward, do you think, as it has been?
Not really. If you look at the run rate of Instagram Reels, they have surpassed $50 billion in run rate. That would have been unimaginable given the kind of lead TikTok had over Instagram, and Instagram Reels came from behind, and now they have a $50 billion run rate. Same thing with YouTube Shorts. They have an engagement share that's almost surpassed TikTok at this point of time. So clearly, the last couple of years, TikTok seems to have lost steam when it comes to the pace at which they were adding users and the engagement growth, etc. And if I had to ballpark, the U.S. revenue of TikTok would not be, over $12 to $15 billion. So Reels being at $50 billion just goes to show what kind of a missed opportunity that was for TikTok.
Interesting. So what does this mean for Meta, which owns Instagram and Reels, and of course and is now firmly in the lead and is no longer playing catch up to TikTok?
A lot of this, revenue ramp up for Reels was driven by the fact that, Facebook or Meta had a better ad stack, and they kept, improving that with more personalization. Now with applying generative AI on top of that, that has helped them with ad pricing. So these are incremental things where TikTok, couldn't even keep its algorithm. So the fact that, they have to redo the algorithm, redo the ad part, the personalization part is likely the reason why their ad revenue hasn't ramped up. And it's going to take them a while, even if, this joint venture would start putting money into the company to, improve its algorithm and personalization, I don't think it's going to happen that quickly in terms of where they were, 2-3 years back.
Should we expect this new joint venture to maybe go public at some point?
Oh, still early days. I would say, given the algorithm change is a big one. I mean, you have to, even though, users are used to coming to the app, you have the traffic, but we know in the world of AI, it's about personalization. It's about that recommendation system and, rewriting the algorithm. I do think it's going to take a while, and it comes down to, what kind of talent they can attract into this new entity. So a lot has to go right before, we can look at this joint venture going public anytime soon.
That would be really interesting.
I'm still going to go make the pitch. If I were a banker, I'd be right on the doorstep today, no doubt. I want to be the first guy there and saying, let's take this thing public. Here's what you need to do.
And you think they're ready? This is something that they want to do?
I don't know. I would think so. I mean, I could bring a lot of money.
And is the administration going to play a role in that?
Oracle would focus a lot more on their cloud business right now and the ramp up there. I don't think they have the time to focus on reviving TikTok.
Yeah, they're working on the AI data centers and making sure they have the financing lined up for that.
Yep. Yeah, I think you're right. All right, Mandeep, thanks so much. Appreciate it, as always. Mandeep Singh, Senior Tech Industry Analyst for Bloomberg Intelligence. But TikTok's got such a brand name. The kids are into it. People are into it big time. They got a gajillion users. It's just a question of, can you get some real business people in there to kind of ramp up its advertising businesses?
To monetize it better.
Mandeep was saying.
I think it's really interesting. I hadn't realized that TikTok had lost so much momentum, that Reels was
Me neither, yeah.
Had overtaken it in terms of just the views and the profitability.
Yeah, I mean, you think about, Meta, you think about YouTube is part of the Google thing. The big just get bigger, it seems like.
The advantage, the size
it's
advantage that they have.
Unbelievable. Yeah, the network effect, if you will, is really apparent there. So, but TikTok was, it is still huge, but it was the only thing, or almost the only thing, and now there's so many more viable competitors.
Remember there's a service called Little Red Book? I think people were really into that for a little bit.
Oh, yeah?
Yeah.
Okay.
I mean, because they were being pushed away from TikTok, so they were like, let's go to Little Red Book.
Okay. All
so
right.
if you use that, let us know.
Yeah, absolutely. S&P up 56 points, 0.8%. The NASDAQ is where the action is, up 260 points. That's 1.1%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Just getting word of a recall at Ford. It is recalling more than 270,000 electric and hybrid vehicles in the U.S. because of a parking function problem that could lead to them rolling away. Ford shares right now, they are a little changed, up by just about 0.6%. A tech rally lifting stocks today with the Dow, the S&P, NASDAQ all advancing. Right now we got the S&P holding very close to session highs. We are looking at an advance on the S&P 500 index of 54 points now at 68.28. That is a gain of 0.8%. The Dow up 268, up 0.6. NASDAQ up 1.1%. NASDAQ 100 index also higher by 1.1%. The Russell 2000 index of small cap shares up 0.9, and our Bloomberg Mag 7 index up 0.5%. 10-year at 4.14%. We do have the 2-year 3.48%. Gold up $12 the ounce, up 0.3%, 43.45 where we stand now. And West Texas Intermediate crude up 0.8%, 56.61 for a barrel of WTI. Bitcoin now surging 3.4%, 88,400 on Bitcoin. Well, Steve Sosnick is chief strategist at Interactive Brokers, and this morning on Bloomberg Surveillance, he told us there are a lot of positives for markets, and that has him concerned.
The backdrop is an accommodative Fed, solid earnings. But I have to ask the question, is there anyone not expecting that? And that's kind of the issue that I have, is if everybody is expecting a certain outcome, by definition, that means it's priced in. And so I do think that we're more susceptible than I think a lot of people would admit for a bit of a pullback, just because of a confluence of oddball factors that are not priced in to the same degree.
Steve Sosnick of Interactive Brokers interviewed this morning on surveillance. TikTok's long-delayed plan to separate from Chinese parent ByteDance put in motion yesterday when the video-sharing sensation said it was being bought by a group of buyers led by Oracle. Oracle shares today, they're surging 7.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, and we're looking at a market that has managed to erase the declines for the week, at least for the S&P and the NASDAQ. They're now positive for this past 5 days, a bit of a turnaround given the weakness that we saw early on in the week.
Yep, absolutely. So good momentum here. This might be the Santa rally.
This might be the Santa rally, or it might just be positioning around $7.1 trillion of options due to expire today as well. We're not sure. Yeah, that's a thing. So Kara Schleif is Chief Market Strategist at BMO Private Wealth, and she joins us now from Minneapolis. Carol, are we seeing the beginning of a Santa Claus rally?
We've been in a Santa Claus rally much of the month, or actually much of the last several months. So yeah, markets are clearly in a happy mood. And I think a piece of it is at this point in the year, with all of the challenges we've faced all year, people are pretty ready to put a pin in it and go off and have a nice holiday.
So again, if you just look at across the board, S&P up 15%, NASDAQ up 20%. Most fixed income up kind of mid-high single-digit returns, which is very, very solid. What are we doing for 2026? How do we set the table for next year?
Well, you know, the interesting thing is most of those returns pale in comparison to the rest of the globe, because you've got a lot of the reports is up 30, 40, 50. I think Korea's up close to 70% year to date. So it's, you know, the whole globe has done pretty amazingly well, given all the policy shifts that have gone on in so many fronts. And so, you know, similar to the prior piece that you had played in terms of the most frustrating thing of all is I can build a really constructive outlook for next year as well. But I hate being in consensus, and the consensus is really constructive.
outlook for next year. And so I think the biggest, there's a couple of big challenges we do look at. And one of them is we need to broaden out the leadership. And a lot of times that handoff from broadening from how very narrow it's been to a more broad-based scenario can be problematic in that handoff. But we don't think it's lasting because there is such strong fundamentals underneath. Because the one thing that gets lost is the fact that when you look at third quarter earnings, you had 8% top line growth in aggregate, 13% bottom line growth. And it wasn't just the Mag 7 driving it, it was a lot of other industries as well. And the focus, the media focus, the strategist focus needs to be on how broad that story is. It's not just an AI story, it's quantum, it's defense, it's cybersecurity. Right. There's a lot of other things playing into that. And I think that's where if we can get from here to there, you may see a pullback in there. But look at the pullback we had in April that we pretty easily erased.
For our listeners and viewers in front of a Bloomberg terminal, type in WEIGO. That's the World Equity Indices. And it gives you just a sense of how stock markets around the world have performed, and that's kind of what Carol was referring to, and some big returns outside of the U.S. on an absolute basis and on a currency-adjusted basis, which is really important because the dollar has been weak this year.
Yeah, I'm looking at Spain, for instance, up almost 50%. Yep. Italy up about 31%. The best of the U.S. indexes is the NASDAQ up 20% right now. So, Carol, when you talk about that broadening out, I mean, let's not talk tech. Let's talk about the other sectors that really are in a better position now that investors are trying to find opportunities there. Is it financials, which have already started to see that consolidation that we had anticipated?
I think a piece of it's financial, but it's also, there's healthcare in there. There's the industrials that play into that. Yeah, I know we've had sort of fitful manufacturing all year, but when you look at what the market, what businesses have had to face down this year in terms of, it turns out they didn't need clarity after all to produce. And geez, now when we're getting a little bit of clarity, hopefully there's that ability to expand. You've got plant expansion starting. You've got lots of different things that are falling into place. And more importantly, you've got an administration that's very focused on creating an amenable environment to encourage production and manufacturing and all sorts of things going on in the United States here. And I think we'll also start to see more and more use cases of where people are taking that artificial intelligence and the movement to the cloud and all the other things going on and really developing good use cases. And you've got a lot of different constructive things going there. And not the least of which you also have amenable markets, if you will, and a lot of IPOs that were sidelined during the government shutdown. They're teed up because it's hard to bring a company public at year end, but I would imagine in the first quarter, Wall Street's got a lot of those teed up.
Yep. Carol, we've had some really good earnings this year, second quarter, third quarter, double-digit kind of earnings. Do we have what's the earnings outlook, and is it enough to support this market, do you think?
Yeah, I do think it is. And that's another important thing to remember is people keep talking about excessive valuations. And when you look at where the earnings went relative to how much the markets are up, it's almost all supported by the earnings. And the other thing that's important to remember is that 8% top line and 13% bottom line means there was a lot of attention to margins. And it comes through in the employment numbers where people are being very careful about rehiring if people leave. They're enforcing return to work policies, which force a few people, out of the workforce, if you will. And so from that perspective, that attention to margin, which we expect gets cranked down even more going into the first quarter, you do have an opportunity to do some more leverage to that bottom line earnings growth. And so we're expecting pretty good results out of that first quarter and another double-digit kind of year.
Carol, very quickly, what is the one thing you think investors perhaps are not appreciating enough?
Appreciating enough. I think how difficult it might be to get markets broadened because you've seen the small caps play, but we need to get more consistency in that broadening, and that might be tough to get to psychologically because people keep trying to move away from the Mag 7, and then a news announcement comes, and here we're all back back-talking Mag 7 again.
Yes, we find ourselves doing that all the time. Carol, thank you so much. Carol Schleif is, of course, joining us from BMO. She is the Chief Market Strategist there. From New York, this is Bloomberg Intelligence on Bloomberg Radio. We are ending Friday, at least for now, with gains in equities.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Here's another story that I totally missed this year. Takeovers of U.S. industrial companies hit a record in 2025, fueled in part by a spike in deal-making by private equity firms. Private equity firms and other investors bought and sold at least $75 billion of U.S. industrial and infrastructure assets this year. That's a record, according to Bloomberg data going back to 1998. So we need to check in with somebody who covers this stuff for a living, and that would be Brooke Sutherland. She's Bloomberg Boston Bureau Chief. Wow. Was this a surprise here, Brooke? I mean, private equity looking at the industrial America, that's a big number, $75 billion.
It is a really big number. And, I think this trend has really been building for a while, but you've seen private equity firms and other similar financial investors take a really growing interest in the industrial sector. And this really picked up coming out of the pandemic, where I think there was sort of a global reckoning about the importance of supply chain resiliency and some of these, maybe not previously so sexy industrial companies that really play to that theme and serve a really important role in making the world go around. And so I think, this has been building, but, to your point, this is really a record volume of transactions that we're seeing private equity firms be involved in from a buyer and seller standpoint in the industrial and infrastructure sectors.
And that comes with I would say, a challenging backdrop for U.S. manufacturing. U.S. manufacturing activity has been in contraction for 37 of the past 37 months. That's according to the Institute for Supply Management, ISM. But that doesn't seem to keep private equity away.
No, and I mean, I think one thing that's, worth sort of unpacking is, in those headline numbers, yes, it's been this really weak period for manufacturing for the better part of 3 years, but there's sort of, two sectors within manufacturing. There's sort of the companies that can play into that AI data center theme, and those who are tied to the aerospace market, which has also been very strong lately. And then there's everybody else. And for everybody else, that's where you've seen a lot of this weakness, a lot of the challenges in terms of rising costs due to tariffs and paralysis on decision making and investment. And so those companies, you've really seen this sort of persistent struggle, dealing with sort of the inventory glut after the rush of the pandemic and sort of this prolonged period of uncertainty. But, in terms of other sectors that really play more into that AI data center theme, you've seen a lot of growth there. And that is perhaps unsurprisingly one of the areas that we've seen private equity firms take a particular interest.
All right, this is the deal. You highlight a bunch of deals in your story here. But the one I like is last month, a Macquarie-led consortium announced the purchase of Potter's Industries, which makes engineered glass beads that are used to make retro reflective road markings that are more visible at night and in the rain. That, to me, is industrial America.
It is, yes. And I mean, I think what's interesting thing about this is, part of the strategy for Macquarie Asset Management is to go one level deeper. So not necessarily, the traditional infrastructure providers as in, the people that make the roads, but who are the companies that supply, the necessary materials to the people that make the roads, which increasingly is becoming a category in and of itself as you see more specialization in the industrial supply chain, companies outsourcing work that was more typically done in-house. You've really seen this emergence of kind of a new category of businesses. But this business in particular, Potter's, I think is really interesting because it also ties into the trend we've seen in autonomous vehicles, which rely on those road markings to know where they're going. And those road markings are not permanent, especially I live here in New England where we get a lot of weather and those road markings will wear down, typically about over 3 years. And so there's also that recurring revenue element to it that investors really like to see.
Brooke, you are the Bloomberg News Bureau Chief in Boston for New England, and it has been a very trying week for the folks in New England with the shooting at Brown University and then the murder of the MIT professor there. Give us a sense of how the news of this week has kind of impacted that region where, higher education is like just a core part of the identity of New England.
It is. And, I think the other thing, that's important to keep in mind is these two communities that were affected, Providence, Rhode Island and Brookline, which is a suburb of Boston, are very safe communities. They have extremely low rates of any type of homicide, let alone, the type of shootings that we saw in the past week. And so I really do think, this experience has rocked these two communities. There's certainly a sense of relief that the suspected shooter has been found. Authorities last night said they found his dead body in a storage facility in Salem, New Hampshire. But I think there's still a lot of confusion as well. We still don't know what the motive is and, why this individual targeted that specific classroom at Brown and this particular professor and what motivated him to do these two shootings, sort of really back to back. So we're still looking for a lot of information there to connect the dots. And I think, to your point, questions persist, in these communities where higher education is so core to the identity. There's a lot of questions about why this university and why this particular individual were targeted.
Brooke, thank you so much. Appreciate it. Brooke Sutherland, she's a Boston Bureau Chief and author of the Industrial Strength newsletter for Bloomberg News. She's up there in Boston, and we'll have continuing coverage of that story up there in New England, which has been very trying for the folks up there in New England here. Looking at the markets, a strong finish to the week here. So we've got the S&P up 50 points and the NASDAQ up 220 points. So a solid start to this Friday session here on, this is the last full trading week of the year. Then we got some days coming off in the next couple of weeks. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. Again, green on the screen on the yield space. 10-year Treasury yield, 4.14%, a little bit steeper. The 2 years at 3.48. We're going to have more coming up. This is Bloomberg. Good morning.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. There's relief at Brown University and MIT now that police say they found the body of the man responsible for the Brown mass shooting and the killing of an MIT professor. CBS's Tom Hansen.
After almost a week of pleading with the public for help, police in Providence last night said 48-year-old Claudio Manuel Neves Valente of Portugal was the man who killed 2 students at Brown University Saturday and say he was a former student there between 2000 and 2001. The search for Neves Valente ended 90 minutes from Providence in Salem, New Hampshire. He was found with a self-inflicted gunshot wound.
Deputy Attorney General Todd Blanche tells Fox News the release of the Epstein files will begin today but will last over an extended period of time. Sources say the release is 3 hours away. CBS's Scott McFarland.
Survivors have sought these records for years. Some are questioning whether the administration will withhold certain files by claiming they're tied to recently opened investigation involving high-profile Democrats linked to Epstein.
They have been fighting for nearly 20 years to let the public know what happened to them, who was involved, and for some measure of justice by the federal government.
Defiance from Vladimir Putin on Ukraine during his annual end-of-the-year marathon news conference. He pledged to use his military to reach its goals in Ukraine if the country does not bend to Russia's peace deal terms, and through interpretation dismissed talk of a possible wider war in Europe.
Are we truly going to attack Europe? This is nonsense. This is done based on the political reasons. And this is done to create the image of an enemy. They are creating an image of an enemy, and they're making Russia the enemy.
Here at home, a different look now at the Kennedy Center in Washington.
One day after the president's handpicked board voted to add President Trump's name, workers have been adding new letters to the exterior. Critics of the change to the Donald J. Trump and the John F. Kennedy Memorial Center for the Performing Arts have said only Congress can change the name. Some members of the Kennedy family have also taken offense. President Trump also recently added his name to the U.S. Institute of Peace, which is now the Donald J. Trump Institute of Peace, an independent agency the administration gutted this year. Linda Kenyon, CBS News, Washington.
And CBS News meteorologist Rob Marciano says the Pacific Northwest is getting another punch.
Oregon and Washington brace for more flooding as another atmospheric river fuels a new storm hitting the West Coast. High water, landslides, and downed trees are impacting roads south of Portland.
The Dow is up 280. This is CBS News. The head of the Equal Employment Opportunity Commission has urged white men to report workplace discrimination based on race or sex. The post from Andrea Lucas, a critic of DEI initiatives, followed Vice President Vance's criticism of DEI. From Southern California, the story of a dog who went missing after getting hit by a car.
His owner says Sparky will have to have his leg amputated after a package thief left a gate open at their home in Fontana, allowing the 2-year-old Australian blue heeler and his golden retriever stepbrother Blazer to escape from the yard. Blazer returned home the same night. Sparky was hit by a car and dragged down the street, then ran away. His owner found him in a neighbor's yard 2 days later with torn ligaments and a severe cut from his hip down to his paw. Deborah Rodriguez, CBS News.
The college football playoffs get started tonight with Alabama taking on Oklahoma. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Epstein Day. Welcome to the Friday edition with the looming release of the Epstein files hanging over everything in Washington. We're counting down to a release at some point today. We'll get the latest from Bloomberg Washington correspondent Tyler Kendall as the president leaves the bubble shortly to rally the troops in North Carolina. We'll have insights ahead from constitutional lawyer Robert McWhirter. And TikTok says it signed a deal, you heard about this, on Bloomberg on a new U.S. joint venture. We'll talk to Shep to get a sense of what's real. And as lawmakers leave town with no deal on health care, we'll have analysis from our political panel this hour. It's all after a look at Wall Street. Let's start right there, right now, with the voice of Wall Street, Charlie Pellet, and an update on Friday. Charlie, what else do you want?
Indeed, looks like as of now, an update for the week. Barely. You mentioned TikTok. Got to bring up what's going on with Oracle. Oracle shares surging 7.6% right now. Part of a broader tech rally. The Dow, the S&P, NASDAQ solidly in the green today, with the S&P up 55, up by about 0.8%. We've got stocks climbing on a record $7.1 trillion options day. S&P up 0.8%. The Dow up 0.6% right now. NASDAQ Composite Index up 1.1%. NASDAQ 100 Index also up 1.1% as tech shares rally. The Bloomberg Mag 7 Index up 0.5% with the 10-year, 4.14%, the 2-year, 3.48%. Gold now up 0.5%, 43.52 the ounce on the precious metal. Silver surging 2.7%, 67.23 on silver. And West Texas Intermediate Crude 56.67 a barrel, up 0.9%. Bitcoin surging as well. Bitcoin almost back at $88,000, up right now by 2.7%. Phil Orlando is chief equity market strategist at Federated Hermes, and on Bloomberg Intelligence this morning, he told us you cannot ignore the risk of another government shutdown.
The leadership within Congress has realized that they got absolutely nothing by shutting the government down for a record 6 weeks, earlier this year, other than the angst of, American voters. I'd love to think that cooler heads will prevail and folks will sit down and actually do what we pay them to do, which is come up with the hard negotiations and the compromises to move the country forward.
Phil Orlando of Federated Hermes interviewed on Bloomberg Intelligence. After earnings, we're looking at Nike shares plunging 9.7%. After earnings, FedEx down 0.3%. Rival UPS down by 1.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And Balance of Power continues now. We say it every week. What a week, the Friday edition. Once again, your host. Here he is,
Honestly,
Joe Matthew.
We're like a broken record, Charlie. At least we're predictable.
Every week for markets, for your program, every week.
I don't know who to blame for that. But I thank you, sir, and it's great to see you at the threshold of the weekend. Welcome to the Friday edition of Balance of Power on Bloomberg Radio, streaming live on YouTube. Search Bloomberg Business News Live if you want to watch the radio on TV. And if you're in the car, your satellite radio will find us always at channel 121. Yeah, you made it to Friday, and it's going to be a doozy. We're waiting around for the Epstein files to drop. We've got an announcement coming from President Trump around 1 o'clock. Our second hour should have some news on that. And of course, he's going to be leaving the bubble today as well to talk about his favorite topic of affordability going down to Rocky Mount, North Carolina. Now, before we talk to Tyler Kendall, because she's got details on all of this stuff, one of the great privileges that I have in having this conversation with you every day is introducing some of the best minds at Bloomberg, right? We bring them in here all the time, the Bloomberg All-Stars. And it's a great honor to introduce you to Bloomberg's Christina Ruffini, who's going to spend the hour with us on Balance of Power. Great to see you.
I'm thrilled to be here. There is no possible way I can live
Yeah.
up to that
Are
lovely
you kidding
intro,
me?
but
Oh,
I am
well.
excited. I've been watching you this show all week. You're a rock star. I'm here to ride to support in any way I can.
100%. So, like, you know, we're going to share some ideas and see what we can learn over the next couple of hours. So thank you for joining us. Tyler Kendall is with us as we consider the idea of affordability. You see Jameson Greer was on Bloomberg earlier today, the USTR, trying to get his arms around what the president likes to call grocery, food prices. Listen to what he said.
Any good president wants to address affordability, and our president is. And over the past month, we saw, dairy, fruit and vegetables, all kinds of prices go down for basic staples. So that's a great development. When we saw inflation earlier, it's really about housing, healthcare, driven by Obamacare disaster. So I don't think that food imports are really going to be an issue for us. The tariff program is really about creating jobs, and the president's regulatory approach is really about bringing prices down and bringing affordability.
That still doesn't remove the fact that people are paying a lot more for food, whether it's beef, eggs. We went through all of these lists in the CPI yesterday.
Look, I was looking at that exchange a couple months ago, and it was, other than rent, for a lot of people, it's their second biggest expense now, while groceries and everything else are also going up.
It's really something. It's sticky, it's stubborn, and that's what the president's going to talk about later on in North Carolina, which is why we bring in Tyler Kendall for more on this. It's interesting, the speech this evening and the announcement at 1, which I believe is about drug prices. You can tell us more, actually have a lot to do with one another, to Christina's point.
Right, exactly. Well, so on the topic on drug pricing, we can talk about that a little bit more. But yes, the White House press secretary did confirm that this is going to be about trying to lower the cost of pharmaceuticals, but it comes during a week where the White House has been really trying to recalibrate its messaging ahead of the midterms and what has been consistent polling showing Americans unhappy with President Trump's handling of the economy. I mean, you had Cliff Young of Ipsos on this program earlier this week, which his data showing that Americans' approval rating of President Trump is now at 39%, but importantly, it's eroding among Republicans, the base that he has been talking to. So that's why we saw a lot of initiatives this week. Of course, his primetime address focused on the economy, trying to reassure Americans when it comes to the economy that a lot of his economic policies have yet to fully kick in, right? We heard him talk about the tax cuts upcoming, but then Joe and Christina, in just the last 24 hours, we have this great story on the terminal that looks at all of the slew of policies that he just announced. You know, everything from the checks for U.S. service members, some industry wins for the cannabis industry, making the days around Christmas federal holidays. This shift and this focus on the domestic after what really felt like weeks of a foreign policy focus.
The other thing that stands out to me is a lot of these policies that were announced are short term, right? A one-time payment is great, but that's not going to pay your health care for the year. A lot of these seem more like Band-Aids than solutions. So what is he doing at 1 p.m.? Does that have a longer timeline? And why not just put pressure on Congress to get a long-term solution for health care?
Right, that's a really good point, considering Congress is now out of Washington and we're not expecting them to be back here until January 5th. Now, as I mentioned, the White House press secretary did confirm this has to do with drug pricing. Reuters has some reporting about the companies involved in this potential deal that's going to be announced. AbbVie, Bristol Myers, Gilead, and Merck. You'll recall back in May, President Trump had signed this executive order urging his administration to look into how they can get what's known as most favored nation pricing deals for pharmaceutical. The idea here being that if they work with the administration to lower prices to where they would be elsewhere in the world, they will then get a tariff reprieve. So interesting to hear from the USTR earlier today, because tariffs really do come into this conversation about affordability in different ways that we may not expect. But we've already seen the administration do this before. Novo Nordisk received a 3-year tariff reprieve earlier this year. Pfizer, AstraZeneca, all of these companies have already signed similar deals with the administration, but you're exactly right. It comes on the heels of healthcare dominating the conversation here in Washington this week.
Does he make weed cheaper? Does the cannabis, that doesn't make prices go down, right? You let us know if you hear about that. Also, Christmas Eve holiday, is that real? Does that mean we don't have to work?
I was going to ask. I'm new here, but looking at you, bosses.
Wednesday is a federal holiday, right?
So I've learned that previous administrations have done this before. It does kick in for this year. It's actually just for this year. I don't think it extends beyond. It's an executive order that was for
So it
this
only
year.
lasts for 1 year?
Trying to, I'll confirm, but we've seen President Trump had done this, former President Obama had done this, so more short term, but definitely designed to try to, garner support, good feelings ahead of the holiday season.
Feel great to not
Specifically
have to work that day.
for
You should take it off.
federal workers, which have been the aim of some of these policies, such
quite a
as
bit of
mass
time off
layoffs.
this year.
The markets will be open, and the U.S. Treasury says it'll
Markets are
still
going to
be
be open.
selling.
Yes.
It'll still be selling bonds
We'll
on
be
Christmas
here.
Eve. So.
We'll be here with a special edition of Balance of Power. Tyler, thank you so much. Reporting from Washington as we turn our attention to the other big one, TikTok. Is this real? Signing agreements for a new U.S. joint venture. When we talk about blocking the talk, we have to bring in Michael Shepard with us. You're reporting from Washington for Bloomberg, and he's been all over this story. Is this real? Shep, we're looking at a deal that sounds a lot like the one the president rolled out, but I still don't understand how they control the algorithm and how we protect data, and that was the whole point to begin with, right?
That's right, and we can walk through it step by step here. First, is this real? And I would say that this is a step forward from what we saw in September when President Donald Trump signed that executive order, really setting the stage for what was formalized yesterday. What we saw was a memo that we were able to break last night that was circulated internally to TikTok employees describing the contours of a binding agreement that the parties had signed. Not only TikTok, but the investors, including Oracle Corp, Silver Lake Management, and MGX. And those are all three new outside investors that we had reported on previously, but they had not actually put pen to paper yet. Now, they did spell out a little bit, Joe, to your question about the algorithm and security, how that will work. And essentially, they will license a copy of the algorithm from ByteDance, the TikTok parent that's based in Beijing, and they will then make a copy of that licensed algorithm and then retrain it. Oracle will retrain it using U.S. users' data that it has kept here sequestered from the parent company ByteDance. Remember, Oracle has this standing relationship through that initiative known as Project Texas, where it would handle U.S. users, TikTok users' data here in the U.S., keeping it secure and essentially running the app here. It's not a huge amount of change in that, but they are trying to put some more security guardrails around it. The question is, though, Joe, will this satisfy all the concerns that surfaced here in Washington, especially in Capitol Hill, but even in the first Trump White House and in the Biden White House around the security of the app?
Michael, Joe asked you, is this real? My question is this done? I mean, doesn't China still have to sign off on this? And what are the odds that they're going to go for whatever they've agreed to on this side of the world?
Well, Christina, this is really the open question that you just hit right there. And it's an important one because as a significant venture in China, the Chinese authorities will have a final say. We've already heard it from President Donald Trump when he signed that executive order in September, blessing the deal. In essence, that really was it as far as he was concerned. But since then, we have not heard from authorities in Beijing to say whether they are giving it their thumbs up or thumbs down. And we're still waiting for that. I will say that the executives involved in this probably wouldn't have proceeded without some sign that they would get an okay from China.
Some sort of assurances.
All right, Shep, it's great to see you.
We're going to bump
Playing
out the
us out the right way here. I like this.
TikTok on the clock.
Mike Shepard on Bloomberg. Return to the Epstein files next.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Best level of the day right now on the S&P 500 index. Stocks are pushing higher with techs leading the way. S&P right now up 60 at 68.35, up by 0.9%. As of now, we're looking at a winning week for the stock market as measured by the S&P. Dow up 287, up 0.6. NASDAQ higher by 272 for the NASDAQ Composite Index, a gain right now of 1.2%. The Bloomberg Mag 7 Index up 0.6% with a 10-year that's yielding 4.14%, the 2-year 3.48%. Gold up $16 the ounce, up 0.4%. Precious metal now at $43.48 the ounce. West Texas Intermediate crude up 0.7. By the way, silver surging 2.6%. Bitcoin right now up 2.9%, just above $88,000, $88,043 now on Bitcoin. As you heard moments ago right here on Balance of Power, TikTok's long-delayed plan to separate from Chinese parent ByteDance is now in motion, with the video sharing sensation saying it is being bought by a group of buyers led by Oracle. Oracle today up by 7.5%. ByteDance, by the way, on track for profits of roughly $50 billion in 2025. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie, thank you so much as we finally crest the end of the week. Thanks for being with us on the Friday edition of Balance of Power. You tired? I am. The city's exhausted. Maybe Christina Ruffini knows what I'm talking about. She's with us for this hour here in Washington as we wait for the Epstein files to be released.
I
Do
mean,
you wear an Oura ring?
I don't.
Did you see that story today?
No good will come from me trying to track sleep that I am not getting.
The Washington, D.C. has the lowest average sleep score in the country, as confirmed today by research at the Oura ring, the people who make the Oura ring. A sleep score of 85 and higher indicates optimal. D.C.'s average was 77.5.
This is what happens when you export the country's power nerds, myself included, to a city where we have a million things we need to get done.
I guess that's true. I don't know. So states with the best mean sleep scores: Wyoming, Vermont, Montana, Maine, and Idaho. So if you want to sleep, move to Wyoming.
That tracks. Those are all lovely places.
We might be up late this evening, by the way, because we just don't know when the Epstein files are going to drop, and we also now don't know how many are going to drop. This is supposed to be the day mandated by law that the DOJ releases the files. Todd Blanche now says we're not going to get it all.
Right, on Fox this morning, he said, I expect that we're going to release more documents over the next couple weeks. So today, several 100,000, and then over the next couple weeks, I expect several 100,000 more. So it looks like we're moving the ball a little bit on that one.
There are also a lot more documents, I think, than people realize were coming. This is not going to be like a black book coming out of a drawer with a list of names on it. This is going to be an enormous amount of disparate evidence that we wanted to spend some time talking to our friend Robert McWhirter about. Constitutional lawyer, practicing criminal defense and civil rights lawyer, Maricopa County, Arizona. We call him on the big cases. And Robert, it's great to have you. Happy Epstein Day, I guess, to those who observe. What do you make of this late decision here? Because we keep hearing stories about scores of lawyers and even intel officials. I picture them with the green visors going through hundreds of thousands of files, and looks like they're not going to be done in time. Yeah. Are we not hearing each other?
I can hear you.
Robert, can you hear us?
All right. Fire away. Guys, tell me if we're not hearing something. Robert,
but what
would they break the law if these don't all come out?
Yeah, what is the enforcement mechanism here? Is there one?
All right, guys, we're not hearing Robert. Maybe you can help us figure that out, because this is going to be a problem. It is mandated by law that they have to come out today.
It is mandated by law, but then what happens? There is no enforcement mechanism. You know, this is something that seems more like a political risk than a criminal risk for the DOJ. DOJ is also short staffed. There's been cutbacks, there's been firings, there've been quittings, and you're having people go through these files who are not normally the people who would redact. I think we've got Robert back. Robert, check me. Is that the case? And what is the procedure for doing this?
Good morning. Yes, hi, I am back, I guess.
There he is.
We got you.
Sorry, I didn't hear the question. What's the question?
No, we're just talking about the process of this because, you know, normally when you request large document dumps, they come a couple ways, and one of them is a FOIA, and you have dedicated FOIA officers who are used to redacting. What we're hearing and what others, including CNN, have reported is that there's not a lot of guidance. They've requisitioned attorneys from different departments, and it's a big lift. So what is the process for this? Is there a process, and is that being followed?
Well, there really isn't a process. The process for these files are defined by the statute. I mean, I would think of the statute as one great big FOIA request, like this is Congress's FOIA request, which the president signed into law. The trouble with this is the statute itself is very unclear about procedure, and indeed it does give time limitations, 30 days from signature, which is today, but there's no enforcement mechanism in the statute. So really, there's not much to done. And the bigger problem that I see is there's nothing to evaluate the completeness of the disclosure. People are going to have to look at this with a fine-tooth comb because I do not trust this administration to give everything. And in fact, there's indications that they want to just dish out things that would make Democrats look bad and pull back things that make Republicans and the president look bad.
They can redact whatever they want, right, Robert? So are we going to be in a world in which Republicans are redacted and Democrats are hung out to dry? Or could we just see entire pages that are redacted and this goes to court to find out more? Or that's just the final word?
That's the final word. Now, the statute does give certain things, and the intention of redaction would be, let's say, for instance, to protect the names of victims or the identities of the victims, of which there are many young women who are victims here. And so it makes a certain policy sense that they can have some redaction. And I think most people would accept that. The trouble is this administration, and under Pam Bondi certainly, has shown a proclivity anytime they have an excuse to do things that avoid making themselves look embarrassing, regardless of whether that's legal or not.
Also, I mean, given the stress and hyperpartisanship of the DOJ right now, if you're one of these attorneys who's been told redact this and you see something that you know could be compromising to the White House or the president, I can't help but think you are going to be tempted to over-redact it in an effort not to antagonize the bosses and keep your job. Where does the discretion there lie? Is there any backstop for that? And there are also reports that there are two versions of some documents and different people are redacting the different documents, so there could potentially be different redactions on the same document twice because there isn't really a standard. It's kind of a judgment call.
Oh, absolutely. And as I think I heard you mention before, a lot of the really fine attorneys in the U.S. Attorney's Office have left or have been shuttered aside to other jobs, kind of the equivalent of the U.S. Attorney or the Department of Justice Siberia. So you've got people there who are either personally conflicted and don't know what to do, and you have people there who are just basically Trump partisans who are going to not give a fair presentation of this. What it has done and what Pam Bondi has done with her Department of Justice is just eroded confidence in the objectivity of that office. And there's no reason to believe that the production of these documents will be objective and fair.
Mm-hmm. There's the legal side, which is why we're talking to you, Robert. There's also the editorial side. And I can tell you that there are scores of journalists and lawyers teamed up in Washington and in New York, waiting for these files to drop today to start reading through them en masse. Considering the role that you play as a constitutional and criminal lawyer, and also your interest in politics, I'm just wondering how you would pursue this if this was dumped in your lap, Robert, what names you'd be looking for first, or where you'd know to jump in the documents to find the news.
Well, first of all, I want to get them electronically so I can do little searches, you know, like,
yeah,
you know, maybe harness a little AI in favor of democracy.
Yeah.
So first of all, I'd be doing that and just typing in certain names. That would be the first thing I do. And then you want to
Control F Melania. You tell us.
Control F Melania. Yeah. Well, you know, that's kind of yours and my standard. I think the younger generation is more into more sophisticated AI than we are, but still, Control F works just fine. And so you're going to find that. You're going to find Control F, Donald Trump, or DJ Tay, right? T for Donald Trump, right? So you're going to, first of all, do that kind of thing, but then it's going to be a painstaking process. And again, kind of to the points that were made before, the legion of journalists who are ready to receive this, frankly, are very competent in their job. we don't have confidence not only in the fairness and objectivity, but quite frankly, if you look at the performance of this Department of Justice and the people they put in, you have some questions about their competency and their ability to deal with these large documents, both in the Department of Justice itself and the FBI that's supposed to be doing the investigation. So I'm putting my faith in journalism, at least on this one, in terms of getting the correct information out.
You've also got a Republican from Kentucky on the Oversight Committee saying pretty outright that if he doesn't see names of men who could be, charged with rape or other crimes, he's not going to believe, or he's going to know that they didn't release everything that they could release. Is he right? Are there things, we've been talking about what is getting redacted. Are there things that if they are not there, look, DOJ has said we're not getting all the documents at once, but what should we be looking for in absentia in these documents that could tell us what?
Well, a lot of these are going to center on what are called FBI 302s, which are the standard FBI report form. It's basically the equivalent of a police report that FBI agents do, their standard police report. So they're going to be looking in gaps in sequential Bates numbering. They're going to be looking for forms that refer to other forms that just aren't there. And it's a very interesting in terms of the politics and the split in the Republican Party, because, the Republican Party has always cast itself as the party of law and order and in favor of that. And if they don't see correct law and order and the respect for victims, they're going to have a real issue here, and there's going to be pushback. And also, I think there's got to be something else to keep in mind, and the people disclosing should know this. People have copies of these things. I frankly am surprised that nothing has been leaked before this. Somebody or several people have these documents in some hard drive someplace, and if they're not correctly disclosed and released to the public, they're going to get out eventually. Don't forget, all Nixon's tapes eventually got out. And I think that's what will happen here. And that, quite frankly, is the bind. And I think also you can read these things. And, I have a lot of experience reading FBI 302s and other large discovery packets. You develop an ability to see what's between the sheets, what's between the lines, and what's missing. And I will tell you, as a criminal defense attorney, that's what you hone in on right away.
Robert, we have 1 minute left. I just have to ask you about what's going on over at the Kennedy Center. They're changing the sign there today. And from what we understand, only Congress can change the name of the Kennedy Center. Is that legal?
It is absolutely not legal. And frankly, it's akin to renaming the Department of Defense, which shows that America is about defending democracy, to the Department of War. And simply, it's not. I also think it's in very, very, very bad taste. It is called the John F. Kennedy Memorial Arts Center because he was an assassinated president of the United States, an event that many of us remember in our lives as a key event. And now Donald Trump wants to hone in, having not had that sacrifice.
Indeed, a living memorial here in Washington. Robert, it's great to see you. Thanks for your read on this. We're going to be looking for the files later on. Maybe they'll drop while we're here today. We've got a couple hours to go. With Christina Ruffini at my side, I'm Joe Matthew. We'll assemble our political panel next. It just got real quiet around here. Where'd everybody go? This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks pushing higher with the Dow, the S&P, NASDAQ all advancing. Last stretch of a busy week for markets. We're also looking at a lot of tech names moving higher today. Tech leading the advance with NASDAQ up 274, now up 1.2%. The NASDAQ 100 index up 1.3%. S&P up 62, up 0.9. The Dow up 0.6, and to be clear, NASDAQ up 1.2%. 10-year at 4.14% with a 2-year currently yielding 3.48%. Gold is up $19 the ounce. Spot gold at $43.51, up now by about 0.4%. And West Texas Intermediate crude oil up 0.7%, 56 a barrel on WTI. Bitcoin up by $1,500 a token at 87,100. Bitcoin up by 1.8%. U.S. Trade Representative Jameson Greer is indicating he supports keeping the U.S. in the trade accord with Canada and Mexico, acknowledging in closed-door briefings with lawmakers that issues with both nations remain. And in a Bloomberg interview this morning, he also talked about the U.S. economy and tariffs.
I think that the tariff plan is in good shape. I think we have a lot of the tariffs we want in place. You know, if there are countries here and there that don't comply with their deals or don't want to finish a deal, then maybe we have to have another conversation. But I think the economy's booming, inflation's down, wages are up. We're on a really great track.
U.S. Trade Rep Jameson Greer interviewed this morning on Bloomberg Radio. Earnings news: Carnival Corp gave a better-than-expected profit outlook for next year and reinstated dividend payments, sending shares higher, looking at an 8.2% jump right now for shares of Carnival Corp. And KB Home shares lower after the home builder posted fiscal fourth-quarter profit that missed analyst estimates. KBH on the ticker. It is now down by 9.5%. Recapping: S&P up 0.9%, on track as of now for a winning week. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Christina Ruffini and Joe Matthew.
All right, Charlie. Happy Friday, sir. We all made it to the end of the week, although this could be a long day as we wait for the Epstein files. That's kind of the big one here in Washington, and we could find ourselves at midnight waiting for the Epstein files because they do have the full day to do this. Christina, we're hearing as well, though, from the Department of Justice, we're not going to get them all, even though hundreds of thousands of documents could drop today. That's how big this cache is.
Yeah, it seems like the end of the week is a rolling target. It also seems like they're now saying they're going to release thousands today at some point, and then there will be thousands of more. And as we were just discussing, there really is no enforcement mechanism. So they're supposed to do it. If they don't, we don't really know what happens.
We'll keep the beat on this through the day. And again, it could be hours from now. We don't know. The president does have an event scheduled for the top of the hour. He's going to be, we understand, making a speech about drug prices, not unlike the announcements he made with Pfizer and Lilly. This will be another round of pharmaceutical companies getting most favored nation status, as they call it. But outside of the White House complex, if you walk around town today, it's a ghost town. Everyone took off. They all left town last night.
Death, taxes, and Washington congressional vacations.
Correct. And they won't be back until after we go over the cliff. So all of the hand-wringing and debating about health care, Obamacare subsidies, and health savings account left us with nothing to show for it.
All those Americans who are trying to pay for Christmas, trying to pay for meals, and looking at their bills when these ACA rates spike, they're all thinking about it, but there's not going to be a thing done until Congress is back in session.
If there's a fix, and that's where we start with our political panel. We've certainly talked it out with both of them. Bloomberg Politics contributor Jeannie Shanzano is with us, democracy visiting fellow at Harvard Kennedy School's Ash Center, and Lisa Camuso Miller is with us as well. Rock Solutions, former comms director, RNC, host of the Friday Reporter podcast. Lisa, I'm going to start with you because you worked for a former speaker in a very different political environment. A lot of folks are looking at Mike Johnson wondering about the decisions that he made. Should he have brought an Obamacare subsidies bill to the floor, even if it failed, just to say he gave it a chance?
I don't know, Joe. I mean, the optics of bringing it to the floor and having it fail is also not a great look. So I think that more than anything, he probably didn't have the card to play, and so he didn't. But I think what was troublesome, and what we're going to see now over the course of the next couple of weeks until they get back, is that the narrative is going to be dominated by costs, dominated by all of the things that are happening. And it'd be interesting to see, while the president is not known for his discipline as it relates to messaging, and so while today we think maybe he's going to talk about costs and he's going to talk about health care, I'm not necessarily sure that's going to satisfy anybody's dissatisfaction with the fact that nothing has been done in this case.
But Gina, I mean, we have seen nothing get done on the Hill for quite a while now. I was saying earlier, it's like the worst congressional level executive dysfunction we've kind of dealt with. There's this great quote from Rosa DeLauro, a Democrat from Connecticut, where she says, "The summer was wasted, December was wasted. We'll just have to get it done in January." Is there any prospect of them getting anything done in January?
It's so true, Christina. You know, I was just looking back when Truman famously called Congress in 47 and 48 a do-nothing Congress. You guys are going to fall over. They passed over 900 bills. We are barely approaching 100 at this point. So this is a real do-nothing Congress. Truman would have fallen out of his chair at this one. And no, there's not a lot of prospect. I think the one positive sign I've seen is Schumer saying, much to the chagrin of some Democrats, that they're not going to push for a shutdown. It's probably likely we get CRs, but it's an election year, and it's a really, really tough election year. And we all know what happens in Washington in election years. Nothing gets done except electioneering. And so I'm not very hopeful, Christina. I should be more optimistic at the holidays, but I'm not.
Well, let's talk about electioneering, because as lawmakers go home and prepare to wrap their presents or whatever they're doing with sugar plums dancing in their heads, we got a big endorsement here yesterday. Lisa and Jeannie, Erica Kirk, the CEO of Turning Point USA, the widow of the late Charlie Kirk, decided to kick off their big conference that's underway last night by endorsing J.D. Vance for president in 2028. Christina, he has not announced a campaign for president in 2028.
He is not, but all of a sudden this has gone from nothing to a little bit of momentum because our colleagues from London were over here interviewing Peter Navarro.
That's right.
And they got something similar. Our amazing colleague Michelle Hussein asked him, you know, who would you trust to continue this agenda? And I think we've got the sound for you here.
J.D. Vance is the vice president, and Marco Rubio, that would be, for example, a great ticket.
With who at the top of the ticket?
J.D. would be there. But Marco's already said that if J.D. runs, he wouldn't challenge him. But Marco, I love these guys. These are, I always admired Marco back in 2016. I always thought he was like, of the people on that stage, the 16 Republicans, I always thought he was the sharpest tool in the shed besides Donald Trump.
Interesting situation, and I'm wondering how Marco Rubio feels about this.
I thought the same thing, especially, yeah. But, you know, it's interesting because you've also got a president who's literally selling Trump 2028 hats
that's true.
in the White House.
So, Lisa, who's going to be the nominee? Are we doing this a little early?
It's way too early, and it's actually quite dangerous, I think, politically, because there is an audience of just one that's paying attention here right now, and anybody that's perceived to be getting out in front of the guy that is running the White House right now would be very unpopular. That's very unpopular positioning. And so while I think Erica Kirk has every right to say whatever she wants to say about endorsements, because that's her prerogative, I also think that it is a very long way to go between now and then. And J.D. Vance is certainly the vice president. We've also seen plenty of vice presidents run and not be successful. So I think that there's a lot of runway to take into consideration. Getting out in front of Donald Trump is never politically popular.
And Jeannie, to that end, I mean, this is early. This is a lot of time. Does this potentially put a target on his back and allow Democrats to spend all this time trying to take him down as a potential candidate?
Well, you know me. I heard this and I thought, thank you, Erica Kirk, because I like nothing more than election season. So 28 can't come fast enough for me. So God bless her. You know, we all remember famously Jeb Bush getting out there early, to Lisa's point. Not always a good idea, but they are battling a lot. I was just talking to somebody out in Phoenix yesterday. You've got fights raging in the MAGA universe between like Ben Shapiro, Tucker Carlson, Nick Fuentes. It is hot out there. They are trying to build this red wall. I don't think it's too much of a surprise that she came out for J.D. Vance. They have been incredibly close since the killing, but even before. So I'm not surprised, but I, for one, am just as happy when people get out there early on 28. Go, go, go. We have a lot to cover.
All right, well, let's talk about the last election,
Christina.
because this is interesting. Jeannie, I don't know how you feel about this. The Democratic National Committee did an autopsy following losses in 2024, not unlike the Republican National Committee did several years earlier, to find out what went wrong and how to publicly deal with the messaging issue here. DNC now says it is withholding the autopsy because it doesn't want to essentially weaken its messaging ahead of the midterms. I actually asked a couple of months ago, this was actually back at the beginning of November, asked Ken Martin, who runs the Democratic National Committee, if this was the plan. Here's part of our conversation. When you were elected, you said, in fact, that would be one of your key missions, is to dig into what took place in the election and the failures that Democrats experienced here. There's word that report may be finished, Mr. Chairman. Do you plan to release that?
We do plan to release that within a matter of weeks. It's not completely finished yet. There's still a few key interviews we need to do.
So, Jeannie, what happened? And is this a bad move? I thought it was about transparency.
I think it is a bad move. I am always in favor of releasing data and releasing reports. I think you also have a lot of concern. I mean, I was just talking about fighting on the right. You have a lot of concern in a very disgruntled Democratic base that this favors people like Kamala Harris. So I do think this is a mistake. And of course, it just doesn't make sense. If you tell people you have a report, but you're not going to deliver it, you're not going to present it, what political kind of savvy does that show, Joe? None. So either don't say you're doing it, but if you say you're doing it, you got to release it, in my view.
And Lisa, I was wondering what they were more afraid of, what Republicans would do with that information or what Democrats would do to themselves.
I think they just would cause themselves unnecessary noise as opposed to just sharing that information internally with the candidates and the campaign managers and all the political operatives that are going to be running these campaigns, rather than releasing it out to the world and allowing the narrative to be that Democrats are weak in a variety of different ways. To me, this is a blip on the screen. Democrats are going to take whatever they've learned and they're going to institutionalize it amongst the politicals, and they're going to hopefully use it to their advantage in the midterms.
Well, I remember the 2012 Republican autopsy, Lisa. The RNC was pretty public with that autopsy, as I remember. What's the point of looking back like this, though, when the electorate has already done its autopsy?
It's incredibly helpful for messaging, Joe. It's incredibly helpful to identify where, in fact, we have deficiencies and where we have to move in order to be meeting the needs and the concerns of the voters. And so that's why it's particularly important, especially because it relates to how you're going to spend money. Where are you going to direct your assets? What kinds of moves can you make? So having that kind of data actually is very smart, both for every political party, for any political party, because otherwise it is so incredibly expensive to run a campaign that if you don't have information that you can use to your advantage, well, then what is the point? I mean, honestly, it can just be a very, very expensive venture to not have that kind of information. But I suspect that the DNC has decided that this is something that they're going to hold for themselves, they're going to use internally, and they're going to use it to their advantage. I would hope. I mean, that's how a politically smart run organization would do this kind of thing.
Do we want to ask about the Kennedy Center?
Sure. I saw the sign today.
You know, we were talking earlier. It's important to remember the Kennedy Center was not actually called the Kennedy Center when they came up with this idea. This had been kicking around since 1938. They finally got it done in 1958, and it was called the National Cultural Center. It was renamed for JFK, of course, after the assassination. Trump is trying to put his name on it. I'm wondering, and either one of you can take this, but at any point, do we reach max Trump naming things after himself saturation, even for the base? Is the ridicule factor factoring it at any point, or do you think people who support the president say the more the merrier?
No way, not at all. He loves this every single day. If you've ever been to a Trump property, his name is all over it, from the Master Grand Ballroom to the hand cream in your room. He loves the idea of naming things with his name, and I don't think that the exhaustion will ever hit, because I think to him it's just a legacy.
Great conversation. They'll be back with us in our second hour. Bloomberg Politics contributor Jeannie Shanzano, Republican strategist Lisa Camuso-Miller. Thank you both so much for being with us. Coming up, we will have much more on this, and the president's going to be speaking, at least that's on the schedule, about pharmaceutical prices. Christina Ruffini, you meet me back here on Monday?
I'll be back.
Or did I ruin this?
If you'll have me, I don't know. Let's talk.
I think I'd love to have you back.
Thank
let's
you so much.
let's keep this rolling. We'll welcome our global television audience to the conversation coming up. We'll get a report from Bloomberg's Tyler Kendall, who's got her eyes on the Epstein files release. Are you staying up until these come out?
Probably because, again, DC, I'm a nerd. I'm here for it.
That's
what we do.
That's why we love Christina. Stay with us, only on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Affordability gets another road test. Welcome to the Friday edition as the president prepares an announcement on drug prices today before flying to North Carolina for a speech on, yes, affordability. We'll get the latest from Bloomberg Washington correspondent Tyler Kendall. And as we wait for the Epstein files to drop, that's also supposed to happen today, at least some of them. We're going to talk it out with former federal prosecutor Sarah Krisoff.
coming straight up. And with our political panel, they're with us for the hour, all after a look at Wall Street. We start with the Friday trade and Charlie Pellet at World Headquarters in New York. What do we have, Charlie?
Right now, we got the best level of the day, very close to it, Joe Matthew, with the S&P advancing 61 points right now. In fact, we are on track as of now for a winning week. On the week, the S&P is up 0.1%. Right now, the S&P is gaining 0.9%, up 61 at 68.35. Dow Industrials up 283, up by about 0.6%. And NASDAQ on this Friday up 1.2%. The NASDAQ 100 index up 1.3%. And the Russell 2000 taking part in the advance, up by 0.9%. The Bloomberg Mag 7 index also higher, up 0.6, with a 10-year that's currently yielding 4.14%. The 2-year 3.48%. Gold is up $21 the ounce, 43.54. That is a gain of 0.5%. Silver now surging 3%, 67.43 the ounce. West Texas Intermediate crude oil up 1%, 56.70 on WTI. And Bitcoin, 86,844 Bitcoin right now, up by 1.5%. Earnings news: Nike lower after the company warned that sales will decline this quarter amid persistent weakness in China. And at its Converse brand, we've got Nike shares trading lower today. Right now, we've got Nike down by just about 9%. Also out with earnings here, UPS, or actually FedEx. FedEx shares also lower today after earnings. FedEx right now trading lower, trading higher by 0.1%. UPS lower. It is down by 0.9%. So again, recapping: the Dow, the S&P, NASDAQ, all advancing. S&P up by 0.9%. Balance of Power, the Friday edition, continues right now. Back we go to Washington. Once again, your host here is Joe Matthew.
All right, Charlie, we thank you. Nice to see you on a Friday, and thanks for joining us on Balance of Power here on Bloomberg TV and radio. We expect to hear from the president at some point this hour. He was scheduled to be underway at the top of this hour with an event specific to drug prices. And you're going to hear us connect the dots here on the issue of affordability. That's at least what the White House wants us to be doing, with the president leaving the bubble later today to rally the troops on the issue of affordability in a rally in North Carolina. It's not going to be until much later, 9 p.m. Eastern time. We've got a full day of activities at the White House as we also wait for the Epstein files to drop. This is deadline day, and the Department of Justice has until midnight. Back to the issue of affordability. That's the conversation that's being provoked by the White House, and we spoke earlier today on Bloomberg TV and radio with the U.S. Trade Representative Jameson Greer about what's the cause of the stubborn price inflation that we've seen specifically at the grocery store when it comes to foodstuffs. And we talked about this yesterday when the CPI report came out, whether it's meat or eggs, up dramatically over this time last year. Here's what Greer told us this morning.
Any good president wants to address affordability, and our president is. And over the past month, we saw, dairy, fruit and vegetables, all kinds of prices go down for basic staples. So that's a great development. When we saw inflation earlier, it's really about housing, health care, driven by Obamacare disaster. So I don't think that food imports are really going to be an issue for us. The tariff program is really about creating jobs, and the president's regulatory approach is really about bringing prices down and bringing affordability.
In a short time, the president will be, as I mentioned, making an announcement from the White House, and that's where we start with Bloomberg's Tyler Kendall, because these really are all the same story. Tyler, when the president talks about affordability, he frequently points to drug prices with deals with the likes of Pfizer and Lilly, this most favored nation status that they're receiving, as well as gas prices. The rest of the prices we're paying remain pretty stubborn. What's he going to say about this today?
Right, exactly. It's no surprise that this event is happening to cap off a week where we really saw the White House try to refocus on the economy, retool that narrative amid what has been consistent polling showing that President Trump is losing ground when it comes to Americans' confidence in him. In his handling of the economy. We were talking about this last hour on this program, but you spoke earlier this week with Cliff Young of Ipsos, and he had a new poll out this week being cited widely that shows that Americans' approval of President Trump has now slipped to 39%. But really importantly, it's showing that his support among Republicans is eroding. And that's why you're seeing the White House really go out this week with a slew of initiatives, his primetime speech, and now this event on drug pricing. According to the White House press secretary, that's what this is going to focus on, lowering the cost of pharmaceuticals. There was some reporting out earlier today from Reuters that named those companies that could be here for a potential deal at the White House, including AbbVie, Bristol Myers, Gilead, and Merck. As you mentioned, President Trump had signed that executive order in May, urging the administration to negotiate on most favored nation drug pricing, essentially alleging that there are unfair trade practices here, that these companies are giving better rates to other countries. And the understanding has consistently been that if they can bring down the pricing, then these companies are ultimately going to get a tariff reprieve from the administration.
Interesting. So he'll have something potentially new to talk about in North Carolina tonight. What's the plan here? He's going to Rocky Mount. He's stumping as well as campaigning.
Well, and you know what's important about this area in North Carolina? This is North Carolina's first congressional district. It was newly redrawn. These are new maps in North Carolina, and this district had historically gone to Democrats, but now it looks like it will lean Republican. So it feels like we are so long away from next November, but everything really does have to do with the midterms. This is all about campaigning and reaching out to the voters in this area in a critical battleground state, now in a critical battleground district, potentially. But
he's going for Whatley, right? Michael Whatley's running for Senate, and that's why they chose North Carolina, beyond its importance on the map in general.
Right, exactly. This is going to be about down ballot races, because even though President Trump himself isn't on the ballot, this has a lot to do with his agenda going forward and whether or not he can get through initiatives like we saw him get through this year if Republicans don't maintain both chambers of Congress. But you're exactly right. This is the second stop in what's expected to be a domestic tour around the country on the issue of affordability. And that's really where the White House has tried to refocus the conversation. We were talking about it earlier, but in just the last 24 hours, Bloomberg News has a great story out on the terminal looking into just the list of policy initiatives released in the last 48 hours, right? Those checks that are going to service members, some gains for the cannabis industry, making the days around the Christmas holiday federal holidays. There has been this retooling to talk about domestic policy amid what has been recent weeks really focused on foreign policy, right? We started this show for weeks talking about the U.S.-Venezuela tensions ratcheting up, what's happening with the talks in Ukraine. And it does appear that the administration wants to shift that narrative.
Really something. It's a late speech, 9 p.m. Eastern time. And it's kind of interesting the way this is all going to pan out. And we're going to talk about this in just a moment here with Sarah Kristoff. But it's Epstein Day. The files are supposed to drop. We don't know when, right? But the DOJ has until midnight. So presumably the president could be on stage in North Carolina when this happens.
Right, and there seems to be an understanding that they may come later in the day to go up against
Friday news drop
against the deadline. And we did hear from the Deputy Attorney General Todd Blanche earlier, who said that there are so many files that ultimately have to come out. We probably aren't going to get them all today. And you know, you've been talking about this. There's no enforcement mechanism to make sure that they do all come out, though it did seem that the administration was indicating that they're going to. And of course, this comes after Congress overwhelmingly passed that bill last month, compelling the DOJ to release all of these items. We should say it requires the release of unclassified investigative records, flight logs, travel documents, immunity deals, internal department communications, and papers. The list is really long here, but of course it poses a political headwind for President Trump that he hasn't really been able to get ahead of, and that's been dominating the conversation over the summer, for example. So we'll see how that sort of pairs with him trying to talk about the issue at hand, which is the economy.
Well, it's pretty amazing to hear from Todd Blanche, Deputy Attorney General, telling Fox News that they will miss the deadline. We'll get hundreds of thousands today, but there will still be hundreds of thousands to be released. So they're not going to get this all done as mandated by law.
No, and one of the other questions here is, of course, how the DOJ is going to invoke some of those exceptions. We know that there's exceptions to protect survivors. There's also exceptions here that officials can withhold any information if it's related to an ongoing investigation, which could be complicated by the fact that President Trump did direct the DOJ to launch investigations into alleged ties between Epstein and prominent Democrats. So maybe that could also impact the amount of files that we ultimately end up getting. At this point, we just don't know. It's wait and see. But as you said, the Deputy Attorney General is saying that we will get, quote, several 100,000 documents today. It's going to take us a while to go through them.
No doubt. This is going to take the weekend. I suspect that headlines will be emerging throughout the weekend. Tyler, thank you so much. Bloomberg's Tyler Kendall helping to update us here in Washington. That sets the baseline for the hour. When the president speaks, we'll bring you to the White House for that news on drug pricing. And we're watching shares of all those pharmaceutical companies get a bit of a bid on this headline this morning. But we want to stick with the idea of the Epstein files being released, at least some of them today. Sarah Krisoff is partner at Cozen O'Connor and former federal prosecutor with the Southern District of New York and joins us now live on Bloomberg TV and radio. Sarah, it's great to have you back. I'm looking at the actual language in the law that President Trump signed into law. Quote, all unclassified records, documents, communications, and investigative materials related to Epstein in a searchable and downloadable format must be prepared by the end of the day. So is the administration about to break the law?
They're clearly not going to fully comply here. And I encourage everyone to actually just read this law. I mean, it only takes a few minutes. It's short. It's a couple pages. But it really helps you understand what Congress has mandated here and will help people evaluate whether or not the DOJ is compliant with what they are required to do.
So was this just a matter of not getting homework done on time, or would that have been impossible knowing that it is truly hundreds of thousands of documents we're talking about?
I mean, there's a couple things going on here, right? I mean, first of all, lawyers are not particularly known for their timeliness. So it is not infrequent that lawyers are later or running behind on a deadline. So that is sort of one thing that to consider here. The other thing is that the DOJ knows there's no real enforcement mechanism here. What is going to happen to them if they are not compliant with this or sort of timely with their obligations under this law? Not that much, probably. And so, did they make a good faith effort to get documents together in order to release them today? Maybe. It sounds like it. But it is a process. It's certainly to the DOJ's credit, it does take a lot of work to comb through these documents page by page to assess redactions. But they have an enormous workforce to get that done. So if they had wanted to get it done, they certainly could have.
Okay. With that said, there's a big question about enforcement or lack thereof. Ro Khanna was talking about this, the Democrat from California, one of the co-sponsors of the discharge petition, said that while the department would be breaking the law, as we've just established here, if it didn't meet the deadline, officials would be unlikely to be prosecuted during the current administration. They would likely be subject to prosecution in the future. So could Todd Blanche find himself in trouble in 3 years?
Yeah, it's certainly possible. I mean, there are some avenues for enforcement here apart from sort of criminal prosecution. There could the Congress could bring a civil case. Individuals could bring a civil case. There could be sort of formal complaints lodged against the DOJ, although those are likely not going anywhere. But there are sort of some processes that could be followed short of a criminal case. But there is this idea floating out there, an interesting idea that there could be some sort of criminal prosecution down the line, but that would require, clearly the DOJ is not going to bring charges against itself or its own representative. So that's going to be something that would happen down the line with a different administration and the DOJ run by different folks.
Well, when you consider this lack of enforcement, the political interests of the administration here and the idea that they can essentially redact anything they want, we might not see anything new today or ever, right?
Yeah, I mean, there are, I guess, there are other processes that Congress has to bring action against individuals that they think have violated the law, right? They have impeachment processes that they utilize. So, I mean, there are other avenues they use, but I mean, I think, you know, we have been waiting very patiently to see what is in these documents. Once we get them, it's going to take a long time to search them and parse them out. Although, you know, with in the current technological landscape, the processing of this type of information is much easier than it ever has been before. And you know, there's a lot to come in the next few weeks to see whether DOJ complies at least in part with the law.
When, assuming this does happen, when the files are released, then considering, Sarah, your experience in the legal field, what will you be looking for? Because you're going to have massive bands of journalists and lawyers digging through these files all weekend. Where do you start?
Yeah, I think some of the most interesting information is going to come in the FBI 302s, which are essentially reports that the agents prepare. So, for instance, if they're interviewing a witness or a person of interest, they are required under their regulations to prepare a report, a 302 regarding that interview. And so the 302s are probably the best starting place for anyone looking at this information to really get a sense of the scope of the investigation that has happened in years past.
Understood. With all of that said, it's entirely possible, if not likely, we're going to be seeing names that have not been invoked in this story yet. To what extent can individuals find out if they are in these files, if they may be prosecuted because they're in these files? How messy is this going to get?
Yeah, so it's a really interesting question because the law itself tells DOJ you cannot withhold information just because it is going to cause someone reputational or professional or personal harm, right? So imagine someone who has a close social relationship with Epstein, but no involvement in the sex trafficking part of Epstein's life. And so that person may be sort of impugned by the documents that are released, but really there is no basis to levy any criminal charges against that person. And that person was in fact like ignorant of the Epstein's involvement in the criminal activity. So those types of issues are really ones that we should consider and are important ones to think about, as particularly when we have, you know, a situation like this where we're releasing investigative files. And I think that sort of precise situation is the reason it is so unusual and to release investigative files.
We've only got a minute left, Sarah. This has been a fascinating conversation. Remember when Pam Bondi, the Attorney General, said she had the client list and it was on her desk? Of course, we now assume that was not the case. Is there a client list, or are we just digging through a lot of receipts here for the next many days?
Yeah, I don't think we're going to see anything like that. I mean, and I think if some sort of very delineated list was there, we would have known about it before this point, right? We had the years-long Epstein conversation and the Maxwell investigation. We would have seen it before. Right. We haven't seen it yet.
Well, I'm really glad you could come back to talk to us about it. Sarah Krisoff, we thank you for your experience and your insights in this conversation. When the files drop, you'll be hearing about it and reading about it right here at Bloomberg. We'll assemble our political panel next for their take on the politics around Epstein, next on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing right now. S&P 500 index very close to session highs on the S&P. Looking at an advance of 63 points right now at 68.38. That is a gain of 0.9%. Stocks are climbing on a record 7.1 trillion options day. The Dow up 324, up by about 0.7%. NASDAQ Composite Index up 275 now. That is a gain of 1.2%. The Russell 2000 Index of small cap shares higher by 1.1%. And the Bloomberg Mag 7 Index up now by 0.6%. 10-year 4.14%, with the 2-year 3.48%. Gold up $21 the ounce to $43.53. Spot gold up 0.5%. Silver up 2.9%. Silver now trading at $67.36. West Texas Intermediate crude oil 56.80 a barrel. WTI up by 1.2%. And Bitcoin now higher by 2%. Bitcoin at 87,292. Earnings news: Carnival Corp gave a better than expected profit outlook for next year and reinstated dividend payments, sending shares of the cruise line operator higher. Carnival Corp shares, they are advancing right now. We do have Carnival shares up by 8.5%. After earnings, KB Home shares down 8.4%. The home builder posted fiscal fourth quarter profit that missed analyst estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thanks. Not bad. Not a bad looking market here. VIX down to 15. Even Bitcoin is rising. We'll keep tabs on the markets for you here with another update from Mr. Pellet in about 20 minutes' time here on Bloomberg TV and radio. The entire city of Washington is holding its breath for the release of the Epstein files that we were just discussing in a great conversation. We learned a lot from Sarah Krisoff about the way this might work, knowing that the law not only mandates the release of these files today, but goes even further to call for all unclassified records, documents, communications, investigative materials to be made available and searchable and downloadable online. So when this happens, you're going to see scores of headlines come out probably today, but also over the course of the weekend. They're talking about hundreds of thousands of documents. The Deputy Attorney General, Todd Blanche, telling Fox News they're not going to get them all out today. That's how many, I guess, there are. They're not ready. We'll have hundreds of thousands more to be released in the days or weeks ahead, even though that would technically be violating the law that President Trump signed himself. We turn to our political panel for the political side of this story, having now covered the legal side. Bloomberg Politics contributor Jeannie Shanzano is with us, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. At her side, Lisa Camuso Miller, Republican strategist, Senior Vice President, Rock Solutions, former spokesperson for the RNC. So let's get into it, Jeannie. We talked about it for months and months. It ended up happening in a discharge petition. A vote was forced by a couple of lawmakers. It then gained critical mass, sailed through the Senate. The president had no choice but to sign it. But will we actually see the files today?
It's still unclear. There are so many loopholes in the bill, even though it was written fairly tightly. They include everything from any information on the victims to things about national security. And of course, as we've talked about, any ongoing investigation. So there's a lot of ways the DOJ could defend themselves by withholding information. Todd Blanche going on Fox News and saying, you know, we're going to do the best we can, but we don't know if we'll get all of them out, or it sounds like they're not going to. But I think left out of all of this, and this has been true from the beginning of this saga, are the victims, the 1,000 or more women who at that point were children in many cases, who were victimized by the most powerful men in the world. They have continued to be victimized by this process. And that is on both sides of the aisle. The Democrats' drip of information has re-victimized these victims, and some of them have talked about that. And it would be very nice if Washington would find a way to support these victims by letting them know what's coming out and when, so they are prepared for this onslaught. I think that is the most troubling aspect of this story.
Lisa, we've talked a lot today about the lack of enforcement here, and Todd Blanche is already making it pretty clear that they're going to violate the law by not getting everything out today. There's not much that can be done, but political pressure as opposed to legal pressure is a very different thing. The fact that we got to this point is due entirely to political pressure. If the White House, if the DOJ doesn't satisfy people, and you're hearing as much skepticism as I'm sure I am here. A lot of people don't think that they're going to be satisfied by the release today. What will be the political response?
You know, I don't know what the political response specifically will be, Joe, but I think the thing to watch most closely here, Jeannie makes a great point about all of those that have been impacted by this. And I think that the worst part of this is that they will relive this over and over again. Politically speaking, Joe, what really does an incredible amount of harm is to all of those vulnerable members of Congress who have no response to what is about to happen, because the White House has given almost no guidance to those members about what it is that's about to happen. So there is an intense and very strong unhappiness amongst elected officials out in those vulnerable districts, feeling very much without any preparation, any understanding of what is about to occur, and not having the right words to say when this information does become available. So it's going to be incredibly corrosive for hundreds of people that will be affected. But overall, there will be questions, there will be no answers, and it'll be a lot more confusion for an issue that really, really deserves to be settled and solved and resolved for so many.
Well, that sounds like a disappointment, Jeannie. Should people prepare to be disappointed?
I mean, the whole thing is incredibly sad, but I think there are heroes in this story. Number one, these victims who for decades have gone against the odds to report on the most horrendous things that can be done to a person and who kept after it. Of course, the congressmen and women who pushed against their own political, with their own political future at stake to get these released. And of course, also reporters like Julie K. Brown of the Miami Herald and so many others who have made sure that they were going to be on this case. And those reporters who are on a Friday night tonight waiting to see these releases so they can pour over them. I mean, so there are really good and positive aspects of this. And I would also include those people in MAGA and elsewhere who wouldn't let this rest. So, we see a lot of positive aspects of this, but I think the negative parts are so glaring, and they mostly have to do with elected officials and on both sides of the aisle who have not only committed these crimes, but turned a blind eye to others who did and have not been willing now to abide by law and get these out immediately and in the interests of these victims. So I think there's a positive, there's a negative, but I think the most important thing is that we remember the thousands of victims here who are reliving this as we wait for this to drop today.
Well, I appreciate you returning to that point, Jeannie. And I'm, as someone who worked in a former Republican speaker's office, Lisa, I'm curious your thoughts about the conversations that took place with Mike Johnson, knowing that there were so many members who wanted this. There were so many folks in the MAGA community who demanded it. It's partly why Donald Trump was looked at the way he was in the campaign, because they thought he would be the only one to actually do this. And the fact of the matter is Mike Johnson resisted this till the very end. It required a discharge petition to go around the Speaker's office and bring it to the floor. Then suddenly everybody was on board and it cruised right through the Senate, as I mentioned earlier. Nothing seems to get done without a discharge petition now, Lisa. Will Mike Johnson regret that decision?
It's really hard to tell, Joe. This speaker himself has been incredibly cooperative and has worked really hard to work in close tandem with the White House for a variety of reasons. It's very difficult for him because of the slim margin that he represents in the House on the Republican side to really get anything done without that kind of very close connection and very close coordination with the White House. But to me, my understanding is that there's been very little guidance, very little information shared from the administration into the Republican conference or any elected officials. The other cynicism I have here, Joe, is that it feels to me like this is going to be a lot of waiting and a lot of anticipating for something that ultimately will not reveal enough information for some actual stories to hit. And so maybe I am the cynic of Washington, D.C. today, but I don't expect this to be as explosive and explosionary, or whatever the word is that you use for this Epstein. I think that this will be the kind of thing that will be a great big buildup to a great big nothing when it all comes to be in the light of day. And not because there aren't people that are guilty, but the way that is revealed and the way that it's rolled out, that it becomes less of a story because of the way that it has been handled, to your original point that who knows how much will really be offered up today.
Spoken like someone who's been around Washington for a minute. Jeannie, the president's going to be on stage tonight. He's going to be in North Carolina, 9 p.m. Eastern time. If this is some kind of Friday night news dump, it'd be the ultimate Friday night news dump, I guess. And the later this goes, I guess later people are going to be up sorting through these files. Does he have to mention this? I mean, would you consider the dynamic of him in front of thousands of people when these headlines break?
Yeah, I mean, you're hard-pressed to imagine what he would say about it beyond what he's already said. And what he has already said has been pretty frustrating, again, for the victims. I mean, these victims asked to go to the White House when he signed the bill in recognition from the White House and the president that they were indeed victimized. Instead, he did it in the middle of the night. And then he politicized it, focusing on the Democrats who were perpetrators, and certainly there are enough of those. So I can't imagine he's going to say anything that will satisfy the people who have pushed for so long and so hard to get these out, that's going to satisfy them. I think what there is a concern about is that he's going to try to counter-program this by saying something outrageous or doing something outrageous. You know, you're hard-pressed to know, but it is quite a Friday night that he's speaking at 9 p.m. And at this point, it looks like we may not even get this document done until around that time.
Well, they could wait till he's off the stage, I suppose, too. And I can't imagine he's going to be gaggling with reporters after the fact. There aren't going to be any binders released today, it looks like, Lisa, but it could, in fact, take the weekend, to your point, for any real news to come out here. That could be confusing for some people as well. But as a communications expert in our last moment, I wonder, for the RNC, which you used to speak for, or the administration, do they need to have a deliberate response prepared for when this breaks?
You know, ordinarily, yes. That would be exactly what we would be doing and preparing. I'm reflecting on this week alone, Joe. The president himself said some pretty unpopular and unsympathetic things about a horrible, horrible tragedy that happened in California. And 2 days later, a very revealing report came through from Vanity Fair. So this administration is really good at dodging all of that kind of information over and over again.
Pretty amazing to see Susie Wiles tell Vanity Fair she's read the documents, Trump's name is in them, but there was no illegal activity. Jeannie Shanzano, Lisa Camuso-Miller, great panel. Thank you both for your insights as we wait for the files to drop. This is Bloomberg.
140 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing right now. The S&P 500 index holding very close to session highs as traders face the expiration of a record pile of options. Right now, the S&P up 59, on track for a winning week, barely after earlier losses. Right now, the S&P is up by 0.9%, 68.34. We've got the Dow up 300 points, up 0.6%. NASDAQ up 1.1%. The NASDAQ 100 index doing a little bit better, up 1.2%. Broad-based rally. Russell 2000 index up 0.9 right now. And the Bloomberg Mag 7 index pushing higher by 0.6%. The 10-year at 4.14%. Spot gold is up $14 the ounce, up 0.3%. 43.47 the ounce on gold. Silver pushing higher as well, up 2.5%, 67.07 right now for an ounce of silver. Bitcoin up by 1.6%. Bitcoin 86,930. BioMarin Pharmaceutical has agreed to buy Amicus Therapeutics for about $4.8 billion, helping the biotech company expand its portfolio of treatments for rare diseases. Shares of BioMarin up by 18.8% right now, and Amicus Therapeutics up now by 30.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thank you so much. On a triple witching Friday, I don't know if we should be scared here. This market looks pretty good. I guess retail's having some trouble. But as Charlie mentioned, broad-based rally and the week with some slight gains. But this is the largest ever expiration, $7.1 trillion, and a triple witching options expiration happening today. We wanted to extend the conversation on the markets before we're joined by our friend David Weston, just to spend a bit of time with Nora Melinda, Bloomberg Markets correspondent who's watching all of this occur. What's this going to mean for the end of the session here, Nora, with this many options expiring?
Well, we're certainly seeing a lot of green across the screen. I have certainly got my eye on information technology. We're seeing that leading the S&P 500 higher. But of course, we know we've been getting a lot of news in the tech space. And more importantly, today we got that TikTok news. We've been seeing shares of Oracle rising higher. I'm looking at shares of Oracle up more than 7% right now. And we know that TikTok is being bought by a group of buyers led by this company, Oracle. So you're certainly seeing a lot of a risk on sentiment right now being displayed in the market. Healthcare, of course, the second best performing sector right now.
Yeah, you know, it's pretty interesting reading analyst notes today about NVIDIA. Everybody's been upset about a potential bubble, suggesting that valuations are too rich in the AI space. But this is really remarkable. An analyst at Truist, William Stein, says semiconductor stocks remain cheap, upgrading NVIDIA today, hiking the price target to 275. Are we going to find that after all the fits that we had about AI at the end of this year, that a huge buying opportunity is being created?
Well, I'm looking at the NASDAQ 100 right now, on pace to end the year up about 21% so far this year. And when we think about a broader potential AI bubble, people are really just fixated on whether or not current market valuations in the tech space are enough to justify further returns as we think about the future and whether or not they're actually going to be able to see all the money being poured into the sector actually paying off. So that still remains at top of mind for a lot of investors when we think about speculative names. But you really are seeing the majority of these tech stocks still buoying the market higher, as we've seen in really recent years, Joe.
Really pretty remarkable. The idea of this broadening out, you know, Charlie was just talking about the Russell. We're looking at the RSP, the equal weight S&P 500. And we've seen us walk up to the line, this market walk up to the line of a so-called rotation or broadening rally, and then it kind of just goes back to the Mag 7. Is it really happening this time?
Well, we're certainly going to have to wait and see for that one. But I'm also looking at the Russell. If you look at the Russell on a year-to-date basis as we're heading into the end of the year, up about 14%. So it's interesting when you just flash back to last year and what expectations were heading into this year as we think about the Trump trade and expectations about his economic policies and how they would actually affect the market. There were some areas where, of course, expectations did fall short as we think about the broader trade war more globally and the impact that it's really had on the economy more broadly. But if you think about it on a broader scale, we still are seeing strength broadly across the broader market. As you're mentioning, the Russell, we're also looking at major indexes like the NASDAQ and S&P 500, double-digit returns across the board.
Just quickly, Nora, you mentioned the Trump trade, and I haven't heard anybody refer to that in months. Remember, that was the big story at the beginning of the year and when the president took office. And really interesting in our macro review column, Markets Live, Trump trades diminishing expectations. What is the Trump trade at this point? Is it AI and crypto, or is it more than that?
Well, if we look at that Markets Live story, they talk about 2026 seeing more modest expectations as we think about this quote-unquote Trump trade, which essentially was optimism on Trump bringing in economic policies that would actually benefit the economy and the broader market. But if we think about the fact that we've also been seeing President Trump putting a lot of pressure on Jerome Powell, the Fed chair, and wanting to bring in another Fed chair that has a more aggressive easing cycle, there are concerns about whether or not this could potentially backfire, especially as we think about this pushing up long-term rates here. If investors start essentially demanding higher yield to offset inflation risks down the line, what this could mean in terms of margins in the market more broadly and what this means for the bond market.
Really interesting, Nora. Thank you. It's always fun to spend some time with Nora Melinda with us from World Headquarters in New York, and we'll see what kind of numbers we're looking at the close. But markets are hanging in here right near our highs of the day with some exceptions. It's been a long time since we talked to our friend David Weston. You know, after Balance of Power, the late edition on a Friday, we all sit down with our popcorn and watch the latest edition of Wall Street Week, and this evening is a really important one. So we invited David to come back on and talk to us about it. Check this out. Not only is this Wall Street Week, but the 21st century so far. We're going to think some big thoughts this evening, and in advance, we get a chance to spend some time with the host of Bloomberg Wall Street Week. David, I hope you've been well. And before I ask you about what you have coming up tonight, because I don't even know how you catalog a quarter century here, I have a lot to learn from you still. I'm just wondering what your thoughts are and what you're hearing from analysts about this year that we're about to close on Wall Street. It has been a doozy, and you know how difficult the news cycle has been for investors with this Trump administration. We're still recovering in some ways from Liberation Day. How do we look back on this year?
You know, just listening to you talk about this, it did strike me that if you go back to last January and see what actually happened, it wasn't as bad as some people said it was going to be, and it wasn't as good as some people said it'd be. Remember, economists said we'd have runaway inflation and then we'd have a recession because of the tariffs. Didn't happen. On the other hand, President Trump and his followers said, boy, it's going to be just off to the races. It's going to be the best time ever for the economy. That didn't quite happen either. So I think it's ironic in a sense when you look back at it. It was a good year, without a doubt, but it wasn't as bad as some people feared, and it wasn't as good as some people hoped, I think.
Do you think the animal spirits we heard so much about show up next year?
Well, one of the concerns, right, those animal spirits and whether they really are in the cage or whether they we have some inflation kick back in. And some people are concerned about that. You see some of the big banks saying, well, let's be careful about the inflation. And some people on the Fed as well are saying we're not out of the woods yet. But at the same time, if you just look at what we've gone so far, it's so far so good, I think.
Interesting. That's really interesting to hear. And I know you're going to be looking at financial markets, but also a number of important themes that we deal with a lot here on Bloomberg in your end-of-year show: China, the broader economy, and U.S.-Europe relations. David, what do you have ready for us?
Yeah, as you say, we tried something a little bit different because it struck us it's not just the end of the year, it's the end of the first quarter century. And so much has happened. As you say, we take a look at the economy, we took a look at financial markets, we also took a look at tech because it was a big 25 years in tech as well as China. And we had some setups to sort of review where we were. Remember Y2K in the year 2000? We had a great financial crisis. We had a COVID epidemic. We had a lot going on. But we also got some great experts in. And when it comes to financial markets, which of course is a major focus of Bloomberg, we thought we couldn't do much better than Ray Dalio, founder of Bridgewater. Absolutely. And he took us through bubbles, the bubble we saw with tech back in 2000 and whether we're in a bubble now. But we also asked him, looking back at it, he might well have anticipated China would have a good time in the first 25 years, and by and large it has. It's really emerged. But I asked him, would you have expected the Gulf to do as well, Saudi Arabia, because now he has his office for his family office over in Abu Dhabi. And he took us back and said, look, there are basically three components for success, and this is what Ray had to say.
Basically, all you need is three things to happen to have a successful country. First, educate your children well so that they can be productive and earn incomes and that they're civil with each other. And then second, if they come out to a country where people can work well to be productive and that there are financial resources like the capital markets, to be able to be productive and everybody earn. And in other words, the basics, earn more than you spend and have more assets than liabilities. If you're financially sound and productive and civil with each other, that's key. And then stay out of wars. Stay out of internal conflicts, that when you have that internal conflict or an internal war of sorts or an international war, that's a problem.
So there you have Ray Dalio's prescription for how you have a successful country. By the way, after we got off the air, I said, Ray, that's sort of a good prescription for a marriage, too. You know, sort of stay out of wars, make sure you have more money than you're spending, and educate your children. But he basically said that explains to a lot of things. Now, unfortunately, we're having a little trouble staying out of wars, including one in Ukraine right now. And we certainly, I would say, and I think Ray would say, are not living with our means in the United States, given what the debt is. By the way, as I said, we looked at the economy and we brought Jason Furman in, and he said the biggest surprise in the first 25 years is if you told him we were going to borrow that much money, he would have said the interest rates would be sky high. And the fact is, it turned out we could borrow more than we thought we could and not drive the interest rates too high.
Don't let them hear you say that, David. They're listening here in Washington. I mean, earn more than you spend. That they should write that on the wall up in the House of Representatives. No.
Yo, that's one bipartisan issue. I mean, both Republicans and Democrats have basically said they'd rather spend more. Thank you very much. And I mean, you know this far better than I, Joe. This is your job, not my job. But you know, people like to get reelected, and it's not easy to get reelected by telling people they can't have stuff or they have to pay higher taxes.
Isn't that interesting? As we hear from the president, you know, he's back in North Carolina this evening, and this line that your kid doesn't need 37 pencils, or you can do fine with one. You don't have to buy your daughter 50 dolls. Yeah. She'll be okay with 2. You ever thought you'd hear a president speak like that after Jimmy Carter told us all to turn the heat down?
Well, it is fascinating, isn't it, Joe? I mean, he has, as he said earlier in your program, you know, he's gotten out a lot of jams before. But it is interesting to hear both that, saying you should put up with less goods, but also saying affordability is a hoax. I mean, that's really hard for most Americans to say. You're just imagining those problems and paying your bills and paying for your house. It's just an interesting political strategy to say, no, I know better than you do. The economy is A. How many pluses did he have to the A? A lot. And so
I think there were 5.
Yeah, you're just confused out there, all you voters. I mean, it may work. He's brought other things to pass that I never would have predicted. But boy, it's an interesting strategy.
Well, and as we've discussed, Joe Biden knows what that's all about. We talked for 4 years about telling people what they're feeling, and obviously that didn't work terribly well for him. I'm just consumed with this idea that you're pursuing tonight, David, of the highlights of the first quarter century. Remembering where we were in 2000, before the 9/11 attacks, we were largely living in an analog world. People were dialing up on a 28.8 modem. And when you fast forward to where we are now with this AI race and a technology that's evolving more quickly than we can seem to get our arms around it, what will the next 25 years look like?
Well, I think one thing everybody we talk to would agree, we don't know. I mean, we don't know where AI may take us. We know we're borrowing an awful lot of money, and we're investing a lot of money in it. But Craig Moffett, from Moffett and Nathanson, we talked to as well, and he took us back to what happened with fiber optics in the late 90s into the 2000s. Yeah. And a lot of people lost money on that. They way overbuilt fiber optics, the way some people now are saying maybe we're overbuilding data centers. But he said because of the overbuild, we got Netflix. We got some really profound changes because there was too much capacity to send data down fiber optic lines. And he saying that could well happen with AI. He said this is the biggest transformation he's ever seen in his life. And it's certainly uncertain what's going to happen. Probably some things will get sorted out that won't be very pleasant. But in building on this vast capacity, it's probably going to create things we could never even imagine.
I love your recent interview with Reed Hastings, which we carried here on Balance of Power. And I can remember talking to him many years ago, early 2000s, when we were all putting the DVDs in the mail and the red envelopes. The idea of streaming movies at that point, we thought could be a generation away, and now we take it for granted.
Yeah, absolutely, and it's transformed so much, and you're seeing it right now, actually, in the Paramount fight, right, with Netflix over the CNN. And the Warner Brothers Discovery thing. You're seeing it play out right now. It's fundamentally changed. By the way, our business, if we can call it that, Joe, the media business will never be the same again. I mean, it just won't. And by the way, one of the things that strikes me about that is it's people fighting over what was, not what is to be, because at the meantime, YouTube is basically the dominant media provider right now.
How true. But everybody wants that trophy called Warner Brothers. It's really something. I'd love to talk to you more about that. David, I missed this. Come back and see us more often. The great David Weston. Make sure you're watching or listening tonight, 6 p.m. Eastern Time, for an important end-of-year Wall Street week with our friend David Weston. I'll meet you back here 5 p.m. Eastern on the late edition of Balance of Power. Maybe the files will be out by then. This is Bloomberg.
is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Mics are hot, Carol. Mics are hot, just so you know.
All right, leaving the potty mouth outside the studio door. It happens. We work in news.
That's just a little preview for what we're talking about at about 4 o'clock Wall Street time. It makes you stronger, apparently.
Apparently it does. You're going to want to stick around. We'll have that during the close. Very good afternoon, everybody. Looks like we made it. It is Friday, finishing up the last full trading week of 2025, Christmas next week, then New Year's, and then we start off a new year. Having said that, it's an interesting day. Stocks up, bonds down.
Yeah, triple witching, in which derivatives contracts tied to stocks, index options, and futures mature, compelling traders to roll over existing positions or start new ones. So maybe we'll see a little volatility late in the session.
A lot of stuff going on. Citigroup estimating $7.1 trillion worth of notional open interest expire. So that can get you kind of seeing a lot of movement. It's a lot. As for us this hour, we're going to talk about U.S. rates. A bit of a review after a week of questionable economic data. Was it, what did they call it? Like Swiss cheese, lots of holes?
Oh, yeah, CPI, Swiss cheese. That was a Bloomberg. I like that.
I like
Bloomberg
it.
description.
It was a cool headline.
Yeah,
they had fun
cool.
in the newsroom on that one. Hey, also lots of Fed talk amid who will be the next Fed chair. We're thinking about that as well. So we're going to get into that with Mike McKee in a moment.
Yeah, also, the week that was in Washington, what some say is a White House that's struggling with its message. We did hear from the president this week trying to stay on message, and I think that's going to be a big theme of 2026 when you think about the midterms and the messages that Democrats and Republicans want to get to constituents.
Yeah, it's not just about the ballroom build-out or the Hall of Fame when it comes to presidential pictures. We'll talk about that. You know you're going to want to know more. Hey, also, speaking of reviews and what's going on, we're going to get a great take on kind of the year that was in robotics, what's to come. Ty Brady's back with us, chief technologist of robotics at Amazon, on the evolution of, yes, robotics and AI in the Amazon
yeah.
in the warehouse. 3, 2, 1, Amazon warehouse.
Soon we'll be replaced with robots. Hey, all that and more coming up over the next hour right here on Bloomberg
How do you
Business
know
Week
I'm not
Daily.
one?
First up, a check of the day's trade and top business stories. Here's Charlie Teller.
Thank you very much. And here's what's going on. We've got the Dow, the S&P, NASDAQ all advancing, triple witching. Yes, keep it locked in to Bloomberg Television and Radio to see how things shake out in that final hour, final few minutes of trading. Right now, though, we are looking at gains. The Dow, the S&P, NASDAQ all advancing. Let me toss in the NASDAQ 100 index, Russell 2000 index, and yes, the Bloomberg Mag 7 index. All green on my screens right now. I begin with the NASDAQ 100 index right now, up 1.2%. Tech shares are rallying. NASDAQ 100 higher. NASDAQ Composite up 1.1%. The S&P 500 index at 68.33, up 58 right now. A gain there of 0.9%. The Dow up 268 on the industrials, up by 0.6%. The 10-year 4.15% with a 2-year currently yielding 3.48%. Gold up 0.4%, 43.48 the ounce. West Texas Intermediate crude up 1.1%, 56.76 a barrel on WTI, and Bitcoin up now by 1.9%, 87,203 on Bitcoin. A rally in several tech names, lifting equities. Oracle shares right now up by 7.6%. TikTok's long-delayed plan to separate from Chinese parent ByteDance put in motion yesterday when the video sharing sensation said it's being bought by a group of buyers led by Oracle. By the way, ByteDance on track for profits of roughly $50 billion in 2025. Again, Oracle up 7.7%, all part of a broader tech rally. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, let's get right to it. Some economic news. Existing home sales in the U.S. barely rose in November. Recent moderation in price growth and mortgage rates motivated buyers at the margin. U.S. consumer sentiment rose in December by less than expected, remaining depressed amid lingering affordability concerns. I'm rushing because I want to get to Mike.
All right, let's get to Mike with thoughts on how it all may affect the direction of U.S. rates. Bloomberg TV and Radio international economics and policy correspondent Michael McKee. He's here.
I'll talk slowly.
Thank you.
Yeah,
He's not
please.
a robot yet.
No.
Is there a case building for higher versus lower rates?
No, but I wouldn't say there's a case building for higher rates at this point, but there's always the possibility because we don't know what's going to happen with inflation. And there was a big debate on social media and other things about the CPI report and whether there's a lot of people. I got a lot of messages from people today on Wall Street saying this is fraud. This is an effort to, to make things look better for the president. And
why are they saying
Is it, Mike?
No, it's not. There's a combination of things that came together. They've never had a situation before where they didn't have a month's worth of data. So they weren't able to give you a month-over-month change. So they had to do from September to November, but there's a missing number in there. And some of those numbers are not actual numbers where they go out and survey the price. Some of them are imputed based on the formulas they use, which is what they do with housing. And so they used a sort of standard rule in their playbook if you have a situation like that where you just repeat the number. And so basically it showed 0 for October, which pushed the numbers down for housing, and housing is a big part of CPI, so it made the whole CPI thing. And there's arguments about whether they should have just followed the rules.
Is that a technical term?
I don't know. Isn't there some point where they should make an estimate based on months in the past or something?
Here's the reason they two reasons they didn't. One is that they're very shorthanded.
Okay.
David Wilcox has a great piece on Bloomberg today about that, about how shorthanded the statistical agencies are. But the other is that if they change the way they have done the imputation in the past, then somebody could say, well, that's manipulation.
Okay.
And so they just decided to stick with what they were doing. And economists and people on Wall Street who follow this stuff, they know that we're going to have to get the December numbers.
I was just going to say, throw it out, wait for
throw it out
month.
and wait. Yeah.
Okay.
Get some clean data.
Okay.
Yeah.
Hey, listen, one thing I want to ask you about, Fed Bank of New York President John Williams said there's no urgency to cut interest rates again, given a recent unemployment and inflation data, reinforcing expectations for a pause after a string of recent reductions. Do investors, though, need to kind of take a moment and be aware that a lot of rate cuts might not be coming in 2026? I think there were expectations that they could, or it really is too soon to tell.
It's too soon to tell. The funny thing is we saw market rates go down yesterday after the CPI report came out, because they were thinking, oh, the Fed's going to be cutting rates more, but we did not see an increase in the odds of a January rate cut. And right now they're only at 21%. So somebody's figured this out, that it's not going to be as simple. And I wouldn't take it. John Williams is a very smart man, but I wouldn't take what he says as gospel at the moment. He'll change his mind if he needs to, because on January 9th, we get a full December jobs report. On January 13th, we get a full December CPI report. So they will have a much better picture of what's going on in the economy.
Okay, Mike, before we let you go, who's going to be the next Fed chair?
No pressure, Mike.
But Kevin Hassett's still the favorite on this one's Polymarket.
Well, it's funny because he's gone up and down.
Yeah.
He was up, then he was down, and Kevin Warsh was up, and now he's down, and Chris Waller making a late bid on the outside is like a horse race.
It actually really is.
And then I heard today that Rick Reeder is actually coming in,
5%.
going to Mar-a-Lago to do his interview with the president.
How do you make sense? Is this what normally happens?
No.
Like as we get close? Okay, forgive me, world, for using the word normal. But I mean, okay, so
any other questions, Gail?
I don't know, stupid normal. This is my Friday. So how do you read between the tea leaves?
I don't think you can. Okay. I've tried. The person who probably would be most amenable to the president in terms of interest rates would be Kevin Hassett. But then people who know Kevin say he might not be able to get that through the Fed. Kevin Warsh might do more to upset the Fed and to revamp the Fed and do things that Trump wants. And you might have someone like Rick Reeder, who was kind of unknown in this, where Chris Waller would be much more of a traditional Fed person, even if he's calling for lower rates.
What about Michelle Bowman? Her name came up
She seems to be off the list at this point. And
he mentioned her. He was asked about her yesterday.
He was pretty complimentary.
Well, he was complimentary, but I think the thing that we're hearing is that they like the job she's doing as the regulatory vice chair.
Right.
She's deregulating the banks, and that's what the administration wants.
Look. Well, yeah, go ahead.
Well, no. If you want to follow up, I want to ask something else.
On like the rates market side of this, and who the bond market would prefer, do we have any indication of that? Are they all safe bets according to the markets?
They're all not terrible bets, put it that way. The markets would probably prefer Chris Waller because they know he would follow sort of Fed protocol, and they could understand his logic and his thinking on things. They know that Kevin Warsh has experience at the Fed, but might want to upset some of the ways that they do business. And there is some worry about Kevin Hassett, as I mentioned, being too in the pocket of the president. Although, if you know how the Fed works, it wouldn't be easy for him to force through big rate cuts.
Mike, one of the things I think about a lot, and I think about after the great financial crisis, having Ben Bernanke as Fed chair, like sometimes we we do have the Fed chair we need at a certain moment, right? Or maybe that's just luck that we get that right person, or maybe there is some science to it or thought. But what's the Fed chair that we need in 2026? How do you think about who do we need to have in that position?
Well, I think you need a couple of the skills that Jay Powell has. One is that he's very unflappable. And whoever the Fed chair is, if they don't cut rates by 200 basis points in the first year, the president's going to be after them. You know he's going to come out and,
whoever it is,
and post on Truth Social about how terrible they are.
Nobody's pricing in 200 basis points of rate cuts.
Well, nobody is except for the man in the White House. So, you know, you've got to put up with that, be able to put up with that level of criticism. But the Fed has gotten much more individualized since the days of Alan Greenspan, who would walk into the room and say, okay, here's what we're going to do. And so it's somebody who can develop a consensus. And so you could have people dissent and say, well, that I would have done it differently, but not come out and say you've just totally destroyed the economy and the country. So that was a skill that Powell brought. As he was a lawyer, and worked in investment banking, and he has ability to bring people together.
And let's not forget, he was President Trump's choice.
Well, yes.
Is this the first time?
Yeah.
Is this a job that nobody, like, who would want this job? Like, you're not going to make everybody happy, and in fact, you're going to make probably the most important person in your world unhappy, because
I can name 4 people who want the job. But,
why though?
Well, if you're an economist, it's sort of the pinnacle. You're using all of your skills to help drive the economy in the one way that economists can do that, and it is a very, very important job. And a lot of people, certainly during the Greenspan years, called him the second most important person in the world to the President of the United States. So it has a lot of perceived power, and it has a lot of great responsibility. So it would be an honor.
I always think about that. Maybe we've already talked about this, but I do again go there that, you know, there are times people say things either on a campaign trail or maybe, you know, when talking about, you know, their possibility of taking over something like the Fed chair. There's things you'll say, and then you get into it and you realize either the importance of a position and what you say and do, how that impacts not just U.S. markets, but global markets. And I just do wonder if that's something that we should assume will happen here as well, despite whatever pressure. You can't have a president who's constantly saying, I don't like you out, I don't like you out. That would create incredible volatility, right?
Well, that's the Lisa Cook case before the Supreme Court coming up in January. If the president can fire somebody for no reason at all, then you would probably have that under an administration with somebody in charge like we have now. But no, you become sort of responsible for the economy. And I don't want to say they would say they're not responsible for the markets. If you lose money, that's your problem. But they are also responsible for making sure they don't do something that crashes the markets.
You mentioned the Supreme Court case in Lisa Cook's case, or Lisa Cook's case going to the Supreme Court. Does the outcome of that have any effect on what the president can do to the actual chairperson of the Federal Reserve?
Sure. If the court says you can fire somebody for no reason, then he can fire Jay Powell before Powell's term's up, or he can appoint somebody and then fire them if he doesn't like them, or anybody else.
I'm thinking more for the next chairperson of the Federal Reserve. Powell's on his way out. He's still Fed chair for a few more months, but if that is a real, if that could happen and if that becomes a real threat, then I would imagine the bond market reacts, and I would imagine the position becomes much more precarious.
Absolutely, and it's one of the reasons that the Fed and people in the markets would be very scared if the Supreme Court ruled against Lisa Cook, is that then you have this volatility and you don't know what the longer-term strategy is going to be, and you have somebody in there who might be taking actions or advocating a position to keep their job as opposed to whatever's best for the economy.
I want to think, we didn't really have a chance to kind of debunk maybe some of the things that the president said in his evening address this past week, but he did talk about the economy, he talked about inflation, money, liquidity that will be coming into the system, giving folks in the military money, which I think many would argue great, because there's a lot of military that come back and face a lot of issues. But I just do wonder about the president's policies and whether that's going to create more inflationary pressure, whether it's regulatory easing or just more money by tax breaks coming into the economy, that again is a big force on inflation in 2026.
Well, as they go into 2026, that's something that Fed officials have on their minds is, do we need to lower interest rates because we're going to get some fiscal stimulus? The amount isn't clear yet because there are limitations on no tax on tips and no tax on overtime that people don't figure in. And then what you get is, oh, well, people get a $2,000 tax refund. That's an average. So somebody at the higher end is going to get more, and people at the lower end who spend everything they've got won't be able to stimulate the economy as much.
Because the people at the higher end won't spend money.
Right. Then there's also the issue of, do they get the insurance subsidies put back in for Obamacare? Because if not, then everybody's got to spend all that money. But in general, there's a feeling we will get some fiscal stimulus. The military thing is kind of disingenuous because that money was already appropriated to give to the service members their housing allowance money.
Oh, seriously?
And so he just put a different name on it, and he'll put his name on the checks and say, I gave you a bonus, but it was already.
But is the amount,
anyway.
is the amount different than those service members would have gotten?
Well, I assume it is because it's around 1776, so they've just divided that up. But that money would have gone into the economy anyway.
Hey,
I see.
Among the president's comments, talking about the economy, what he inherited, where it is today, what he said about inflation, and so on and so forth, what do you think, to be fair, what wasn't correct? What, in your mind, as you listened to it and heard it, that you think, here's the reality?
Well, most of it was not correct. I mean, there was a lot of exaggeration and a lot of cherry picking of data. In almost every category, growth, unemployment, inflation, the numbers are worse today than they were on the day that he took office. But they're still not bad. That's the thing.
Yeah.
But he can't claim credit. He can't say there was a mess because Biden did not leave him with a mess. And he hasn't done anything that has significantly improved it to this point, which is why you see him and his officials saying, well, next year is going to be great.
One area where you could take a victory lap would be oil prices, and we're going to spend a good portion of our program
yeah,
talking
maybe
about that later. But just very briefly in 30 seconds, why maybe, and wouldn't that have a greater effect on the economy because more cash goes in consumers' pockets when prices gas goes down?
It has a greater effect, but what we're not getting necessarily is the business investment side of that. This happened in 2015 because prices are so low. We're not seeing more drilling.
There's no incentive.
We got drilling rig numbers out today, and they fell again. The number of rigs out there is lower, but because of technology,
right?
The wells they have, they're able to pump more out. And then you've got a lot of other countries adding oil now.
We're going to talk about this in our 240
Guyana.
block. A great story, the Bloomberg Big Take. Michael McKee, thank you so much. I think we're not going to see you for the rest of the year.
No, I'll see you in a year.
Okay.
No.
Merry Christmas, happy holidays. Bloomberg News, Mike McKee, of course. Hey, as we head to a break, President Trump getting ready to make some comments there from the White House.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We who got the Dow, the S&P, NASDAQ all advancing. The last stretch of a busy week for markets sees gains, and right now the S&P 500 index holding close to session highs. The S&P higher by 61 at 68.36. That is a gain now of just about 0.9%. Stocks are advancing on a record 7.1 trillion options day. Dow up 293 now, up 0.6%. NASDAQ up 270. That is a gain of 1.2%. The NASDAQ 100 index up 1.3%. Russell 2000 index of small cap shares up 0.8, and the Bloomberg Mag 7 index up 0.7%. The VIX just about 15.2 right now on the CBOE Volatility Index. We've got the 10-year yielding 4.15%, the 2-year 3.48%. Gold up $14 the ounce, 43.47, up by about 0.3%. And the West Texas Intermediate crude oil up 0.9 now, 56.64 a barrel. Bitcoin up 2.3%, 87,550 on Bitcoin. Cruise news, specifically earnings. Carnival Corp up 8.7% after earnings. Carnival gave a better-than-expected profit outlook for next year, and it reinstated dividend payments. That news sending shares higher. Also out with earnings, KB Home, the stock is down 8.1%. The home builder posted fiscal fourth quarter profit that missed analyst estimates. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovic. We are watching and monitoring the president there at the Roosevelt Room in the White House, making some comments. He's speaking to reporters at a drug pricing announcement. He mentioned Johnson & Johnson will be there next week. He also took questions and has talked about the gold card, if you will, the golden visas, if you will, or forgive me, no questions, but making a variety of statements. He's talking about the golden visas. Those are those basically pay $1 million and you can kind of get entry into the United States. And he says they've taken in $1.5 billion from them. And then, Tim, he's also talking about reiterating unemployment went up due to federal layoffs. And he says the government workforce will continue to be reduced. He also talked about 4.5% unemployment rate is an amazing number. So forgive me, making some comments there at the podium. We'll continue to monitor it. And if he does take questions from reporters, we will certainly share that with you.
Yeah, he also follows up on comments that he made on True Social earlier today, where he said 100% of our new jobs are in the private sector, and he could reduce unemployment to 2% overnight by just hiring people into the federal government. He made these comments on social media just in the last couple of hours.
All right, good to know. That's the backdrop. And this event is supposed to be about drugs and pharmaceuticals. We heard that from the White House spokesperson, Caroline Leavitt, earlier today. So again, we'll continue to monitor that. Certainly something that plays out in the business community and certainly in the market community. Hey, one of the things that we love to talk about, robotics, technology, automation. Bloomberg Weekend recently reported out that humanoid robots are coming as soon as they learn to fold clothes. Count me in.
Okay. Yeah, okay.
Why they wrote this, apparently the team attended a recent Silicon Valley summit, and there they saw small robots roaming and pouring lattes, while evangelists hailed new AI techniques as transformative. But full-size prototypes, they were pretty scarce.
Okay, I want to see what Ty Brady has to say about this. He's chief technologist at Amazon Robotics. Ty is also founding partner of Mass Robotics. It's a not-for-profit organization that's become the world's largest robotics innovation center and serves on a number of boards to promote STEM learning and advancement. Ty, good to have you back on the program. Happy holidays. I want to get to this idea of humanoid robots because it doesn't matter if a humanoid robot can fold laundry for a lot of the purposes that you have for Amazon. How are robots, apart from the Kiva robots, used right now in Amazon warehouses?
Well, thanks, Tim. Thanks for having me on, Carol. Nice to hear you as well. It's always a pleasure to be on the show and talk all things robotics and tech with you. Indeed, the age of physical AI is here. Amazon is building our physical AI systems to help better the customer experience, expanding our selection, lowering cost, fueling the faster delivery times that we know our customers love. But given your question, think of the very practical, everyday experience where we're doing this at a very high reliability and scaling this where we're shipping millions and millions of products every day here for the holiday season. It's really exciting to see. It's very real. It's very practical, and it's something that we're very proud of in what we're doing with our employees.
All right, we want to talk about this. You know we do, and we will. But I do want to pick your brains because I always feel like I learn so much, when you join us.
Bring it.
Is that so these humanoid robots? I mean, Elon's working on them. Other people are like, is it years away? What's your thought? Your expertise? You know this world.
I do know this world. I will tell you that we usually start with what problem are we trying to solve? What's the problem we're trying to solve? And once we figure out the problem, then we actually go to functions. What functions should the robotics, should the physical AI systems do, right? So from the functionality, should it fold laundry? Should it do your dishes? Then we derive form. And when you kind of get the cart ahead of the horse when you start with form first, and then see how can you apply this technology. And we don't do technology for technology's sake inside Amazon. What we do is we solve problems. We solve problems, everyday problems, at an incredible scale that actually advances the state of the art in robotics. Right? So if you wanted a robot to wash your dishes, well, congratulations, you have that. You don't necessarily need a humanoid form to wash your dishes. As a matter of fact, it'd be kind of comical to see a robot pick up the dish, pick up a sponge, put the soap on it, scrub the dish, and put it in the drying rack when you have this really practical robot in your kitchen today called the dishwasher, which is amazing and blends right into the woodwork. So we think about function first and then allow the form to follow.
Okay, so we want to talk specifics here about what's happening in the warehouses. Blue Jay and Illuna and more, your systems, Blue Jay Robotics, Illuna Agentic AI, delivery glasses, Amazon's warehouses. These are well known for robotics and the use of tech and AI. How does all of that continue to evolve and specifically impact productivity side by side with human workers?
Absolutely. Yeah, the word I want to use is supercharged. We're supercharging the world's largest fleet of robotics out there with AI, using AI systems to better the reasoning and to better assist our employees, right? We want to eliminate the menial, the mundane, and the repetitive through the use of robotics as a tool set for employees. And we're entering this era where foundation models are making our robots smarter, more affordable, more adaptable, more conversational, and really reshaping work as we know it, not just in e-commerce, but actually across industries and creating new kinds of jobs.
Ty, I'm jumping in because right now we're showing, for those who are watching on TV and YouTube and our streaming service, what looks like your special delivery glasses. As we continue to show this, just tell us what they're all about. They look like normal glasses, but what do they enable a driver to do more easily?
Yeah, well, it's the fundamental principle that we have is to use them as a tool set. So allow the driver to understand where the delivery should be. Allow them to be kind of hands-free in order to take the picture of the package at your door. Allow them to understand what's the best route to the customer's door. Allow them to see their delivery notes of where they should place the delivery at the right spot. That's just right for our customer. I mean, we're customer obsessed. So any tool that we can give our delivery employees or our frontline employees, that's how we want to use technology.
Are they rolled out?
I think that we're still in the early stages of deployment.
So when would they be fully rolled out across the network?
Hard to tell.
Would it be within a year, maybe within 2026?
Yeah, we are a pretty, once we get to the alpha and beta deployment, it's typically within about a year that you'll see this starting to roll out. And we take a very measured approach when things roll out. We test it, we make sure it's great for our employees. Does it add value for our employees? Does it create a safer environment for our employees? And then we'll test that at a smaller scale. And then we go into the millions and millions of scale.
Hey, I want to go back to Blue Jay and Illuna. Tim brought up Blue Jay, your next generation robotic systems. And Illuna is an agentic AI system. So talk to us about that. How much are they deployed today across your fulfillment network? And I'm curious about milestones that we should all be watching out for in the next 12 to 24 months, Ty.
Sure. So at Luna, we're actually using kind of in a monitor-only manner right now during peak. Right, we actually just went through the peak of peaks where we have our largest outbound happening just actually yesterday. And what Illuna does is it gives operators a complete real-time view to help guide their every move. Right. So think of many dashboards now can be consolidated into human consumable text, human consumable recommendations of how to actually deploy the network and how to deploy various robotics inside that building in a way that it gains these more efficiencies. So we're seeing that. That is rolling out today. And then we're really excited about Blue Jay as well. You can think of this really for our same-day network. That's a growing network that they have inside of Amazon, where we're getting the goods right to the customer's door in a matter of hours. What Blue Jay does is it really indexes on a smaller footprint. You can think of this as three assembly lines kind of combined into one, where we have robotic arms picking orders for our customers out of our containerized storage systems and allowing those to be delivered right to the customer's door. That's really an exciting time.
So if we think about this time right now, the holiday peak, where people are trying to get stuff as quick as possible, specifically, where does the tech that you just outlined have the biggest impact? Is it smoothing labor variability, preventing bottlenecks? Does it improve on-time delivery metrics? Is it all of the above? Is it something I didn't even mention?
Yeah, it is all the above. Plus, what it's allowing us to do is really exception handling, right? When we think about robotics, and you think robotics and physical AI at scale, when you ship millions and millions every day, just 1% of exception handling can kind of eat your lunch. So any tools that we have to help us with the exception handling, maybe one of the systems is not picking up a particular object right. So that learning needs to be propagated through our other manipulation systems. Or maybe a mobility system is having some bottlenecks because of the way the inventory is stored inside of the building. People have really good skills of critical reasoning and critical thinking and using common sense. So tools that allow them to understand the situation better, perceive their environment better through the use of robotics, and then have truly physical agents to help with that in concert with our employees is going to allow us to deal with all the exceptions that we see, every day, especially at peak.
Hey, Ty, just got about a minute left here, and I know we've talked about this with you before, and I think it's a fair question. You guys have addressed it about the impact on your workforce, and I wonder if it's smarter to think about maybe not that what you guys are doing in terms of automation, or other companies for that matter, that it means doing away with workers, but maybe it means that you will have to hire fewer workers in the future. Is that fair?
Well, first of all, Carol, any question you ask is fair. So I think it is fair to always ask those questions, and we should always kind of, have the mindset of people first, and which we do inside of Amazon. So what are we doing specifically for our employees? And I'm really proud of this. We're building better machines for them. We're listening to them. We're iterating on our designs. We're rolling out a tool set for them to use that every day at scale. A scale that's almost unimaginable when it comes to what we've done inside of robotics. We're upskilling them. We have a $2.5 billion pledge that we call Future Ready to prepare 50 million people for how technology will impact and change not only the nature of work, but also what their everyday lives. And we're also creating a safer environment with our robotics, eliminating the repetitive, the menial, the mundane, allowing machines to do the heavy lifting and the repetitive actions, and allowing people to work with them in order to use this beautiful thing here.
So net,
He's pointing to his head, everybody.
I'm going to read that as that you'll be hiring more in the future. But we'll continue this, certainly in 2026. Happy holidays, Happy New Year. Love talking, certainly, with Ty. He's Ty Brady, Chief Technologist at Amazon Robotics. As we head to a break, President Trump speaking in the Roosevelt Room at the White House, talking about drug pricing. We'll continue.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Just getting word that the Epstein documents are expected around 3 p.m. That word from CBS. The Dow, the S&P, NASDAQ all pushing higher. Stocks are climbing on a record 7.1 trillion options day. S&P right now holding close to session highs. We're up 61 right now, 68.35. Gain there of 0.9%. We are, by the way, wrapping up the last full trading week of 2025. Dow Industrial is up 285, up 0.6%. NASDAQ doing a little bit better, up by 1.2% now. NASDAQ 100 index up by 1.3%. The Russell 2000 index of small cap shares also higher, up by about 0.8%. And the Bloomberg Mag 7 index up 0.7%. Dow Transports this Friday, they're down, lower little change, but the transport's down by about 0.1%. 10-year 4.14% with a 2-year 3.48%. Gold is up $14 the ounce, 43.47, now up by about 0.3%. West Texas Intermediate crude oil up 0.9%. WTI 56.66 a barrel. And Bitcoin up 2.6%, 87,770 on Bitcoin. Marin Pharmaceuticals has agreed to buy Amicus Therapeutics for about $4.8 billion, helping the biotech company expand its portfolio of treatments for rare diseases. Shares of both companies are advancing, with Marin up now by 20%, and shares of Amicus Therapeutics are surging by 30.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, almost every day an oil tanker arrives off the coast of Guyana to pick up a cargo that could reach a buyer practically anywhere on the planet. The stream of shipments is all the more remarkable because, Tim, just a few years ago, the country did not pump a single barrel of oil.
It was a really big deal.
Yeah.
They found it there. On the other side of the globe, at ports in the UAE, which has been exporting since the 1960s, there's also a constant flow of vessels pulling into load oil. OPEC's third largest producer sent the most crude overseas in years last month. Together, the two countries offer some of the clearest signs of an oil market facing a major glut. So writes our Bloomberg News team in today's Bloomberg Big Take. Here to talk about it is Bloomberg News managing editor for Energy and Commodities America, Simon Casey, joins us here in the Bloomberg Business Week studio. I just want to start with this basic question. When I was in college in the early 2000s, there was this theory that had emerged, which was like kind of peak oil. We are going to run out of oil, and the world needs to prepare for that.
That's right.
Was it just fracking that we learned, or different extraction methods? What turned that theory on its head?
Technology, fracking's part of that for sure, absolutely. Particularly here in the United States, totally turned around the fortunes of the United States oil industry, and you could argue the U.S. economy. But also, oil companies got good at extracting oil far, far below the sea. You know, at deep out, drilling miles beneath beneath the sea, beneath the ocean, in a way that was, unforeseeable. So we no longer talk about peak oil production. It's not a thing. We talk about peak demand, maybe, but that's some way off as well. We talked about that briefly during the pandemic. Both are growing right now.
All right, so what does that mean that, prices are already down in terms of oil prices this year. Do they continue to go down?
That's the consensus. I mean, getting into the price prediction game is a bit tricky, and I never want to go there. But look, when you look at where we are at the moment right now, I think Brent is around $60 a barrel. It began the year around 80. As our story today says, people are talking about prices in the 50s next year, possibly even low. We could see that, and it could go down there.
Great for when we're filling up our cars at the gas station.
Still feels a little pricey when I fill
Does it?
A little bit.
You got to go to the not fancy gas stations. But compared to where we've been in the past few years, I mean, this is so much lower.
That's true.
So it puts more money in consumers' pockets. That's stimulative to the economy. But we were speaking with Michael McKee a little earlier, and he made the point that it also, but the challenge, though, is what it does for drillers and what it does for oil exploration in an economy where the president politically wants to drill, baby, drill.
Yeah, he was backed by the oil industry in his election campaign pretty heavily, pretty prominently. They want to have greater freedom to drill where they want, when they want, without too much regulation in their arguments. And there's a wall of oil coming to the market, but it's not just coming from the United States, it's coming from OPEC as well. And that's a bit of a problem for companies here in the US. Now, they've got a lot more efficient, particularly here again in the United States, since the pandemic, since the nadir of the market. When you remember, we had negative prices at one stage, we had people going bankrupt. They've done a very good job of getting their costs right down, producing more from each well. So their break-even costs have gone down. But when you're talking about prices in the 50s, you're not far off break-even prices for a lot of producers here in the US. And there are some producers on the high-cost side who are going to struggle.
Okay, so what are break-even prices? Like, what is the cost of extraction?
It's a great question. It's always really difficult to answer. But if you're looking at the Permian Basin down in Texas and New Mexico, which is the biggest oil patch in the United States, probably around somewhere like $40 to $50 on average. For the Exxons and Chevrons of the world, they can live with prices below $50. Once you start to get to $40 and below, even they are going to have to make some tough decisions.
So, I mean, one of the things I think about a lot is what oil has done in making power brokers in the world, geopolitically or just economically. I was looking at, I think, Bloomberg says U.S., Saudi Arabia, and Russia are, I think, the top producers in terms of oil. Canada and Iraq are also significant producers. But I do wonder, with this oversupply, how does that change the dynamics of that power structure?
Well, the US has made this big comeback. So with the fracking revolution, the US went from a net importer.
That's a big deal, right?
It's a big deal.
Yeah.
I mean, it really is a foreign sort of policy tool that wasn't really there like a generation ago. And you can see that now with the Trump administration. It's not just oil, but remember gas as well. They talk about exporting LNG and how that changes the relationship with Europe. Europe is much more reliant on American energy than it used to be. So it's a positive for the United States. Look, Saudi Arabia is the power that it is because it's the next biggest oil producer. It produces oil far more cheaply than anyone else. Its costs are way, way lower than what I was
Meaning
just
the
saying.
cost of extraction.
Cost of extraction,
So
yes.
how low could...
I mean, that's a closely guarded secret, but smarter people than me estimate that it's in the single digits.
Wow.
Well, and the IMF says they effectively, Saudi Arabia needs a crude prices close to $90 a barrel.
That's the issue, yeah.
Right? And it's nearing its highest ever annual level of debt issuance this year. I mean, this is a change of fortunes.
They produce oil very profitably, and yet fiscally they're in a bit of a sticky situation. They're having to issue, I think, a record amount of debt this year to make things work for them.
But where does OPEC Plus come into this? Because OPEC Plus could tighten the spigot a little bit.
They could
reduce supply,
and maybe they will. Look, they've been steadily increasing,
and that would bring prices up.
It would, but then it's they're a group. They have to find consensus. What's been going on this year, in large part, is a grab for market share, and this is one of the big games going on behind the scenes. Is U.S. shale has been tremendously successful, especially post-pandemic. Yeah. They've steadily expanded, not in a reckless way, I think, compared to previous cycles. But as OPEC had pulled back, the U.S. shale had got more of the world's share, a bigger share of global supply. And the Saudis wanted to take back some of that share. That's what they've been doing. They have all this idle capacity. They wanted to get it back. But I mean, yes, if prices continue sliding, if the global economy shows signs of weakness, maybe they'll have to take the opposite tack to what they've done this year.
What do you think is the net takeaway of this story and the oversupply? I mean, quite a change from where we were. I grew up in the 70s, and I remember, the license plates, odd evens, and who could go to the gas station. So I'm just wondering the net takeaway of what this all means.
There is plenty of supply, and look, the outlook for prices next year are pretty bearish, and it's going to take something truly extraordinary to change that. And you can never rule out price shocks, because what did we see in 2022? We saw a major war, Russia, Ukraine, and that changed things completely overnight, and prices went above $100 a barrel. So, God forbid something like that happens again. But that is that's the main takeaway from the story. There's plenty of supply next year, and it's unlikely to change in the short to medium term.
Simon Casey, managing editor for Energy and Commodities America for Bloomberg News, in our studio with us. Check out the big take. The world is awash with oil and prices are poised to keep falling.
It's a great deep dive there. Hey, folks, we're coming back looking at stocks on the move. In the meantime, as we head to a break, once again, we take you to the nation's capital, the White House, the Roosevelt Room. We are now various members talking about drug price.
You're listening to Bloomberg Business Week Daily with Carol Masser and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody, we are coming up on the last hour of trading as we get ready to wrap up the trading week. We're a little excited because you know why?
Why are you excited?
We're off next week.
I didn't know.
Can we say that?
You know what? Working makes me excited, Carol.
I love working.
I don't want to be off.
Oh, come on.
Is this thing on?
Okay, I love working too, but I also like taking a break every once in a while. I like being with my family too.
Hey, just a little preview of what we have coming up in the next hour. Some fun stuff.
It's all business.
Yeah, fun stuff.
All right, we do have some fun stuff. Wow.
Yeah, we're going to be joined by the CEO of Lofted Spirits. We're going to talk the high-end alcohol business.
No, you know what's really cool?
And it's like perfect before so many people are going and spending time with, their families
We're going
for the holidays.
Hopefully drink some whiskey.
Not that like drinking is what you want to do when you're with your family, but you know what I mean.
We're going to drink whiskey with David Weston.
I know.
That's what's cool.
That's pretty cool.
That's my Christmas gift. Like, that's kind of fun. David always teases us that we have these guests on, alcohol guests, and he's like, wait. So now we're inviting him to the party.
Okay, before that, a little business, Carol.
Yes.
The S&P 500 up 0.9%. The NASDAQ Composite up 1.2%. In the S&P 500, in terms of what's moving, only utilities and consumer staples are in the red today. Information technology surging along with healthcare.
And we should point out we are continuing to monitor an event at the White House.
Speaking of healthcare.
Yes, and it's supposed to be, they're talking about pharmaceutical pricing, and so all of this, Johnson & Johnson is expected to be at the the White House next week. So anyway, we're monitoring those headlines as well. That is a live shot. Various members of the president's team and others there as they are making a drug pricing announcement. We're looking for a little bit more details on that. The president did say that the 3 pharmaceutical companies that still need to offer pricing concessions with the United States to avoid tariffs have also agreed to a deal and are coming in at a different time next week. So again, monitoring that for you. A day where we are seeing a rally in stocks in a big way.
I'm Tim Stenevec along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg News cross-asset reporter Emily Griffeo. She joins us here in the studio. Everything in the green? Is that what you have today?
I don't have everything in the green, but we can start with a stock that is up, Tim. Oracle, ticker ORCL. It's up about 7%. It's still down 15% on the month, but we did recently get news that TikTok is said it's being bought by a group of buyers led by the software company Oracle. And the TikTok CEO told employees that ByteDance, their parent company, signed binding agreements to create a joint venture majority owned by American investors, including Oracle. This is according to an internal memo reviewed by Bloomberg. The kind of question mark here is whether Chinese regulators will approve the transaction.